Performance of BOCOM, and so that certainly weighed on their performance through the Hong Kong session. UBS on the other side of the ledger, though, coming through with numbers that seem better than had been anticipated. On the luxury sector, Hermes seems to be the standout performer to the upside there, or the one that's telling the best story. We had something more disappointing coming out of Kering. And autos, we're watching Mercedes, but we've also had some guidance from others in the sector as well, Guy.
So does that all net itself out? Do we see, therefore, little movement when it comes to the market open? I think that probably is what we're looking at here. You're not going to see much volatility at an index level, potentially going to see some volatility at a single stock level. And that certainly is the early trade. But we do have a lot of banks reporting out of Spain. That is where we see some losses coming through this morning. So that market is down by around 0.4%. We'll see what Caixa does this morning. We'll see what Santander does this morning. We'll get to the single stocks in just a moment. But at the moment, the stocks 600 absolutely becalmed, as is the FTSE 100, despite what we're seeing with HSBC and names like BAE Systems, which are out with numbers as well. We'll wait and see what the CAC does as well. We're focused very much on the luxury story there. We had Kering last night. We've got Hermes out with numbers as well this morning. We're going to be talking to Capgemini a little bit later on. But no action there, and I suspect we may have to wait a little bit this morning to see exactly how the DAX opens. But the early indications are, at least at an index level, not much to see here, but below the surface, feels like there could be a lot of churn, Chrissy.
Quite a bit of churn. I feel like we should just go straight to some of those individual movers that you had named, because interestingly, we're seeing Santander's right now one of your biggest weights on the stock 600, down about 1.5% there. Remember, their earnings came in slightly lower than expected. They came in line, but their net interest income came slightly lower than expected. So some weakness there that the market is not a fan of. Hermes is also underperforming, despite those earnings coming in fairly strong this morning. So that is not necessarily good news for this market. But from a sector perspective, I'm seeing a lot of them. Yesterday's losers kind of be your outperformers today. Novo Nordisk, for example, is your biggest index weight to the upside, which, of course, we know was one of the biggest losers in yesterday's trade. Yeah, it's interesting. It does seem as if the picture we're getting with 2/3 of sectors to the downside, or maybe even 3/4 of sectors to the downside, that looks a little more negative than maybe the futures picture had us believing at the start of today. Financial services, one of the worst performing sectors, and UBS is a feature there, down by 1%. So despite the fact that there were positives in those numbers, that's a weight. But Aberdeen Group is more negative than that. Basic Resources, also a weight on the London market. Rio Tinto, you went through the numbers there, Chrissy, and that stock down by 1.4%. So on balance, this is a slightly more negative open, perhaps, than we'd been anticipating.
It's interesting. I wonder if Hermes is down because they can't tell us much in terms of the hit. It was really interesting. Some of the companies that are reporting numbers that aren't being specific about what they think the hit is going to be from tariffs are not being rewarded for that ambiguity. And I wonder whether Hermes is basically saying, we don't know yet, is a negative at this point. If you don't know yet, why am I going to invest in you? I can invest in another stock. I can put money to work in companies that do know.
Yes, and it seems as if the market, so often we'll say, you know, the numbers backward looking aren't interesting, it's the guidance and the outlook, and that is always and often the case. But Logitech is an interesting case in point, because that stock is up by just over 2%, and here's a business that has been telling people it can keep its prices higher, it can push its prices higher as a result of the tariffs, it can counter the tariffs that way, and that story seems to be going down pretty well with markets, and that stock is up this morning on a day where it seems difficult to impress.
So is Kering. So Kering is also up this morning.
Well, and that was the thing I was saying earlier about how these big drops in sales were actually in line with expectations. Yeah. So I suppose some of that was in the price already, and saying they can cope with the tariffs.
Precisely. They've come out and said, we can cope with this. We know, we think we can deal with this. And at this point, we don't actually know whether or not there are going to be carve-outs for this sector.
Yeah.
It's looking unlikely, judging by what the US commentary is at the moment. But at least they're being reasonably specific in terms of what they are saying. Adidas is getting hit hard, though.
Getting hit hard despite, again, positive numbers on the sales front. So that was interesting. Sticking with the German sector, though, Mercedes is flat right now, marginally in the positive territory, higher by, we'll call it 0.1%. I'm being generous. But the fact that it's not taking a bigger hit after those profit warnings is surprising. So again, to your point, maybe clarity is the trick. Let's get another perspective here. Maximilian Uller, European equity and cross-asset strategy head over at Deutsche Bank Research, joins us from Frankfurt. Max, pleasure to have you on the program. Let's test that theory that we were just discussing with you. Is that the trick to success from European corporate earnings, actually giving a tariff hit or a tariff number in terms of how much money they're going to lose, how much margin compression, as opposed to not giving any clarity at all? What's the winning formula?
You're completely right. So guidance, first of all, good morning. The winning formula is guidance improvement and also guidance clarity. I completely agree, right? If you look at the stock reactions this earnings season, then you see that any comment on guidance uplift has been rewarded extremely, and guidance cuts, obviously, a lot more down for the equities than any beats or misses on earnings. So the focus is clearly on guidance, and I would say, you know, those companies have had a hard time until Sunday, so maybe they've just not been yet ready to kind of make those statements. But going forward, I think guidance should be improving, because the lower case in that range, you know, of having potentially 20-30% tariffs, which was in the cards just a couple of days ago, that's now gone. So even if you keep your guidance, the top line or the upper end of your guidance the same, you probably have an improvement in the overall guidance, which we think will be supportive for markets overall.
In terms of that supported for markets overall, we're now getting headlines that there may be carve-outs, or at least a push for carve-outs, maybe some questions about whether Europeans can actually deliver on those investment promises that were early on agreed. Does that affect at all the market narrative that is perhaps pricing in now, that 15% level?
Yeah, so we haven't yet seen those investments really. They're still to come. The 15% tariff, we think, is more than priced in and more than reflected in earnings expectations. So earnings expectations have come down since the US presidential elections by 10% for full year expectations in Europe. So massive revisions. And our take is that if we are at such levels, we should be seeing something like a 4% hit to European earnings. So our view is that those negative implications for earnings at a level of 15% are more than priced in. Obviously, then depends on the industry. You've been mentioning some of the auto companies earlier. Here, we think the positive implication should be something like 3 billion for full year 2025, so pretty positive, moving tariffs from 27 to now 15. So that should be pretty positive for the sector. However, you know, that's just one of many troubles that industry has. So if you look at earnings revisions for autos, they've been coming down 50% year to date. So massive hit to earnings, and that's not just because of tariffs, right? There's competition in the US, competition in China, lots of unclarity about the trends in EVs. So that's good news, but it's not enough yet to really push that sector higher, we think.
Max, good morning. So broadly speaking, given that we have some certainty, at least around the tariff rate, even if we're not sure exactly what it applies to, but 15% for Europe and the US, you've been through what impact that does to profitability for European corporates. So do you still feel comfortable leaning into a strong story for European stocks versus, say, US stocks? Or has your thinking changed a bit based on that trade deal?
Yeah, so let's start with the directional upside, and I think the directional case is pretty clear. 2 months ago, we turned neutral, saying there's so many things we don't have clarity on. The beautiful bill, right? By now we have it. We talk about earnings. I think the earnings picture is actually quite good. We've been looking at for more clarity in German fiscal. Now we know that the German fiscal is front-loaded, and they'll be spending more than we expected until the end of this decade. So positive. Plus, very big unknown, tariffs, also now known. We know now we have 15%, reducing the uncertainty. Plus, US and Europe, and I'll get to your question in a second, both positive economic surprises, plus favorable financial conditions. And obviously lower tariffs and more certainty on tariffs is good for both regions. So longer term, I'm still wearing my blue hat. I still think Mega is the place to be over kind of the next 12 months. Tactically, especially with US tech companies coming out, we think they should be moving in the same directions because they actually have the same drivers right now. And maybe going back a little bit to the question on Germany, we now have clarity, but we don't yet have any spending of the German government of that money, and that will come later this year. So up until we really have that impulse into order books, I think there's no reason to believe that Europe is short-term outperforming US equities.
Yeah. And are the positives already in the market for the defence sector, Max? We've had numbers out from BAE this morning raising their guidance. You talked there about the German fiscal spend. Do you think this sector has much further to run? How close to the top are we?
I think we are at the top. If you're a top-down person like I am, right, you were surprised by how much Germany is spending. You were surprised by the NATO announcement now saying 3.5% plus 1.5% on infrastructure, which is almost a tripling of the levels we were at only 5 years ago. So massive impulse, and that is, we think, more than reflected in what happened in the sector. So we have a basket of defense companies that can focus on defense, and their PE moved up from 17 to 37 year to date. So, from a top-down perspective, I'm wondering what's the next news that could really prop those names in that sector up even further. So we think, from a top-down perspective, that story is over for now. We don't see the next big impulse. And what you can do, of course, is look for stocks that particularly benefit from some of the underlying trends. But top-down, I would say the defense story is over for now.
Max, morning. Are you comfortable with multiples where they are right now? 22.5 over in the United States, long-term average 18. You put the S&P on 18 with current trailing EPS, you get somewhere in the kind of 4,000s. Are you comfortable with 22.5? Are you happy to chase a market at 22.5?
Yeah, again, technically, yes. I think that the trends that we currently see, they overrule any multiple discussions. Those multiples that you're mentioning, they are because of what we are seeing in US tech. And if they again manage to deliver earnings growth of 20+%, and we'll know today and tomorrow, then why not let them have that high multiple? So we had multiples starting at similar levels earlier this year. They then dropped because of tech. They now been moving up and above where we were beginning of the year purely because of tech. And if tech delivers, I think people will not be looking too closely at multiples. In Europe, you don't even have that discussion, right? Because multiples in Europe are still not expensive. And now, I said technically I would be neutral US versus Europe. If you now look further out, I'm still wearing that blue hat because the divergence in PEs is just massive.
But just going back to the tech story, does anything else matter? Is this a market that is purely driven by tech? Do I need to worry about what is happening with tariffs? Do I care about the Fed? Do I care about anything other than big tech? And big tech continuing to drive this AI bus higher and higher and higher. Well, sure, you drive a bus higher and higher and higher, but let's take the bus higher and higher and higher. Is that all that counts at the moment? Because that is where the multiple story is, as you say.
Yeah, unfortunately, I think today and tomorrow, very little people will be interested in what the Fed is going to do unless they do something very unexpected. And everybody will be looking what the Microsoft, Meta, and tomorrow Apple and Amazon is going to do. So unfortunately, from a macro perspective, that's the new macro variable that we have to be looking at. They are making up the biggest share of S&P earnings. So yes, there's a reason why they're so important, because they're so big. So yes, AI is the driving force. And if you look at performance, again, it's all about tech, right? The rest of the US market is actually not doing so well over the last couple of months.
Yeah, I think it's planes that go higher and higher. Airbuses, maybe that's where the connection is. Max, nice to see you. Maximilian Julia, European Equity and Cross-Asset Strategist, head over at Deutsche Bank Research. Thank you very much indeed. Let's take a look at the Core 6. This is what we're watching here in Europe. There's a bunch of interesting narratives there. It's interesting to see that LVMH is tracking a little bit higher, but elsewhere we're seeing weakness pretty much across the board. Nestle's fairly flat. That tech trade is fairly flat going into those big numbers. The story yesterday was actually on the right-hand side of the left-hand side of the screen there. Novo took a massive hit yesterday. We haven't really talked about that yet. And what I think is interesting this morning is you are not seeing a bounce on the back of that. In fact, you are continuing to see that trend taking Novo stock a little bit lower after the warning that was delivered. So we're not seeing a bounce in Novo, which I think is worth noting as well. What else are we watching this morning? Let's find out. Chloe Mellet is here with the details.
Good morning, Guy. Let's start with consumer goods company Danone, which is up more than 6% this morning. So the sales beat expectations, and there was volume recovery across all of its categories, and especially in the high protein products. So it's benefiting from that protein trend at the moment, and it is up 6% this morning. Moving on to the luxury space. So we have both Kering and Hermes. So Kering is actually up this morning. Its sales were way down, major drop in sales, but crucially they were in line with expectations. So it's getting rewarded this morning. There's kind of enthusiasm about that ongoing turnaround. However, Hermes is down 2.7% this morning. The numbers were really good, but maybe because there is no guidance raised, maybe because there's concern about that exposure to China, to tariffs, it is getting a little bit of a beating this morning, down 3% now. Moving on to Adidas, we've got a similar story to Hermes, where we've got good numbers, but investors are still disappointed. So profit beat expectations for Adidas. However, it did not raise its guidance, and it mentioned that there was still that tariff uncertainty, and that could kind of weigh on consumer demand in the US. So we're down almost 7% this morning. And then finally, JDE Peet's, which is a coffee retailer. We've got a huge increase this morning, up 11%. It raised its outlook, and that's thanks to strong coffee prices.
I thought you were going to say thanks to strong coffee. Well, that's good for this time of the morning. 8:15 here in London. Chloe, thank you very much. Chloe Mellet from our equities team. Coming up, we'll be back to some of those earnings stories that we've just been covering for you. UBS, HSBC, Santander, all in focus. We'll dig deeper into today's bank earnings stories next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Welcome back to the opening trade. We are 18 minutes into the session. As you can see, largely a negative session across much of Europe. Few exceptions. It's a single stock day. It's not a top-down story day. The best performing sector year to date for Europe has by far and away been the banking sector. It has eclipsed everything else, including the defence sector. But what we're watching today is a little bit of an unwind of that trade. We are down by around 0.8% on that sector. There's a number of names that stand out. Some of those names that we've been talking to this morning. HSBC is the big loser and obviously a big heavyweight in that space. But Santander is down. BBVA is down. Not out with numbers, but you've also got CaixaBank softer as well. So you are seeing some quite significant losses coming through. HSBC is the one that stands out. Thomas Noetzel, our senior UK banking analyst at Bloomberg Intelligence, joins us now to break it all down. I want to start with HSBC. What is the market not liking in these numbers to deliver a near 5% drop?
Well, you have to look into the details of HSBC results. On paper, on the reported numbers, it looks like they missed pre-tax profit. But if you look in the underlying profitability, excluding notable items, it's around 10% beat. So definitely revenue is doing well. Cost restructuring is on target. There was a little bit higher cost of risk because of CRE in Hong Kong, but it wasn't that much to derail the whole profitability. So underlying profitability is quite strong. The bank has confirmed 3 billion share buyback as expected by the market.
That sounds like quite good news.
So, rather good news, but you know what is I think it's all about travel versus arrival, right? Okay. The stock has rallied over the past 3 months quite nicely, especially since 2nd April Liberation Day. It recovered more than it has lost. So, you know, analysts are looking, okay, what is the new catalyst, right? And if you look at the stock, you know, it's all in line with expectation. ROTE, mid-teens, buybacks, same story. But we have still elevated risk, tariff risk, trade risk, right? There's still some unknowns. So possibly there's some profit taking on stock.
Okay. Let's talk about some of the Spanish banks, shall we, then, Thomas? We've had numbers out from Santander, from CaixaBank. If I start with Santander, that stock down by 2.2%. Seems difficult to impress, perhaps because of the sector having travelled so far.
Exactly the same, I think, story as HSBC. Maybe they reported everything in line, met the expectations, met the guidance. No upgrade to guidance despite quite good results. There's no news on share buybacks or higher distribution, which we anticipated, maybe because of the recent strategic moves in Poland and the UK. So, you know, we expect a colleague of mine who is covering the stock, like we have to wait till February for new investors' days to have new catalysts that will drive performance of the stock, will help the momentum. So I think it's all about catalyst, everything in line, everything as expected. So we need new catalysts for new momentum.
What about buybacks? I mean, we keep waiting for this era of European banking buybacks to kind of end, either with the volatility or with NII coming down, and it hasn't yet. In fact, it feels like it's going full speed ahead. What is the straw that breaks that camel's back?
Well, first of all, I think it proves that the banking sector is a little bit more resilient than we anticipated to tariff, trade war risk, but definitely interest rate cuts that are coming in the second half of the year will have more pronounced impact in 2026 than 2027. So back then, maybe revenues would be weaker, maybe cost of risk will normalize because we still live in quite benign credit conditions. So we would need to see both those factors to work to have any impact on the share buybacks.
Thomas, thank you very much. A nice little wrap of some of the earnings news we've had from the banking sector in Europe. Thomas Noetzel from Bloomberg Intelligence, thank you for bringing us the banking story. Let's move on to the luxury story this morning. We've also had some corporate reporting there, a pair of luxury brands, in fact, reporting numbers. Hermès sales rising as wealthy shoppers continue to snap up Birkin bags. Meanwhile, Gucci sales plunged as shoppers turned away from Kering's largest brand that's undergoing a design revamp again. Interesting that the share price performance this morning seems to be perhaps at odds with the things I've just described. So let's talk to Andrea Felsted, a Bloomberg opinion columnist, who can help us understand what is happening here. So let's start with Hermès, shall we? These numbers, they looked kind of decent, and yet the stock down by 2.4%. What is it that's disappointed this morning?
I think all of the luxury stocks have been hit by the downturn. We've got China, probably China's not getting any worse. We've also got this phenomenon that tourism is actually down in Europe and in Japan, and Hermes isn't really immune from that. But as Thomas was saying, you know, it's on a very high rating. So if it doesn't beat, then again, there's a bit of disappointment.
Yeah, so easy to disappoint on that particular front.
Yeah.
It is. Talk to us a little bit, though, about where the growth is coming from a lot of these places from a regional perspective. I think we were here last quarter having this conversation with you, and we were talking about this kind of U.S. offsetting China dynamic. It feels like the markets have flipped that this time around.
Well, yes and no, because the phenomenon we've got in the US is that stock markets are really roaring. We've got crypto back. That's historically been very good for luxury. LVMH was saying the US isn't getting much worse. Kering was saying actually the US was a bit stronger for Gucci. China, it's not deteriorating anymore, but it's not getting better. Kering was saying it's really the high-end products that are selling well. I wonder if that's because, you know, wealthier Chinese are more immune. The middle class, that engine of growth, is still feeling a bit under pressure.
What's happening with Sambas at the moment?
Very interesting. My favourite subject.
Okay. So Puma didn't do well the other day. No. Adidas, I'm looking at not doing well this morning. What's going on?
So the Sambas really ruled the Adidas retro styles. Last couple of years, they've been flying. We're just seeing a broader range.
I'm thinking of buying a pair. That probably tells you that we're coming to the end.
Give him the fashion advice, Andrea.
I'm obsessed with people's feet, and what I'm seeing is a lot more of the Nike retro style. The Onitsuka Tiger, Onitsuka owned by Asics, that's really... I went to the hairdresser on Saturday. Ladies sitting both sides of me had those on. Adidas hasn't got the monopoly anymore. We're also seeing Nike coming back. There's a bit more of a move away from lifestyle to performance. Everyone's been wearing trainers for a long time. Now we're getting much more into performance, running, sport. Now I think that's a bit, and that's where Nike's really focusing on. But I think it's a good opportunity for Adidas as well. And the CEO has talked about using the brand heat in the lifestyle sector to move into performance. And what you get with performance, you know, these companies are also fashion brands. So what you get, you want a performance hit, but you want to be able to modify it slightly so it works out of the gym as well.
So which shoe am I buying?
See, Andrea,
I'm quite a fan. I'm still a Nike girl. I'm quite a fan of those retro Nikes, the low-rise retro Nikes. So that would be my advice.
Okay.
Andrea, I'm going to put you on the spot, 30 seconds if I can. When it comes to the tariffs question around spirits and drinks, how does that affect the likes of LVMH, Pernod Ricard?
Well, LVMH, the luxury group, the handbags, it shouldn't be too much of a problem because, you know, wealthier customers, bigger margins. But having said that, they've all raised prices a lot over the last 5 years, so they have less wiggle room. Spirits, it's gone through the same thing as the luxury brands. Big, you know, overconsumption in the pandemic. That has weakened, so they probably have less pricing power too.
Interesting. Certainly some fall that we're going to keep an eye on as we see the French still pushing for those carve-outs. Andrea Felstead from Bloomberg Opinion walking us through that earnings picture. Coming up, we stick with more earnings, an exclusive conversation ahead with the CEO of Capgemini as the company announces a multi-year share buyback program. That seems to be the common theme of the earnings this morning. Win or miss? Stick with us. This is Bloomberg.
Applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
This is the opening trade, about 30 minutes into today's session. It doesn't seem like from the surface there's a lot going on, but let me reassure you there absolutely is. I'll give you one case in point when it comes to some of the individual stock performers. Novo Nordisk is one of the big movers underneath the hood, down about 2.4% this morning, which doesn't seem like a massive move for Novo, but add that on to the over 20% drop that we saw yesterday. Of course, is coming after their profit outlook cut, naming a new CEO, really trying to pull back a lot of the CapEx spend that they've spent on Novo Nordisk. And this is a really big deal, of course, for one of the core six, the granolas, the mega trade, whatever you want to call it, a really big one for Novo Nordisk. And this doesn't even factor in yet any sort of pharma tariff impact.
I think being included in that group was a really tough option for Novo, because since then the stock has been under really quite significant pressure.
Yeah.
We've been on a downtrend. It's facing obviously a lot of generic competition or off-patent competition.
Do you think your core six jinxed it?
I'm going to take full responsibility.
Yeah, it does raise interesting questions, though, about a business that is so geared around, they had other things going on, but it became so geared around one product, and you're so far out in front on that one product, and then everybody comes after you. And what does that do to your business?
I think the real struggle they had, the real problem that they had was that they initially couldn't meet demand. And what that produced was an environment for others to try and step in and meet that demand. And they've struggled to kind of move on from that, and it's still a battle that they're having to fight. Let's turn to another corporate that we're watching carefully this morning, one certainly that is seeing significant upside in terms of its performance. Capgemini, the software company out of France, is up circa 3% right now, just shy of that. Initially, at the get-go this morning, it was up even more than that, so we faded an early 6% move down to a 3% move, but I think we'll take a 3% move on a day when equity markets broadly are drifting sideways, so not a bad performance. At the moment, we're looking at first half results coming in better than anticipated. The top line, the revenue line, certainly driven by some quite nice and improving, it seems, trends. We've got a narrowed outlook from this company as well. Its CEO is Ayman Ezzat, and he joins us now. Ayman, good morning. Can I take the first half and the numbers that you've delivered this morning and extrapolate that into the second half?
Well, for the moment, we see stability in the environment. I think it is good. When you started the year, there's a lot of concern about the impact of tariffs, geopolitics, and the deteriorating overall situation. I think we sailed through the first half with some stability. We still see that stability going into Q3, but we remain cautious for the full year. As you know, there can be very abrupt changes, and although we start to getting some agreements on tariffs, we know there is not an overwhelming support for some of these agreements, and we have to be careful to see really what's going to be the impact on the economy, which is still in a slow mode right now. So investment are still pretty tamed from our clients. They don't see a lot of growth in the economy, and that's kind of slowing down the rate of investment. There's some nice deals, but overall it's still not a high growth environment.
So you don't necessarily see the clarity that we're getting on the trade front, and I appreciate that it is back at the kind of napkin, back of the envelope kind of trade deals at the moment. You don't see that clarity being enough to generate a pickup in investment at this stage?
I would like to see it before I can sign on it. You know, we have seen a lot of cautions from our client on the investment front for the last, several quarters. Yes, there is traction coming from generative AI and agentic AI. It's getting a boost on the other side. We have seen some cuts in other places and quite a bit of control on discretionary spend. That, of course, is holding quite a bit back the growth for the industry overall for the last few quarters.
Ayman, it's Kriti in London. Talk to us about how some of that may be offset by the momentum you're seeing in the AI space specifically. There is an argument here in the markets that all the business uncertainty, all the geopolitical risks that you were seeing around the world can be offset by the idea that AI is growing faster and has more diverse uses than it did, say, even 12 months ago. Is that a trade-off Capgemini sees?
Yeah, so we always have growth areas. I mean, generative AI and AI is one growth areas. You know, we also see, being a large European player, some traction coming from sovereignty, from defense. We see traction in life sciences. On the other side, we have been heavily impacted, for example, by the auto industry. So it's a trade-off between what are the growth levers that we see today, but also some of the negative impact that we're still, experiencing many in the manufacturing industry right now, but also to a certain extent in the consumer goods and retail in Europe.
Well, Ayman, talk to us a little bit more about that growth area as well, specifically when it applies to Europe. There's continued weakness in France as well, specifically in France, but of course in broader Europe. Talk to us about how the AI trade, at least growth picture, works in a place that is still really struggling.
Yeah, so we see, so clients are investing in competitiveness, and we know that generative AI and agentic AI is really a big driver of competitiveness. I think there was a lot of hope about the impact it will have, notably on all the technology costs, IT costs, etc. After 2 years of really working on it, yes, there is some impact, but it's much less than what people expected. It's a lot more complicated to manage existing environment and upgrading existing environment than it is to, for example, generate completely new application or write new code. It's not the same thing, so we don't see. A lot of the hope now is really on the end-to-end business processes. We really see the advent of agentic AI, especially helping us to accelerate the hyper-automate end-to-end business processes, which is really going to drive companies' competitiveness. So it's not just about cost, but it's also about, speed of decision-making, quality of decision-making, and also significantly better business outcome. We see it. We see more and more deals coming us that way, and that's really the background of our acquisition that we have done on WNS, that we announced a few weeks ago. It's really to go into this new area of intelligent operation where we see a lot of traction, a lot of appetite from our clients, including in Europe and including in France.
Yes, I was interested in that deal with WNS, that purchase of WNS, and the way that takes you into agentic AI, Ayman. Paint a picture, help us understand a little more what difference agentic AI can make to a business. Which are the business processes that will really benefit from the use of these kind of agents?
Yeah, if I try to simplify it, if you take an end-to-end business process, that's probably 4 or 5 steps. You have to break it down to tasks and then to micro tasks. And typically, this end-to-end business process ends up being defined at the micro task level of about 120 micro tasks. And after that, we are able to identify 30, 40, sometimes 50 micro tasks in which you can use GenAI assistant or agentic AI. And what you do is really hyper-automation of these tasks. It enables you to be able to reduce significantly the length of the process. It's much faster, provide agility, provide scale, but also very good business outcome. If I take a simple example, and it's not just about productivity and cost. They might have 30 or 50 people working on a forecasting and planning process. Through GenAI and agentic AI, you can significantly improve the quality of that forecast. The quality of the forecast will have an impact on your shipping costs, your inventories, and your fulfillment rate. So you can get significantly great improvement in terms of business outcomes as I just described them, without necessarily getting a lot of cost reduction. So more and more, what we're pushing is to shift the discussion from purely cost and productivity to really how do you create more value leveraging Gen AI and agentic AI.
And are businesses buying into that, Eamon? Do they want to just save costs, or are they interested in that latter conversation you described?
It's shifting, you know. The people that have tried hard see that it's much more challenging to drive some of this productivity. Yes, there are some areas where we have seen the productivity gain, but the focus on really value creation and business outcome is yielding a lot more results. And that mood is shifting bit by bit towards focusing more around how we can create more value versus just how do we generate productivity.
Eamon, final quick question. The defence spending story has been dominant in Europe since the beginning of the year. We're starting to see Germany beginning to spend money and deliver some quite significant deals. You are downstream of this. Are you starting to see a pickup in the defence business from your defence clients? How long do you think this process lasts for? And just give me a sense of whether or not this is a structural shift, whether this is a long-term narrative that you can work with.
I think it's a long-term narrative. I think it's a complete evolution in terms of the perspective around defense in Europe and the fact that Europe has to take care more and more of its own defense spending and rely less in the US from that perspective. So we do see it trickling down. Not every country for the moment. Germany, you mentioned Germany. We definitely see some impact there in Germany. And for us, it's both working with ministries of defense, so more on the government side, but also working with a number of industrial manufacturers and industrial players who basically need to scale up their manufacturing, need to invest more in R&D, and hopefully some new large European programs, you know, cross-country programs to be able to develop some new defense armament, where the areas where we play very strongly, like, you know, help to develop, for example, a concept like cloud defense is going to be something important in most of the new armament systems that are going to be developed in Europe.
Eamon, great to catch up. Thanks for the time this morning. Really appreciate you running us through the numbers and the outlook. Eamon Ezzat, the Capgemini CEO. The stock is now up by 2.2%. Earlier on, nearly 7%. So we're fading that early move, but the stock's still positive on a day when we're seeing broadly markets drifting sideways. What are we going to talk about next? President Trump set to make the final call on a US-China trade truce. We'll have the details for you on that story next. This is Bloomberg.
Villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life. rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. More breaking news coming from the corporate story. We've already had Mercedes out with figures this morning. Let's stay in the auto sector and talk about the numbers we're getting from Nissan. Remember that Japan did the trade deal a few days back. A little bit of clarity coming on what exactly is happening there, the car sector being one of the beneficiaries. Nissan is now forecasting 180 billion yen operating loss for the April to September period. Now, that's quite specific, and they're not actually giving us much in terms of the full-year outlook. So no full-year profit forecast. Headwinds include lower sales. I think that probably is something that we already knew about. The foreign exchange story, remember the yen is getting stronger, therefore the reported sales coming back into Japan are a little bit more problematic, and the tariff impact that we are going to see. Now, while we have clarity, tariffs obviously on a year-on-year basis are increasing quite significantly, and it is citing a difficulty in forecasting in the current environment. So despite the fact we've got a trade deal, still got a difficult environment to forecast from a Nissan point of view.
Absolutely. Are you going to be in a very different environment in terms of pricing? What kind of volume are you going to be able to shift under those conditions? So a lot of uncertainty there. Let's stick with the tariff theme, though. The US and China are to continue discussing the terms of a tariff truce extension. US Treasury Secretary Scott Bessent says President Trump will make the final call on extending the tariff truce with Beijing.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
I just had a phone call from Scott Bessent and had a very good meeting with China, and it seems that they're going to brief me tomorrow. We'll either approve it or not. But he felt very good about the meeting. Better than he felt yesterday. Yesterday I said, "Ooh, here we go again. Here we go again." But today it worked out very well.
Let's get some analysis then of what exactly we know and don't know about what's going on between the US and China right now. Our Europe correspondent, Oliver Crick, has been on location in Stockholm to try and ascertain what exactly is happening there. And Ollie, I admit to being slightly confused because the two sides locked in these conversations for quite some time over the last couple of days. The Chinese delegation seems to have said that they've agreed to extend the tariff truce, but America's saying it's too early to say. What are the top lines for you?
Yeah, and you can imagine some of the confusion among journalists who are here all gathered in Stockholm. There were two press briefings in two separate locations, one by the Chinese, one by the Americans, led by Scott Bessent and Jameson Greer, the other by some of the trade delegations from China. And the Chinese went first, and they basically seemed to indicate, as we were awaiting the U.S. delegation, that the truce had been agreed to. They did not specify for how long that truce would go on for, but they seemed to say that, listen, this is locked and loaded, we're ready to go. Then Scott Bessent came out, he said, well, we're not quite there yet. As we know, Donald Trump does not like to deprive the market of any moments of suspense. And basically, though they had sort of had a very long discussions for 2 days, the U.S. and the Chinese side, and Scott Bessent had actually spoken to Donald Trump, he wanted to wait until the full briefing that will happen today in the White House in order to make a determination as to whether or not to rubber stamp the continuation of that trade truce between the United States and China. And that is a decision that needs to be made before August the 12th, when the trade truce is set to expire. All of that being said, Anna, and I think why the market generally took it fairly positively or didn't take it too negatively, was that all of the sort of sounds from the Chinese side, from the American side, were that these talks were extremely constructive, that they were very, very positive. I would say there was a little bit of detail lacking on any kind of concrete progress on some of the key issues. That being said, they wanted to really cast this as a sort of productive meeting, something that sort of advanced things. But at the end of the day, they wanted to leave the discussion and the final decision to Donald Trump.
Ollie, there's been a lot of chatter about a Trump-Xi summit. Where do we stand on that?
Yeah, I think we're probably some distance away from that summit. I mean, when we think about kind of the discussions that we had between the United States and China, and we tried to sort of drill down on some of the key topics that are still sort of existing between these two sides, we didn't get a whole lot of detail on progress that was made on a number of things. One of our reporters asked the U.S. delegation what the sort of biggest concession that they got out of China was, and they said that basically before there were not magnets flowing, now the magnets are flowing to the United States, and that isn't necessarily a new development. So these are the kinds of things that the Trump administration still needs to make progress on. Outside of that, there is that massive trade surplus that China runs. This is one of the cornerstone promises of the Trump campaign, was to right the trade relationship with China. We are still some distance from that. So I suspect that this is going to be kicking the can down the road. We're going to be in a holding pattern for a little while now. And we should say that we have seen from the Chinese a very large appetite for being tough in negotiations when they ratcheted up the pressure by sending up the tariffs. And we should also say that there is a difference between Trump 1 and Trump 2 in terms of how the Chinese are negotiating. In the first Trump administration, these trade discussions happened in Washington, D.C. They are now happening in Stockholm, Geneva, the United Kingdom. These are places that are seen as sort of third-party neutral places, and that is in part because the Chinese want to assert themselves a little bit more and want to be treated more as equals rather than as a sort of a subsidiary to the United States in their discussions. And we've seen their ability to exert some of their leverage on the U.S. as well.
You wonder where the next meeting will take place, which European capital gets to host. Ollie, great stuff. Thank you very much indeed. Ollie Crook joining us out of Stockholm. We await the briefing later. We await the Trump verdict on what that deal is going to look like and whether or not we are going to see that extension. Let's turn to some of the data. Remember, it's a massive day for data. It's a massive few days for data on both sides of the Atlantic. We have seen some numbers out of France already this morning when we get GDP data out of both Europe and the US later on. But the French economy unexpectedly accelerated in the second quarter. One of the reasons for that is that we've seen an inventory build, which in some ways is kind of forward demand, but this is offset to a certain extent some weak domestic demand and a drag from trade. So net-net, is that a positive? Output rose 0.3, beating economists' expectations for a 0.1. Inventory build, very fickle, very hard to kind of read and call. So Schneeweiss, who leads our Western European economy coverage, joining us now. Anything that you can kind of read out of the French numbers into the wider European numbers? Zoe, what are we looking for there?
So overall, as you mentioned, that inventory build isn't necessarily good news. Obviously, it's good news for the second quarter as such. 0.3% growth is much stronger than anticipated. But overall, it just isn't necessarily a sustainable build. If you do inventories, basically, you're building things that nobody else wants and just putting them in your inventory. Overall, the number for the euro area, economists before those French data had said that there was going to be stagnation in the euro area. That's primarily because German numbers, which we're just about to get, will be in contraction. We also had a contraction in Ireland, which is that wild card in the euro area. Each time Ireland's growth or contraction almost always completely dependent on those big multinationals. So we had the French number. Let's see if that's enough to let the euro area as a whole grow. Spanish numbers yesterday also were slightly better than anticipated. But again, old hand really hinges on Germany.
Okay, so we've seen the French. So what are we expecting then from Germany, Zoe? If that's that's the big one, I guess.
Germany is the big one. We're expecting economists are expecting a contraction of 0.1%. That really is, though, the flip side of that very strong first quarter. If we all remember, companies across Europe, and particularly in Germany, were front-loading in the first quarter. And that front-loading means that if you push it into the first quarter, there's less to do in the second quarter. And that's really this technical effect that happens there. Again, this won't be a contraction in Germany, obviously, is not good news. And we just have a new chancellor here. So obviously a good number in the economy is something you can crow about. Still, a contraction of 0.1% should not be enough to return those calls for the sick men of Europe.
Zoe Schneeweiss, our economics editor in Frankfurt, putting that data into a little bit of context. We thank you so much. Plenty more data, as she mentioned, coming up ahead. 10 a.m. UK time, Euro area second quarter GDP, the U.S. numbers for the GDP as well, plus Bank of Canada's rate decision, all of which may show maybe some signs, maybe some cracks on the tariff front as well. But I think the highlight, the big event of today is going to be the FOMC decision, 7 p.m. UK time, and then earnings coming from Meta and Microsoft. Val's got all of that on her radar. Val, what is top of mind for you?
The Fed decision. I know widely expected to hold interest rates, but that's really not where the drama is. It's all about whether they start to lay some groundwork for the cuts to resume in the second half of the year. And the way they can do this is by changing some real choice words in the statement. It is the first and second sentence of the statement that characterize both economic activity and the labor market as solid. If either of those are dropped, it could be a hint that the door is opening wider for a September rate cut after their summer pause in meetings. Now the note, there is something else other than those two lines in the statement to keep an eye on, and that's at the very bottom of the statement where it details the voting activity of the members. We know that Governor Waller set up his dissenting argument essentially before the Fed's blackout period. If he is joined by Governor Bowman, that will be the first time we see two governors dissent at a meeting since 1993. It's more often we get dissents from the regional Fed voters, from the regional Fed presidents, but it's highly rare we get multiple dissents from two Federal Reserve governors. Note, there's only 7 of them, so 2 of them dissenting at one decision could maybe get the market thinking that Powell could have maybe lost some control over the narrative.
I can't believe I'm going to say this, but why do I care about the Fed today? When this is a market that is not driven by the Fed at the moment. It is driven by big tech. The multiples that are being driven in the S&P are by big tech. We get 2 of the big names dropping numbers, and we get 2 big names tomorrow. Today we get Meta and Microsoft. This is all that matters. Forget the Fed, forget trade, forget everything else. It's all down to...
It's hard for me to get on board with that kind of view, but I will talk to it.
So yes. Diplomatic, Valerie.
But yes, we do get 4 Mag 7s reporting in the next 2 days. Meta and Microsoft kick it off tonight. Focus for both of them will be on CapEx spending, whether they raise their CapEx guidance like Alphabet did last year. But then for Meta, it's really all about the justification of this AI spend. They spent $14 billion on the investment of Scale AI. Zuckerberg has spent a lot of money hiring this AI task force, his task force of geniuses.
Every day there's a number. There's kind of we've recruited from here, we've recruited, and the salaries are epic.
$100 million. That sounds kind of nice. Yeah. So it's whether that kind of expense, whether investors can justify it with the current revenue that they're pulling in from digital advertising. So those 2 things will be weighed up, definitely. When it comes to Microsoft, it's about their cloud business, yet again, that's really driven their path higher for sales. I think a lot more focus will be on the sales driven by AI tools. Yeah. Remember, they have that tie-up with OpenAI, ChatGPT. Are they doing well at commercializing the use of AI that could pose maybe some big upsides or downside risk in these results?
Now, I know that AI is obviously now these days a macro theme, but back to your core area of focus, Valerie, perhaps where you spend most of your time in macro land. So we've got data out even before we hear from the Fed. Is that going to be anything that might destabilize our view of the world?
Look, it can be quite interesting because we know that the first quarter GDP was quite warped by the drag forward when it came to that import surge, which dragged on GDP that came into a contraction of 0.5%. Economists are penciling in a 2.6% rise in second quarter GDP, and actually trade is going to be a significant boost to this number today. The most interesting part could come from the more consumer spending angle. We know that consumer spending makes up 2/3 of U.S. GDP. Was the front running of tariffs just something one-off, or will that kind of consumer spending be sustained in the second quarter?
Okay, Valerie, thank you very much. Valerie Titel, she has a busy day ahead of her. We have lots of corporate earnings then from the tech sector and all of these macro themes to deal with. We will hear from former Fed President Jim Bullard later on today. We'll be joining the Bloomberg team ahead of today's Fed rate decision. You can catch that interview 12:30 p.m. London time. That is it for the opening trade. European stocks a little lower this morning. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Zurich, and these are your top stories. UBS sees a brighter outlook and posts an earnings beat. The bank's chief executive tells us they will not shrink in response to Swiss capital rules.
Having a global diversified business is a strength for us and for Switzerland, and shrinking is definitely not an option.
President Trump will make the final call on extending a tariff truce with China after the latest round of trade talks between the world's biggest economies. Plus, watching for dissent, investors expect a pause from the Fed despite Trump's pressure to cut. Now, first thing is first, let's go straight to the markets. And again, there's quite a lot going on in European stocks. But of course, look, it's the Fed dissent could aid the gold's ascent. That's how we start our markets. Live blog. And of course, the big focus is not only what's happening with GDP a little bit later out of the U.S., but also, of course, the Fed trajectory ahead. S&P futures gaining some 0.1%. We always look at euro dollar 115.56, Brent crude 73.07. Now, a couple of the stories we also need to watch out for is, for example, European stocks falling under the weight of the miss from HSBC. So there is quite a lot of banking news stories. And then we're also watching for a tsunami reaching Hawaii as there has been a powerful quake, putting all of the Pacific on edge. So you can see the CAC 40 in France actually gaining, but the FTSE and elsewhere a little bit on the downside. We're also getting some European data. So Germany, preliminary second quarter GDP falling some 0.1%. That is perfectly in line with the economists' expectations. And also Italian preliminary second quarter GDP. Now, this seems a little bit more of a surprise because it's fallen 0.1%. The estimate was a gain of 0.1%. Euro dollar, you can see at 115.52. Now, UBS has posted higher than expected profits in the second quarter with net income of $2.4 billion. The chief executive, Sergio Armati, told us earlier that Switzerland's planned bank capital rules are costly to shareholders.
Shrinking is not an option. UBS and Switzerland benefits from our diversification. You look at this quarter, Switzerland is performing well despite a very challenging environment around interest rates and the economic situation. But we have offsetting businesses that allow us to benefit from this diversification. Having a global diversified business is a strength for us and for Switzerland.
Well, Sergio Ramadi also spoke about the impact that President Trump's tariffs could have on the global economy.
If we land at around 15% on average is a base case scenario, which in any case is something that needs to be digested. This is 6 times higher than what we had at the beginning of the year. This brings some kind of inflation. If you think from an exporter standpoint of view, if you are a Swiss or a European exporter, you are basically seeing your clients in the U.S. have to pay 15% more because of tariffs, plus another 10 to 15% more because of effects.
Well, for more on UBS, let's go straight to Noel Ilian, who's here with me in the Zurich office. Noel, thank you for joining us. I mean, it's interesting because for one of the first times, there's also a second press conference coming on right now with the chief executive and the CFO talking about regulation. So, I mean, earnings were fine, but it's really the focus on capital requirements that's worrying investors.
Yeah, so actually it's the first press conference since Motti returned as CEO. And Hammer's left, so it's an unusual, rare move for UBS, and they haven't really publicly made any announcements since June 6th proposals from the Swiss government. So we're excited to see what they will announce in connection to this.
And when we asked, Sergio Ramadi was very tight-lipped. I mean, there's a lot of speculation, first of all, that they're looking possibly to move headquarters, that they could sell parts of the business, and he kind of like pushed back against that. So are we expecting any news from this press conference?
Who knows? We'll see what they come up with, but we are analysts, at least they are expecting UBS to say how they want to mitigate the impacts of these capital requirements. So it's definitely a big topic for everyone at the moment.
No, I mean, if you look at the capital requirements, are they really overshadowing what the business is doing, which is actually, again, integration of Credit Suisse, which is faster than expected. It's not easy, and they had a good set of results today.
Yeah, it's also having a big impact on the share price at the moment compared to other European banks. So, yeah, it's definitely on top of mind for everyone. And the results, as you mentioned, they were good all round. Especially markets performed well. They had good net new money inflows as well. So overall, yeah, pretty good set of results for UBS.
I mean, do you sense a lot of frustration from UBS leaders about how they're being treated in terms of the capital requirements by Swiss policymakers?
That's a good question. I do think that the way it was an unexpected, kind of the way this is playing out. And I don't think UBS executives thought that this would happen when they agreed to take over Credit Suisse a couple of years ago.
Noel, thank you so much. As always, Noel Ilian there with the very latest on UBS, and we'll bring you more of our interview with the UBS chief executive later in the hour. Now, the U.S. and China are continuing discussing the terms of a truce extension. Now, the U.S. Treasury Secretary Scott Bessent says President Trump will make the final call on extending the tariff truce with Beijing.
The Chinese deputy minister did say that we had agreed on a pause. We have not. Nothing is agreed until we speak with President Trump.
Now for more, let's bring in Oliver Crook. Ollie, good morning. So we wait for Trump to decide what's going to happen next.
Yeah, that's right, Francine. There was a little bit of confusion yesterday after these 2 days of meeting on the U.S. side, led by Secretary of the Treasury Scott Bessent, flanked by Jameson Greer, the U.S. Trade Representative, and the Vice Premier of China. They spent 2 days here in Stockholm, occupying the Prime Minister of Sweden's office here to thrash out the discussions about extending that trade truce that is holding between the United States and China until August the 12th. And we got the first press conference in 2 different places. The first from the Chinese, seemingly suggesting that everything was locked and loaded, that the truce had been agreed and that we could all move on. And then the Secretary of Treasury saying, not so fast. We still need to get approval from President Trump. So we understand that Scott Bessent now is back in the United States. He will brief the president today, and the president will make a determination as to whether or not to extend that truce between China and the United States. And just a reminder to everybody, there was a situation a few months ago now when the sort of trade war escalated between the 2 biggest economies in the world. We had tariffs upwards of 100% on both directions, basically precluding all trade. trade. And this meeting was really, the hope of this meeting was to extend that truce for another 90 days. And the reason that the market has been, I think, relatively calm about what we saw, the fact that there is no deal, is that ultimately both sides were saying these were very, very constructive discussions. And I think the base case for the market still is that that truce will be extended.
So Ollie, I mean, again, the 90-day extension leads, could that then end up with a Trump-Xi summit? Is this was what President Trump wants?
Yeah, I think the question, Francine, is how many sort of 90-day increments are we between a meeting between these two leaders? Because I suspect we're not just one away. Because in many of the discussions that we've had over the last 2 days between the Chinese and the American side, we didn't get a lot of clarity on any progress that had been made on some of the other fundamental issues. There is still, of course, the main issue as far as the Americans are concerned, which is the very large trade surplus that China runs with the United States. There has not made a huge amount of progress in terms of how to solve that. There is the question of the continued buying of Russian crude oil. This is something that is entering the discussion a lot more between the U.S. and China. Scott Bessent brought it up with the Chinese counterparts yesterday and the day before, and it didn't seem that the Chinese were really willing to move on that at all. And then he was also asking about the secondary sanctions that potentially the Trump administration will place on anybody buying Russian crude, saying that basically the Chinese are kind of unwilling to adjust their behavior there, and that if they are sort of okay with that, then potentially they will have to pay 100% tariffs if they continue buying Russian crude oil. So there are a lot of sticking points that have not yet been resolved, and we know from the discussions over the last 2 days that a Trump-Xi meeting has not come up explicitly between the two delegations. Another topic that has not come up, something that is still outstanding between the two, is the sale of TikTok. Trump says there's a buyer in the United States. You still need the nod from China. So I think there are still a great many issues that need to be discussed and progress that needs to be made before these two men will be willing to be in the same room to have something to deliver to the world.
Interesting. Ollie, thanks so much. Oliver Crook there. Also interesting that this week the Taiwanese president scrapped his Latin America trip amid reports that the U.S. actually also posed a stopover in the U.S. Now joining us is Simon McAdam. He is Deputy Chief Global Economist at Capital Economics. Simon, thank you so much for joining us. What can you tell us about U.S.-China? Where are you expecting tariffs to land on that?
Well, I mean, something we've been thinking since the election back in November was that it's a geopolitical issue here that's at stake that means that China is ultimately going to be tariffed at far higher rates than the rest of the world. What exactly that rate will be a few months from now is anybody's guess. We're currently at around 40% effective tariff rates that are in place right now. That seems plausible that we could end up there. Equally, a couple of 10 percentage points higher or lower than that, it seems plausible as well. But the big issue is that China will remain highly tariffed compared to the rest of the world. But that's because of a geopolitical rivalry between the US and China.
Simon, what can you tell us about the EU and US? I mean, this is a very big week in terms of trade. There's also the August the 1st deadline. That's Friday. But the market seems to be convinced that actually it's like almost one and done, that we know what the tariffs pretty much look like. I mean, are we certain that then they don't change in 3-4 weeks?
Well, that's the issue. We're dealing with President Trump is negotiating not with one country, but with a bloc of 27. And those 27 have all got to agree. We've already started to hear out murmurs from some countries like Germany and France that they don't like the deal, but they might have to suck it up. But the French are talking about trying to get exemptions on certain things. So this could be a little bit of messy backroom deals being done over the coming weeks. But I would think that, broadly speaking, the EU will go along with this deal. I mean, let's be clear. This is a really bad deal for the EU, hardly reciprocal, using Trump's language. Not so long ago, the EU was talking about trying to get terms for a zero-for-zero tariff deal with the US, and now they're looking at 15% rates on most of their exports, including higher rates on steel and aluminium. So we're very far from that, and this is a huge increase in tariff rates from the sort of 1.5% rates that we saw just at the beginning of this year.
But why do you, I mean, 15, I guess, is better than 20, but it's not as good as 10. Should they have negotiated more to get a better deal, or was this always going to be the best that they would get?
Well, this is the thing, isn't it? This is Trump's strategy. Threaten 50 and 30 and make 15 look good. But as to the point you make about whether they could have got a better deal, there are some constraints that the EU faces as a negotiating bloc. For one thing, it has very high pain tolerance. Some of those countries in particular are exposed to trade with the US. And also you have got to get agreement from all 27 countries. And just remember also, there is that thing called the Ukraine war. And I think there are also geopolitical concerns that it's really important to get the Americans on side. And there are increasing signs of that happening. And the Europeans wouldn't want to jeopardize Trump's increasing support for Ukraine by throwing a spanner in the works, by retaliating and bringing more trade uncertainty to its own economic bloc.
Simon, why haven't we really seen actually the tariffs show up in U.S. inflation? Is it a matter of when it shows up, or could it just dissipate?
Well, actually, if you look closely in June, you could see it. I mean, there is one thing here about not trying to cherry pick numbers, but if you do look at the sort of goods that we think would be affected, the sort of heavily imported goods like clothing, electronics and such, we could see that there were very big price increases. So excluding cars, core goods prices rose by 0.5% on the month in June. So we could already see that tariff effect start to come through. But this argument that in May and June we should have seen big increases in goods inflation, I just don't think is very credible. Everybody knows that in Q1 there was this massive increase in imports into the US, a build-up of inventory. It was quite clear that some of this pre-tariffed inventory was going to be run down before firms are in a position where they want to raise prices. And then there's that other thing called profit margins. Profit margins, if we look at the national accounts, suggest that profits in the US for the corporate sector are extremely high levels by past standards. So there's great scope there in the meantime to absorb some of this while firms are trying to navigate the uncertainty. And maybe we'll start to see some of these deals being done, these rates seeming a bit more durable that are being imposed. And then maybe we'll start to see these price effects carried through to consumers more clearly in the price data in the next couple of months.
How much is world GDP impacted by these tariffs?
I mean, our estimate is that compared to a world in which there were no tariffs, no tariff uncertainty, the world will be about 0.3% smaller by the end of next year than it would otherwise be. So now, obviously, within that global aggregate, that global hit, in a context of a global economy that usually grows at about 3%, so sort of a 10% hit to sort of the growth rate over a 2-year period. So it's not insubstantial. But within that aggregate, of course, that some countries are getting hit far more than others. On the face of it, the likes of Canada and Mexico, given the huge USMCA compliance carve-outs that they've got in their deals with the US, it would suggest that maybe they won't be hit very much at all. But of course, they're so exposed to the US economy that they are some of the most hit economies. Clearly, these high tariff rates coming out on parts of Southeast Asia are going to be bad news for those economies as well. Whereas the likes of the UK has obviously got its deal and isn't that exposed to trade with the US. Japan, now that it's got its trade deal, particularly for its auto sector. The auto sector is so important for Japanese exports to the US. India is another place as well, which is going to be less hit than the likes of Southeast Asia, Canada and Mexico.
Yeah, and Simon, overall, I mean, how quickly will we find out exactly how exporters globally are reacting to these tariffs?
Well, already it's quite clear that there is a case of rerouting, so from China, let's say. So we can see that Chinese exports to the US have collapsed. We can see that Chinese exports to other parts of the world, particularly in Southeast Asia, have increased, such that overall trade performance in China has not been hit terribly. In other parts of the world as well, we are starting to see these patterns of trade diversion. This is something we're going to have to be monitoring very closely. We know from the first trade war under Trump's first term, the sort of dynamics here, where parts of Southeast Asia and Mexico see a boost to their exports to the United States. But we'll have to see this time, because something's different this time. And that thing is that Donald Trump is very much aware of the rerouting issue. He's already started talking in these trade deals and these letters that he's been threatening people with that there will be higher tariffs for transshipment. Now, it's going to be difficult to monitor that and to gauge the extent to which shipments are coming in through third-party countries. But I think that Washington is very aware of this issue and may well start to impose tariffs on countries that start to succeed too much. So if you are too much of a beneficiary of trade diversion, then you yourself may find yourself further down the line with higher tariff rates.
So what does the Fed do in all of this?
Well, so the Fed at the moment, I mean, as you described earlier, I think the July hold is pretty much nailed on. One or two dissenters could be in the pack there. I think the debate is about maybe what happens in September. We're at Capital Economics, we're of the view that the Fed is not going to be cutting interest rates this year. Now, that is not what the Fed, many of the FOMC participants believe themselves in the dot plot. It's not what markets are pricing in. But our belief is that the tariff effects, as we say, we're already seeing them in June, but I think they are going to build over the second half of this year. The other element of the Fed's mandate is about the labour market and how the overall economy is holding up. And on that case, I think there are some people who are cherry-picking some weak signs or some softer signs in the labour market data to paint a picture that the US needs to cut interest rates quite rapidly. We're just not of that view. And we saw the JOLTS yesterday. The JOLTS report came out, and that suggested that the labour market is in very good shape. So if you've got a labour market in good shape, you've got an economy that's humming along, the tariff effects and the immigration effects on growth aren't going to really be phasing in until later in this year and into next year. I think there's just a case for the Fed to stick to its guns and to believe that there are upside risks to inflation. So you stand pat for the time being.
Simon, thanks so much. Simon McAdam there, Deputy Chief Global Economist at Capital Economics. Now, coming up, Mercedes reinstates guidance at a lower level. We'll dig into that and the other firms reporting this morning. That's in just a few minutes, and this is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Today, the Fed decides.
It's not just about the economics, it's about the politics.
The Fed is in policy purgatory.
It's going to press on the dual mandate. If the Fed wants to maintain its credibility, I think it makes sense to stay where they are right now.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
He's under fire. They're coming out of the trenches after him.
How do they justify how this is not political?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Well, Novo Nordisk has named Maziar Dustar as its new chief executive officer after issuing a profit warning due to disappointing sales of its blockbuster weight loss drug. Well, shares of Novo plunged as much as 30% in Copenhagen, the biggest drop on record, wiping some $93 billion of its market value. Well, let's bring in Naomi Kresge, Bloomberg's senior reporter on pharma. Naomi, thank you for joining us. Now, investors appear to be disappointed with the appointment of the chief executive and this profit warning.
Hi, Francine. Good morning. Yeah, I mean, I think that for investors, this is about a realization that after pioneering the market for obesity medicines, Novo is no longer the market leader. And not only that, but there, is potentially a lack of a clear pathway for becoming market leader again. And I think that this is really giving some investors pause. In terms of Mike Dustar's appointment, some investors had hoped for more of an outsider. He's been with the company for more than 3 decades and has been in management for quite some time, has been one of the architects of Novo's strategy, which he now will need to change to some degree.
So what's behind Novo's problems, Naomi, and what does the new chief executive actually plan to do about it?
It's really a multi-pronged issue. I mean, in the U.S., you have a situation where compounding pharmacies are continuing to sell cheaper copycats of Novo's GLP-1 drugs. This is something that Dustar will need to address ASAP. You also have a broader competitive situation where Novo has been losing ground to Eli Lilly. Zepbound, Eli Lilly's weight loss drug, is taking more new prescriptions. Lilly has next generation assets that are showing themselves to be very potentially successful, like lots of interesting data coming there. And Novo's next generation drug, CagriSema, had disappointing clinical trial results. And so this is a multifaceted issue of competitive position, copycats, and pipeline.
Naomi, thank you so much. Naomi Kreska there, of course, our Bloomberg senior reporter, covering this very, very closely, and we'll continue watching this developing story as the new chief executive takes over. Now, among a number of big market updates this morning, Mercedes-Benz has also reinstated guidance at a lower level, blaming pressure from U.S. tariffs and intensifying competition in China. It's a busy morning for trading updates. Here with all the latest is Bloomberg's Chloe Mealy. Chloe, kicking off with that downbeat assessment from Mercedes, what do they say?
Yeah, so Mercedes reinstated that guidance that they had withdrawn earlier this year on the back of tariffs, but they reinstated it at that lower level. That's something that we saw from Stellantis as well earlier this week. And obviously this tariff story is a big part of this, but crucially for Mercedes, it's also about that intensifying competition in China, where essentially local manufacturers are making electric vehicles much cheaper. And Mercedes has to compete, obviously, in China, but also in its home market of Europe. You know, companies like BYD are also trying to push into that European market. So both of those issues, the tariffs and then also that competition, that's putting pressures on margins this year. And we'll also see revenue that is much lower than last year's level.
Better news, Chloe, from Adidas this morning.
Yeah, so Adidas, on a surface level, Adidas actually did quite well. So profit did beat expectations. It saw really strong sales of its retro sneakers like the Sambas, for example. But there's a couple of things that disappointed investors a little bit. So we got weaker than expected revenue. That's on the back of the end of the Yeezy franchise and also a stronger euro. But also crucially, more importantly, Adidas actually did not raise its guidance. And that's something that investors had been hoping for because of that really strong second quarter profit uplift. The CEO said that there was really kind of no visibility going forward because of the tariff uncertainty. But that means that now the guidance actually sits below expectations. So that kind of led the share price down this morning.
Okay, Chloe, thank you so much for joining us today. Chloe Mealy there with the very latest on some of these earnings. Now, earnings season faces a crucial test also later with tech giants Microsoft and Meta set to report results after the bell. Now, Microsoft is expected to post a 14% rise in sales driven by growth in its Azure cloud computing unit. Now, while Meta's results are also a chance for the chief executive, Mark Zuckerberg, to address the company's costly artificial intelligence ambitions that have dominated his time and attention over the past several months. Now, the big tech earnings continue tomorrow with Apple reporting. We'll bring you all of the analysis right here on Bloomberg. Now, coming up, we'll talk to Alicia Garcia-Herrero, the chief APAC economist at Natixis, about a possible extension to the tariff truce between the U.S. and China. That's next, and this is Bloomberg.
to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Zurich, and these are your top stories. UBS sees a brighter outlook and posts an earnings beat. Now, the bank's chief executive tells us they will not shrink in response to Swiss capital rules.
Having a global diversified business is a strength for us and for Switzerland, and shrinking is definitely not an option.
Now, President Trump will make the final call on extending a tariff truce with China after the latest round of trade talks between the world's biggest economies. Plus, watching for dissent, investors expect a pause from the Fed despite Trump's pressure to cut. Now, back to one of our top stories, and President Trump is set to make the final call on maintaining a tariff truce with China before it expires in 2 weeks. Now, an extension would mark a continued stabilization in ties between the world's two biggest economies. Well, joining us now is Alicia Garcia-Herrero, Chief APAC economist at Natixis. Alicia, thank you so much for joining us. What does each country need from each other?
Well, as we move on, it seems the U.S. needs so much more China than China needs less, because the U.S. have not been granting extensions to anybody. Look at what happened with Europe, what we're expecting for India, around 20%. And things look very different for China, much more positive. The U.S. is ready to wait. The U.S. is ready to make concessions on export controls, on virtually everything. We even are discussing potential reduction of the fentanyl 20% tariffs, you name it. So the question is, why is this so different from what we heard from Trump's campaign before he was elected?
So, Alicia, first of all, why does Trump want to, does he really just want to deal with China for optics, or does he need the rare earths, or is this a turning point in what he wants to get from them, or does he just want a photo op with President Xi?
I think Trump has realized that the market can take a lot. Look at how nicely the market is reacting to every deal, but the market cannot take the U.S. pressure on China. Every time he's tried to do this, the market has reacted very badly. And the market is reacting badly because the U.S. is very much dependent on China for many products, not only rare earth. This is also about the consumer. This is about, any retailer in the U.S. telling the president that they will not be able to operate without Chinese goods. And I think he knows that. So he just needs a deal to basically calm down that inflation expectations and make sure that he makes it to the midterms.
Alicia, I mean, something that definitely struck me this week was that the U.S. didn't seem to be welcoming the Taiwanese president who wanted to do a stopover in the U.S. before going on to Latin America. Yeah. I mean, what does this tell us? Again, is this just trying to find a deal with President Xi? Is there something more? Could we see a turning point in terms of U.S. foreign policy?
Well, there is more to that story that is kind of coming out of Taiwanese kind of Taiwan experts around, which is actually a meeting by the defense minister who in the Pentagon back in June, and that apparently Xi Jinping managed to stop through a call to Trump. So, there's a lot going on in the direction you're mentioning. I think Trump is aware that a lot of the pressure that China is putting on the table in these negotiations relates to the U.S. basically not meddling with Taiwan. I think that's part of the discussion that is going on, that has been going on since the beginning. I think in Geneva, London, Stockholm, you name it. And it's only going to continue because Trump is showing willingness basically to offer China, I wouldn't say everything China wants, but certainly more than had been expected at the beginning of the year.
When you look at, Alicia, I mean, the two countries are really racing for critical technologies, i.e. AI. Who's doing better at the moment? And again, is this the real race, that it's not about geopolitics or anything else, but it is only about AI?
Yeah, so I'm happy to say that we've been doing a lot of research at Bruegel on this point. And so we've been going subsector by subsector in the three most relevant critical technologies, semis, quantum, and AI. And the field where China falls behind clearly, I would say even slightly so with Europe, so, really far behind the US, is quantum. And I do think that the amount of investment that the US is putting on quantum is making a big difference. The US AI action plan, in my mind, is really Trump's hope in this kind of extended trade war in which he cannot really push. So what else can he do? Attract funds from the rest of the world. Look at Japan, look at Europe, in the billions and billions, hundreds of billions, to support this U.S. ecosystem of critical technologies, whether it's AI or eventually quantum. I think that's where the U.S. is heading. So China is falling, but it is following, but I think it's still following, in my view.
Alicia, when you look at what happened over, actually since January 19th with the inauguration of Donald Trump, could China be the real winner in this? Because if countries are getting more away from the U.S., do they need to turn to China? Are there also active questions in Europe on what to do next?
Yeah, so totally. I mean, if the plan was to encircle China, I would say it's actually not working. It's the other way around. China, if we continue, may encircle the U.S., or at least partially, because many of the U.S. allies are kind of thinking, okay, why I'm here? I've been, I've been treated miserably, whether it's with tariffs or, other means. So this is making a lot of space for China to get other countries closer, but not only among U.S. actors, but also Global South, because, the question is, who is offering more? And by now, if you look at greenfield investment, China's greenfield investment is really booming. Everybody's thinking, okay, that's what I need. And China is the only one offering this at the moment, because what the U.S. is doing is attracting investment into the U.S. rather than offering investment into any other country in the world. So that's how, China is indeed making strides to attract the rest of the world in a nutshell.
Alicia, this is a difficult question, but do you think Presidents Xi and Trump will actually meet before the end of the year?
I'm not sure if this is a difficult question, but I can tell you what I think. They will meet by the end of the year. I think Trump is looking forward to this meeting, probably thinking he will, this will be extremely positive for his image globally, that is. Now the question is, will he pick the right timing, a very, very dangerous timing for the world, would be this anniversary. I think it's the 3rd of September, if I'm not mistaken, Putin in town in Beijing. What about that one? Hopefully not that one. But yeah, I think he will be heading to China by the end of the year. That's the question.
So interesting. Alicia, thank you so much for all of your thoughts. Alicia Garcia-Herrero, Chief APAC Economist at Natixis. Now, Keir Starmer says Britain will recognize Palestine in September unless Israel agrees to a ceasefire with Hamas. The UK Prime Minister says Israel must also commit to a peace process that would result in a Palestinian state. Israel condemned the announcement, calling it a reward for terrorism. Now, joining us now is Paul Wallace, our managing editor for Economy and Government in the Middle East and Africa. Paul, good morning. So what are the details of Starmer's position, and are we likely to see more countries follow the UK and France?
Hi, Francine. Essentially, Starmer has said that the UK will recognise Palestinian statehood come September if the war in Gaza between Hamas and Israel is not over. So this is him putting pressure on Israel, essentially to end the conflict before then. France has taken a slightly stronger view and said it will recognise a state of Palestine regardless. As to the question as to whether this will change anything for Palestinians or for Israel, the answer is probably not. Of course, it's symbolic. It is very significant that the UK is doing this and that France is doing this as well. But it's important to note that the Israeli position against a two-state solution is very much hardened has very much hardened since October the 7th. There's very little support for a two-state solution, and I'm not just talking about within Prime Minister Benjamin Netanyahu's far-right nationalist coalition. I'm talking about Israeli society as a whole. It does not support this, and there's even quite strong evidence that many Palestinians don't either, that everything that's happened since October the 7th, the day itself and the war in Gaza since then, and pretty intense clashes, deadly clashes in the West Bank too, have sort of hardened each side's stance and made a two-state solution that much more difficult to achieve.
So, Paul, what's been the reaction from Israel?
So Israel has kind of reiterated its position, if you like. Benjamin Netanyahu has said pretty simply that this rewards terrorism. Essentially what Israel has argued, well, people like Netanyahu have argued for a long time, since pre-October the 7th, but certainly since, is that if you have an independent Palestinian state that has not been negotiated with Israel, then it presents a security threat to Israel, and that essentially something like October the 7th could happen again. So that's a pretty firm position in Israel, and that's what a lot of Israelis think as well. And it seems as if, whatever happens between now and September, it's quite hard to see the Israeli government taking any steps towards accepting Palestinian statehood. There could still be a ceasefire in Gaza, which would obviously be welcomed by most of the world, but is very different from Palestinian statehood. That's something that's still ongoing, and at some level, Hamas and Israel, they're still holding talks to bring about a ceasefire, but it doesn't look imminent.
Paul, thank you so much. Paul Wallace there with the very latest on the Middle East. Now, 4-foot tsunami waves have been recorded in Hawaii. Remote parts of California are bracing for impact after a powerful earthquake in Russia's Far East triggered tsunami alerts across the Pacific. Now, the magnitude 8.8 quake struck at a depth of 21 kilometers of Russia's Kamchatka Peninsula on Wednesday morning local time, triggering tsunami alerts from Japan and China to as far away as Indonesia and New Zealand. And Blackstone has confirmed that a top executive in its real estate business was killed in yesterday's shooting at its Manhattan headquarters. Wesley LaPatner was chief executive of Blackstone REIT and a 43-year-old mother of two. She was amongst 4 people killed in the shooting, including a police officer and a security guard. Now, law enforcement officials say the gunman was targeting the National Football League headquarters in the same building, but went to the wrong floor. Now, coming up, we're back here in Zurich. The chief executive of UBS say he will not make the bank smaller to mitigate the impact of future Swiss capital requirements. More from our interview with Sergio Armati next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Well, the UBS chief executive, Sergio Armati, says he will not make the bank smaller to mitigate the impact of future Swiss capital requirements. Now, his comments come as the lender posted higher than expected profit in the second quarter with net income of $2.4 billion. Well, I spoke with Sergio Armati about the bank's results a little bit earlier.
If I look at the overall profitability, particularly when looking at the core underlying profits being up 25% year on year with wealth management, businesses in every region growing on a PBT basis, double digit, very strong, and I see good inflows in our alternative business in asset management, reaching 300 billion of assets. In markets, we delivered the second best quarter on record. So I think that's across the board in Switzerland, we continue to be a strong partner to our clients, with 40 billion of credits or new credits. So across the board, making good progress on the integration. Big milestones was achieved. 400,000 clients were migrated in Switzerland in a smooth way. We are now working on delivering the second wave in the third quarter. And in non-core and legacy assets, we are making good progress in taking down cost, and so I'm very pleased.
So even you're ahead of expectations in terms of integration?
Mm-hmm. No, we are online. We are on track. I mean, the integration, I think the next, we already achieved 9 billion of cost savings out of the 13. So we believe between now and year end, we're going to achieve another billion or so, and then 3 billions are going to come in 2026 as we basically shut down all the legacy systems, and we also complete all the logistical migrations.
Sergio, is UBS seriously looking at a possible new headquarter?
Look, what we are right now, we are very focused on serving our clients, on delivering on the integration. I think that's and our base case is that we are working also very hard to make sure that we can successfully operate out of Switzerland as a global bank.
But I mean, I guess the relationship between UBS and Switzerland looks from the outside to be at rock bottom. Do you need Switzerland?
I think that we have a very strong and solid relationship with our clients and the broader Swiss business community and client space. We serve more than 2.5 million clients, probably even higher, 200,000 SMEs. So we have a very solid and embedded relationship with the communities where we live and work in Switzerland. So I think that's I wouldn't really extrapolate some kind of issues to the broader Switzerland. The vast majority of the people recognize our value, and we recognize the value Switzerland brings to us.
Is everything on the table? I mean, could you sell off the U.S. investment bank? Is there anything that you could get rid of to lower that capital requirement?
Look, our view on that matter is crystal clear. Shrinking is not an option. UBS and Switzerland benefits from our diversification. You look at this quarter, Switzerland is performing well despite a very challenging environment around interest rates and the economic situation. But we have offsetting businesses that allow us to benefit from this diversification. Having a global diversified business is a strength for us and for Switzerland, and shrinking is definitely not an option.
When you look at the market views, of course it's a big week for trade. I think we also have GDP a little bit later in the U.S., but how do you see it going forward?
Well, I mean, the good news is that now we have probably a higher degree of predictability on what the outcome of this tariff discussion will be. If we land at around 15% on average is a base case scenario, which in any case is something that needs to be digested. This is 6 times higher than what we had at the beginning of the year. This brings some kind of inflation. If you think from an exporter standpoint of view, if you are a Swiss or a European exporter, you are basically seeing your clients in the U.S. have to pay 15% more because of tariffs, plus another 10 to 15% more because of effects. And this is a quite big change, so it remains to be seen what's happening in Europe in terms of economic effect, but also what is the consequences for inflation in the U.S., and this will then translate into potentially consequences for the monetary policies of central banks.
But Sergio, are clients saying, look, they're also worried that this is not it for tariffs, that they can always move back, so actually the uncertainty could remain?
That's a fair point. I think that's what investors and clients, corporate and institutional investors, private investors want to see is stability. I mean, first of all, we need to reach agreements, and then they need to see that there is a degree of predictability and stability in these agreements. There is a degree of news fatigue in the market, so people want to be able to act with certainty.
UBS Group Chief Executive Sergio Ermotti speaking to me earlier now. Time for a look at other banking results. HSBC earnings for the second quarter fell short of expectations after it posted an increase in expenses. Now, the lender also took a charge on its holdings in a Chinese bank. Well, joining us now is Bloomberg Intelligence Senior Bank Analyst Thomas Notchel. Thomas, thank you for joining us. So what were your key takeaways from the set of results from HSBC?
Hey, good morning. So first of all, yes, the bank may have missed on reported pre-tax profit numbers, but if you look into details and you exclude all the notable items, actual pre-tax profit is of 10% beat, so relatively very strong underlying performance. Revenue were strong, NII was strong despite HIBOR plunge in the second quarter of the year. Transaction banking was strong, wealth management is very strong, so the revenue momentum is still still much on track. Cost on like-to-like basis is flat, so it's as well suggesting restructuring costs is on track. So definitely good news there as well. And cost of risk was a little bit higher than the full-year guidance of 40 basis points, and this is reflecting commercial real estate troubles in Hong Kong. But banks seem to be confident that the provisions it set aside will cover the risk looming in the next couple of quarters.
So we've also had Spanish banks, Santander and CaixaBank, reporting results. What stood out for you?
Well, what stood out for me is now, if you look at the share price performance, definitely there's lack of new catalysts, right? So Santander reported in line. There's no upgrade to 2025 numbers, guidance. There's no There's no new news on the share buybacks or some other capital distribution following recent strategic moves in Poland and in UK. So, we are expecting possibly Investors' Day in February to have new catalysts, some that would keep the momentum of the stocks up. If you look at CaixaBank as well, they beat the guidance, they beat the expectations, but the revised guidance is in line with consensus again. So there's no exciting news to keep the momentum of the share price performance in the couple of last months.
Thomas, thank you so much. Bloomberg Intelligence Senior Bank Analyst Thomas Nutzel. Now, Visa reported third quarter earnings that beat estimates, with revenue rising some 14% to a record $10.2 billion. Shares fell 2.3% and exited trading after the world's biggest payment network left its full-year earnings outlook unchanged. And L'Oréal shares are higher. That's despite sales missing expectations in the second quarter. The world's biggest maker of beauty products reported weaker demand in North Asia and a slowdown in Europe. European sales rose 2.4%, well below forecast. The beauty industry as a whole is facing consumer uncertainty due to U.S. tariffs, while demand for skincare and makeup in Europe is slowly, particularly in France. Sales at Gucci have plunged to 25% on a comparable basis as shoppers turn away from Kering's largest brand. Well, luxury goods are in focus today, with Hermès and Prada updating investors. We're now joined by Bloomberg opinion columnist Andrea Felsted. Andrea, difficult set of figures from Kering. These issues once again at Gucci.
Exactly, and we're really in a holding pattern for both Gucci and Kering. Gucci's got a new designer, Demna, and he won't show his full collection until next March. Apparently, we'll get a hint of it in September, but that looks quite a long way to sort of wait. Plus, we've got a new CEO also coming in September. So these results, obviously, Gucci was quite worrying still, but they're not really the main event. It's really what comes next that matters.
A more positive, Andrea, outlook from Hermès.
That's right. I mean, Hermès continues to outperform. Overall, the results were in line with expectations, but leather goods outperforms. It's really all about that Birkin bag. You know, the fact that there's more demand for the bags than Hermès can meet means they tend to outperform in difficult times. You know, you make a wish for your Hermès bag. If it turns up and you don't want it, there'll be someone else further down the line who will want it. So that's really what keeps things going in the right direction.
Prada also reporting today, Andrea.
Exactly. So the thing to watch with Prada is whether Miu Miu can keep up its incredible growth. It's been the fastest growing luxury brand. It's fashion, it's younger, it's slightly but not much more reasonably priced. We'll see if that's still continuing or whether it has slowed, and also whether there are any hints about what it's going to do with Versace.
And what do all of these results actually tell us about the wider luxury sector, Andrea?
I think they show us that we are probably closer to the bottom of the downturn than we are the top. The US doesn't seem to be getting any worse. We are seeing, stock markets rallying, crypto coming back. That's always good for luxury demand. Again, China not getting any worse despite the trade war. And Kering was actually saying they were seeing some signs of improvement at the very top end.
So interesting as always, Andrea. Thank you, Andrea Felsted there. Now, up next, Bloomberg Brief, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy? It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it. the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport. Do you ever envision having a team that's based overseas in Mexico City or in London? Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. Dissent at the Fed. More than one governor may break rank in today's decision as President Trump intensifies the pressure. And it's a mega earnings day. $7.6 trillion in market cap will be reporting. Results include Microsoft, Meta, and Qualcomm. And just 2 days away from President Trump's tariff deadline, we await deals with China and India. Well, we finally broke the winning streak of 6 days that also brought with it 6 consecutive records. We move higher again today. It's been a very mixed earnings bag. That has been weighing on just how successful these indices have been. You're looking at an S&P that's a little change this morning, up about 1/10 for the NASDAQ. For the bond market, it was a powerful rally, really being brought about first by jolts. But this narrative started to evolve. Are we going to get a quarterly refunding announcement today that does something to cap yields? You can see some of those gains reverse. It is yields higher this morning by about 1.5 basis points for your 10-year yield. That is trading at 4.33. It's a busy day of earnings, of a Fed decision, of data. Before all that, though, let's look at some of the stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start with Starbucks. Out with earnings after the bell yesterday. Came in with a beat in net revenue, and their sales numbers looking good in their key markets of North America and China. Those shares are rising 4.6% in pre-market. The new CEO's turnaround plan looks like it is proceeding on schedule. Next, let's move on to Visa. They failed to raise their guidance, seeming to disappoint investors. Those shares are down close to 2% in the pre-market. The CEO did have some positive news on U.S. consumer, saying consumer spending remains healthy, both in discretionary and non-discretionary buckets. Let's move on to Europe. We did have a lot of European banks reporting earlier today. The big one, HSBC, Europe's biggest lender, disappointing on profit. Those shares are declining nearly 3%. And then lastly, UBS, a bit of a different picture here. They did come in with a beat on profit. Those shares are in the green, but the CEO saying some really positive comments, Danny, saying that their clients are ready to deploy capital, that their deal pipeline looks healthy as this uncertainty around the economic outlook has dissipated. Danny.
Valerie, thank you very much for that. We'll catch up with you later in the hour. Also this hour, we'll speak with Kit Jukes, SocGen, who will join us for his view on the dollar and where we go from here. Later, we'll also count down to the Fed decision with Priya Misra of JP Morgan. Now, trade headlines this week have sent the euro weaker, the dollar stronger. Markets still awaiting more clarity as we get more deals in the pocket. Kit Jukes of SocGen writing, the right market position in August is no market position, especially this August. But the danger is dollar shorts turn into dollar long as U.S. exceptionalism is reinforced. I'm pleased to say Kit Jukes, Chief FX Strategist at SocGen, joins me now. So, all right, Kit, I'm ready to just pack things in and go to the beach, given that. But it does seem like the pain trade is kind of here this week. We saw the long end, for example, have a powerful rally yesterday. The day before that, it was $1 long. Are we off sides heading into what is bound to be a volatile and thinly traded summer?
Well, we're definitely skewed in terms of our positioning, so we can probably go both ways, which is particularly scary. Yeah, look, what we know in the market is that there's been a lot of dollar selling, particularly euro and yen buying over the last few months, so the market has a big dollar short. The professional market, on the other hand, has tended to be long in terms of options positioning dollars. So we have a mix of those positions, and then against all of that, of course, we'd started to see for the first time some hedging of US dollar exposure from the long-term investor community that's been buying US stocks. So there are quite big positions in different places. The one that's getting squeezed out because of the perception that the Europeans caved on tariffs, for want of a better way of putting it, was clearly the euro-dollar position in the market. And that saw us fall faster over the last 72 hours than most people had expected, after having gone up higher than pretty much anybody had expected. So we can squeeze that one out. I don't know how far we can squeeze the bond market. I've always thought the thing with the bond market is that there will be supply and it will come and someone will have to buy it. But yes, in FX, I mean, frankly, we could be at 120 or 110 at the end of the summer. I wouldn't be that surprised. It's a question of navigating the news pretty carefully.
It's a perfect encapsulation of just how confused and how many cross currents there are right now, Kit. But when it comes to the euro, you said the EU is perceived as having caved in. How do you actually understand how we evolve from here, whether there is some real economic damage to come from the EU because of the deal that they reached with the US, and what that means for whether a trend of a strengthening euro is broken at this point or simply just disrupted?
I think there's two parts. And firstly, the best estimates I've seen of what the effective tariff rate is at this point in time is that it's gone to 11% from about 10, because the tariff deals have lots of things that don't have tariffs, some things that had higher tariffs, and so we get this headline announcement. In the end, it doesn't move the dial as much as it moves the sense. And I'm with everybody else. I'm disappointed by the way the negotiations have been so one-sided. But so you had a pretty big market reaction to this in terms of disappointment. I don't think the economic impact is anything like as significant as that. That's going to be determined by lots of other things. So we'll see what happens with the European data. Meanwhile, I think the big story is still to come in twofold. One, the U.S. economic story. Do the tariffs get paid by exporters or producers, exporters, importers, consumers? The more the U.S. consumer pays for these tariffs, the more the U.S. economy is going to end up having to slow as disposable income is hit. We're not even going to know this for months. That's the first big thing. And then there's this piece about, let's call it Fed independence, but let's see how Fed policy evolves from here with massive uncertainty about inflation and some signs of some slowing in the economy, but not enough signs to scare anybody.
I'd love to break down those two separate thoughts, Kit, but if we just start with the Fed, because we have the decision today, we may get 2 dissents, the first time that's happened since the 90s. How do you expect that to change things at all if we do get a decision that has likely Waller and Bowman dissenting?
It just increases the talk about what happens next. I mean, there's no, I don't think you can make an economic case, not a serious one, for cutting policy now ahead of the way that tariffs have played out. The economy is too strong to justify easing policy at this point of view. Would I think be a sort of pretty broad consensus view from everybody outside the United States anyway. So if you get a sense that policy is being politicized, I don't know that you get a massive reaction straight away from 2 dissents. That's not huge, but it adds to this sense that President Trump wants lower rates. President Trump wants a weaker dollar. If officials start to support that against what the economy is doing, then it's a big threat to the international investor community, which fundamentally has been driving the dollar higher for the last goodness knows how many years.
Part of the curiosity, though, Kit, is it's a Chair Powell who usually is pretty successful in stitching together some sort of consensus. If we don't have that clear consensus, if we don't have what many have said has been groupthink and maybe welcome some dissents, but if we don't have that, does that muddy the message that we're likely to get from Powell today?
I think the message is muddied by any kind of dissent only in the sense that the message is politicized. You know, so we know what the Powell message is, and if it were a completely united Fed arguing to the U.S. administration that we can't realistically cut interest rates while there's this much inflation uncertainty out there, and while the economy's not doing that badly, let's not exaggerate the weakness that we've seen in small pockets. If that's a united front, it tells one story. If there start to be cracks in that, it just adds to this sense that the U.S. administration wants to politicize monetary policy.
So, Kit, if we need to wait to see what the impact to the economy is as to who's paying for tariffs, what inflation looks like, what is your sense of timing? When can we come back from the beach? When should we come back from the beach for those who have gone and start to pay attention?
We should absolutely be back from the beach in time for the August payroll data at the beginning of September. September is always the most exciting and important month in financial markets. August is always dangerous and difficult and all sorts of things happen. I have big principles on this stuff. Definitely you need to be back from the beach in your office in the first week in September. But and then we'll see where it goes. I think for now, we're just going to react. We're going to overreact to each piece of news, and it's going to make it very difficult.
What about the timing and just the sequencing of things, Kit? Because maybe you start to see some of that economic weakness or inflation or what have you at the end of the year. But then in the start of 2026, you get the one big beautiful bill starting to take hold. You have what's expected to be more deregulation. Does that yet again confuse just where we stand and how loose or tight conditions are for this economy?
Look, if the U.S. economy comes out of this into next year with, let's say it comes out of this with looser fiscal policy and the tariffs haven't caused a really big amount of economic damage, then the bottom line will probably be that the peak level for the euro or the lowest level for the dollar in this cycle is somewhere around the end of this year. But, because in the end, what we've got is an environment where the rest of the world has invested far too much money with far too small foreign exchange hedges on it into the U.S. economic dream. And is now nervous. If it transpires that the U.S. economy can kind of reverse that nervousness and uncertainty and come into 2026 looking like it's going to come out with, let's call it a slowdown that isn't a recession and pulling away after that, then I'm just going to have to come back from the beach, see how much money I can make being short of the dollar in the fourth quarter of the year, and then get long dollars at Christmas.
Kit, you are our favorite travel agent. Thank you so much for coming on the show this morning. Kit Jukes, hopefully you're off to the beach after this. Great to see you. All right, let's get you some other top stories that are trending on the terminal this morning. And the Aston Martin Formula One team will be valued at around $3.2 billion in its latest stake sale. CEO Adrian Hallmark said that the team's listed car maker has agreed to sell its minority stake in the team for nearly $150 million. He declined to name the buyer, saying the deal had yet to complete. Mercedes-Benz and Porsche are scaling back profit expectations for the year as President Trump's trade war takes a toll on the luxury car makers. The two German firms are also highlighting intensifying competition in China, where an EV price war is hurting demand for its pricier models. Shares of Hermes, meanwhile, are falling despite a sales increase. Concerns over the stock's valuations overshadowed the better-than-expected second quarter results. The performance of its share price this year is quickly moving towards the average of the sector. Coming up, the third round of U.S.-China trade talks are done. We're going to bring you the takeaways with our reporters on the scene. That's coming up next. This is Bloomberg.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
Treasury Secretary Scott Bessent speaking in Stockholm after the third round of trade talks with his Chinese counterparts. For more details on the meeting's outcome, we're joined by Oliver Crook, who is in Stockholm, and Brendan Murray, who's tracking that and other trade deals, who leads our global trade coverage for us. Oliver, let me start with you. What has been the outcome of day 3?
Yeah, there's a little ambiguity around that, Danny, after these sort of 2 days of meetings wrapped between Scott Bessent leading the U.S. delegation, flanked by Jameson Greer, the U.S. Trade Representative, speaking with the Chinese Vice Premier here in Stockholm for 2 days on trade negotiations. The ambition was to get a truce prolonged between the United States and China in the trade war that they sort of prompted earlier in the year, where you saw tariff rates exceed 100% in each direction, basically precluding any trade between the two biggest economies in the world. The ambition here was to extend the deadline, which is August the 12th, for that truce to continue. We had a press briefing first from the Chinese, who seemed to have indicated that that was a done deal, that that was locked in, and then a little bit later hearing from Scott Bessent saying that no, we're not quite there yet. We're waiting for the final sign-off by Donald Trump, who will be briefed today by the delegation that was here in Sweden about whether or not he's going to extend that truce. Longer term, Danny, there's a lot that has been made about a possible meeting between Xi Jinping and Donald Trump at some point in the near future, though I have to say in a number of the conversations that we heard from Scott Bessent yesterday, saying basically that there wasn't a huge amount of progress, it seems, on some of the other key issues that the United States and China have to work forward to. So instead of having anything really to deliver, and I suspect that this is a relationship that is going to continue to make progress really with 90-day increments. So I think that for the market, generally speaking, the expectation is you will get an extension of that truce, despite the fact that they did not strike it here in Stockholm. That's why you've seen the markets be relatively calm about all this. But again, in terms of longer-term progress, I think this is a long road that we're going to be kicking the can down for the months to come.
Brendan, to Oliver's point, it needs a final sign-off from Trump, but just because Trump has the final sign-off doesn't mean that more work needs to be done. The EU is a great example of this, of Howard Lutnick saying yesterday that still plenty of horse trading is left to do. Read the EU deals. Brendan, what is left to be negotiated? What are still the unknowns a few days out now from actually getting that deal agreed upon?
Well, the deals that we've seen so far, whether it's the EU or Japan, are broad frameworks. They're kind of ambitious goals that the two sides agree to with big numbers. But the more you dig into them, the more unachievable they look, and the more details there needs to be hashed out, and important details in terms of the rate of tariffs that are going to be applied to sectors and broadly on these various economies. So what we're expecting over the next 48 hours before the Friday deadline is the three big deals that could still come together in Asia are India, South Korea, and Thailand. There are indications that those are still moving moving in the right direction, although Jameson Greer, the U.S. Trade Representative, said that India was still has some work to do. And then in Europe, there's a Swiss deal that the Swiss are trying to get over the line. Pharmaceutical tariffs are a big issue for Switzerland. So we'll have to see. It's going to be a furious 48 hours for the White House to codify these tariffs and get them in a place where they can be implemented on August 1st. And in the meantime, you've got a lot of chaos out in the business community that doesn't really know which direction the tariffs are going and whether they'll be kicked in on August 1st as the president has promised.
Even though we've seen these tariffs be placed on, these agreements happen without any reciprocal tariffs, retaliatory tariffs rather, from other nations. Oliver, given the U.S.'s position and its ability to get these deals, broad frameworks, let's call it, agreed without any kickback, without any pushback from these countries, how does that color the U.S.'s standing as it speaks with China?
Well, I think that's really interesting, Danny, that precise point, because you look at the deal that you got with Japan and the United States, the EU, the United States, the UK and the United States. In all of those sort of conversations, the dynamic there is that the other side of the table, whether it's the Europeans, the UK and the Japanese, as sort of Brendan was alluding to, they want to appear to be giving Trump more than they really are, right? There's these hundreds of billions of dollars pledges. These things are going to be very hard to monitor. How much of it is stuff that's already been pledged? All of these sorts of things. You have basically the exact opposite dynamic with China, where China has been building itself up over the last few decades economically, its status on the global stage, and it is basically unwilling to bow to the demands of the United States, as we've seen in the last couple of times. And I'll just make one final point here. The first time you saw these trade negotiations and Trump won, the Chinese delegation went to Washington, D.C. In Trump 2, they're in Geneva, the UK, Sweden, third-party neutral countries.
Oliver, thank you very much for that. That is Bloomberg's Oliver Crook and Brendan Murray. Coming up, we're going to take a look at the front pages this morning. That includes a tsunami warning for the west coast of the United States and parts of Russia and Asia. That's coming up next. This is Bloomberg.
Opinion, at least, the reason that the U.S. is so creative and innovative and has so much interesting development and has, most of the largest trillion-dollar businesses is because we have the best capital markets. And capital market development is really what creates the funding in order to pursue ideas. So in America, any idea you have, there's a market for it. Right? So building markets like the securitization markets in the U.S. Really allowed for non-financial companies to get into the financial industry business. And that was really a derivative of making the securitization market so competitive. So building securitization markets and continuing to grow markets and figuring out how to continuously fund ideas, I think that's going to be the next stage of growth for these markets.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Let's take a look at the front pages this morning. First up, it's Fed Day, and the Wall Street Journal is looking at the potential for Fed governors to break rank. President Trump has been cranking up the pressure on the central bank and Fed Chair Powell to cut rates. The Fed is expected to hold today. Next up, the FT reporting that the German economy shrank 0.1% in the second quarter. The print was in line with expectations, but it does mark a slowdown from 0.3% growth in the first quarter. And on the New York Times front page, a tsunami waves reaching Hawaii after the biggest earthquake since 2011. The 8.8 magnitude quake has also prompted warnings and evacuations in Alaska, California, and Japan. For more on this, we're joined by Bloomberg weather and climate reporter Joe Wertz. Joe, what's the latest?
Well, like you said, those waves have hit Hawaii and California. They've been moving across the Pacific since that quake started. Broad tsunami warnings were issued across the region, but we're starting to see some of those get downgraded. Some canceled outright. Ones in China have been canceled. Some of the ones in Hawaii have been downgraded to advisories. So we're hearing that, while there still could be some potential impact, the biggest fears of damage or disruptions from these waves seem to have been missed. No major disruptions or damage reported so far.
Joe, is there understanding that there's still evacuations in places? Where does that still exist? Where are still the risks?
Yeah, still some evacuations, still ports being shut down, some energy infrastructure and things like that were evacuated as a precaution. So those are still ongoing throughout the region, and authorities have been out early and loudly trying to keep people away from the coastlines and off the beaches, and have advised that it's going to be a little bit before they start giving the all clear signals. So some of that those evacuations and disruptions still in place, but we're starting to see those get canceled and the situation be downgraded a bit.
Joe, thank you very much for that. That is Joe Wertz. A quick check on your bond market this morning, and we are looking at yields pushing higher, but that was after a powerful rally yesterday. We're up by a basis point and some for both the 10-year and the 30-year yield at 4.33 for the U.S. 10-year yield after softer JOLTS data, and a look forward to a quarterly refunding announcement and a Fed decision today. Coming up, we're going to speak with Priya Misra of J.P. Morgan on that busy week and how to hedge risk assets for that. That's coming up next. Stay with us on your brief.
is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. Dissent at the Fed. More than one governor may break rank in today's decision as President Trump intensifies the pressure. It's a mega earnings day. $7.6 trillion in market cap will report, including Microsoft, Meta, and Qualcomm. And just 2 days away from President Trump's tariff deadline, we await deals with China and India. Well, we broke the 6 consecutive days of gains and 6 consecutive days of records. We push higher this morning ahead of big earnings, again, from Microsoft and Meta. We get Apple, we get Amazon the day after. Plenty of risks ahead. The NASDAQ 100 outperforms, up 0.1%. Meanwhile, the big rally in this bond market takes a breather, the best day for duration since June, but we move higher by more than a basis point, nearly 2 for the 30-year yield. Yesterday was marked by, yes, softer JOLTS data, but also perhaps some questions into the market about what we might get from a quarterly refunding announcement today. We also have a Fed decision today and GDP data. There is a lot, but let's look at some of the stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with Starbucks. Out with earnings after the bell yesterday. Came in with a beat in net revenue and showed some decent sales numbers when it came to their 2 key markets of China and North America. Those shares are rising near 5% in pre-market trade. Maybe this is the first signs that the new CEO's turnaround plan is starting to work. Let's move on to one of the losers from the earnings last night, and that's Visa. Those shares are down near 2% in pre-market trade. They failed to raise their guidance, which is causing some disappointment among investors today. But the CEO did have some positive things to say about the health of the U.S. consumer, saying that we're seeing resilient spending when it comes to discretionary and non-discretionary spending. Lastly, let's end on a check on some European banks. We did have a fair few amount reporting earnings in Europe this morning. HSBC, Europe's biggest lender, came in with a miss due to rising expenses. Those shares trading down 2.5% in London. And then the Swiss giant UBS, that came in with a beat when it comes to their profit. Those shares are rising sub 2% in trade in Switzerland, with the CEO saying that their deal pipeline, their clients are ready to deploy capital now that economic uncertainty has dissipated. Danny.
Valerie, thank you very much for that wrap up. And it is a huge week for markets. The earnings will continue. Valerie mentioned the ones we've already got, but we also have 4 Mag 7 names out with results. $11 trillion of market cap report today and tomorrow. But that's not it. We also have a Fed decision. We have the July jobs report. We have a tariff deadline on Friday. By the way, we also have GDP data today. There's PCE out this week. There's so much. JP Morgan Asset Management Portfolio Manager Priya Misra writes, this is one of the most macro weeks of the year. Any weakness in the incoming economic data threatens all markets, and we think owning some duration is an attractive way to hedge risk assets. I'm pleased to say that Priya joins us in the studio now. Priya, really wonderful to see you this morning. So with all of that, between earnings, between data, between a Fed decision, more trade deals? What is the biggest risk, do you think, of this week?
I think it's really the jobs data. So I'll be watching ADP, I'll be watching claims, and then the all-important payroll report on Friday. You know, because we have seen some slowing in payrolls. I think there's a big question, how much of it is immigration? How much of it is just noise in the data? Is there some seasonal component? We saw that last year. But are we seeing fundamental slowdown? Because remember, even the debate at the Fed is all about risks to both sides of their mandate. The Fed's been really concerned around the inflation side of the mandate. I think the market's pricing that in and not really pricing in any risk to the growth side. You start to see that the payroll numbers are slowing down, that it's still concentrated in a couple of sectors, but the overall pace of hiring is slowing. I think the market might start to worry about the other side of the mandate. And then I think the soft landing narrative that I think is embedded in every market, that starts to unravel. So that is, you know, as you said, there's a lot this week that we're all trying to keep an eye on. But I think it's the jobs data that's most important.
If there is weakness and the soft landing narrative starts to unravel, how vulnerable are we with stocks at an all-time high and credit spreads incredibly tight?
So I had a client actually tell me yesterday, well, the Fed's going to cut. And yes, I do think the Fed's going to cut. I think they're very credible if they see signs of that downside risk. But here's the issue. Interest rates are still restrictive. How much do they need to cut to get into accommodative territory? We can debate what's neutral. Is it 3, 3.5? We're at 4.5. So there's a lot of, they have to cut a lot, and they'll want to see what happens on the inflation side. So the speed of those cuts may not be as much as I think risk assets might want. And then there are lags to monetary policy. We saw it on the way up. So I do worry about risk assets. I think there may be this hope that, oh, the Fed will cut, but you're not going to get much on the fiscal front. And so if we are slowing down, I think you'll get a pause and some of the risk premiums should rise. And, you know, that means wider spreads, that means weaker stocks. And it doesn't need to be recession. It's just a slowdown, I think, closer to 1% in GDP. I think that might make the market a little nervous, and that's why I think having a well-diversified, balanced portfolio, that's why bonds should play the role. And I know we've debated correlations. I think the last time I was on, I was saying, I don't know, correlations are unstable. We're seeing now more signs that correlation's coming back because the Fed will be in play. That helps. The Sell America trade, we've seen the auctions. They've been fine through this period. Foreign demand still strong. You know, domestic demand's been extremely strong as people are saying, if I can get 5.5%, 6% in high quality spread product, all in yields with lower volatility, it's attractive. So I think that's why that correlation will hold. So if you have risk assets on your portfolio, just own some duration in case the economy does slow down more than is.
Well, duration had a fantastic day yesterday, Priya. There has been some chatter, maybe we get something from the quarterly refunding announcement that helps to cap yields. Do you think that's a move this administration would make?
I think not yet, because we still have a deficit issue. We still have very high funding needs. I think what the market is looking for is the message, is the reading between the lines. Is the deficit a little better because of tariff revenues? I think the market looked at OBBB, the One Big Beautiful Bill, and said that's a 6 trillion bill or a 5.5 trillion bill in terms of total deficit. Well, how much do the tariffs come in? If 10 or 15% is the new zero in terms of tariff, that's a tariff revenue of 300 billion or so per year. That's 3 trillion over 10 years. If this is the new normal of having 10 to 15% tariff rate, then the deficit picture might be a little better. So we'll watch at 8:30. Does the Treasury acknowledge it? That actually the deficit picture is not as bad. And then does TBAC or Treasury start talking about where do they issue it? And I think if they just signal that there's more demand in the belly of the curve, which I would agree. I think demand in the long end is not that high. Pensions and insurance are there, but that's not growing. The marginal demands in the front end, will Treasury skew that issuance in the front end? I think that's what the market started to price in a little bit. I don't think you're going to get any definite announcements today at 8:30. They can just keep auction sizes the same, but we'll be watching for that messaging. You know, do they say, well, actually, the deficit, I know everyone's concerned, it's not as much of an issue. You don't have to issue as much in the long end. I think some of that fiscal fear is priced into that long end. I think we started to see some of that come off. But I don't think you're going to get some big announcements.
Are you expecting any distortion in the curve, especially on the front end? When you get legislation with things like stable coins, that needs to be backed by those cash-like instruments. Are you starting to see that? Are people preparing for that? Will it have a lasting impact?
I think it's another source of demand. And you know, whether banks, so we had the SLR relief, banks might end up buying more, again, 0 to 5 year treasuries. you raise a great point. Stablecoin, I mean, let's see, is that worth $1 trillion? TBAC has said could be as much as $1 trillion of demand. We haven't seen it, but I would argue if Treasury has to issue, and this is, you know, the Treasury should always be looking for the lowest cost of financing for the taxpayer. If there's more demand in the front end, whether it's coming from stablecoin or banks, they should issue more in the front end. So I think we'll see this over time. Let's see how much stablecoin demand picks up. But I think they're smart in trying to find new buyers, domestic buyers of treasuries. If foreign demand is going to be a little bit less, well, where's that demand going to come from? I think stablecoin and banks might be the place.
So, Pri, when we get a Fed decision today, there is a chance that we get 2 dissents, the first time since the 1990s. It's a Fed Chair Powell, who for his term has been very good at cobbling together a consensus. What happens if it's that much harder to do it this time around?
So I think 1 or 2 dissents is priced in. I mean, Governor Waller's speech was, I think, the first time I've seen a dissent before the meeting. I think he effectively did that. Now, it's possible that you get more than a couple of dissents, but look at how extraordinarily uncertain the economic outlook it is and the risks to the outlook is. And so I think the dissent is priced in. I don't think it looks that political because Governor Waller, and maybe you'll see this from Governor Bowman, have highlighted that they're more concerned about the risks to the labor side of the mandate. They're in the team transitory, and as somebody who was part of team transitory a few years ago, I have some sympathy for that view. Tariff inflation tends to be often one-off. And you look at service inflation in the last few months, it's been weaker. Does Chair Powell get a little bit of a consensus and doesn't get those dissents? I think that is a chance that you don't get those dissents because he highlights that maybe the risks to inflation are not that high. Remember the June meeting, or even before that, they were highlighting that they're more concerned about the inflation side. And I think if he can sort of tone that down a little bit, you may not even get the dissents. It is going to sound a bit dovish. So I think, yes, dissents. I still think the sanctity of the Fed, or the structure of the way the Fed is set up, they're in there looking at the 2 mandates. I don't think they're political. I think it would be a mistake for the market to see 2 dissents as being political because it's just a difference in views in terms of the risk to the mandate.
I was going to say, I was talking with Kit Jukes of SocGen earlier, who basically was saying there's no reason to be talking about cutting, certainly no reason to cut in July. Do you think that there are people who are looking at Waller and looking at Bowman and saying this is political and missing a market narrative that might be unfolding? Is there a real risk in that some of the conversation around it is being distorted because of the concerns about what is political and what's not?
Great point. I sort of, you know, if we didn't have the political background, I think the intellectual argument that Governor Waller is making is actually very sound. He's saying, look at under the hood. Private hiring is slowing. It's highly concentrated. Look at JOLTS. You're not seeing any signs of wage inflation. This is very different from 2020, 2021 when inflation was taking off. He's highlighting what economists will tell you, that tariff inflation tends to be a price level shock, one-off shock. So I think there's a very solid intellectual argument for cutting, you know, not 200, 300 basis points. I think that's where we can, if you have the dissents where people are saying they should cut 300 basis points, that I think does look political. If the argument is, let's just take the level of restrictiveness lower, let's get to neutral, if that's 3 or 3.5, I think that's a very valid argument because the economy, there's no question the economy is slowing. We're not into recession, but if we're slowing at sub-trend, Fed funds shouldn't be here. It should be closer to 3.5. So I actually think, yes, I think the market may be saying, well, this is just auditioning for the next Fed chair. I think it's unfortunate because there is a real debate, and I'm sure the Fed is having that debate as we speak, that let's look at the 2 sides, let's look at risks, and do we signal that the risks are shifting? I think that's what I'll be watching for.
All right, we'll see what that decision brings at 2 p.m. Eastern today. Priya, so wonderful to speak with you. Thank you for helping us set that up. Priya Misra of JP Morgan Asset Management, and you are watching Bloomberg.
Listen carefully. you hear the rhythm in the markets. Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity. I hope you survived the day.
I did. It was a busy day.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The Chinese deputy minister did say that we had agreed on a pause. We have not. Nothing is agreed until we speak with President Trump.
U.S. Treasury Secretary Scott Bessent speaking after 2 days of trade talks with his Chinese counterparts in Stockholm. For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, what is the latest? How close are we to an extension or even a deal?
Well, Secretary Bessent said this decision is going to be up to President Trump. They're going to go back to Washington and brief him on the talks today. The body language in the press conferences afterwards was one where you got a sense that the talks were cordial but not warm, and not a whole lot of progress was made. So the decision goes to President Trump about whether to extend for another 90 days is one option, according to the U.S. officials that we spoke with. So we would expect some kind of clarity on that one way or the other, but it would be a surprise if he didn't extend it. That would just create a whole lot of more uncertainty for markets and businesses that are already facing a lot heading into this Friday deadline for these separate reciprocal tariffs on the rest of the world.
To that point, Brendan, where might we see more deals get inked before the Friday deadline?
So the three deals that we're watching that seem to be close are there's been one with India that has been close to the finish line that they're going to try to get over the line by Friday. South Korea is also furiously trying to get a deal that resembles what Japan got, and Thailand is also expecting something before Friday. The Swiss here in Europe think that they're in the queue near the front of the line too, but we'll have to see whether the White House can pull all of these together with just 2 days to go.
Yeah, it's a whole lot and not a lot of time. Brendan, thank you very much. We'll catch up with you throughout the rest of the week, Brendan Murray. It's also a busy week of earnings, and there, Starbucks rising in the pre-market trade this morning, up 4.7%. That's despite sales and profit that fell more than anticipated. The CEO says the company's turnaround is ahead of schedule. For more, let's get the latest with Bloomberg's Sabah Meddings. Sabah, what did we hear from Starbucks? Why the rally this morning despite some of the weakness in the figures?
Yeah, it was a fascinating set of results, actually, because like you say, there was a fall in comparable sales. But I think what investors are really focused on is the green shoots of what we saw from Starbucks. They talked about how they've got this kind of crucial target for serving customers in drive-through locations under 4 minutes. I think it was sort of just hovering above 3 minutes. There's a $500 million investment in labor, getting more workers on the shop floor, sort of improving rotas, things like that. Brian Niccol, the CEO who joined in September last year, he really wants to kind of create this more cozy look at Starbucks. And he's got his work cut out. They've got to reverse sort of several years of declines in sales. And it is a tricky time because, obviously consumers in the US are squeezed. They will have to look at prices a little bit. But, another green shoot also investors are responding to was China, which does look to be sort of signs of improvements there in terms of sales. And Brian Niccol said on an analyst call that he had 20 parties that were interested in a stake in the China business, which was reported on Bloomberg.
Of course, Brian Niccol, formerly with Chipotle, Sabah, which you and I believe spoke earlier this week about how poor some of the earnings have been. As you look at some of these consumer companies, both across the U.S. and Europe, what has been distinguishing between those who are able to cope with the current environment of uncertainty, maybe consumers getting a little bit more cautious, and tariffs on top of that?
Yeah, for consumers, it is really, really tricky. And I think particularly what you've seen in the US is when there are sort of threats on tariffs, people are pulling back a little bit, is how much ability these companies have to push through prices. I think perhaps talking about Heineken, what will the impact of tariffs be, whether it's sort of packaging, raw materials, how much sort of price elasticity they have. I think when Brian Niccol joined, he sort of said he was conscious of not putting up prices. And today there was, he will have to do that in some sort of to some measure, but we'll be a little bit cautious about it. So that'll be a really interesting one to watch.
Sabah, thank you so much for that. That is Sabah Meddings. Now, in the next 2 days, $11 trillion worth of market cap of companies are set to report. Now, the bulk of that is going to come from the big tech players. Just today, Microsoft, Meta, Qualcomm, they will be releasing results after the market close today. Back with us is Valerie Teitel. Valerie, what are we expecting from the tech giants today?
Well, look, for both Meta and Microsoft, it's going to be a fair amount of attention on their CapEx guidance after Alphabet last week raised their full-year CapEx by an extra $10 billion. So that is going to be a theme through these earnings reports for big tech. But let's focus in on Meta for a bit because it's all about whether the CEO, Mark Zuckerberg, can convince investors that this AI spending is justified. Remember, it was just a month or so ago that he spent $14 billion in an investment with Scale AI. We also know that he's been building out this AI super intelligence team with some of these compensation packages being worth over $200 million. It feels like it's not a day that goes by that we haven't heard that Meta has poached yet another AI researcher from a firm. Yesterday was no different. Apple lost the 4th AI researcher to Zuckerberg's AI super intelligence team. So it's about weighing up these expenditures and these kind of costs with the revenue they're currently making on their advertising business and whether Zuckerberg can convince the markets that it's worth it.
Valerie, at the same time, likely what we got from Alphabet last week is what we'll get this week. Just unbridled spending on things like data centers and, to your point, talent. When you look at the overall environment and what this does for the economy, how important is it that we continue to get, at some pace, capital expenditures coming from the tech giants?
Well, look, this extra boost to CapEx will essentially boost everybody who's within their pipeline. Especially looking at Microsoft. A lot of the attention is going to be on their cloud business as well, but their CapEx guidance is something that's going to be of focus. Now, remember, when it comes to Microsoft, their cloud business is about the sales that come from these practical AI applications. Remember, it's tie up with OpenAI's ChatGPT. If it's able to capitalize on just giving the businesses these kind of tools to help AI, that's been something that's boosting Microsoft's bottom line. But there could be something that clouds the Microsoft earnings, and that is what happened last week when it came to that cybersecurity breach by Chinese hackers. We did hear from Microsoft spokesperson that the impact was minimal, but it might be a key concern for not just their clients, but for investors if Microsoft can convince them that their cybersecurity measures are rock solid.
Valerie, thank you very much for that preview. We'll see what those earnings bring after the bell today. Bloomberg's Valerie Teitel. Coming up on the show, there are no shortage of market events to look out for this Wednesday. We could probably spend an hour just reading you the calendar, but we will have your trading diary for you up next on your brief. Stay with us.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute news whenever and wherever it happens. I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your very busy trading day. First up, we're going to get ADP employment data. That comes at 8:15 a.m. Eastern. GDP and a quarterly refunding announcement at 8:30 a.m. And then, of course, it's Fed Day, in case you forgot. The latest rate decision coming at 2 p.m. Chair Powell's news conference will come at 2:30 p.m. Will we get 2 dissents? It would be the first, if we do, of getting more than 1 dissent since the 1990s. And a deluge of earnings after the market closed. That includes Meta, Microsoft, Qualcomm, and Ford, but just to be clear, we have a lot of earnings alongside that. And already earnings we had last night moving this morning in the pre-market. Starbucks, one of them. Better than expected net revenue. Recall they have a new CEO that they poached from Chipotle. They say that the turnaround plan is on schedule. Those shares up more than 4.5%. Mondelez, those shares, though, are down this morning 2.5%, just thereabouts. It sees weaker North American sales. It did affirm its guidance, though, for the year. Then there's Seagate. That's extending what it had of double-digit losses. Post-earnings declined 6.3% is where we stand this morning. 2026 revenue and EPS fell short, below analyst estimates. Let me just set you up with how this bond market is looking before that Fed decision, because it was a big rally yesterday. Some questions of would yields be capped in today's quarterly refunding announcement. Also softer JOLTS data. We're little change this morning, but your 10-year yield hangs around at 4.32. Your 30-year yield at 4.87 after the biggest rally for duration since June. All right, that's it for your Bloomberg Brief. Surveillance is ahead. This is Bloomberg.
Villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse. the philosophy they believe, yin yang 5 elements, the concept of the life, of the happiness. They build this kind of roof like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
There is a little bit of a handing off of the baton here from trade and taxes to the Fed.
The Fed shouldn't be cutting rates. They're not in the position to cut rates.
I expect Fed's playbook isn't going to change a whole lot.
Risk assets don't really care as long as the idea of rate cuts keeps being alive. That is totally fine.
The question really is, of course, around the September meeting.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, it's Fed Decision Day.
I call him too late, pal, because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He's a knucklehead. Well, I'd love him to lower interest rates. Other than that, what can I tell you?
Fed Chair Jay Powell stepping into an uncomfortable spotlight following months of pressure from the White House to cut interest rates. Investors will be looking for some signs of dissent on the FOMC. The decision just hours away.
So we're going to get a lineup of guests this morning telling us the Fed meeting, we're going to anticipate it so much, and they are not going to consider it as important as the earnings and as the economic data coming out this week. But everyone's watching. We'll be actually on air at that time, so if you want to watch us, go ahead. The reason why is because of the political ramifications of this. I'm sure that there will be one President Trump also watching this meeting. The key question is, how does it get messaged at a time where they're likely to hold rates, at a time where the President of the United States keeps saying, too late, is holding rates unnecessarily tight, terrible, horrible. Let's see what he does. Let's see what the White House responds with when they do hold rates steady.
The next meeting after this one is September 17th. We've got 2 jobs reports, 2 CPI reports. The chairman of the Federal Reserve has every single reason in the world to make this very, very boring later on this afternoon. And there's a couple of individuals in the FOMC that might do their best to make it entertaining.
Well, entertaining for one person in terms of campaigning to be the next Fed chair, and that is Michelle Bowman, as well as Chris Waller. This would be the greatest descent on the FOMC going back to 1993, and it harkens back to the 1980s when the Reagan White House kind of stuck a couple people in the on the Fed's board in order to skew things, and you had some dissent, and it was a much more kind of volatile committee. Are we heading back to those days? Is that actually appropriate? And this, I think, is an important conversation. It's one thing to say it's politically motivated. It's another thing to say that on Wall Street there is incredible disagreement about where we are in the economic and inflationary cycle, and an incredible disagreement on how much we should cut rates. So as much as we want to cast this all in a political light, and properly, it also has a big economic debate underpinning it.
The debate is actually interesting on both sides of the demand day. It's not just about inflation and tariffs on the labour market. If you go to the statement, and we'll be looking at the statement this afternoon, when the Federal Reserve says the labour market is solid, you've got a Fed governor coming into this meeting making the case that the labour market is on the edge. And I'm looking for any subtle change in language in that statement later on this afternoon.
How does a Fed chair that has designed his entire chairmanship on consensus building deal with dissent in a graceful way? That will be a very interesting moment. at the press conference and in the statement.
What a day we've got coming up for you. A Federal Reserve decision and news conference with Chairman Powell. Lots of earnings and lots of economic data. Coming up this hour, we'll catch up with Stuart Kaiser of Citi as stocks snap a 6-day winning streak. John Lieber of Eurasia Group with Fed Chair Jay Powell under pressure from the White House. And Angelo Zeno of CFRA looking ahead to earnings from Microsoft and from Meta. We begin this hour with Stock Steady as traders await big tech earnings and a Fed rate decision. Stuart Kaiser of Citi writing earnings are the biggest risk for the week and unemployment the most important for the next 3 months. Stuart joins us now for more. Stu, good morning.
Morning.
Just how relevant is this Federal Reserve?
I mean, they're all relevant. Don't get me wrong, but I think to your point, they would like this to be as irrelevant as possible. I think unless they signal that the inflation data they got a couple weeks ago actually changes their thinking and their thought process on the path of rates, I think the market, this is going to try to be a nothing done type event. There's always a risk, and I think the risk here is that they skew a little bit more hawkish. But all in, they've got, to your point, a lot of data coming up. They also have Jackson Hole, which they can use as sort of a quasi FOMC meeting about a month from now, and I think that gives them a lot more freedom to be flexible today.
It's a long runway into September. You've got a sort of a 1 month view and a 3 month view. In the near term, the earnings. We've got Meta, Microsoft later. In the longer term, the next 3 months or so, the labor market and unemployment. Just kind of frame that for us this morning.
Yeah, I mean, I think to us that's been the most unemployment rate has been the most important data point you get, for a while now. And I think to the extent that if the Fed is cutting rates with a 4.1% unemployment rate and you're an equity investor, you have to probably really appreciate that help. If you get the unemployment rate rising up to around 4.5%, then in our view, a couple rate cuts is not nearly enough, and that'll put a lot of pressure on the Fed to cut more aggressively. But if they're also getting a little bit of a tariff impact on inflation, it creates some kind of dual mandate issues for them. So, look, the U.S. consumer has been the white knight of the global economy for a long time now, and to us, that weakness in that part of the economy is by far the biggest risk to the market.
What weakness? And I say this because, yes, we did get JOLTS data, job openings data yesterday that came in slightly lower than the expectation, but the quits rate's still holding in there. And a lot of the other surveys have shown quite a bit of resilience and stability. What weakness and cracks are you looking at that gives you a sense that maybe we could get up to 4.5% unemployment rate?
I think at this point, you'd actually need to see job losses, right? To your point, the labor market feels like it's in a state where you don't have a ton of layoffs, you don't have a lot of quits, but if you do lose your job, it's quite hard to find a new job, et cetera. So I think when economists see that, they view that, to John's point, the labor market's on edge. There's some weakness and some fragility there. But I think until you see actual layoffs from corporate America, the market's going to try to look past this stuff.
There are a couple of different stories that are kind of layered on top of each other, which is one reason why it's been such a difficult market to understand this year. One of them has been the earnings story, and the AI story in particular. We get Meta and Microsoft today after the bell at a time where capital investment has just been through the roof. At what point is this market really hinged on the idea that continues, this idea that capital expenditures has to keep accelerating in the AI space?
Yeah, I mean, I think that's probably the single most important thing we get later today. Obviously, the earnings guidance matters, but it's the CapEx guidance. If we look back to Google last week, they actually increased CapEx again this quarter after a massive increase last quarter. So, look, I mean, that's the key to U.S. equity markets now. It's the key to the earnings outlook, and frankly, I think it's the key to the U.S. versus rest of world, discussion as well. If you want to be in that AI trade, you kind of have to be in U.S. equities. So, that CapEx is kind of the fulcrum for a lot of stuff, valuation, earnings, and also kind of relative performance globally.
Stu, just to build on that, does it make this equity market in America that much more resilient compared to, say, Europe? The numbers coming from Europe this morning, Adidas getting hammered this morning, not signaling much confidence at all. Porsche, Mercedes cutting their outlooks. China a problem. Tariffs may be in the future a problem for them as well. Just describe the character of the US market versus, say, Europe, and what that means for the resiliency of those individual stock markets through the rest of this year.
Yeah, I mean, I think if you look back the last couple of years, I would argue that U.S. exceptionalism has been a combination of fiscal spending and the fact that we have large cap tech and growth stocks in the U.S. that frankly just don't exist in a lot of other markets. If you want to invest in AI and large cap tech, you maybe have a small number of companies in China at the top end. You have probably a handful of companies in Europe, and then you have the U.S. And I think I was in Europe a few weeks ago, and I was surprised at how underweight the AI trade a lot of those investors felt, especially after 1Q earnings when the CapEx guidance got pushed so much higher. So, look, the U.S. has large cap, it has growth, and it has tech and AI, and I think what that means is there's just a gravitational force kind of pulling dollars into the U.S. market that you just don't have elsewhere.
Begs the question this morning, what is the compelling case to make today for superior returns on the continent for the foreseeable future.
Okay, perfect example for this. And as you were talking, Novo Nordisk, the weight loss company, I think of them, given some of the drugs that they have, used to be the second most valuable company in Europe. After yesterday's sell-off, is the sixth most valuable company in the index. It just shows you how much they're hinged on luxury and weight loss, and the idea that is sort of not necessarily with the AI trends.
And the market cap is something like 10% of one of the mega cap stocks reporting later.
Exactly. This is the reason why people are watching what happens in the U.S. with Microsoft and Meta, and saying that that determines U.S. exceptionalism more than almost anything else at a time when you're facing off with what we're seeing over in Europe.
Stu, can I pick up on a little bit of tension maybe in your call between the earnings from big tech and what might happen in the labour market over the next several years? The companies that will be responsible for developing the technology that might lead to job losses are the companies that might do the best over the next several years. Are you expecting some kind of divergence between how big tech performs and labour market developments over the next several years?
I mean, it definitely could be the case. There's been a lot of articles written, and we see it as well on Wall Street. As this AI it replaces a lot of the mundane tasks that we all do. And I think what you're seeing in that is, in a very simplistic way, is continuing claims. Right? Continuing claims are very, very high. If you lose your job, it's hard to find another job to replace that. And that may not be AI today, but that dynamic is what people are worrying about. With AI in the white-collar space in particular. So, yeah, there's an opportunity or risk there that these companies continue just to sort of acquire wealth and market cap and earnings at a time when it is sort of a negative impact, at least a down market on the unemployment rate.
Given how many question marks there are, and given the lack of clarity when it comes to the forward trajectory of the economy as well as just corporate developments, are you surprised there's been such little volatility, that the VIX has just fallen off a cliff?
Over the course of the last couple of months, yeah. Over last month or so, yeah. And realized volatility's collapsed. This is a little bit sort of how you evolve out of crises, though, is, you get this massive, surge of volatility for a period of time. The VIX goes high, the curve inverts, and then, people de-risk. And vol becomes sort of, self-correcting to some degree, and that brings the VIX down. I think what you're seeing now is the VIX is low, but the VIX term structure is very high. So the market is still pricing risk kind of in that 3 to 6 month window, even though the front of the curve is quite low. Look, if you look at two things I think are contributing to that. One is like vol target investors, systematic investors. They've bought the market 41 consecutive days. And the second would be we're on pace for a call at $1.2 trillion in buybacks. That's $5 billion a day of equity being bought. So I think once you take out the aggressive selling and then the re-risking, which is what we saw kind of into April and then out of April, what you're left with is systematic and more slow burn kind of money coming into the market, which is suppressed volatility. Obviously, everybody on Wall Street would like a little more volatility. So I'm not celebrating it. I'm just trying to explain where it might be coming from.
It makes sense. Stuart, it's good to see you. As always, thanks for being here. Thank you. Stuart Kaiser there of Citi on a range of issues. One being, we could have some negative developments in the labour market, but continue to have positive developments for the stock market.
Yeah, and you really highlighted a key point that people are looking at. The economy is not the market, and what we've seen is the biggest winners might be doing so at the expense of certain human mundane tasks that can get replaced by some of this AI development.
If I was to start an ETF, I'd call it payroll protection, and it would just be long NVIDIA, and that would be it. And I suggest that everyone should take out that option, that insurance package.
Yeah, it's called the NASDAQ, which is the reason why people are buying U.S. equities. It does go to the heart of the lack of clarity on exactly how this is going to evolve. And it's a question that we're going to hear in earnings calls from a lot of big companies, how they are adapting AI, whether it's with efficiencies or whether it's retraining.
Equity futures positive this morning by 0.1%. Looking forward to $11 trillion of tech earnings across just 4 tech names over the next 24 hours. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The U.S. and China have wrapped up 2 days of talks in Stockholm. The Chinese trade negotiator says they agreed to extend their 90-day tariff truce, but Treasury Secretary Scott Bessent said the Chinese may have jumped the gun a little. Bessent saying extending the pause another 90 days could be an option, but the final decision would be up to President Trump. Meanwhile, a massive earthquake off Russia's Far East has sparked tsunami warnings across the Pacific. The quake was a magnitude 8.8 off the Russian coast, the strongest since 2011 when an earthquake off Japan's east coast sparked the tsunami that led to the Fukushima nuclear disaster. Hawaii saw 4-foot waves before some alerts were downgraded to warnings and evacuees were allowed to return home. And Blackstone's offices in Midtown Manhattan will remain closed this week, and it's unclear when they will reopen following Monday night's shooting. Among the 4 killed was a Blackstone employee. NFL Commissioner Roger Goodell says NFL employees who were the intended target of the shooting should work from home until at least August 8th. That's your Bloomberg Brief. John?
Yahara, thank you. We'll have more on that story later on this hour. Up next on the program, Trump versus Powell.
I call him too late Powell because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He's a knucklehead. Well, I'd love him to lower interest rates. Other than that, what can I tell you?
Up next, we'll catch up with John Lever of Eurasia Group, live from New York City this morning. Good morning.
In New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The week begins a little bit later this morning. Check out this lineup. 8:30 Eastern Time. Economic data, Treasury refunding. Later on this afternoon, Chairman Powell and a Fed decision. And then after the close, earnings from Meta and from Microsoft. That is a packed 12 hours coming right up. Equity futures on the S&P 500 just about positive this morning by 0.1% on the Nasdaq, up by 0.2. Your small caps up by 0.4. Under surveillance this morning, Trump versus Powell.
I call him too late Powell because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He keeps the rate way up. I think it's Trump derangement syndrome. We have a moron at the head of the Fed. I think if Jerome Powell stepped down, it would be a great thing. He's spending $2.5 billion rebuilding the Fed. I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. He's a knucklehead. It's a tough construction job. It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1. I'm not aware of that. Yeah, it just came out. Well, I'd love him to lower interest rates. Other than that, what can I tell you?
Here's the latest this morning. Fed Chair Jay Powell expected to keep policy unchanged in the face of rising pressure from President Donald Trump to cut interest rates. Bloomberg's Tyler Kendall joins us now for more. Tyler, good morning.
Hey, John, good morning. Well, we are expecting to hear from President Trump later on today, but as you mentioned, if the Fed's expected to hold rates steady, that means that the president is likely to be unhappy, as the White House has really expanded its list of criticism ahead of this FOMC meeting. As you heard, it's gone beyond the Fed's wait-and-see mode, its stewardship of the economy, and it's really started to focus on Chair Powell's management of the central bank itself. And we saw that on full display last week when President Trump put on a hard hat and went down to the Federal Reserve's headquarters here in Washington to criticize the recent cost overruns of the renovation project that's currently underway. And we should say that there actually was sort of a sigh of relief after that tour, because President Trump indicated that he didn't think Powell's handling of the renovation ultimately amounted to a fireable offense amid speculation that the administration could be building a legal case here to remove him. But President Trump did say he made clear to Powell in private on that tour the path of monetary policy he wants him to take moving forward. The argument has also expanded into debt servicing costs for the U.S. government, something that Lael Brainerd, the former Fed vice chair and NEC director under the Biden administration, told me is an attempt by the administration, she says, to cover up the true costs of the reconciliation package, that one big, beautiful bill. Now, John, I did ask the Deputy Treasury Secretary Michael Falkender last year, in terms of economic outcomes that the Treasury is tracking, what would be the difference between cutting today and cutting in September? And he actually said that in his view, it's really about the big picture and keeping up with peer nations, just another instance that we can add to this list of criticism. Of course, we should say that Jerome Powell has defended the central bank's approach and says that any decision will be made with non-political analysis.
Tyler Kendall with the latest down in Washington. Tyler, thank you. More from Tyler in the next hour. Something on the edge of dangerous. Is it fair to say things are a little quieter since that visit last Thursday?
It seems like he got it out of his system for now. This is the question. Is it sort of in wait-and-see mode until let's see what they do on Wednesday, today, given the fact that he's saying, oh, terrible, how big the price was. And you had Jay Powell saying, not true at all. It was like a marital spat. And then he said, just lower interest rates and it'll all be good. So here we are. And what is the response post-Wednesday?
I'm not suggesting he won't say anything later. I'm just suggesting things are a little calmer. Maybe in Washington.
Blow the steam off the top.
Possibly. John Lieber of Eurasia Group joins us now for more. John, we've got to talk about this and obviously trade, but let's just start with this. We've seen criticism of Fed chairs throughout the decades. Is there anything different about the criticism coming from this White House to this Fed chair?
Yeah, there's a lot different because Trump's been spending the first 6 months of his administration taking a really heavy hand with the rest of the executive branch and asserting authorities that I think a lot of people, including me, didn't think he had. I mean, he's shutting down agencies, he's firing federal workers, and he seems and he's removed bipartisan board members from the FCC and other boards. So this is clearly a real threat that the president's trying to exert more influence over the Federal Reserve chair. We've seen presidents try to intervene with the Fed in the past. In the 60s, there was a legal opinion from DOJ that said that they couldn't fire him. And now it looks like Trump has the authority, or at least thinks he has the authority, to actually fire Powell. So this is a very different situation than I think we've ever seen with the Fed chair, at least in the last 40 years.
The president himself has acknowledged the fact that his term is up in May, and he might as well just wait. Why cause the disruption between now and then? John, how are you thinking about the timeline, the process to replace Chairman Powell?
So there's an open seat on the board that comes up in January. And from what I understand, several of the nominees who want the job are trying to angle to get onto that open seat, which is a version of Scott Bessent's shadow Fed chair. You put somebody on the seat, an outsider that Trump likes, that person would kind of just tend their garden and vote for the 5 months before Powell steps down, and then they would become the chair whenever Powell steps down. I think that's one plausible path here, and possibly the most likely. But I think, I don't think Trump's going to fire him. I think probably he'll make the announcement in the November-December timeframe, and probably no later than January or February. That person will then take over in May when Powell goes away. But this is not over yet, and I think that Trump has temporarily stopped threatening Powell. Today's an important day because if the Fed doesn't cut rates, let's assume Trump backs out again, and we'll have to wait and see what he says. Now, I do think the threat of the firing has gone down significantly after that visit at the Fed building last week. Trump seemed satisfied that the building wasn't that opulent, that it wasn't that much on the cost overruns, and it wasn't that crazy. And I think he also got the message that firing Powell would be very bad for his presidency. So I think the threats have receded, And I think markets will continue to look through Trump's statements about the Fed today and later this year.
What's more important then to you from a policy perspective, John? What we hear from the Fed today and the response from the president, or the refunding announcement in a little more than 2 hours' time, when we get a sense of exactly how the Treasury plans to finance itself. This is actually a key component of this whole discussion, given that there plans to be more emphasis on issuing on the front end, which is more directly connected to that Fed rate.
Yeah, I think that's right. And I think that, this issue of where to fund on the curve is one that the Treasury has been putting a lot of thought into. They were very critical of the Biden administration for having borrowed a lot more on the short end. But now they find that that's where the demand is and that's what they can do. So, I think this announcement will give some indications. This was something that the markets have been paying more and more attention to in the last few years. And given the enormous debts that the U.S. is racking up, these questions about how the U.S. is going to fund it, who's going to buy that debt, are top of mind. And I think the refunding is an opportunity for investors to get a peek as to the volume of treasuries that are going to be coming down the pike soon, which is enormous.
Maybe this is unrelated, John, but do you think that the fact that there has been some agreement between the U.S. and Europe and the U.S. and Japan gives some breathing room to take the pressure off the Fed, given that there will be the revenues coming into the U.S. Treasury from some of these tariffs that have been agreed upon?
That's probably right. I mean, I think we don't know the exact number that's coming in. It certainly is a nice little plug for the U.S. government. Let's assume it's $150 or maybe $200 billion a year in additional revenue. However, the government's running $2 trillion plus annual deficits. And over the long term, it's clearly unsustainable because of the U.S. demographic problems. So it probably helps in the short run. And I think that is going to be something that is important to pay attention to. But on the other hand, this makes virtually no difference in the long run picture of U.S. deficits.
Hey, John, appreciate your time. As always, John Lieber there for your Asia Group. Looking for that refunding announcement at 8:30 Eastern Time. The Federal Reserve, refunding, GDP, tons of earnings. This 24 hours ahead of us is absolutely packed.
It's pivotal. It really creates the halfway mark in 2025. It's shocking to think that we're just halfway through this year. And we look ahead until the second half, where things get a little bit more interesting in terms of the ramifications of some of these policies. We might start to see it in earnings, but really a number of economists and analysts say the proof's in the pudding in the second half, in the third quarter, in the fourth quarter.
We have clarity on the policy now.
Correct.
To some extent. At least we know what the deal with Europe's going to look like with Japan, and we're going to kick the can with the Chinese for another 90 days, possibly. So we've got the clarity on the policy. They've got 2 more CPI reports. Question I would have for the chairman today is 2 CPI reports enough to get a decent read on how this is going to play out, not over the next several months, but over the next 12 months? At some point, you have to take a leap of faith. If it's not today, when is it?
Yeah, and to that point, and this is the reason why you keep focusing on the labor market, how telling is the labor market that is resilient and holding in there, like so many guests who come on our show talk about, versus the Chris Waller view of things and what other people say as well, which is there have been cracks, and they do suggest that there's a greater degree of weakness than maybe some of the headline numbers demonstrate.
That's the latest on what we can look forward to over the next 24 hours. Coming up next on this program, we'll catch up with Sal Lafreri of Protective Countermeasures. The security experts look for answers following the tragic Manhattan shooting. Live from New York City this morning, good morning to you all. You're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Earnings in America just around the corner. 20%, 1/5 of the S&P 500 reporting across 4 names. That's more than $11 trillion in market cap. Huge companies, and their earnings reports are coming right up. Equity futures on the S&P positive by 0.1%. On the Nasdaq up by 0.2. 3 hours away from the cash open with your morning movers is Danny Berger. Hey, Danny.
Hey, John. Some stocks on the move that reported after the bell yesterday. Visa being one of them. Those shares down almost 2%, despite the fact that they upheld their guidance for the year. Earnings coming in solid. But analysts had been expecting that they would upgrade their earnings. The fact we didn't get that means that shares fell. On the bright side, the CEO saying that the consumer is healthy and they are spending. But that is a different story than what we heard at Mondelez. That's the maker of Oreos, of Ritz crackers. Completely different. Their North America sales miss. And there the CEO said that the consumer isn't healthy, that the consumer has anxiety, also saying that they did not expect to bounce back in the second half of the year because that's when tariffs will really start to hurt. So those shares down 2.5%. Elsewhere with consumer companies reporting, there was Starbucks. Yes, they did miss on a few figures, but the CEO, Brian Niccol, says that the turnaround is ahead of schedule and that things are going well. Those shares up 4.7% in reaction to that, saying that they were also going to unleash a wave of innovation in 2026. That includes things like protein cold foam. That sounds more like a science experiment than a drink. But either way, positive reaction to that, John.
Danny, hold up. What are they calling it?
A protein cold foam. I literally have no idea what that is. I only know those words.
How's that going to work? How do you drink foam?
Are you kidding?
You can drink foam. I can taste foam on something.
Oh, really? I actually really enjoy drinking foam, I have to be honest. Hold on a second. When you froth milk and then you just have the froth and you put some cinnamon in it, it's really yummy. It's like foam.
You just have the foam. That's
I mean, imagine that there's drink underneath
That's what I'm
but it's
getting
like,
at.
yeah, right. So like, it's just, but it's sort of like, it's sort of like sorbet, except foam if you want to lose weight.
This is not important. I'm getting lost in it.
Yeah, but I think that it's something that's really
first time I've heard
deep
of it.
dive.
Okay. Danny, thank you. Thanks for the distraction. Equity futures positive by 0.1%. Let's get you some top stories. On our radar this morning, a divided Fed. The central bank widely expected to hold rates steady today, but Fed Governor Chris Waller and Vice Chair for Supervision, Michelle Bowman, signaled they might dissent.
So how does a Fed chair who has designed his whole chairmanship around consensus message this? And then I think it's going to be really important. How much does he really lean into the idea that there's economic justifications on both sides of the argument at a time when that's really where Wall Street's at, but there is a pretty loud mouthpiece at the White House screaming down his neck. I mean, really, the reason why this feels like a marital spat is because it felt like they were looking at their balance sheet and bickering over line items. I mean,
this is the president and the chairman.
President and the chairman.
Okay.
So I just wonder how much he's going to cater to that relationship in addition to the relationship of the different Fed members.
Do you think it's possible that the division within the Fed might be a strength for the chairman today and not a weakness? That you can say it's difficult to provide a consensus right now because there are two very different views of the world. And essentially, Governor Waller did this for him a few months back when he put out a speech, and it was called A Tale of Two Outlooks. And he could present today a tale of two outlooks. You could say on the one hand, some officials are expecting this. On the other, some are worried about this. And we want a little bit more information, 2 CPI reports, 2 payrolls reports, to get back around the table in September, come out with some new forecasts.
A strength for Fed Chair Jay Powell in the eyes of who? I think that is the important question, because right now, you are absolutely correct. Right now, Fed Chair Jay Powell largely is endorsed by this market and said, a lot of people think he's doing a good job. There is this question of how much is he catering to one person in the White House, the way that other people speculate that some governor members are doing so.
Mr. Chairman, good luck. 2:30 Eastern Time for that news conference. The President setting to make the call on the US-China trade truce before it expires in 2 weeks' time. Chinese officials saying the latest round of trade talks landed on an extension, while the US Trade Representative Jamieson Greer said they jumped the gun. So where are we?
Yeah, big question mark. The expectation in markets is that the can will get kicked. It would be a huge surprise if President Trump tries to disrupt that in any kind of way, although there still are questions of what's being achieved in each of these negotiations, these extensions, especially given some of the concerns that people have about the concessions that are made in each of these particular meetings.
Yeah, particularly the relationship between the EU and the US. Just where are we on that front? How much pushback are we going to see over the next several weeks? I think one official in the administration yesterday said if they don't agree the tariff's going up.
Yeah, which is a pretty big threat, given that you're hearing already different parties that are more extreme saying this is the reason why we want to leave the EU. And that's something that you increasingly hear in the Euro region as a number of member states say this wasn't a good deal for us.
Pushback continues on the continent. This time it's from European corporations. The tariffs are taking a toll on many European companies. Porsche this morning cutting its profit outlook for the 3rd time this year. Adidas reporting weaker than expected revenue growth. And these companies starting to think about just how much this is all going to cost.
Yeah, one of the problems for particularly the auto manufacturers in Europe, and it kind of is a microcosm of the bigger story, is that they rely on 2 big markets disproportionately, the US and China. Both of those markets present opposite threats in different ways. One of them competitively with just dumping vehicles, and the other one saying, we're not going to have as much demand for you in terms of the pricing. This creates a real headwind at a time where there already was an existential question around how quickly they were adapting to the EV revolution, et cetera. It just puts the whole economic growth story in Europe on tenterhooks, and that's one reason why we've seen some skepticism expressed, particularly through the currency.
I'm pleased you said this, because it's not just China and it's not just tariffs. It's about whether the consumer actually wants electric vehicles from sports car manufacturers. That's the issue at play for that company.
Well, it shows that their margin for error was that much smaller because they already had been experimenting. And so they're at a weaker foot. And it shows that those with a stronger hand are able to maneuver through the threat of tariffs and the threat of competition from China. And those that kind of were missing it a little bit, whether it's Stellantis or Porsche, are feeling the pain that much more greatly. And I think that that's actually the story that really is encapsulated by the European auto manufacturers.
That's the latest from the continent this morning. Let's turn to the dominant story in this city over the last 24 hours. 4 victims killed by a lone gunman inside a Manhattan office building, making this the worst mass shooting in New York City in a quarter century. The victims have been identified, including top Blackstone executive Wesley LePatner. Joining us now, Shonali Bassett. Good morning, Shonali. A company in mourning.
A company in mourning, John. You have to remember that the building, of course, is still closed. You have very many companies that were housed in that building, but Blackstone in particular. Remember, the shooter was allegedly not looking for Blackstone. He was looking for the NFL. In the hallway, in the lobby, is where LePatner was shot as he was entering the building. I would say that people across Wall Street knew her very, very, very well because she ran a core business at Blackstone. This is a more than $325 billion real estate business at which she was a key executive, including the chief executive of BREIT, which is a more than $50 billion investment trust that connects to retail investors. It's one of Blackstone's biggest pushes. But she's also, this year, John, she joined the board of the Met. She, of course, was also on the board of the UJA Federation, so very close to the Wall Street Jewish community as well, and the Jewish community across of New York. But remember, the people who were killed in this shooting were across very many walks of life in New York. So this shooting looms very large. Remember, the woman who died at Rudin Management was not yet 30 years old. She was a very young associate. So still shaken, many people still working from home through the course of the week, certainly in that building. And in buildings nearby, people are back to work. But remember, the scene still looks like a crime scene in a place in New York that has become core Wall Street. Remember, these buildings are no longer downtown anymore. Most of the financial industry is now in Midtown nearby. So certainly this week does loom large across Wall Street.
Sonali, I'm pleased you brought this up. You know better than most who've always speaking to individuals of various financial institutions that are housed along Park Avenue. Executives over the last few years have made a massive push to get people back into the office. And I imagine over the last 24 hours, there's a greater degree of anxiety of employees of those companies about going into the office. How are the companies actually responding to this, to try and offer people securities that they're making the office place a safe place?
I'm glad you mentioned this, because even before this happened, I had been talking to executives about just this matter, John. And you did see, since the United Health executives killing just a matter of months ago, the very top ranks have increased security for themselves, of course. But in addition to that, this was a very strange shooting, wasn't it? I mean, the fact that he was able to get his hands on an assault-type rifle of that sort is certainly something that is hard to protect from. This is a building that was already very significantly secured. And the strange thing as well, John, is remember, this is in the August months in New York where a lot of people are not in town. So you can't really get a sense of how many people are actually coming in versus not coming in at this point in time. A lot of the executives in the companies I speak to say they're telling their employees, if you need a moment, take a moment. Don't feel like you need to rush back in. However, how long will that really last for? And how soon will employees be pulled back in neighboring areas? For Blackstone itself, remember, they also did say that at town hall late yesterday morning, saying that people need to take the time for themselves and grieve as needed here. But to your point on security, there has been increased security. I have talked to other businesses as well who are looking at increasing or reviewing security as we speak.
Sonali, appreciate the update. Thank you. Look out for Sonali later on Bloomberg TV. Let's build on some of this conversation with Sal Lafreri. He is the president of Protective Countermeasures, a firm focused on providing risk and threat management solutions to corporations. He joins us now. Sal, welcome to the program. We want to do better. How can these corporations do better?
Well, I think, as the woman just mentioned, that the, security at the building, especially at that particular building, was relatively strong. He actually had uniformed NYPD, even though he was working off duty, but uniformed NYPD presence in the lobby. It's tough to increase it any more than that. So the problem, I think, that really is existing, and I think that this starts to show, is that when you have these situations develop, this guy didn't just snap. He didn't wake up one day and decided he was going to do this. This is something that happens over a progression of time. And there are particular indicators to potentials to violence that occur that are often overlooked. And, we've developed a program called the TAG program, a threat assessment group that works with corporations, that actually looks at when you get that inappropriate correspondence that comes in. And more times than not, people just kind of throw it away and go, it's just a kook, it's a problem, it's nothing. And what we've seen over time is that it becomes something. It's a slow development. And the ability to get in front of it at that point to provide some type of counseling or interdiction is critical. Trying to stop it in the lobby in the moment when he walks in with the rifle is way too late.
Given that this was the most deadly shooting in Midtown in New York in some 20 years, from what you've seen, has there been a real increase in threats to different corporate offices, or is this just a really high-profile one-off that you can point to?
No, I think there are significant threats that are coming through. I think we see it almost on an everyday basis, right? 20 years ago, you didn't see the road rage incidents that you have today. The amount of anger, the amount of frustration that people are exhibiting, whether it's the economy, whether it's COVID, whatever it is, we're starting to see this uptick in it. And I think the other thing is with the advent of social media, it makes it very easy now to reach out to people. You know, before you almost had to work to get to a CEO and to get something in his hands or to get to him. You know, and today you can start off very slowly, and you can make these threats. So we're seeing an uptick along the way, where ultimately it winds up in violence. And, you know, one of the other statistics I think is sort of crucial is when the shooting happened the other day, I think the statistic was something like that was the 245th active shooter situation we've had in the country since January. So the amount of violence there is just, it's starting to just uptick.
There's still a lot of questions, and I know that the NYPD has gone to Las Vegas to get more ground intel to understand exactly what happened here. What's the key piece of information that you're still waiting to learn to properly gauge what this threat was and how to better protect against something like this going forward?
Well, I think one of the things that they'll be able to do is when they get into the home to understand, get a look at the computers if they're still there, any electronic devices that he may have had, to see where that progression came from. Was there any information? Was there anything that was sent to the NFL? Were there other writings? Were there things that friends and neighbors may have seen a change in? I think while we're not looking for a prosecution because the perpetrator is dead, but what we'd be looking for is a good understanding of what the motivation was in this. And again, this wasn't a thing where he just jumps up one day and decides to do this. Especially if it's proven to be true that it is CTE that he had, that's going to show over a period of time. And I think those are the indicators that we're going to be looking for. Did he write a manifesto, which seems to be going on? He did write a suicide note that he brought with him. So clearly he had an indication that this is what he was going to do, that he wasn't going to leave alive.
Tragic. Truly heartbreaking. Sal, thanks for making time for us this morning. We appreciate it. Sal Lafreri there of Protective Countermeasures with an update on stories worldwide. With your Bloomberg brief, let's cross back over to Yahara. Hey, Yahara.
Hi, John. The U.S. and India are racing to negotiate a trade deal before Friday's deadline. President Trump says he may settle on a 20 to 25% rate, though that isn't final. Any levy of that magnitude would be a blow to India, which had been one of the first countries to negotiate and had been seeking lower rates than the 19% given to Indonesia and the Philippines. Meanwhile, HSBC shares are falling in London trading. The bank reported quarterly earnings that fell short of expectations as its CEO pushes through an increasingly costly restructuring. Expenses for the second quarter jumped 10% to $8.9 billion. And as the world's largest trade bank, it says it will see an impact from higher tariffs. And an Australian space rocket making the country's first attempt to reach orbit crashed shortly after takeoff. The Ares rocket exploded after 14 seconds of flight from a launch pad northwest of Brisbane. But Gilmore Space says it still considers the launch a big step for Australian capability and is setting its sights on another test flight. The launch came after months of delays. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara a little bit later on this morning. Up next on the program, a high bar for big tech.
I think we're going to see some pretty big CapEx numbers. I think we're on a path to $100 billion at Microsoft. We're probably on a path to $80 billion at Meta. But you put it all together, I think investors will reward it.
Up next, Angelo Zeno of CFRA.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Live from New York City, welcome back to the program. Under surveillance this morning, a high bar for big tech.
When I look at what's probably going to happen out of the likes of Meta, Amazon, and Microsoft this quarter, I think we're going to see some pretty big CapEx numbers. I think we're on a path to $100 billion at Microsoft. We're probably on a path to $80 billion at Meta. At Meta, I mean, the question is, are we going to see 18% top-line growth? That definitely justifies this level of CapEx spend. At Azure, at Microsoft, my gut is we're going to be north of 35%. But you put it all together, I think investors will reward it.
Here's the latest this morning. Mag 7 stocks going into earnings season close to record highs following a 40% rally from the April lows. Angelo Zeno of CFRA writing, recent strength from Microsoft and Meta means that they have the highest bars to beat, but we think both remain the cleanest AI stories. Angelo joins us now for more. Angelo, welcome to the program. Let's talk about those two names. What makes them the cleanest AI stories?
Well, and thanks for having me, John. I'd say overall what makes them the cleanest AI stories is, one, there's a clear path for AI monetization here over the next couple of years for both those names, I think. The other thing, too, is there's just less, there's less outside stories tied to it. For instance, with an Alphabet, you've got more legal regulatory issues out there. Apple's obviously got some of their issues. So there's a number, when you look at the other Mag 7 names, it just gets a little bit messy in terms of some of the competitive and legal regulatory issues that are out there. I'd say within those two names, Meta and Microsoft, you can also add NVIDIA, obviously among the Mag 7 names, which is also a very nice, clean story as far as the AI revenue trajectory here over the next couple of years.
Angelo, can we just sit on Meta? Is the more important number today going to be the CapEx number or the earnings number, the revenue figures?
So I actually think it's more of what the OpEx number is going to be for Meta. And, when you think about the CapEx number, they did hike it last quarter, right? So I think they actually got ahead, about a quarter ahead of everybody else in terms of hiking the CapEx number. And they actually did it back in April when visibility was very low at that point in terms of some of the tariffs and what have you out there. But they were looking long term, and we thought it made sense here. They could potentially increase CapEx again this quarter, especially with some of those, the 232 sectoral semiconductor investigation. We'll get an outcome here over the next couple of weeks, and that could potentially inflate some server prices out there. But at this point in time, we're looking actually for CapEx to be relatively sustained, maybe increase slightly. The OpEx number, I think, is what I'm a little bit more interested in. They actually tweaked it down last quarter. I think with some of these recent hires that we've seen, the creation of that superintelligence group, I actually think there's a significant bias to the upside in terms of OpEx, and that could potentially have a negative impact in terms of the earnings trajectory. But again, the most important thing is going to be the revenue here for the company. And based on what we saw out of Alphabet and what we're seeing from the digital ad landscape right now, I do think there is a bias to the upside where they could potentially beat by at least 200 to 300 basis points.
That is the most Wall Street way of saying that people are really going to look for the $100 million bonuses and some of these these capital expenditures that they seem to be making. It seems like we keep flipping and flopping from the nuts and bolts of balance sheet analysis to the hopes and dreams of the promise of AI. Which is it going to be that is better rewarded in this particular earnings cycle? It feels like you're saying the hopes and the dreams more than the nuts and the bolts.
I think it depends on the company, to be honest with you. In terms of the infrastructure plays, you think of a company like a Microsoft, and and even some of these non-Mag 7 names, right? The Oracles of the world. Those have been some of the best performing names this year, and because the reason for that is because you're getting immediate monetization of AI from those names, and that makes all the sense in the world. In terms of Meta, it is more the hopes and the dreams because you're not getting that instant, revenue recognition from AI. This earnings call is going to be all about Zuckerberg really telling the AI story here over the next 2 to 3 years. It's kind of justifying some of those recent hires that he made and talking about the potential for them to really see a step up in AI monetization in 2026 and 2027, which we think he's going to be able to do. And we think there are a number of ways that Meta is going to be able to monetize AI across that app-based platform. So I think it all depends on the company, Lisa, but as far as Meta is concerned, it is more the hopes and dreams.
Do you think that Meta is going to change its name given the fact that the metaverse no longer is the hopes and dreams of this company?
So I've been saying I think they should change the name to Meta AI. So not necessarily fully change get the metaverse out of its name, but throw AI in there. But no, I don't think they fully changed the name. But I wouldn't be surprised if they threw AI across that name.
Angela, credit to him. Just how adaptable is Mark Zuckerberg? His ability to say we're going all in this direction, then to accept that's the wrong direction and pivot and go elsewhere.
I think you give him all the credit in the world. I mean, one thing with Zuckerberg, and a lot of people often forget this, is he's got the voting power in that company, right? He can essentially do whatever he wants within Meta, which is something that a lot of these other CEOs necessarily can't do. So Zuckerberg is really kind of able to switch on the dime and kind of inflect it and change his thought process and throw that across the organization really quick. So but yeah, I mean, you have to give the guy credit. I mean, he realized he was wrong back a couple of years ago, realized he overhired, significantly cut costs because that's essentially what was needed to be done in an inflationary type of environment, and now he's kind of pivoting again towards going full force AI, and the street does like it because unlike the metaverse, AI does have that kind of that revenue trajectory that I think Wall Street can see here over the next 2 to 3 years.
Angela, appreciate it as always. Angela Zeno there of CFRA, head of earnings from Meta and from Microsoft. This earnings call later, just a recruitment pitch to anyone at any other tech firm.
All you have to say is $100 billion. I think your recruitment pitch is pretty solid.
Up next on the program, Cameron Dawson of New Edge Wealth, Heidi Kribo-Rediker of the Council on Foreign Relations, Courtney Breen of Bernstein, and the former St. Louis Fed President, Jim Bullard.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We've had a great run. I think investors should feel good about that.
Industries with the strongest margins have been leading.
Values right now are not cheap.
The weak dollar, if that starts reversing, that will actually put some pressure on U.S. stocks.
No one wants to admit this, but the direction we're going in now, it looks like we are going to see better participation across the economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. As we count you down to the opening bell, 2 hours and 30 minutes away. Your scores look like this. Equity futures positive by 0.1% after snapping a 6-day winning streak in yesterday's session. On the Nasdaq 100, higher by 0.2%. The Nasdaq and Big Tech in focus later. Earnings from Meta and Microsoft. Tons of economic data at 8:30 Eastern Time. And then the awkward one later on this afternoon. A Fed decision and Chairman Powell news conference.
You know who made it awkward? President Trump, by saying, too late's going to come to the podium. Look, he has a point with respect to the economic argument for cutting rates at a time when people don't see the inflationary pressures accelerating meaningfully over the next few years, stemming from tariffs, at least isn't sort of the premier economic look. That said, there isn't really a reason to cut right now, given what we're seeing in the underlying jobs economy. And so you're going to experience that descent for the first time in a massive way, going back to the 1990s.
There isn't a big difference between now and going into September. We've got 2 more CPI reports, 2 more payrolls reports on August 1, September 5th, CPI August 12th, September 11th. I actually think the more interesting debate will be at the September meeting. You've got that data underneath you. You've got to provide some forecasts. And I think at some point you've got to make a call on this. You've got to make a call. Governor Waller's made that call. He's saying he doesn't think there's going to be that much pass-through. And the degree to which there will be pass-through, it's going to be transitory. That's basically his argument on inflation. He's made that call. Will the rest of the committee make their own call in September?
Well, and right now you're hearing more members actually suggest that that's the case, right? So it's not just Mickey Bowman and Chris Waller, two Fed governors. If they both dissent, it would be the first time that you get that kind of dissent on the Board of Governors going back to 1993. It's also Mary Daly, and she came out and she said, we can't just sit on the sidelines forever. You have to make a call at a certain point. Currently, there's a 66% chance of a rate cut baked in for the September meeting. This is why I think it is very interesting in September. If they don't cut, that will require a bigger explanation for the market, let alone President Trump, than if they do cut. And I think that that really sets up a pretty fraught meeting.
Citigroup says you can't hurry Dove. Do you like that?
That's beautiful.
I feel like they've used that one before.
I feel like that should be a song. And I feel like we're about to get a song.
No, because it is a song.
No, Hurry a Dove.
No, you can't hurry love. Oh, my goodness.
Oh, sorry.
No. Oh, no, Bramo. We can't restart. We're live. Coming up, Cameron Dawson of New Edge Wealth with stocks snapping a 6-day winning streak.
I'm going to leave.
Heidi Kripa-Rediker, the Council on Foreign Relations on U.S.-China trade talks, and the former St. Louis Fed President Jim Bullard counting down to a Fed rate decision. You going to be okay?
No, I don't think I am.
Okay.
I think I would have to bow out.
Let's begin this hour with stocks steady ahead of a Fed rate decision and Mag 7 earnings due out after the closing bell. Cameron Dawson of New Edge Wealth writing, we are still in an uptrend, but this setup suggests some healthy near-time digestion. Cameron joins us now for more. Cameron, good morning.
Good morning.
Any comment on that and what just happened? Should we let that go?
Absolutely no comment.
Okay, great, guys. All right, I'll just be listening to Supremes over here. All
just describe the setup for us. What's on your dashboard right now?
Okay, we are going into a tougher seasonal stretch in the month of August. We typically see volatility pick up. We are having this position where we're starting with an overbought condition. We've seen valuations get to 22.5 times forward. Positioning has now gone from being deeply, deeply underweight in April to now modestly overweight. Still room to get more overweight. You've seen strategists chase this market higher by raising their price targets. You've seen sentiment rebound. All of this suggests that maybe we could have some digestion. Nothing to end the rally. We're still in an uptrend. There's still buybacks that are pushing things higher. Earnings revisions are still moving higher, but healthy digestion would be good.
So the question I'd ask then is how much capacity do we have to absorb some negative news? If it comes from earnings, if it comes from the data through the summer, are we going to be okay?
I don't think that the market would take it lightly simply because of what is priced in, given the fact that you are trading at such high valuations. If we were at lower valuations and positioning was very light and you saw people bracing for downside, that would certainly be something the market could take. But look at option volume. You have the percentage of call options being the highest since 2021, with put options being the lowest since 2021. This just suggests that people are only pricing in or expecting upside potential, not necessarily bracing for downside.
So Mama said you can't hurry love,
there
and
we
you just have to wait. She said, Dove don't come easy. That's pretty good, right? I'm just telling you, I'm trying to redeem myself. It's failing miserably. I feel like crashing and falling. You're talking about this sort of high bar for any kind of downside surprise, or in terms of just justifying the bullishness that you're seeing currently baked into the market. Is there a dissonance between the hopes and the dreams for rate cuts and the optimism that we're seeing expressed in equity valuations?
I would say yes, given the fact that financial conditions are so easy and that equity valuations are high and credit spreads are tight. It's one thing for people to say the equity market is not the economy, but everywhere we look, we see high valuations. Whether you're looking at CLO spreads being near record tights, high yield spreads being very, very tight, all of this suggests that financial conditions are loose and easy. This is not a market that is begging for more liquidity. In fact, we see signs that liquidity is incredibly abundant. So to think about big, huge Fed rate cuts in that environment, there is that dissonance that you talked about.
Well, this is one reason why I think that today's tech earnings and tomorrow's tech earnings are going to be so important. A lot of the high valuation story has been justified by the idea that we're about to embark on this technological sea change that's going to rejigger our expectations of valuations and potential for growth and efficiency. Do you reject that? Do you think that that's not a valid argument? That's just basically pointing to the boogeyman to justify what people like to want to keep going?
Look, I think that there is reason for optimism to have this idea that AI could be a big step change function difference in the productivity of the U.S. economy. However, there's an interesting caveat, which is that we may be living in a digital world, but it is becoming increasingly more material, meaning that these companies are having to spend hundreds of billions of dollars on CapEx. So you you are transmuting a capital light business that was very software driven, high margin, high return on invested capital, now having to throw a ton of capital at those businesses. That suggests to us that potentially return on invested capital goes down as you see more capital intensity because of the physical infrastructure that is needed to support this digital world.
Do you think the benefits are elsewhere in the equity market?
Eventually, yes.
But not yet?
We're not seeing signs of it yet. And I would say that the market is pricing in some idea that you are going to get that broadening of the AI benefits. Look at 2026 earnings. The expectation is for 12.5% growth. To get there, you have to bake in more than 100 basis points of margin expansion. That, to me, says that you're pricing in some kind of productivity benefit on a broad basis from this AI.
So just to pick up on this, do you think we're too bulled up on 26? Never mind 25.
Everybody is looking to 26 now and completely ignoring 2025. I think what ends up happening is that if 2025 numbers come in better than expected, you could effectively hold 2026 constant simply because you would not be needing as much growth. But 2026 prices in an acceleration in revenue, which in a decelerating nominal GDP environment, if that's what we get, stable real growth and deceleration in inflation, that becomes even more challenging. So at the 297, we don't see a lot of upside in those earnings from there.
You know, we keep saying that the economy is not the market and the market is not the economy, but what you're describing is something a number of people have talked about, which is for decades, there was more investment appreciation, asset price appreciation, and it wasn't going into the real economy. What you're just describing is that more and more of it is going to go into the real economy through investment in the physical world. We are becoming more material. Suddenly you have to actually create the goods to go with the technological advancement. Does that mean that you could see equity valuations stall out, but gains in the underlying economy in a way that we haven't seen for a very long time?
I think that that is the most fascinating point or question, which is that if you start to see more of this capital intensity, it would suggest that some of the left behind sectors like materials and utilities start becoming and staying much more relevant versus this world where we have constantly been seeing upside to margins because of the lack of capital intensity, because this was a software driven kind of bull run really since the great financial crisis. So if that capital intensity picks up, we're seeing more investment within manufacturing. If we start seeing a pickup within PMIs, all of this suggests that maybe we should look at some of those more value sectors because they have been left in the dust over the course of the last 15 years.
Can all of that happen with rates where they are? I mean, this goes back to the Fed and capital investment, given the fact that we're still seeing that, even with rates that are considered, at least by the president, to be too high. Do you need to see them come down to really boost that cycle?
So it's really interesting that we're seeing this deceleration in real GDP from 2023 and 2024 into 2025. But I think it's really hard to make the argument that the reason we are seeing a deceleration in growth is because of the Fed. The real Fed funds rate is lower today than it was this time last year. We've gotten 100 basis points of cut and core PCE has stayed about the same. So to argue that the Fed is so tight that this is the reason why we're seeing lower growth, I don't think that's the case. It's coming from other areas.
Cameron Dawson of New Edge Wealth, appreciate your time, as always. Chair Waller cuts 100 basis points next year, doesn't he?
That's the expectation.
If he gets the job.
Markets. Well, I mean, this is sort of the theory that the less they cut this year, the more they're going to cut next year because it will ensure that whoever does get selected will be uber dove. They can find their love. It's really easy to find their dove.
Yes, you keep going, don't you? That's great. Okay. Let's get you an update on stories elsewhere. Elsewhere, away from here for a moment with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with Starbucks. Shares are rising 4.6% in the pre-market, even after the company posted a bigger than expected drop in sales and profit in the latest quarter. But investors are seemingly encouraged by CEO Brian Niccol's confidence in his turnaround strategy, with Niccol saying efforts to speed up service and improve staffing are ahead of schedule. Meanwhile, UBS posted higher than expected profit in the second quarter. The Zurich-based bank said earnings were aided by results at the investment bank, and in particular, a 20% boost in equities trading revenue. UBS signaled that the prospect of cooling trade tensions should continue to support their results. And 4-foot waves were recorded in Hawaii, and initial signs of a tsunami were detected in California and Indonesia after an 8.8 magnitude earthquake hit Russia. The quake was the strongest since 2011 when an earthquake off Japan's east coast sparked the tsunami that led to the Fukushima nuclear disaster. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the hour. Up next on the program, the US and China preparing to kick the can.
The Chinese deputy minister did say that we had agreed on a pause. We have not. Nothing is agreed until we speak with President Trump.
That conversation up next with Heidi Krieber-Rediker of the Council on Foreign Relations. That's after the commercial break, a commercial break that Lisa will spend researching song lyrics.
No, I promise. It's over. You can come back.
We're done?
It's okay.
Moving
I promise.
on.
We're not going to mention anything again.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Equities are doing okay. Stocks are higher by 0.1% on the S&P. On the Nasdaq 100, higher by 0.2. Earnings later on this afternoon. Data at 8:30 Eastern Time. Chairman Powell and a Fed decision later on this afternoon as well. 2 p.m. for the decision, 2:30 for the news conference. Under surveillance this morning, the US and China preparing to kick the can.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines. The Chinese deputy minister did say that we had agreed on a pause. We have not. Nothing is agreed until we speak with President Trump.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, expecting talks between the US and China to continue, suggesting that President Trump will make the final call on any extension beyond the August deadline. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Ollie Crook in Stockholm. So, Ollie, let's talk about it. Have we agreed to a pause, a truce, an extension? What have we agreed to?
Yeah, Jonathan, it depends who you ask. We had sort of two sparring press conferences here in Stockholm after those 2 days of talks between the U.S. delegation led by Treasury Secretary Scott Bessent and on the Chinese side led by the Vice Premier. The Chinese spoke first. They seemed to indicate that basically a truce had been struck, that there would be an extension to that 90-day truce in the trade war between the United States and China. Then we heard from Scott Bessent. He said, not so fast. We have not yet agreed to this. We need to first go back to Washington, D.C., brief the president today, and he will make the final determination ahead of that August 12th deadline. I think that the market took all of that in stride because both sides went to great lengths to say that the talks were very, very positive. They were very, very constructive. Despite the fact that they were apparently constructive and positive, there was not a lot of sort of palpable outcome in terms of some of the concrete issues, how to right the trade surplus, how to deal with one of the issues that the U.S. administration is taking on further and further, which is the continued buying of Russian crude oil. So I think, John, going forward, how we think about the trade negotiations with China is that these are discussions that will be sort of measured in 90-day increments. I suspect that the market is currently pricing that Trump will okay it, but we're still some distance before these two leaders, Xi Jinping and Donald Trump, can deliver anything concrete, which is why I suspect a summit is probably not quite on the cards anytime soon.
Tyler, maybe you can address this question. Just what is taking so long? We all assumed we'd get a 90-day extension. Why haven't we seen it yet?
Well, John, the Treasury Secretary, Scott Bessent, said that he would be meeting with President Trump in the Oval Office today. There is an event on the public schedule at 1:30 p.m. Eastern, right before that Fed decision, so perhaps President Trump is going to speak then and make this more of a formal announcement, because it did seem like these U.S. officials really wanted to make clear that it is ultimately President Trump who is negotiating here and would be the final say on any sort of decision. Though we did get some of those positive indicators from the Treasury Secretary that it does seem like they are on track, that this really did amount to sort of a check-in to make sure that both sides were living up to the agreements that have been reached in Geneva and also London, particularly when it comes to those export controls. In fact, you heard the USTR Jamison Greer in the room that Oliver was in say that the U.S. never wants to talk about magnets ever again. They just want the assurances that those export licenses are going to keep flowing. And the Treasury Secretary himself defended the U.S.'s part in these negotiations when it comes to loosening some of those export controls around NVIDIA's H20 chips, for example, saying that he doesn't think it poses national security concerns. It seems that at the moment they were really just setting the stage to tee up President Trump to announce potentially this extension later on today, because of course they're against this background, John, of the August 1st deadline. And in all of those negotiations, officials have made clear that the final say rests with the president.
Tyler Kendall with the latest alongside Ollie Krug. Ollie, Tyler, to the both of you, thank you. Joining us now to extend the conversation, Heidi Kribo-Rediker of the Council on Foreign Relations. Heidi, welcome to the program. I just want to pick up on two lines that came from the Treasury Secretary, Scott Bessent. We don't want to decouple, we just need to de-risk. Is that the more diplomatic way of saying we want to decouple, but we're not in a position to until we de-risk?
I think you hit the nail on the head. I mean, decoupling is actually... I'm not so sure that that's the best final objective anyway. I mean, the de-risking is really because we have vulnerabilities where we have put all our eggs in one basket, particularly when it comes to rare earths, rare earth magnets, and the related technology and some critical minerals. Some other products as well, but China really dominates that space, and we're trying to de-risk in the U.S., but it's and our allies as well. But it's very, very, very difficult. China has the chokehold on those particular commodities, and I think they're going to continue to use them, whether or not USTR Greer ever wants to talk about them ever again or not.
How much, Heidi, has the U.S. gotten more leverage when it comes to getting some sort of coalition of trade partners to work on tamping down on the threats that some perceive as coming from China right now? Do you think that they are in a stronger position if there is yet another 90-day delay?
So first, I think as to the 90-day delay, if it is what happens, I think that is the very best option right now. And the coalition of the willing is to look at both the offense and defense. The offense meaning you want to be able to make the investments in all of the areas collectively that protect economic security from weaponization from China. You also want to make sure that if you're going to rattle the saber of Russian secondary tariffs or secondary sanctions, however you want to categorize them, that you have to be prepared if you impose those on China, that they're probably going to, reinstate some of those export control restrictions, because that is literally their choke point right now.
How much do you get a sense that that has been the crux of a lot of the discussions, particularly with the European Union, but also Japan and certainly in Southeast Asia, which has been a conduit for a lot of Chinese goods into the United States through those nations? How much has that been one of the main discussion points and part of the negotiations versus just sort of an ancillary part?
Oh, I think critical minerals and rare earths have been key. All the other issues that Secretary Bessent mentioned on overcapacity, that affects everybody. You have both developed and developing countries that are feeling the brunt of the auto, excuse me, the use of tsunami on a day like today, but the tsunami of Chinese auto exports flooding markets everywhere from the EU to Brazil. But I think, the one caveat is that because we have proven ourselves, unfortunately, to not be the most trustworthy trading partner, and one of Trump's big objectives is really to upend both the trading and the security systems, the architecture. I think there's not a lot of trust out there, and one thing that you really need when you're dealing with a coalition and building a coalition is you need trusted partners. So we need to make sure that we don't lose that trust along the way in order to be able to implement collectively some of the things that we want to do on economic coercion.
Heidi, it makes me think of Canada, supposedly a North American friend of the United States of America, left out in the cold. And I've been surprised, I know you are too, that the two key issues really that are left on the table, put China to one side, it's Mexico and it's Canada. And we're not hearing enough, I don't think, about what's about to happen. What do you think is about to happen?
So, President Trump has been very dismissive of any deal being reached with Canada. And we traded more than $900 billion in goods and services last year with Canada. They are the country to our north. It's not a small player. They're our closest partner in addressing many things, including our critical mineral challenge. We've, a lot of the investments that have been really for shared economic security have been together with Canada because we are so complementary in terms of what we can both extract and refine and produce together for on the critical minerals front. So I think, I'm very worried about the fact that Canada has not been more front and center. In particular, Mexico has, it comes with a different set of issues. They're connected, but I think Canada in particular is one that I am truly worried about.
Heidi, do you think that's because they just haven't focused on it? Or do you think that's just a natural consequence of the fact that we have USMCA and we can renegotiate it next year? Which one do you think it is?
So, it's a good question. We do have the ability and obviously are going to renegotiate USMCA, but at the same time, the feeling that President Trump really likes to have all the cards to play and feels like Canada has very few cards to play because they haven't diversified. They're so tied to the U.S. economy, and they're really trying to figure out how quickly they can diversify their energy exports, their critical mineral exports. They have a very comprehensive political backing for de-risking from the United States right now. I think that's unhealthy. But I do also think that the president is going to use whatever leverage he has to strike the best deal he can. And but I do worry that he is probably more likely to be conducive to working with Mexico than he will be with Canada, and I'm worried about that.
Interesting. Heidi, thank you. Appreciate your time, as always. Heidi Krieber-Rediker there of the Council on Foreign Relations. I have some sympathy with trade negotiators right now. There's only so much they can negotiate until they renegotiate USMCA. So I guess with that in mind, it makes more sense to focus on other nations, on China, on Europe, on Japan.
It feels personal with Canada. Let's be honest. It feels personal coming from President Trump, when he keeps on talking about the 51st state. And it feels personal when you look at some of the numbers coming from Canada. Actually, the Bank of Canada said that they did a survey, and it showed that for the first time ever, 55% of Canadians say they are avoiding or spending less on vacations in the U.S. So there you go.
They've taken it personally. Without a doubt, it's in the data, to your point. Up next on the programme, we'll catch up with Courtney Breen of Bernstein as Big Pharma braces for big tariffs, plus Danny Berger with your morning movers. Hershey, trimming guidance on tariff concerns.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Just missed out yesterday on a 7th consecutive day of gains on the S&P 500, following 6 all-time highs. Still well on course for a 3rd straight month of gains on the S&P 500 this morning, up by 0.1% on the S&P. On the Nasdaq 100, up by 0.26. Switch up the board and get to the bond market. 2-year, 10-year, 30-year bond yields this morning just about unchanged. Since the Fed last met, also just about unchanged. The 10-year and the 30-year yesterday, though, with a decent rally. This morning, 432.23. Yesterday, job openings a little bit lower than expected. Decent auction and a big event about 60 minutes from now.
Yeah, there was sort of a curious move in the 30-year bond. You saw the yield coming in more than 10 basis points, the biggest one-day move going back to early June. Is it really because JOLTS and the headline number, especially with the solid quits? Some people were pointing to that refunding announcement, which is what you're referring to, in about an hour time, and this idea that maybe we'll get a sense that the Treasury Department is going to issue a disproportionate amount of bonds on the front end, or debt on the front end, and maybe even reduce coupon sizes in the long end. And that, I think, is what people are watching out for.
Mike McKee's going to break down that story for us in about 60 minutes from now. The 10-year at 432, the 30-year at about 487. Let's get you an update on stories elsewhere and get you some morning movers with Danny Berger. Hey, Danny.
Hey, John, I got some earnings for you. Humana reporting this morning, upping its guidance, something that has been very rare among health insurers. In fact, most of them have been cutting their guidance because of higher medical costs. Humana, on the other hand, said that costs were in line with what they expected. They also saw a big boost to both their pharmacy and their Medicare Advantage programs, so those shares up 7.5%. To the downside this morning, though, is Hershey's, the chocolate maker, gaining some back. It was originally down quite a bit, up now just about 0.2%. The issue for them is tariffs. Initially in May, they gave an update saying that the tariff cost for them would be $20 million. They now say it will be as much as $180 million. So they've had to revisit the cost there. At the same time, cocoa prices have doubled. They have also increased how much they are charging for that because of the shortages. Perhaps the fact they're able to pass that along is why you're seeing some of the losses trimmed. Finally, VF Corp this morning. This is the maker of North Face, of Vans, a turnaround taking hold for the company. They've been struggling with a lot of their business, but the earning comes in better than expected, so that gives investors the confidence. Shares are up 17% this morning, John.
It's a nice rally, that's for sure. Danny, thank you. More from Danny in the next hour. On our radar this morning, our top story. Blackstone's Midtown Manhattan offices will remain closed this week following Monday's shooting. The NFL commissioner, Roger Goodell, saying the league's offices, which are in the same building, will also be closed through August 8th. Elsewhere, President Donald Trump ramping up pressure on Vladimir Putin, giving Russia until August 8th to reach a truce with Ukraine or face economic penalties. The Kremlin responded, saying the country has, quote, and check this out for a quote, acquired immunity to sanctions.
And arguably, they've demonstrated that that has not been a deterrent when it comes to their incursion in Ukraine. Yesterday, we did see oil prices pop on the back of this. The idea that maybe this was something that was going to lead to sanctions and a real tightening of the screws in terms of oil exports from Russia. I just wonder about the timing of this. What triggered President Trump's desire to crack down a little bit more, at least in theory, in terms of the time frame? Was it the negotiations with the Europeans about how the tariff structure would work, and how much muscle is there behind this? And I think that's the other thing, because there have been a lot of threats, and we haven't always seen them come to fruition.
The two issues now fit quite neatly. Basically, the Europeans have agreed to buy $250 billion of energy every single year from the United States for the next 3 years. That number was running at something like 80 billion. If they're going to increase that number, it needs to drop elsewhere. And they need to completely cut off their energy relationship with the Russians, which still exists to this day, which many people find absolutely ridiculous.
Which underscores how the trade issues turn into national security issues, turn into geopolitics very quickly, and we see that on a mass scale. I will say it is notable that when President Trump was asked about oil prices and whether it concerns him that oil prices could go up, should he tighten the screws on Russia, he said, we can always pump more. We're good. We can always have that production tap turned on. So it seemed like he was diminishing that as a potential threat.
Arguably moving the crude market in the last 24 hours. Here's an update on trade. The president's saying that India might be hit with a tariff rate of 20 to 25%. The two nations are working on a deal ahead of Trump's self-imposed deadline this coming Friday.
This would be a huge disappointment. They were hoping to get something below that 20% level, and there's a real question around what this relationship looks like, where some of the grievances continue. It goes to a point, though, that you mentioned earlier, John, is the business model of creating cheap goods outside of the U.S. and then shipping them in for fast fashion to the U.S., is that business model dying? And I think that really the idea that the likes of Apple, which was going to move their production from China to India, this question of where do you go that's safe from some of these potential tariffs, the fact that you can't find a place is really raising questions about that exact issue.
Nailed it and pretty much read my mind. I don't think you can underestimate how much that move by Apple irked this White House. At one point in time, if you go back a couple of months ago, India is almost at the front of the line to get a trade agreement with the United States. That move happens bang. And the president was vocal about it, very public, that he was unhappy with Apple and Tim Cook about moving production out of China into India. And remember the conversations we were having, and Dan Ives would joke about producing them in New Jersey? Right. I don't think you can understate the importance of that move and how much it derailed talks with India.
I wonder how much you're conditioned by experience. And this administration remembers back in the first Trump 1.0 when they came up with tariffs on China, and then all of a sudden Thailand and Vietnam, and then transnational shipping became a really important conduit of goods into the U.S. Was that sort of a telltale warning of what would happen if they didn't make that a bigger priority in this particular trade dispute?
That conference call with Apple later on this week, that's must watch. It really
Thursday.
is. Must listen.
Let's listen to the sort of disgraced diplomat, not disgraced diplomat, but the fallen diplomat, at least when it comes to the eyes of President Trump.
More diplomatic terminology there. Nice.
Trying. It's like...
Yeah, not doing so well this morning, are we?
Loving the dove.
Yeah. Let's turn to trade, keep it on trade, and turn to pharmaceuticals. The U.S. Commerce Secretary Howard Lutnick promising, quote, massive tariffs on non-U.S. made pharmaceuticals. Courtney Breen of Bernstein writing, we do believe that the pharmaceutical companies have already begun aggressively mitigating the tariff risk. We would anticipate that the 15% EU tariff will likely cause a headwind. Courtney joins us now for more. Courtney, welcome. Let's talk about those so-called mitigation strategies. What kind of mitigation strategies have been implemented by the companies that you cover?
With you this morning. I think one of the things that we've seen the pharmaceutical companies aggressively engaging in is actually just bringing forward stock into the US at a much faster and much earlier rate. So if we look at the data of pharmaceutical imports into the US, in March and April, after we saw some language around potential pharmaceutical tariffs, we saw an increase by 250 and 300% in the rate of pharmaceuticals being brought into the country. This has been specifically described by many of the pharmaceutical companies, and we have some clear anecdotes as to how long that pharmaceutical stock could last as well on the scale of years.
So, Courtney, once you've done that, I guess my question now, and the question of the White House would be, is 15% sufficiently high enough to redirect production, to get these companies to think about moving their manufacturing base?
It's a great question, because these manufacturing networks are highly complex and they get built over decades. Many of the companies that I cover are 150 or so years old, and these manufacturing networks kind of resemble the fact of the age and the legacy of those companies. And certainly over the last few decades, there's been a real incentive to have a lot of that manufacturing anchored in Europe, anchored in some of these lower tax regions, where you can also pair that manufacturing with intellectual property and other value-added capabilities that mean you're able to minimize your profit exposure and therefore your tax exposure in the US. So to be able to make changes, it is incredibly hard because you'd be talking about perhaps actually turning a large site that has real capital investment in it off in one location and then trying to turn it on in another location. And to set up a new manufacturing site in a place like the US, we would be talking of a scale of about 5 years to go from a greenfield kind of no site in place to something that's able to produce commercial product. So there's time, there's money, and there's kind of untangling of the web of the manufacturing network that's sitting there already to be done. What we're more likely to see are some of the stopgap reactions. We saw the inventory pull forward already. We've begun to see some partnerships with CDMOs or contract manufacturers here in the US take shape so that pharma companies can import goods at a lesser finished state and finish them in the US, thereby minimizing their tariff exposure. And then we're also seeing kind of more work going on in sites that these manufacturing companies already have in the US, expanding sites, expanding the number of lines, enhancing the operational efficiency. And then the final step is, look, if you're really looking to expand your volume and you need to make a new manufacturing CapEx investment decision, of course, with this pressure, it makes more sense to now consider the US, but I don't think we're going to see wholesale kind of turning off manufacturing sites in one location to turn them on here in the US.
Courtney, my understanding is that the tariffs and some of the potential investigation is non-generics. It's the new drugs. Generics are not exposed to that. I just wonder what the consequence of this is. If there is some sort of ground-breaking medication, is there real price sensitivity? Is the real pushback coming from insurance companies that are going to have to pay the higher prices?
Yeah, you're absolutely right. There is a distinction between kind of branded and generic on the basis of what we've heard out of the EU kind of since the weekend and since the deal, where this 15% EU tariff will primarily apply to branded products, with most generics being excluded. If you think about the patient, the end user, what we know is in the US, 90% of prescriptions that are filled in the US are actually for generic products. So kind of most of the kind of interactions that a patient will not have this 15% tariff or any sort of pricing impact kind of wrapped within it. On the branded side of the equation here, we do know margins are higher. And what we do know is that the industry has more constraints than if you would compare it to an average consumer industry who can choose to raise prices as needed. In the government channels, so your Medicare and Medicaid, there are restrictions on price increases. Medicaid requires the lowest price available in the market. Medicare limits price increases to inflation and some other parameters that prevent companies from kind of passing this price or this tariff cost on. Similarly, in the commercial setting, often these contracts are set over a number of years or with highly competitive terms across a number of companies. And so your ability to just raise your price and kind of compensate yourself for the additional tariffs that you're paying is unlikely to be kind of fully passed through, and certainly not fully passed through on a timely manner. So we do anticipate some pressures in some of these companies who haven't been able to fully aggressively mitigate the near-term risk of these tariffs.
Courtney, we still have pharma tariffs still to come. The EU Commission President Ursula von der Leyen was very, very careful to point out and very purposeful to point out this was all-inclusive. There is a conversation here, as I'm sure you're aware, about whether these tariffs actually survive legal proceedings. And for that matter, they believe the White House might actually avoid making the decision on sectoral tariffs until they have clarity on legal issues around things like IEEPA. When you speak to management teams, and I won't ask you a legal question, I just want to understand from your perspective, when you speak to management teams at the moment, do they convey confidence to you that 15% is it, it's the clarity they need and they can move on? Or are they still confused and uncertain about what the future might hold?
It's a great question because I think not only on this topic, but many others, we've seen kind of volatility on kind of what actually gets implemented relative to what gets announced and over what time horizon. And certainly when you're making large capital investment decisions, like you might be if you're initiating a new plant here in the US or even expanding one that already exists, you need quite a lot of certainty. And so while almost all of the large cap pharma companies have announced capital commitments here in the US, many have not yet begun actually initiating that spend or breaking ground or those expansions yet. And that is because first they were waiting for what was going to be in the most recent bill in terms of the extension of the Tax Cuts and Jobs Act. And so what would be the rebates or the additional benefits they may gain from the tax incentives of investing in America. So that was one side, and we've got more clarity there. And then the second side is, well, how long does this tariff persist for? At what rate? Through which countries, and how does that compare to the fundamental growth drivers in my business and how those fundamental growth drivers are exposed to manufacturing in those locations. So yesterday we began kind of earnings of my covered companies, and Merck was one of those companies that presented yesterday. And we did hear from them that they are waiting for more clarity from both the administration and kind of anything that gets kind of really ratified and implemented for them to be able to fully validate, particularly beyond 2025, what the impact might be to their business.
Courtney, thanks for making time for us this morning. Appreciate it. Courtney Breen there of Bernstein on the latest with pharmaceuticals and the tariffs they face now and in the future. This from the president just moments ago. The August 1st trade deadline won't be extended.
Which is the reason why people are expecting letters, as you were mentioning earlier, to the nations that do not necessarily get trade deals. Again, what are these trade deals, though, since they are pretty not necessarily teased out in full, sort of trade agreements, MOUs, and that seems to be where we're at.
Let's get you an update on stories elsewhere. Our top stories worldwide with our Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Adidas reported weaker than expected revenue growth, sending shares plunging to their biggest intraday drop since April. The company only reaffirmed its annual forecast despite a bump in profit during the second quarter. The CEO cited uncertainty around the impact of U.S. tariffs, echoing the concerns of its rival, Puma. Meanwhile, Apple has lost its fourth AI researcher in a month to Meta. A key engineer is joining Meta's super intelligence team, and Apple is now weighing a pivot toward using more third-party models like those of OpenAI and Anthropic, but sources say that's hurting morale within its AI team. And the Aston Martin Formula One team will be valued at around $3.2 billion in its latest stake sale. CEO Adrian Hallmark said that the team's listed car maker has agreed to sell its minority stake in the team for nearly $150 million. He declined to name the buyer, saying the deal had yet to be completed. That's your Bloomberg brief. John?
Yahara, thank you. Thank you very much. Up next, making the case to cut rates.
I don't think I could be any more clear, I hope, as to what my position is and why I think we need to do this. It's just how I read the data. Some people don't want to cut, some do want to cut, but coming out and making the case either side, that's good, healthy debate.
Up next on the program, we'll catch up with the former St. Louis Fed President, Jim Bullard.
my opinion at least, the reason that the U.S. is so creative and innovative and has so much interesting development and has, most of the largest trillion-dollar businesses is because we have the best capital markets. And capital market development is really what creates the funding in order to pursue ideas. So in America, any idea you have, there's a market for it. Right? So building markets like the securitization markets in the U.S., really allowed for non-financial companies to get into the financial industry business. And that was really a derivative of making the securitization market so competitive. So building securitization markets and continuing to grow markets and figuring out how to continuously fund ideas, I think that's going to be the next stage of growth for these markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
A statement from the President of the United States just moments ago, from President Donald Trump, saying the following: the August 1st deadline is the August 1st deadline. It stands strong and will not be extended. It's a big day for America. That's a big day that's 2 days away. For today, we're looking ahead to a Federal Reserve decision later on this afternoon. Under surveillance this morning, making the case to cut rates.
I don't think I could be any more clear, I hope, as to what my position is and why I think we need to do this. It's just how I read the data and how I think about going forward, how you respond. Some people don't want to cut, some do want to cut, but coming out and making the case either side, that's good, healthy debate. Otherwise, if we're always going to do the same, the joke is, why don't you just have one person set policy and send the other 18 FOMC members home?
Here's the latest this morning. At least one Fed official preparing to push back against keeping policy unchanged today. Some Fed watchers looking for two governors to dissent for the first time since 1993. The former St. Louis Fed President Jim Bullard telling us previously, I think that the Fed could resume its normalization process. September would be a natural focal point for that. Jim joins us now for more. Jim, welcome back, sir. Just how compelling is the case for lower interest rates today?
I think the policy rate's a little bit high for the current environment, and so I do think that the committee could set up a September rate cut at this meeting. I think the risk for the chair is probably that that gets priced in even more than it already is, and he can't preserve enough optionality going into September, but I'm sure he'll do a good job on that part. So I think the committee's in pretty good shape here.
Do you think that it's good to see dissent, that that's actually healthy and important right now?
I've always felt that dissents show, in some circumstances, they just show that there's a lively debate and that various points of view are being heard, and that can be helpful to the chair, I think. Sometimes the Fed gets criticized from all sides, and sometimes when it's always unanimous, you get criticized for that as well. Too much groupthink. So I think dissents can be valuable.
A lot of people are watching today's meeting, press conference, for any clues of what type of pressure President Trump seems to be exerting, at least psychologically, on the Fed. I wonder how much of a cloud you think that is. As a former Fed member, I know you're probably going to say it doesn't factor into their mentality, et cetera, et cetera. At the same time, the rest of the market is perceiving it that way and is taking everything that happens on the FOMC as, oh, this person is running to be the next Fed chair. Oh, this person is just trying to show their defiance to the president's discussion.
Yeah, I don't know. I don't think the committee pays too much attention. There's a lot of data, a lot of analysis. That's the way the meeting works. It's a big formal meeting. And, you know, I think every member takes their role extremely seriously. And if they feel like the data is pointing them in one direction or another, they make the call, and that's that. So I don't really think the theater affects that part of the discussion.
So, Jim, let's talk about the data and where we are by the time we get to September 17th. 2 more CPI reports, 2 more payrolls reports. And there's an assumption right now from some that they've got to wait. And they've got to wait because they need to see the tariff pass through to consumers. How much will we see? And once they've seen it, to what degree will it hang around? To what degree will it actually be transitory? Or will it be sticky? Jim, is 2 CPI reports enough to draw any conclusions on that?
They're going to want to see that data going into September, and that'll be that'll carry the day here today, I think. And they'll, you know, who knows? You can always get surprised by the data. You've also got jobs reports in there, so they'll want to see that before they make a decision. That'll be the basic idea. But I think the notion is that they've already put the recalibration policy on pause for the first 6 months of 2025, waiting to see what the tariff policy would be and whether it would feed through to inflation. They didn't really get anything out of that. And that's why the policy rate's sitting a little bit high compared to inflation readings and unemployment readings right now.
And James, do you think that, Jim, do you think that it's fair to think that next year you're going to see some pretty significant rate cuts, not just because of the new Fed chair, but because you think it could be appropriate based on potentially ongoing disinflation?
I think it is going to be appropriate, and I think if they make 2 rate cuts this year, September and December, and then they follow that up in the first half of 2026, they would start to get to the neutral rate, what the committee thinks the neutral rate is, maybe 3% or 3.25% or somewhere in there. And that would be the exact rate that you should be at if inflation continues to decline toward 2% and unemployment continues to be in the low 4% range.
Hey, Jim, appreciate your input as always, sir. The former St. Louis Fed President Jim Bullard there weighing in on the decision later on this afternoon. Market's comfortable with this. You look at the forecast from the Federal Reserve for inflation, for the dots where rates are going to be. Ultimately, the Fed is communicating inflation goes up, it comes back down, and we'll be cutting interest rates. The market's okay with this because they don't see hikes. They see a bias to reduce interest rates. Now, will the market be okay when they start to sense a bias to wait? To wait? And to wait a little bit longer. And that's the debate, not for today, but for September. I really want to know whether 2 CPI reports is enough to draw any conclusions about the trajectory for inflation beyond September and into next year.
Just a cheat sheet, you're probably not going to get the answer to that today because the goal will be to watch paint dry. And so let's see if they can accomplish that goal.
He's got every reason in the world to make this boring.
Yes, well, he usually does. But let's see if he could actually
Can he execute?
Yeah, exactly.
In that news conference. Up next, we'll catch up with Joseph Amato of Neuberger Berman, Shweta Kajuria of Wolf Research, Blake Gwynn of RBC, and Claudia Sam of New Century Advisors. From New York, the second hour of Bloomberg Surveillance, or the third, we're losing count.
Whatever.
That's up next.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
There is a little bit of a handing off of the baton here from trade and taxes to the Fed.
The Fed shouldn't be cutting rates. They're not in the position to cut rates.
I expect Fed's playbook isn't going to change a whole lot.
Risk assets don't really care as long as the idea of rate cuts keeps being alive. That is totally fine.
The question really is, of course, around the September meeting.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. The opening bound 90 minutes away. Your scores look like this. Equity futures on the S&P 500 positive by 0.1%. On the NASDAQ up by 0.2. Coming up over the next 24 hours, absolutely packed with data, with earnings, and sandwiched in between, a Federal Reserve decision with Chairman Powell.
Yeah, and in about a half an hour time, we get a Treasury refunding announcement that might have more import for the bond market than even what we get from the Federal Reserve, because it will give a sense of just how much the U.S. government's going to lean on short-term debt to fill its coffers rather than the long-term bond. I am curious, though, about what the Fed can possibly say to give a better guide at a time when they're under so much scrutiny. And basically, the status quo would be hold 2 dissents, first governor, 2 governors' dissent since 1993, and kick the can to September.
Get to September, 2 CPI reports later, 2 payrolls reports later. Is that enough information for the chairman to get a consensus about what to do next?
The key issue for them is to really understand consumer demand and how it responds to potential price hikes. If CPI does go up as expected, the one-time price shock that a lot of people are talking about from tariffs, how do consumers handle it? And they're going to be gauging that too. It's not quite as simple as how do you look through this? It's does consumer demand hold up and accept higher prices, or is there that price sensitivity that causes companies to kind of accept more from the margins, push it back onto suppliers, and really have a shelf life for those price increases?
That's why emphasis in a news conference is really important. Will the chairman put equal emphasis on the firmer goods prices we've seen and are expecting over the next few months, as he would on the softer services prices we've seen recently? If you put equal emphasis on both, then maybe you can say we're open-minded about the situation. But if you choose to overweight one versus the other, That's going to be interesting to read through what that means for policy.
Especially because policy will be set by him maybe for a couple of months more, but not by him, maybe next year. And others in the committee clearly are putting the emphasis elsewhere. We certainly heard that from Chris Waller, but we also are hearing that from some regional Fed presidents as well. And I do have to say the fact that Treasury Secretary Scott Bessent talked about how they were considering some regional Fed presidents as well, potentially for the seat of the chair. There is a question about whether there's going to be more dissent represented here and whether there will be more emphasis on some of the services disinflation and consumer pushback to price increases.
The formal process to replace Chairman Powell is underway. Equity futures on the S&P positive by 0.1%. Coming up this hour, Joe Amato of Neuberger Berman as Stock Snapper's 6-day winning streak. We'll catch up with Shweta Kajuria of Wolfe Research previewing earnings from Meta, plus Blake Gwynn of RBC reacting to this morning's data and the refunding announcement in about 27 minutes' time. We begin this hour with Stock Steady ahead of the Fed decision at 2 p.m. Eastern Time. Joe Amato of Neuberger Berman writing macroeconomic policy supports a soft landing scenario. As inflationary pressures continue to soften, we believe the Fed has more flexibility to ease policy. Joe joins us now for more. Joe, good morning.
Good morning.
How much flexibility does the chairman have later on this afternoon?
Well, he's got a couple of his team members who are dissenting, so that puts, I think, him in a little bit more of an awkward spot. But I think the Fed has been in a process to normalize rates over the course of the last period of time, and it got derailed a bit by, of course, the tariff announcement. So I think there's still a movement toward that normalization process, which we think they're going to get back on track on. We think there'll probably be a couple of cuts this year, not today, of course, but probably in September and later in the year, reflecting the fact that inflation, while edging up a bit, has still been under control, and the labor market, while again solid, still showing some signs of weakening. The number coming in Friday is going to be one of the lower numbers we've had over the course of the last number of months.
How much is the bullishness in risk assets predicated on this idea that there will be 2 rate cuts from the Federal Reserve in 2025?
I don't know that broad market bullishness has got to be driven by rate cuts. I think you have within the internals, if you think about small caps. So small caps, I think, do need to see a movement toward lower rates and rate cuts, and that historically has been sort of a catalyst for small caps to rally. But I think what we've seen over the last number of months is the hard data has held up well, broadly. We've gotten some good news on tariffs off, of course, the panicky early April announcements, and I think the market's reacted to that. And many businesses are responding quite dynamically to this issue of tariffs and maintaining margins. We're going to see a little bit of margin pressure in this second quarter, but margins are still at pretty high levels, remarkably, because tariffs have been in place for a number of months now.
So it raises the question about earlier this year, how so many people wrote off the United States as being the biggest loser from some of these tariffs. And suddenly people are coming around to this idea that maybe that was too fast. Do you think that sort of the Fed is a sideshow to really the crux of who is going to bear the brunt of it? And our U.S. companies showing in all of these earnings reports time and again, they're doing just fine, better, in fact, than those in Europe.
I don't think the Fed's ever a sideshow. So, but as it relates to
it might be today.
The notion of tariffs, you have 3 ways it can go, right? You either put price increases to customers and they eat it. You put a little, you eat it as the company and pressures margins, or suppliers eat it. So it probably ends up being a combination of that. We've seen inflation tick up a little bit. There's signs of that right in the last inflation report, particularly around things like apparel and home furnishings. You see the margin pressure I referenced, and then, we don't really have transparency to supplier income statements per se, but, there's probably some pressure going on there as well. And remember, goods are only a portion of the inflation CPI number. It's not the full number. And like you referenced just before, right, services have been softer than expected.
I think Lisa was attempting to get you to defend your overweight in European equities. So let's be more direct. Can you defend your overweight in European equities?
We've moved early in the year to a theme of broadening out, right? U.S. certainly had, was the major driver of markets over the course of the last number of years, but we did think there'd be a broadening out. Now, that broadening out would include small caps, value, non-U.S., right? We're very bullish on Japan. Europe, we think with fiscal stimulus, particularly out of Germany, I think is going to show improvement, and the relative valuations were attractive. So we upgraded our developed markets outside the U.S., which would include, of course, Europe and Japan. So we're sticking with that. We're not underweight U.S. because U.S. still has so many competitive strengths, particularly the tech sector. Like if you look at this second quarter earnings, S&P 500 earnings ex-tech will be flat. Tech's up 17%.
Yeah, but what's
which
Europe's
blends
tech?
to up 7, whatever the number comes
But
out.
what's Europe's tech? It's not weight loss drugs anymore.
It's not.
Novo
but
Nordisk
you have,
didn't
Europe
work.
is a more cyclical economy. So if you get higher nominal growth rate spurred by, they have lowered rates, you get some fiscal stimulus, the cyclical nature of Europe's economy will improve, and you have the relative value differential from a valuation standpoint. To me, it's not necessarily a long-term secular or strategic allocation per se. It was more of, I don't want to call it a trade, but it was more intermediate term opportunity.
Which is one thing that we've seen with respect to the dollar and sudden strengthening on the back of some of the announcement that we've heard with the EU and European Union and how the tariff agreement kind of got tied, and suddenly this realization maybe there'll be a little pain in Europe. And I just wonder, if you see a cheapening in European assets at this point, is that a buying opportunity or is that a sign that this trade is over?
Well, I think it represents a buying opportunity. You know, we're not looking for opportunities that last a month or two, right, in the context of allocating it to clients. So we're looking for something that has some legs to it. And we think there, I mean, the amount of fiscal stimulus that's going to go into the ground in Germany is massive relative to the size of that economy and the European economy. And we haven't seen that in a long, long time. So I think that does have some legs to it in terms of the opportunity. The dollar took a very significant pullback, right? So that's rare to see it that, you know, move that fast, that much. We still think the dollar will grind lower over time, but because U.S. hard data is held up and rates have probably stayed up higher a little longer than expected, the dollar has come back.
Are you expecting any adverse developments in bond markets in Europe that might hold back that equity story?
We do worry a bit about that, right? You know, if you look at the fiscal situations of different countries in Europe, while Germany has lots of room to stimulate, there are other countries in the region that don't, you know, from in terms of what their local bond markets are. So we are watching that closely in terms of the spreads in whether it's, you know, Italian bonds versus bunds or versus treasuries or what have you.
So
but
with that in
I
mind,
think they have enough room right now to stimulate.
So how do you play the European story at the moment? Someone might look at this situation and say, okay, I buy an ETF that tracks the Eurostoxx 50. Is that the way to do it, or is there a better way to do this?
Well, we're an active manager, right? So we have strategies that manage, you know, European stocks or what have you. So we're looking at high-quality global companies that happen to be domiciled in Europe that have flexibility. We'll get some benefit from a local economy being stimulated, but you know, we're still looking for quality companies that have global reach.
That overweight, of course, Japan and Europe. Not on India. This just dropping from the President of the United States just moments ago. India will be paying a tariff of 25%. This just dropping from the President just moments ago.
Yeah, a huge disappointment for Narendra Modi, given the fact that they were looking for something closer to that 19% that we saw from Thailand. It raises this issue that we were talking about earlier. What were the main sticking points that ended up with a tariff agreement that was substantially higher than the region expected? And frankly, something that a lot of retailers in particular are going to have to factor in if they move their manufacturing there and produced a lot of textiles in particular.
This from the President, the statement just dropping just moments ago. Remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high. The President goes on to say among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country, a 25% tariff for India.
Yeah, he also went on to mention Russia and saying that India has always bought a vast majority of their military equipment from Russia. They also are some big energy buyers from Russia. Suddenly, this goes back to what we were talking about earlier. This is a key negotiating tool. The geopolitical positioning, what the relationship is with different countries and Russia, how much they are going to connect with China, that is all part of the tariff negotiation in a very different way than previous years.
That's the latest on trade this morning. Joe, it's good to see you. Thanks for dropping by. Thank
Great.
you, sir. Joe Amado there of Neuberger Berman. Let's get you an update on stories worldwide, including on trade, with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Exactly, John. The U.S. and China have wrapped up 2 days of talks in Stockholm. The Chinese trade negotiator says they agreed to extend their 90-day tariff truce. But Treasury Secretary Scott Bessent says the Chinese may have jumped the gun a bit. Bessent says extending the pause another 90 days could be an option, but the final decision would be up to President Trump. Meanwhile, Gucci sales plunged in the second quarter as shoppers turned away from Kering's biggest brand. The 25% decline at the Italian label matched analyst estimates. Gucci does have a new artistic director, but he has yet to unveil his debut collection. His predecessor lasted only 2 years in the job. Kering will also see a new CEO. arrive in mid-September. And JP Morgan Chase and Coinbase have signed a deal that will let customers directly link bank accounts to crypto wallets starting next year. This move follows a recent announcement from JP Morgan that it will charge fintech companies from accessing customers' information. Users will also be able to fund Coinbase with Chase credit cards and rewards points. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, the morning calls, plus Shweta Kajuria of Wolf Research previewing earnings from Meta, and we'll have the latest ADP employment report from New York. This is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Unless they signal that the inflation data they got a couple weeks ago actually changes their thinking and their thought process on the path of rates, I think, the market, this is going to try to be a nothing done type event. There's always a risk, and I think the risk here is that they skew a little bit more hawkish. Unemployment rate has been the most important data point you get, for a while now. If you get the unemployment rate rising up to around 4.5%, then in our view, a couple rate cuts is not nearly enough, and that'll put a lot of pressure on the Fed to cut more aggressively.
No sign of that this morning. The ADP report just dropping. It's an upside surprise. 104,000 against an estimate in our survey of 76. Let's get you an update with Mike McKee. Good morning, Mike.
Good morning, John. Well, it was a negative 33,000 last month, so ADP not quite in line with what we're getting from the Bureau of Labor Statistics, so we'll see what happens on Friday. But the numbers underneath, the categories themselves are kind of interesting. 7,000 jobs created in manufacturing and 15,000 in construction. Both of those were low last time from the BLS. Service providing jobs were up 74,000, including 46,000 in leisure and hospitality. Now, that would probably be because of seasonal factors, kids getting summer jobs, but we've been hearing a lot about how there aren't any this year. So it's going to be very interesting to see how that breaks down. A loss of 38,000 jobs in healthcare and social services. That's the big category that's been growing forever in the BLS numbers. So some interesting sectoral numbers from the ADP. Also, they do track pay gains, and those who stayed in their current job got increases of 4.4%, and those who left their jobs and got new ones had increases of 7%. This is, of course, as always, the most important indicator of them all for Lisa, except for anything else that comes out.
Mike McKee, she gets very excited about ADP. You know that. Mike, thank you. and the quarterly refunding announcement at 8:30 Eastern Time.
Well, I am very excited for the quarterly refunding announcement. It's unclear what to do with this, since it seems like markets aren't really taking that much of a signal from this. You're not seeing a huge response in markets, and people tend to not see the correlation with this and what we get on Friday. Nonetheless, I think about what Neil Richardson says, which is this is not a market that's falling out of bed. You are seeing signs of potential weakness, particularly with those new graduates or teenagers looking for a summer job. But this isn't exactly something that's fallen off a cliff.
We've got a lot to get through this morning. It's not just the data. We'll get more of that at 8:30 Eastern Time. We need to talk about trade. This is quite a statement from the President of the United States. It came just moments ago, so if you're just tuning in, I'll share it with you now and read it out verbatim. While India is our friend, we have over the years done relatively little business with them because their tariffs are far too high. The President goes on to say, among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country. Also, and this is the additional point the President makes this morning, they have always bought a vast majority of their military equipment from Russia and are Russia's largest buyer of energy, along with China, at a time when everyone wants Russia to stop the killing in Ukraine. All things not good. India will therefore be paying a tariff of 25% plus a penalty for the above, starting on August 1st. Thank you for your attention to this matter.
And it goes to the heart of how Russia has been an increasing part of its negotiations, trying to tighten the screws there, and really coming as a surprise at a time when a lot of people were expecting the end tariff rate on India to be something around 20 or 19%. So highlighting a change in tone around Russia and a change in tone around what the parameters are of negotiation for some of these new trade agreements.
Going into that deadline this coming Friday. If you are just joining us again, look at futures this morning. We're doing okay. We're positive by about 1/10% on the S&P. That's the price action. Here is some morning calls. First up, Citi, downgrading Union Pacific to neutral, citing questions over its deal to buy Norfolk Southern. Your second call from JP Morgan, raising its price target on Boeing to 251, noting its solid second quarter results. And finally, Morgan Stanley raising its price target on Nvidia to 200, citing exceptional AI strength. Let's stick with big tech. Investors are waiting the next round of Max 7 earnings. Meta, Microsoft report after the closing bell. Ed Ludlow joins us now with more. Good morning, Ed.
Yeah, good morning, John. It's going to be an evening where we try to do a lot of math, right, with a real focus on capital expenditures. We know the story. Meta and Microsoft both have told us that in this fiscal year, there will be capital expenditures of just north of $70 billion. But the thing that the Wall Street is trying to work out is, like, what's the math coming out the other end? So in the quarter that each company is going to report, Microsoft's expected to tell us that capital expenditures are up 30% from a year ago, but overall revenue growth 14%. Meta's expected to tell us that capital expenditures are up 100% from a year ago, but revenue up 15%. So that's going to be a question of how much patience and tolerance the market has for each of these companies to say, well, actually, we're seeing that translation of AI investment into top-line growth. Microsoft's a little easier, right, with Azure, because they often tell us our cloud growth was 34% is the expectation for this quarter. Of that, there was X contribution in terms of percentage points from AI. In Meta's case, it's a little bit less easy to calculate and understand. So then you go to management and how much you believe them, which is the fun of having an earnings call in quick succession.
Looking forward to your coverage, Ed, later on this morning on Bloomberg Technology, and then this afternoon when we actually get those numbers from big tech. Looking ahead to Meta, Shweta Kajuria of Wolfe Research reiterating her outperform rating on Meta with a 750 price target, saying we expect Q2 revenue to beat street estimates, in part driven by FX tailwinds and resilient demand. Shweta joins us now for more. Shweta, welcome to the show. Let's talk about what you are expecting beyond just the numbers in Q2. What about the outlook for spending from Meta? I think we might have a connection problem with Shweta Kajuria of Wolfe Research with the microphone, Bramwell.
Can you hear me?
Yes.
I think we've got the microphone up now. Shweta, carry on, please. If you heard me, I didn't hear you. So if you remember the question, please.
I did hear you.
Help me out.
Yes, I did hear you. And good morning, and thanks for having me. Yes, beyond the top line numbers, even though we expect a beat on the expenditure side, we think the number one focus is going to be OPEX and CAPEX. And I think Ed before me was just talking about that. We actually do expect Meta to even potentially raise their CAPEX guide one more time to even above $72 billion for this year. And more importantly, investors will be looking for how they talk about elevated CapEx spend over the next few years. We actually have almost $100 billion of CapEx for next year. Maybe 90 to 100 billion is where most of the investors are, even though consensus is calling for a significantly lower number. I think that those numbers are going to go up, and that is a key question.
Shweta, the other issue is how much they're spending and on what, right? I mean, they are giving these $100 million bonuses to try to attract a lot of AI talent. What's the vision here? The metaverse was one thing. Is it just to become more efficient? Is it to have the best kind of targeted advertising? Or is there some sort of bigger sea change goal that will redefine this company once again?
Well, Meta is trying to do quite a few things with AI. On one hand, it's their core platform, so both automation of advertising in terms of content creation and helping advertisers improve their ROAS, and improving user engagement for all of us to be making more engaged videos so that we spend more time on their platforms, and not only sit back and lean back sort of engagement, but also more interactive engagement is where they're headed. On top of that, they are also investing more on what they call business messaging for WhatsApp for all those sellers, and that will need a lot more compute. In addition to directly competing with Gemini and OpenAI with Meta AI, their new app that it's standalone now that does something very similar. And then finally, they're all of this coming together with their hardware, whether it is glasses or AR or VR hardware. So all of this will likely require a significant amount of compute, which is what they're building ahead of time.
Shweta, I remember when we used to think about Meta or Facebook as a social media company and directly competing with advertising and the like. Who are their main competitors now?
Well, it is increasing. It's a great question. It's increasingly becoming more of an entertainment company. So yes, it is social media, and historically we've seen it as competing directly with TikToks of the world, whether it's TikTok or even Pinterest or Snapchat. But increasingly so because of the consumption, it is now becoming more of an entertainment company. So even YouTube and any of the CTV sort of competitors, where do consumers actually spend time, is where they're competing, and that includes Netflix, Amazon Video, YouTube, and all other entertainment platforms.
Shweta, I know you've got to run. Thanks for that, and our apologies about the connection.
Thanks for having me.
Thanks for being here. Appreciate it. Shweta Kajuri there of Wolf Research on Meta. That stock is up 20% so far this year.
Yeah, a huge rebound since April 2nd. Where are we in the year? It goes to show how high is the bar for the likes of Meta and Microsoft that report after the bell today. Is it crucial for them to show blockbuster earnings and the promise of hopes and dreams in terms of their capital expenditure spend in order to maintain a rally that has propelled the entire stock market in the United States?
I know a lot of this year has been exhausting, but it's flying by. After the Fed decision today, there's only 3 left for 2025.
Yeah, and those are going to be really important 3, given the fact that this market is expecting them to cut rates twice in that period, amid a search for the next Fed chair, which might be currently sitting in the Fed governorship or even potentially one of the regional.
Who knows? We're going to find out in the next several months, potentially. That decision comes later. Coming up next, we've got some economic data, including GDP, plus a Treasury refunding announcement. Mike McKee's going to break down all the details in just a moment, and we'll get the reaction from Blake Gwynn of RBC. Live from New York City, you're watching Bloomberg TV.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Live from New York City this morning. Good morning to you all. Lots of economic data still to come, including the Treasury refunding announcement in just a moment. That's all going to come at 8:30 Eastern Time, so 15 seconds away. The scores into that look like this. Equity futures positive by 0.1% on the S&P. On the Nasdaq 100 up by 0.1. In the bond market, the 2-year, 10-year and 30-year. Yields a little bit higher this morning, up by 2 basis points at the long end, up a basis point, not even on 10s, 432. With the data, with the headlines, is Mike McKee. Good morning, Mike.
Good morning, John. Well, we've got a stronger than expected GDP number, 3% for the second quarter initial read. That's up from a 0.5% in the first quarter. 2.6% was what was forecast. Now, the interesting thing, of course, is we've got to break that down by category because we had the trade distortions in the first quarter. So let's look now at the GDP personal consumption number. Comes in a little weaker than anticipated. It's up by 1.4%. The forecast was for 1.5%. Gross domestic private investment, non-residential fixed, 1.9%. That's down from 10.3%. A lot of anecdotal reports that businesses were holding off on spending, and it looks like that indeed is what happened. Equipment spending fell from 23.7% gain to a 4.8% gain during the month, and intellectual property, software, etc., rises only a little bit, 6.4% from 6%. Looking at net exports, which should at least provided a big jump in the Atlanta Fed GDP now last week, or last reading. Exports were down 1.8%. Imports were down 30.3%. They had risen by 37.9% in the first quarter. So we know this is basically an import story and also an inventory story. Inventories down $185.5 billion. They were up $151.6 billion in the first quarter. So you've got inventories working against you. You've got trade working for you. And it looks like between the two, we really get a stronger than expected report because spending is not as strong as it was anticipated. Yeah. And the key number for us today is going to be real final sales to domestic purchasers. And right now, we're looking to see exactly what we got there at an annualized rate, 1.1%, down from 1.5%, 1.9% for domestic purchasers in the first quarter.
Mike, we'll let you look through all of those numbers from the GDP. I do want just one word, though, from you on the Treasury refunding announcement. That quarterly refunding announcement's been hotly anticipated. It looks like they are maintaining the total volume of sales, but they are doubling their buybacks of longer-term bonds. What is the significance of this? Can you tell us the expectations versus the actuality of the way the U.S. is going to finance its debt?
Well, they had anticipated increasing the number of buybacks. What they're trying to do is take old off-the-run bonds out of the market because nobody really wants to trade those. And so they buy them back, and then if you're looking for bonds, you've got to get newer ones, and that gives you a better price discovery. So they're going to 4 per quarter. The other big issue was what are they going to do about bills, because Scott Bessent's been critical of the Yellen Treasury terming out their sales. They're going to increase their short-dated bill auction sizes in August and October, but they say that is because they are rebuilding the Treasury General Account now that we have spent a lot of that money on the debt ceiling. Since that's been fixed, they're going to do that. And they don't expect any other changes to auction sizes for the next several quarters. $58 billion this time in 3-year notes, 42 in 10s, and 25 in 30s. It's a slight increase in 10s and 30s, but then they anticipate keeping that level for a couple of quarters.
Mike McKee, thank you, sir. Stay close. Bond yields higher, up 3 basis points on 10s to 4.35 on 30s, up 3 basis points to 4.89. Just unwinding some of the rally we saw develop in yesterday's session.
And part of that was on the expectation that there would be a real sort of retracement from issuing on the long end. In other words, issuing bonds more on the front end and even reducing some of the bond issuance on the long end. You didn't see that today. Hard to parse through whether the move is more on that or the fact that we got above the expectations when it came to GDP.
Blake Gwynn of RBC Capital Markets joins us around the table. Blake, good morning.
Morning.
This was a big focus for you this morning.
Absolutely. Yeah, I think, so what we got here, just looking at the headlines, and obviously when I get back to my desk, I'll be looking through some of the details a little bit more closely, but I think this is pretty close to what we thought was the consensus or priced in, the priced in outcome, that this would be the most market neutral. I think, just what we've seen initially, bond markets seem to be taking this pretty well in stride. I think if you would have gotten a more aggressive communication around shortening the WAM, if you would have changed some of that forward guidance where Treasury is kind of committing to not, to not increase coupons over the next several quarters, if you'd gotten some change there, maybe we could have seen some follow-on flattening, some follow-on rally to what we saw yesterday, but I don't think this is enough to really carry that through.
There are certain tools available to Treasury. Lisa mentioned one, boosting the buybacks in 10, 20, and 20 to 30-year buckets. What does that mean, ultimately?
So, this is, I think, been the biggest focus for us in a lot of our conversations with clients, because I think there's a real almost desire in markets to try to make these buybacks into a QE type of program that we saw the Fed do. But there's some very, very big differences. So they doubled the size here. They were in the long end, so 10s to 30-year buckets, they were buying about $8 billion a quarter. When you look back at the last QE program we had from the Fed, they were buying $40 billion a quarter in 10 to 30-year, 40-ish. So much bigger in size. So even with this doubling, we're still far from the size of what they were buying in the long end from the Fed. But I think the bigger issue is really the mechanics by which they buy it. And what I mean by that is the Fed is a completely price-insensitive buyer that had to buy those securities every quarter. So if you have a big price-insensitive buyer that come or hell or high water has to buy $40 billion every quarter, it's very different from what I think these buybacks represent, which is somebody who's saying, we may buy up to this amount. If things cheapen up enough, if things look attractive enough, we'll come in, but that's more a cap. We could also buy zero. So if you look at those two different scenarios and how you position for that and how it should impact markets, how it should impact yield levels in the curve, very, very different things.
So right now we're seeing the refunding announcement not necessarily causing the bulk of the move, it's a small move as it is in terms of yields just ticking higher. It really is coming on the better than expected economic data. Are you saying that essentially if the Treasury remains pat, things will remain as such, but if they do start to issue more on the front end at the expense of the long end, that could cause a pretty substantial rally? Is that what you're saying?
Well, I think there's varying degrees of this, right? Because I think what they're already doing in a way is kind of communicating that they're going to focus more on front-end issuance, because saying that they're not going to increase coupons for several quarters now, you're getting to the point where, given the financing needs that are coming, if you're not doing coupons in the next couple quarters, it means you're leaning more heavily on bill issuance on the front end. So even if they do nothing, even if they just maintain this kind of forward guidance that we're not changing coupons, you're going to see bills and short-dated issuance become a bigger part of the package, just naturally. So I think what markets wanted to see was something less passive and a little more active, where Treasury is actually saying, no, we are doing this, we're shifting, we're going to use these buybacks more like a QE program to really push down on yields, to push down on the curve. But that's not what we got today.
We've gotten a taste of the summer of the pain trade. The idea that all of the consensus bets in the first half of the year were challenged over the past couple of days. The idea that you could short the dollar, long the euro. The idea that long rates were going to keep rising. The idea that Europe would keep outperforming over the United States. Does that have legs because of the dynamic that you just said in the rate market in particular, that you could see an ongoing flattening rather than that steepening?
So the way we've been kind of viewing it is rather than these kind of issuance discussions really being a force to push yields lower or to push the curve flatter right now, the way I'm viewing is it's really reinforcing the kind of ceiling that we've seen. As we've seen basically since April, really the whole year, anytime 30-year yields have surpassed 5%, they very quickly trade back down. Within a session or two, they're back down below 30. So we're getting this really kind of range-bound trading. And I think having this discussion around WAM and knowing that the Fed, knowing that the Treasury seems to be focusing more on front-end issuance, even if it's just passively, I think that's enough to keep this kind of soft ceiling on yields, and that's probably reinforcing the top end of the range that we've been trading in. Now, if they go more active, if they really start to communicate a little bit more, that's where we start to see the downward pressure and really breaking out of the bottom side of those ranges.
Second quarter GDP out just a moment ago comes in at an upside surprise of 3%. The estimate in our survey was 2.6. Mike McKee still standing by. Mike, just to dig deeper into the economic data, for those of you out there that missed all of this, Mike, just go through it again. How much are the net export numbers flattering the overall story for the U.S. economy?
Oh, tremendous amount, John. We saw net exports rise or fall rather by $1.026 billion. That's down from $1.359 billion. And the contribution to the change by net exports was almost 5%. So the 5% subtracted from quite a bit from what we saw. And of course, we had a big rise in the first quarter. Also, though, the surprise is the slowdown in spending on both the consumer and business side. The personal consumption is up by just 1.4%. Now, that's a little bit stronger than the first quarter, but it is relatively weak compared to what we were seeing. And non-residential fixed investment falls from 10.3% in the first quarter to 1.9%. On a 6-month basis, which is kind of the way you'd want to look at it, given the trade and inventory distortions we've seen, the first 6 months, first half of 2025, growth has averaged 1.25%. In the last 6 months of 2024, growth averaged 2.75%. So a significant slowdown in the economy over the last 6 months. The president's critics will say it's his fault for the tariffs. The president will look at the top line number, I'm sure, and talk about nominal growth being stronger.
He's got some thoughts on that already. Hey, Mike, thank you, sir. Mike McKee with the latest. It's not an argument you often hear on Wall Street that growth is so good, cut interest rates, but it's an argument we're getting right now from the president. Second quarter GDP just out, 3%, way better than expected. Too late, Chairman Powell must now lower the rate. No inflation, let people buy and refinance their homes.
There is this theory coming out of the White House that sovereign risk, developed market sovereign risk, should be equated to credit risk, where the higher the rating of a country, not a company, should get a lower benchmark borrowing rate akin to the likes of Microsoft or Apple or Johnson, one of these major companies that have lower borrowing costs relative to their peers. That is not the way traditionally it has been viewed. It traditionally has been viewed as a rate for developed markets tied to inflation and growth that should be higher with faster growth. And yet, it's a sort of unconventional take on the economics of today.
Blake, final question. How much of a snooze is this meeting going to be today?
I don't have high hopes, let's be honest. We're watching to see if there's any dissents, but how exciting can that really be?
I'll make it easy for you and leave it there. Blake Wynn of RBC. Blake, thank you, sir. Appreciate it. That decision coming up later on this afternoon, the news conference at 2:30. Are we going to try and make it exciting later this afternoon?
Make it exciting. It just inherently has such drama and excitement. We could just keep repeating that clip of Donald Trump and Jay Powell with their hard hats on and just say, $3.1 billion. I don't see that anywhere. I don't think so. We just replay that over
It's
and
a
over
fantastic impersonation
really
you've got going there.
I'm really doing really well today.
People want to hear you sing again, too.
Let's move on.
Missed that from earlier on this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump says India will pay a tariff of 25% starting on Friday. In a post on Truth Social, he wrote, "While India is our friend, we have done relatively little business with them because their tariffs are far too high. Trump also suggesting he would add an additional penalty due to India buying Russian oil. Meanwhile, Palo Alto Networks agreed to buy Israeli firm CyberArk for $25 billion in cash and stock. The deal gives Palo Alto a suite of identity security tools which help users determine who should have access rights within an organization, according to the statement. And Kraft Heinz reported sales and profit that topped estimates. Second quarter organic revenue fell 2%, less than the 2.8% drop that analysts had expected. The packaged foods giant reiterated its outlook, pointing to progress in winning over inflation-weary shoppers. Shares are up 0.5%. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Claudia Sahm of New Century Advisors on potential dissent on the FOMC. From New York, you're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
I think the policy rate's a little bit high for the current environment, and so I do think that the committee could set up a September rate cut at this meeting. I think the risk for the chair is probably that that gets priced in even more than it already is, and he can't preserve enough optionality going into September.
That was the former St. Louis Fed President Jim Bullard speaking to us earlier on in anticipation of a Federal Reserve decision later on this afternoon. We've got some data to wrestle with. This on GDP. Really, the GDP guessing game of the year so far has all been about navigating trade. This came from Kevin Gordon at Charles Schwab just moments ago. He writes in, first quarter, net exports take the biggest bite out of GDP in history. Second quarter, net exports make the largest contribution to GDP in history. That's the situation of the last 6 months.
Yeah, how much is it a wash? Essentially, you've just seen massive distortions in data as people bring forward their exports, their imports, and then have a lot of inventory. These are the big questions as we grapple with trade deadlines and trying to understand the relevance of a lot of economic data.
The opening bout just around the corner, 42 minutes away. Equity futures positive by 0.1%. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John, we're in the thick of earnings season. Humana among them this morning. It's a rare health insurer that has upped its guidance for the year. Basically, everybody else has been cutting it, grappling with higher Medicare costs, medical costs. Humana, on the other hand, says, hey, costs have come in line. It also saw better business when it comes to their pharmacy and their Medicaid Advantage programs. Those shares up 10%. We also had Starbucks earnings after the bell yesterday. It did miss on a couple metrics, but it's all about the turnaround. CEO Brian Nichols saying it is ahead of schedule and that it will be unleashing a wave of innovation in 2026. So get ready for your protein cold foams and more croissants at Starbucks locations. Finally, Visa wrapping up the earnings here. Those shares, though, down 2.6%. It did beat, but the issue with Visa is that they left their guidance unchanged. Analysts had been expecting them to raise their guidance, so disappointment there. But Visa CEO going on to say that it is a consumer who is resilient and continuing to spend. John.
Danny, thank you. Thanks for this morning. We'll continue to count you down to the opening bout. Lots happening in your trading diary at 2 p.m. Eastern, a Fed rate decision. 30 minutes later, a Chairman Powell news conference after the closing bell, earnings from Meta, from Microsoft. On to tomorrow, core PCE and another round of jobless claims, plus results from Apple and Amazon on Friday, the payrolls report, and the president's self-imposed tariff deadline. A lot to look forward to as we turn back to the Federal Reserve. Claudia Sam of New Century Advisors writing, the possibility of two dissents from Governors Waller and Bowman is notable in terms of Fed history, but policy moves on agreement. Claudia joins us now for more. Claudia, welcome to the program. What kind of agreement can we make today at the Federal Reserve? What can we agree on?
I think it'll be really interesting to see if the committee is getting more comfortable, having more conviction in their, forecast that inflation may rise this year, but then, come back down. So I think a lot of this discussion around what are the risks of the persistently high inflation. We know from Governor Chris Waller that he sees those risks as very low, and that's why he's in favor of a cut. But is the committee moving in that direction of moderating those risks, or is it are they still very much demanding more data to get comfortable with the idea of a rate cut?
Claudia, what do you think? And it matters a lot what you think, because the SOM rule is often pointed to, and was certainly pointed to at the end of last year for the 100 basis points of rate cuts in the second half. Do you see the same cracks that Chris Waller is seeing?
I don't see this. I can see the cracks that he's pointing to. I maybe don't draw as strong an inference as he does. I do think it's time for the Fed to really be pivoting to, why are you waiting? What are you looking for in the data? What do you need to see with inflation, right? Like, focus on that as opposed to well, we can wait. We saw a lot of discussion at the last press conference about, well, the economy is solid, the labor market is solid, so we can wait and get more data. And I think there are sufficient signs of weakening. And some of the softening, the risks in the labor market, they've been with us for a while. Like, these are not new. The low hiring rate paired with the low layoff rate, this is not new. And yet we do see signs of demand softening. We saw some of this looking at first half GDP numbers and hiring concentrate. Like, there are just a lot of signs that this is not a labor market that will hold up, indefinitely. And so the Fed needs to back off some using that as its safety blanket in terms of waiting for more data and recognize those risks are out there. We hear a lot about the risk to the inflation outlook. We should be hearing some more about the risk to the labor market outlook as well.
There have been a number of people who've speculated that Fed Chair Jay Powell might take an even more hawkish approach to policy, might signal that the labor economy is in a good place and that they're balanced roughly in their mandates, in order to avoid accusations of political interference, that he's getting bullied by President Trump. Do you ascribe to any of those ideas, or do you think that that's a bit speculative?
the best way for the Fed to stay out of the politics as much as it can is to put its head down, parse through the data, be transparent, right? The data don't speak for themselves. We need to hear how is the FOMC interpreting the data? What are they looking for? Like, that's the message he needs to stick with. They're not going to win. The Fed will not win if it plays politics. Like, that's just not the game that it is well suited for, nor should it be doing it. So I think we should just get a lot more of their thinking and just lay it out there. That's part of the transparency. That's part of the accountability that comes with the Fed being the ones that make the decisions about interest rates.
So, Claudia, let's stay on the data. I just wonder if 2 CPI reports is enough between now and September to draw conclusions about how much tariff pass-through we'll get and how much of that tariff pass-through is going to stick around.
2 more CPI prints could give us information both on the tariff pass-through. I mean, the tariffs working their way through the economy, this is going to take time. And we could see, ever rising tariff effects as we go into the September meeting. So, I mean, they're going to have a real explanation of how you would cut into a rising inflation environment. But we have also seen months of the outside of the tariffs, look at the housing, really strengthen the case that underlying inflation, set those tariffs aside, underlying inflation is really moving back down to target. And that is a really important piece. And 2 more months of data in that direction can help bolster the case for a rate cut based on the inflation risks are less.
Do you think they're in a position today and through the summer to keep on saying the labour market is solid, so we have the luxury of waiting? Can they write that in the statement once again this afternoon?
Well, they can write whatever they want to write in the statement. I think it would be misguided. I mean, we have seen various pieces of information about the labor market that point to some weakening. And also, if you are running an economy with below trend growth, and that's, focusing on consumer spending, business fixed investment, kind of the core of it, that weakness does eventually show up in the labor market. And the Fed itself, its baseline forecast shows some weakening in the labor market this year. So it seems completely appropriate to at least be pointing to the risk, pointing to that outlook. I mean, that's, a very reasonable thing to be pointing out. And I think they'll be a little flat-footed if they just keep hanging on to the labor market is doing just fine, economic activity is doing just fine. Because that's really, I think that's a pretty one-sided reading of the data right now.
We'll see if we get that change at 2 p.m. Eastern Time. Claudia, appreciate it. As always, Claudia Sam there, New Century Advisors. Claudia's right, of course, they can write whatever they want. Just how credible is that argument still, to keep on saying the labour market is solid so we can wait?
Yeah, well, that's one reason why. How much do you see different views represented? Some people see it as solid, other people maybe don't necessarily see it as having that same degree of resilience. But Claudia mentioned there about the housing market and how that's been a huge disinflationary force. I wonder how they address that as well. Whether they ascribe that as some sort of leading indicator, or whether it's been a cycle unto itself. And that's clearly on the president's mind as well, when he points to the fact that borrowing costs are too high to buy a home.
Should we take a little break?
And then come back.
Come back later on this afternoon.
I'm eager.
Special coverage of the Fed's decision just around the corner. Bob Michael of JP Morgan, Diane Swank of KPMG, the former New York Fed President Bill Dudley, Jeff Rosenberg of BlackRock. Coming up tomorrow, Chris Verone of Strategas, Mira Pandit of JP Morgan, the former Kansas City Fed President Esther George, and Walt Piecyk of Lightshed Partners. From New York City this morning, good morning. This was Bloomberg Surveillance.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg. Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicide. homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
All right, we are 30 minutes until the start of the cash trade on this Fed Day. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, countdown to the Fed decision. The central bank is expected to hold rates steady despite President Trump's calls for cuts, but we could see the first dissent since the 1990s.
Whoa.
Meanwhile, earnings rush in. Companies worth $7.6 trillion in market cap report today, with Microsoft and Meta after the bell. And just 2 days away from his tariff deadline, President Trump announces a levy of 25% on goods from India.
So a lot to get to, but before we get to big tech specifically, let's talk a little bit about Starbucks. It reported that sales continue to slow, but the stock is higher this morning, as you can see, as CEO Brian Nichols says that turnaround plans are ahead of schedule. Shares currently up about 5% pre-market. Some good news for Starbucks, which is just about flat on the year.
All right, Meta and Microsoft are doing better than that, and both of them report after the bell, with investors focused on, obviously, the AI CapEx, which is expected to top $70 billion for the two companies combined this year, Katie.
Well, for more on today's tech earnings, we're joined now by Bloomberg Tech co-host Caroline Hyde, as well as Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. So a great roundtable to kick us off. It's finally here. We finally get to start to get some earnings.
And not
Caroline.
Fed Day.
Not Fed Day.
By the way, I said $70 billion combined.
You did.
Was I wrong about that? Is it $70 billion each?
Each, I believe.
Okay, just wanted to issue a little bit of a correction.
You're talking about the revenues that they're bringing in per quarter, or you're talking about the
CapEx,
market capitalization?
CapEx.
That's where we should start.
70 billion is far too small. Microsoft is more than $1 trillion.
No, CapEx.
Of capital expenditure.
Yes.
Sorry, well, yeah, 70 billion each.
Yeah,
and
it almost feels like more information on the contours of CapEx. I mean, maybe this is going too far, but it feels like that is the focus rather than actual numbers themselves in terms of the bottom line.
I think for Azure growth, we're going to want to see that the capital expenditure is being made up for by the amount that they're growing.
Azure,
34% growth rate, 17% of that, so about half is coming from AI products. Are they able to vindicate what has been a complete ramp up in terms of capital expenditure? When it comes to Meta, we're actually anticipating maybe a bit of an articulation coming from Mark Zuckerberg. How is the superintelligence race going to benefit his company from a personal perspective as well as an enterprise perspective. Of course, we're all thinking about the productivity it brings us at work. What about human connection? Why does he need to win the superintelligence race? Why does he need to be buying scale AI for how many billions? And indeed, the capital expenditure that was going up to $72 billion raise for the full year. We also know that, of course, that has been helping drive revenue for the company. This company is already up 20% in terms of year-to-date what they've achieved in their share price. And a lot of that is because ads are doing better because of generative AI.
Superintelligence, I gather that's the unit that Mark Zuckerberg has amassed around him. Mandeep, we heard the other day that it's going to be $20 billion in just headcount costs, personnel at Meta. Who was telling us that?
Gil Luria.
Gil Luria was telling us that the other day. $20 billion of that $72 billion in CapEx is just hiring people.
Well, I mean, what I can tell you is the one big beautiful bill has a very interesting clause for all of these tech companies. In fact, they can depreciate their entire CapEx in year one. And what that does is it gives you a lift in free cash flow. So to my mind, all the free cash flow numbers for big tech companies right now have not been revised upwards despite the CapEx increases because of the upfront depreciation, both on CapEx and R&D. And that was something that was in the big beautiful bill. It was passed. And I think you will see that lift in free cash flow expectations.
Well, let's talk about what investors are hoping that this CapEx materializes into, the return on investment. There was a really interesting quote from Gabriela Santos over at JP Morgan Asset Management telling Bloomberg News that if a company is saying maybe we'll see an AI benefit in 5 years, we're no longer at the point where that will get a pass. Valuations are mattering more and more, and valuation especially matters if a company can't grow sales as fast as expected or as quickly as CapEx. And Mandeep, that has kind of been the existential, geez Louise, question hanging over big tech over the last couple earnings seasons, but I imagine it's increasingly urgent.
I mean, I'll give you one anecdote from yesterday. Anthropic said their revenue 5x to $5 billion. They started the year at $1 billion run rate. Now they're at $5 billion. In 7 months, they have 5x their revenue. Microsoft actually saw a sequential increase to 35% in Azure revenue. Google saw that 500 basis point sequential increase to 32%. I expect the same to happen to Amazon. And look, if Anthropic is saying they have to cap the use of their premium model because everyone is using it too much, that tells you that the cloud providers are running out of capacity. And to my mind, everyone will have a sequential lift to their cloud revenue. And if they don't have it, then probably they're losing share. And Amazon is the one in spotlight from that perspective.
What about the actual quality of the products? I mean, I use ChatGPT constantly, but also sometimes Google, Gemini. I don't think I use Llama that much. Is that still what Meta is
That's the
calling
underlying large language model.
Yeah.
But if you're in WhatsApp, you're using Meta's AI product. If you're in Instagram, you're
But I type my messages myself, and I receive them.
But maybe
from
they're
people who type
offering.
them.
But also, what's interesting is that they have their own standalone Meta AI app now to compete with ChatGPT. They really want to show themselves as a direct competitor when it comes to the chatbot era, but the underlying technology as well. Look, they're building the Superintelligence Labs team to be able to bring about the next multimodal a large language model, whatever that might be. It's not going to be called Llama, maybe another animal, but ultimately that is what superintelligence is going to bring. In fact, we've already got this post coming from Mark Zuckerberg himself, almost front-running his earnings this morning, talking about why he thinks the benefits of superintelligence are going to be shared around the world, why it's not just about what's happening in the workplace, but personal superintelligence is going to know us deeply, understand our goals, and can help us achieve them, that will be far more most useful. He thinks that his personal devices are what are going to benefit as well from the ultimate winning out in their large language models. So yes, they want to go ahead and be versus Gemini and ChatGPT, but they also want their devices to sell off the charts, and they want to be able to be enhancing their product by building what Llama, and remember, Llama hadn't done that well in the latest upgrades, and that was why he got so frustrated and took it such a personal perspective on hiring this new team.
Yeah, personal perspective, definitely one way to put it. So we'll probably get more clarity after the bell tonight, or at least that is the hope. But we also have to talk about a big deal in the AI space today. Finally getting confirmation here that Palo Alto Networks has agreed to buy CyberArk software in a $25 billion deal. Mandeep, Dan Ives over at Wedbush said that this is a home run deal. What is your perspective on this tie-up?
I mean, they had to do something because Google has announced this big deal for Wiz, $32 billion deal. And at this point, all the hyperscalers are bundling their own security. AI agent security is going to be the next big thing. And all the existing cybersecurity players are trying to find that pivot to AI agent security. I mean, I feel that's the one area that can have huge growth because we are moving from a seat-based model where you're securing users to securing AI agents, which is far greater in magnitude compared to the number of users you have to secure. So from that perspective, the strategic rationale is there, but $25 billion, we have seen traditionally an acquisition of that size will create an operating margin drag in year one, EPS drag, because the synergies are just not there when you're overpaying that kind of multiple, you know, anything above 10 times sales. It's very hard to justify, you know, in terms of revenue accretion, and margins will compress, but the strategic rationale is there.
All right, Mandeep, thanks very much for joining us this morning. Mandeep Singh runs our tech coverage for Bloomberg Intelligence. Thank you to Caroline Hyde, as well, co-host of Bloomberg Technology. That show kicks off at 11 a.m. On the economic front, the U.S. rebounded with 3% GDP growth in the second quarter. President Trump hailed the data in a social media post as way better than expected, in all caps, and renewed a call for Fed Chair Jerome Powell and his colleagues to lower interest rates. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now from Washington. So, Mike, what's the data look like when you parse through the details?
Well, I hate to burst the president's bubble, but the data aren't all that great in terms of second quarter growth here. We had an increase of 3% in GDP after a decline of 0.5%. But remember, that decline was caused by inventories and exports. And we had the same story this time. But look at the spending numbers as well. Consumer spending up an anemic 1.4%, and business fixed investment up 1.9%, down from a 10.3% rise in the first quarter. I will point out, given your discussion that you just had, that intellectual property spending, which includes software and computer design, et cetera, was up 6.4% after 6% in the first quarter. Those are fairly strong numbers. But inventories were down by 26 billion. Net exports were down as imports fell significantly, reversing what happened in the first quarter. So how do we know what's going on with the economy? We look at real final sales to domestic purchasers. They were up just 1.1% during the quarter. That is down from the first quarter number of 3%. So at this point, we are looking at a weakening economy, which because of the numbers, the way they add up, guys, it looks like the economy is on hold because of Donald Trump's tariffs.
Interesting, too, to see the market reaction. 10-year Treasury yields seem to be selling off. The yields moving higher, up about 4 basis points. This all as we count down to that Fed decision at 2 p.m. today. A big day for Michael McKee. Appreciate you joining us right now. Meanwhile, let's get a check on equity futures. We're just about 20 minutes away from the opening bell. Not too much action when you take a look at the index level. That's been the case, feels like for several weeks now. The S&P 500, the color's green. It's pretty much unchanged. A little bit more direction when it comes to the NASDAQ 100 ahead of some of those big tech earnings. You can see it's the Russell 2000 that is leading gains this morning, Matt, even though you do have that sell-off underway in the long end of the Treasury curve. Let's look under the hood, though, at some movers on our radar. Maybe we'll find more action there because Visa left its full-year outlook unchanged to move that disappointed investors. You can see that disappointment in shares down about 2% pre-market.
Yeah, Humana is gaining 10% pre-market after raising its guidance for the year thanks to growth in its Medicare Advantage and pharmacy business. So you see at least one health care company doing well today.
Yeah, absolutely. A rare bright spot, it feels like, when it comes to the health sector. Also keeping an eye on Marvell. It could see higher demand for its products due to potential delays for Microsoft's in-house chips. That is good news for this company, up about 9% pre-market.
All right, coming up, Starbucks climbing despite sales and profit falling more than expected. We'll give you the latest on the company's turnaround. This is Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Now to high interest. Look at what's making headlines around the world. Electronic Arts is reporting first quarter net bookings that beat estimates thanks to positive trends for its football franchise FC and shooter video game Apex Legends. By the way, when I say football in this context, am I talking about soccer? Possibly. Vinay Prasad, a top FDA regulator, has left the agency after controversy over his handling of Sarepta's gene therapy. Earlier this month, the FDA asked Sarepta to stop shipping its drug after 3 deaths were linked to the treatment. That decision led to backlash from advocacy groups and conservative media outlets like The Wall Street Journal and Laura Loomer, who said patients deserve access to the drug. Analysts say Prasad's departure is a major positive for the biotech sector because under Prasad, the FDA was seen as very conservative when it came to drug approvals, and they want all of those drugs just to be out there. Harley-Davidson announcing today it will partner with PIMCO and KKR for its financing unit. This as sales decline in its latest quarter thanks to softer motorcycle demand. We're going to talk about that deal in the next hour with Daniel Peterzak, KKR's global head of private credit. Katie?
Yeah, looking forward to that conversation. Hog ripping higher this morning. Starbucks also having a good morning in the pre-market. Sales and profit fell more than anticipated last quarter. You wouldn't know it by looking at that pre-market gain. That is due to CEO Brian Nichols' comments that his turnaround plans are ahead of schedule. That plan includes cutting down wait times, revamping the menu, and remodeling stores. Bloomberg Intelligence senior restaurant analyst Michael Halen says that Nichols' plans could markedly improve the business in coming quarters. Michael joins us now, and I have noticed that when I order a coffee on the app and I come into the store, they actually have written on the cup, which is nice. I don't think that's why we're seeing such an outsized gain this morning, though. When we say the coming quarters, Michael, put that into context. How long might we have to wait to actually see this plan really take root and show up in sales, in profit?
Yeah, so we're going to see it in the top line first, right? They're going to spend $500 million next year to help boost that top line, right? So the margin, although we will see some margin expansion likely next year, you know, it's not going to even get back to 2024 levels. So, you know, we could see a sales improvement as early as next quarter. We're lapping a 7% decline last year in the United States, right? And so, a lot of, you know, he pointed to a lot of operational improvements. You know, he talked about a 49% hourly turnover rate. That's fantastic, right? So that indicates service is improving. Speed of service is declining. Their speed of service times are improving, and so that's getting people their coffees more quickly, and so that should incentivize people to come more often, right? Value perception scores are the best they've been in 2 years, and so for all of these reasons, you know, we think investors are seeing some momentum, and that's why people are buying up the shares. You know, next quarter should see improvement. 2026 is where we expect even more improvement. You know, it's going to be a big year for innovation for Starbucks.
What I don't get what the innovation could be, Michael, because, and I'm not as deep into this as Katie.
Open your mind, man.
Well, I mean, it's just coffee, right? And apparently it tastes a little bit burnt. I don't know too much about that, but otherwise they just offer carbs like muffins and cakes. What can they do that's going to bring people in to buy an expensive daily cup of coffee?
Yeah, they're going to make some improvements to the food, right? They're going to have some more healthy options. They're going to improve the food in the bake.
But they don't have a kitchen, dude. It's just a storefront. Like,
Yeah,
they can't be a restaurant.
Dunkin', for example, has pretty good food, at least compared to Starbucks, in my opinion, Michael.
Yeah, and so they see a good opportunity there. There's some other things coming. Cold foam sales were up 23% this year. So in this quarter, in the third quarter. In the fourth quarter, they're going to introduce protein cold foam. So this kind of goes hand in hand with the healthier options, right? They want to offer some more healthy options on the menu to get people in the stores, because obviously that's a big trend in the restaurant industry. So, you know, they're making some menu changes. They've been paring the menu to improve operations. Now that the operations are starting to hum along a little bit, they're going to start making some additions to the menu to try to juice sales.
All right, well, I'm, for one, excited to see what protein cold foam looks like. Michael Halen, really appreciate your time. That is Michael Halen of Bloomberg Intelligence. You and I need to go to Starbucks after the show. I'll walk you through the menu, and we can talk about what cold foam is.
Right. I have no idea. I'm trying to think of what it could be, and I still don't know.
You know when you get like a nitro cold brew and it has like a little bit of a head on the top?
I don't. Is that a Guinness?
No, but it's a similar thing. We'll discuss in the commercial break. We have to get to some of the other movers.
Yeah, let's get to that. We are just 9 minutes away from the market open.
That's true. We have Vans and North Face owner VF Corp surging as a brand revamp begins to pay off. I was actually taken off guard there because I didn't realize shares actually now up more than 20% pre-market right now.
Wow, that's a massive gain. Etsy, which is the website where you buy like stuff that somebody made at home, earnings topped estimates as AI tech helped boost sales with personalized marketing.
That has to help. It certainly is helping pre-market. Meanwhile, Kraft Heinz sales beat estimates as it begins to win over price-conscious shoppers. You're not really seeing that show up in a big way in the pre-market, only up about 0.4%.
All right, coming up, one of our favorite guests joins us. Jay Hatfield of Infrastructure Capital reiterates his stag deflation call. We'll discuss that and his 6,600 year-end S&P price target. This is Open Interest.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets. Well, the U.S. economy surged last quarter. Annual GDP rose at a 3% annual rate. That is above the 2.6% Bloomberg estimate, as Americans shopped more and imports fell. Jay Hatfield joins us now. He is the founder, CEO, and portfolio manager at Infrastructure Capital Management. And Jay, first of all, it's great to have you back with us. Second of all, you take a look at the data that we have continued to get. GDP this morning coming in strong. You had ADP coming in stronger than expected as well. We keep looking with a magnifying glass for some hint that this economy is starting to weaken. Feels like we're just not seeing it yet.
Thanks for having me back, Katie and Matt. Well, I think the way to look at this data is you really average the first 2 quarters. So we're 1.5. Our prediction on GDP growth is 1 to 2 rather. So 1.5 would be consistent. And the reason for that is you have a very slow old economy. So it's housing, construction, and obviously a very strong tech investment. And investment's what drives cycles, not the consumer. Everybody talks about the consumer. It's really investment. 12 out of 13 recessions were created by a housing crash.
Right.
But we haven't had that really because of post GFC hangover. I've never had a big increase in construction of housing, so you can't have a big crash, and we have a shortage. But we do have a slowing housing market. Can't do that forever. The Fed needs to cut rates.
All right, we're going to take a break. We're going to come back. We're going to do the whole market open dance. But we have an ECAN chart on GDP, which I think is particularly fascinating. And you point out we need to average out the last 2 quarters. Check out the red block here in the last 2 quarters GDP. That's all exports and imports. We'll talk about that with Jay Hatfield when we get back. This is Bloomberg.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We are moments away from the start of trading on this Fed day. This is Bloomberg Open Interest. I'm Matt Miller. After snapping a 6-day winning streak yesterday, 6 days in a row of new record highs, the S&P actually fell just a little bit. We're up just a little bit in terms of futures today. You can see NASDAQ futures doing better, and the small cap futures, they're moving as well. You got Ambic ringing the bell. Ambic Micro, the New York Stock Exchange. These guys make, according to themselves, ultra low-powered semiconductor solutions for battery-powered AI devices backed by ARM Holdings. They raised $96 million in an IPO, selling shares at $24 a piece. Meanwhile, the NASDAQ Stock Exchange, you've got what looks like a nonprofit ringing the bell. It's called Go Project. I have no idea what that is, but I'm foregoing.
Yeah.
I like Go.
All right.
My favorite Bloomberg TV name ever was Bloomberg Go.
Yeah, I remember.
With David Weston.
Yeah.
I thought it was great.
I like open interest a lot, and I like Starbucks a lot. So let's talk about it, because this company reported yesterday that sales are continuing to slow, but the stock is higher, as you can see, with CEO Brian Niccol saying his turnaround plans are ahead of schedule. You can see shareholders are psyched about the coming innovations that we talked about with Michael Halen. We're talking about protein cold foam, Matt Miller. We're talking about more seats in the stores, and we're talking about better bakery items. There's a lot to look forward to. At least that is the message from shares.
Yeah, looking forward to my Starbucks tour after the program. Meta and Microsoft report after the bell, with investors focused on AI spending, which is expected to top $70 billion each. We're talking about CapEx here, $70 billion a piece, or maybe even more. And by the way, ChatGPT tells me that does not include spending on personnel. That would be OPEX, operating expense.
Yeah.
So add that $20 billion extra bill for Meta to staff its super intelligence suite.
And what does it produce? What does the ROI look like? That is the big question, you could argue.
Yeah, right now, nothing, right? But as long as we have companies that are providing ultra-low-powered semiconductor solutions for battery-powered AI devices.
We will have companies to ring the bell.
That's right. We are back with Infrastructure Capital Management founder and CEO Jay Hatfield. And I teased, Jay, the ECAN screen on the Bloomberg terminal. It's a great way to look at GDP and a number of other data releases. But you see a big red block bringing GDP down. In the last quarter, that was a rush to import stuff ahead of tariffs. Now you see a big red block in the positive side of the ledger for this quarter because we're just not importing as much. You say GDP is going to be 1 to 2%, what, for the rest of the year?
Correct, yeah, for the year.
And then do we get a boost from 1B3? I mean, what's the point?
Well, it's critical that we have Fed rate cuts because right now you have a very slow old economy. We have to have Fed rate cuts. And if you really look at the housing market, it's in a lot of trouble. Even in San Francisco is out there. It's slowing, even though we have an AI boom there. It's just because rates are almost over 7, and that's just not sustainable on the mortgage side.
Why don't we get used to that? At some point, like my parents paid, I don't know, 17% on their mortgage for the first house in the 80s. So, like, don't we at some point get used to 6-7% mortgages?
No, because we had wage and price controls during the 70s that tanked our oil production, which nobody focuses on. We had a 1,200% increase in inflation from primarily oil. We don't have that now. We have robust production, no controls. So we're not going to have that type of inflation again. And we have more global savings. So rates are never going to go that high. We think sustainable rates are 4 and 3 on the Fed funds rate.
Let's talk a little bit more directly about the Fed, because you said that we need rate cuts. The broad expectation is we're not getting one this afternoon. We are expecting perhaps some dissents from Bowman, from Waller, and you do see this sort of jockeying for who might be the next Fed chair. That is the bet that Wall Street is trying to place, and I wonder how you're thinking about that process.
Well, we're very focused on Keynesianism versus monetarism. So the Fed chair has said that the money supply doesn't matter. So to us, that's like the Pope saying that there is no Christ. So that is just horrible mismanagement. That's why they said that inflation was transitory when the money supply was going up 70%. So we're in favor of Waller because he's a monetarist from the St. Louis Fed. And we are not in favor of Warsh because he's ultra hawkish and helped create the great financial crisis by being a hawk in the 17 increases leading up to the great financial crisis.
But he'll be a dove if Donald Trump wants him to, won't he?
Maybe, maybe not. You never know.
But you want Waller, you want cuts, and you think 3% is where we should be. We're at 4.5% now. How does that sequencing look to you? How do you think we get there?
Well, we do think there's going to be a September cut. And if you hit the nail on the head, Katie. It's really the dissents. So there hasn't been 2 dissents since 1993. So we think that Powell, who's more of a politician, as evidenced by saying that the money supply doesn't matter, will try to placate at least one of those 2 Republican dissenters. So I would look for the critical element to be the dissenters. And if he does get at least one of them to not dissent, that means he's probably promised or at least indicated that he's open to a September cut.
It'll be really interesting to see what that actually looks like. Usually we just tune in, we tune in at 2 p.m. to see the decision, but the real action starts at 2:30 when the conference actually starts, but 2 p.m. will be interesting this time around. I was speaking to Jeffrey Sherman of DoubleLine a couple weeks back, and he was talking about the idea of a shadow Fed chair and the idea that once we get to May 2026 and we have a new chair installed, that rates are going to drop. And the way that he was thinking about playing that was a yield curve steepener. That is the position that he has on in his portfolio with that sort of dynamic in mind. How do you think you should be investing around that?
Well, we disagree with that thesis. The terminal command of the day from our perspective is MIPR. So that shows the terminal rate of the Fed funds, and that's what drives the 10-year. So if you just look at it, you can do a correlation about 70% correlated. You can replicate that on the terminal. But it's really almost 100% correlated in reality. So right now, there's 100 basis points gap. And so we think the 10-year will go below 4 because the terminal rate's going to go down to about 3, which is where it should be. That's where it normally is. It's normally actually 75 basis points over Fed funds. It's really 2 3/4 to 3. So we don't agree with that. We think we'll just have a normal 100 basis point differential. That's been extremely reliable over the last couple of years. People say, oh, well, the Fed cut rates and then the long rate went up. Well, that's terrible. It was because they cut rates and then they made hawkish commentary and the terminal rate rose. So we don't agree with that. We're bullish on rates.
What about the rising debt and deficits? I mean, Scott Bessent came in with this 3-3-3 plan, but it's starting to look more like a 7, right, on the deficit this year. And a lot of economists have forecast that number to climb. Now, it looks different if you calculate in a ton of revenue from tariffs, but if we put up tariffs, that revenue should decline as well, right?
Well, there was a lot of disinformation about deficits that came out of the budget process, or the tax bill process. Even the CBO was projecting the deficit drops to 1.7 trillion next year. That's in their own, sort of nonpartisan projections. So we simply added 350 billion from the tariffs, and we're coming out with a deficit of 1.3 trillion. And a lot of people don't make these projections. It's very straightforward to do. And that's only 4.1% of GDP. And it's sustainable because nominal GDP normally grows at 5%. So we're actually bullish on tariffs. We think it's good for economic growth. In our models, that increases economic growth by 0.2.
Do you think tariffs are good for economic growth?
In the long run, absolutely.
How does that work out?
Because you reduce the deficit, which reduces crowding out. So you have more private investment, which results in higher GDP growth. And the IMF estimates that national savings is 70% correlated with economic growth. So 10% increase in national savings, like China has 45. Well, guess what? They grow, 6 to 7. It's solely for that reason. So you have to save more to have higher economic growth, and tariffs does the trick with regard to that.
All right, Jay, we have to leave it there. We have to have you back again soon. That is Infrastructure Capital Management founder and CEO, Jay Hatfield. Meanwhile, let's get a check on this market. We're about 9 minutes into the session, and you take a look at where we stand at the index level. It doesn't look too exciting, but this is a coiled spring. We know that all of the action comes later in the afternoon. We get that Fed decision at 2 p.m., the press conference at 2:30, and then those big earnings report after the bell. Here's where we stand as we count down. You can see the S&P 500 up about just 0.1%, almost an even split when you look at the breakdown of gainers relative to losers. Up at the top, you have NVIDIA leading this market higher on a points basis, up about 1% or so. You also have Broadcom, Eli Lilly rebounding from yesterday's losses. Those are the winners. Take a look at the losers. Up at the top, Palo Alto Networks. We know that they are inking that $25 billion deal for CyberArk, that price tag bringing down shares this morning. Apple, too, losing a little bit this morning. It's roughly the same makeup when you take a look at the sectors as well. Maybe a bit more green than red here, but pretty much even. Utilities higher by about 0.75%. Healthcare up there, too. That's different from yesterday. And financials punching higher right now. Down at the bottom, industrials, materials, and then energy is your biggest loser today. Matt Miller currently off by about 0.7%.
All right, that makes me go GLCO to check the oil price. And we actually see a little bit of a bounce here. WTI crude up to 69.71. Brent crude adding 50 cents to 72.97. Coming up, we're going to focus in on the tech. Meta and Microsoft kick off back-to-back days of Mag 7 earnings. We'll look ahead with New Street Technologies infrastructure analyst Antoine Chaiben. This is Bloomberg.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to the job?
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back to Open Interest. It's time now for top calls. Some of the analyst action in focus this morning. First up, Peloton getting raised to a buy over at UBS. The analyst says that there's improvement in the company's fundamentals and the risk reward is more favorable. Shares currently up about 7.4%. Next up, Booking is getting downgraded over at Wedbush after the online travel agency gave an outlook that was seen as disappointing. Booking is warning that, quote, increased uncertainty in the economic and geopolitical environment threatens to weigh on travel demand. Shares right now up about 1%, though. And finally, we have Union Pacific getting cut at Citigroup after the railroad agreed to buy Norfolk Southern. The analyst says that both stocks may trade sideways as investors assess the likelihood of regulatory approval. That is certainly one of the big questions out there. Shares pretty much unchanged, though, Matt.
Yeah, it seems like a very big deal, not only in dollar terms, but also in terms of market dominance. So will be interesting to watch. That deal's not expected to close until 2027. Now, Meta continues to go all in on artificial intelligence. The CEO, Mark Zuckerberg, is expected to address the company's costly AI ambitions after the bell today when Facebook reports second quarter results. Joining us now is Bloomberg Tech co-host Ed Ludlow. And Ed, we're talking about, and just correct me if I'm wrong here.
Sure.
Possibly more than $70 billion in CapEx, and then maybe more than $20 billion in operating expenses due to personnel costs, hiring the super smart people for the super intelligence group.
Yeah, the phrase I keep seeing in all the sell-side notes is expense risk. So $72 billion is the upper end of the range that they gave us for this fiscal year on capital expenditures. And actually many corners of the street are actually expecting that they might raise again one more time and boost that range. But the math's kind of simple. You know, in the quarter that Meta's going to report, they'll probably say that capital expenditures grew 100% from the same period a year ago. But at the same time, revenue is growing at about 15% year on year. And so what they will look to is Mark Zuckerberg to explain the conversion when all of that investment is sort of tangibly relating to revenue growth that is AI related. And Zuckerberg actually posted a video on Instagram this morning and on Threads explaining his vision for superintelligence, but it didn't go as far as to say, well, like, here's how we're going to make money from it. And so I'm sure that will be a part of the calculus on the call.
Well, that's what I wonder about, Ed, and I know this is a discussion that we've probably had before. I keep going back to Meta's year of efficiency. You think about the 2022 that they had down 64%. Mark Zuckerberg tightened the belt. The year of efficiency was coined, and then 2023 up almost 200%. I wonder when investor patience runs out with these enormous sums of money that we're talking about.
Yes, we shall get in trouble with the audience, but Wall Street can have short memories, right? And it's so interesting how the pressure point on Meta has changed, because there have been clear examples in recent quarters where the market has cheered this commitment to capital expenditure. You know, one thing that's really kind of unique in Meta's case as opposed to Microsoft, because Microsoft gives us more information about the cloud portion of revenues that are AI related, but Meta has this hiring spree that's going on and this acqui-hire consideration, which is almost like OPEX as much as it is CapEx. But the vision that Mark Zuckerberg posted in the video this morning is super intelligence in the form of the AI they're working on, AR, augmented reality headsets, or the smart glasses being the way you interact with it, and then a creator economy. And he took this kind of little dig at productivity and productivity workers, you know, using AI in the daily course of normal software or enterprise. So it's just about how convincing that message is on the call for this vision of the future for Meta.
All right, well, looking forward to getting those details. Our thanks to Bloomberg Tech co-host Ed Ludlow. You can catch more of him at 11 a.m. Matt Miller, you have something to say.
Well, I just want to say, I've asked ChatGPT.
Oh, good.
Mark Zuckerberg first said year of efficiency, February 1st, 2023, and he only said year. Singular.
Singular year.
So that year is well over.
It's well over. It's well over. We should get another chair for ChatGPT, our third anchor sitting next to us. Let's keep this conversation going, though, because Microsoft's AI spending is also under scrutiny. Joining us now is Antoine Schreiben. He is technology infrastructure analyst over at New Street. He has a buy rating on Microsoft with a $550 price target. Antoine, we'll get into the specifics, but let's just talk about that overarching question first. When do we start to see a return on investment from some of these enormous figures we're talking about when it comes to CapEx? And how much does that question matter when it comes to tonight's results?
Yes, thanks, Katie and Matt, for having me on the show today. So I think this debate around ROI can easily be misframed by investors. I think what we should really be asking are two questions. The first one is, will Microsoft retain good pricing power in the AI era in order for these investments to fuel sustainable growth? And the second one is, will those investments drive strong productivity enhancements that will allow the company to offset the increased CapEx and the depreciation in the P&L with cash costs growing slightly slower than revenues? And so in practice, what does that mean? It simply means that you're growing your headcount and your cost per employee, but you're just growing it slightly slower than you're growing your revenues. And by the way, there's nothing new here. This has really been at work over the last decade with the rise of cloud computing, and now it's just being supercharged by AI, and that's really what we call the special replatforming theory. And we use the special term, you know, in conjunction with the relativity theory, because we're applying that now to the top 4 hyperscalers and Microsoft. But the general theory, which we're working on now, is about applying the same framework to the entire global economy.
I wonder when you're going to see headcount start to shrink, Antoine, because we've heard from others. Bill McDermott from ServiceNow said he's going to be able to cut $100 million out of personnel costs with AI. And obviously, Microsoft is using AI to write a ton of its code. I think 30% was the last I heard, but maybe it's more now. So when do you think they're going to be able to use their own product to reduce not only costs, but headcount?
I mean, we've already seen a lot of news flow around Microsoft reducing headcount. The headline number is 15,000 employees since the beginning of the year. That's like mid to high single digits of the overall workforce.
But they still hire people, right? Even as they reduce headcount. That's why you say headcount's going to rise just slightly less than revenue.
Exactly. That's where I was getting at. I was going to say what you should expect is headcount to decrease as they are replatforming parts of their business. But then overall, in our replatforming framework, cash costs are still growing. They're just growing slower than revenues, but they're still growing. So that makes room to increase headcount and just allocate the investments, the cash investments in areas of your business where you can now leverage AI to be more productive. So you're just moving money around in your business, but overall, you're not decreasing the overall headcount over the long run. So now we're in a phase where Microsoft is reducing the headcount, but we expect over the long run, this whole AI replatforming to drive, additional investments in human capital.
It's a good point that you're sort of moving the chairs around. You're not taking chairs away. Antoine, we don't have much time left, but I do want to get your thoughts on a deal from this morning. Palo Alto Networks reaching that $25 billion deal to buy CyberArk. We were having a conversation with our own Mandeep Singh about how maybe the price tag looks a little bit difficult to justify. You certainly see Palo Alto down about 8% at the moment. What do you make of this combination?
And I think that really reflects two concerns. The first one is the acquisition price, like $25 billion. That's by far the most expensive acquisition that Palo Alto has done. And more generally, I think investors are concerned about, like this platformization strategy in the cybersecurity space. Palo Alto has been, in effective terms, offering some subscriptions for free that compete with direct competitors, like Zscaler, like CrowdStrike. In order to wait for the subscriptions with those competitors to lapse and then start monetizing, start platformizing, start essentially consolidating the space. And that strategy is, of course, in the near term going to wait on growth. And for us, we're not too concerned. We think that that acquisition, the CyberArk acquisition, CyberArk specializes in areas like identity, access management, identity governance, and that's going to allow Palo Alto to cross-sell a lot, like to platformize, to accelerate the platformization that is going after. And maybe if in the near term is going to wait on free cash flow per share by, I think, 8% based on what they disclosed on the acquisition between like...
Antoine, we got to cut you off. We're running up against a break, but really appreciate your time. Antoine Skyban of New Street. This is Bloomberg.
up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachian Zahran, and this is Bloomberg.
cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Tsunami warnings have been downgraded from Japan to California's Pacific coast after an 8.8 earthquake, one of the largest ever recorded, hit Russia's east coast. There were mass evacuations in Hawaii. Maui County Mayor Richard Bisson.
Right now, no reports of any damage, no injuries. Really happy with our first responders. Our fire department made a few rescues.
The BBC's Shaima Khalil is in Tokyo.
The meteorological agency has downgraded the warning level now to advisory, which means it's the lowest alert level. It has been a very tense day here in Japan, especially for the nearly 2 million people, some of whom were woken up by sirens alerting them to a tsunami and who have been told to evacuate to higher grounds.
Russia's Geological Survey has just reported a volcano eruption near the epicenter of the quake. Never mind the president's tariffs, brand new numbers on the GDP show the U.S. economy grew at a better than expected rate of 3% in the second quarter after slowing down in the first. CBS News business analyst Jill Schlesinger.
This report really does show that the economy seems to be managing higher prices without seeing a big deterioration. The months ahead will probably give us more data and reveal more about what's going on underneath the hood of the economy as those tariffs take hold.
President Trump says he will not extend Friday's deadline. He posted to Truth Social today he'll impose an extra 25% tariff on India for buying Russian oil. After the administration tried to pause it, federal funding for some health research is flowing again.
White House Budget Director Russell Vought had declared the National Institutes of Health could only give funding to staff salaries and expenses, not to new grants for outside health researchers.
We have an agency that needs dramatic overhaul.
But last night, senior White House officials intervened and the budget office canceled the pause of about $15 billion in funding. Most NIH-funded research on cancer, diabetes, and other conditions is conducted by outside scientists. Michael Wallace, CBS News.
A Marine veteran who disarmed a man during a stabbing spree at a Walmart in Traverse County, Michigan, is speaking out.
He didn't seem like he was aware of all the things that were happening. He was just very wild-eyed and just not there.
Derek Perry held the suspect down until police arrived. All 11 of the wounded are expected to survive. In Birmingham, England, Cheers for Sharon Osbourne and Ozzy's 4 children. They all attended a celebration in the streets of his hometown today. Osbourne died last week. He was 76. This is CBS News. A cyber attack strikes Minnesota's capital city.
Minnesota called in the National Guard to help after St. Paul was slammed by what Mayor Melvin Carter called a cyber attack by sophisticated hackers.
This was a deliberate, coordinated digital attack carried out by a sophisticated external actor, intentionally and criminally targeting our city's information infrastructure.
Information systems were shut down as a defensive measure to contain the threat, causing Wi-Fi outages across city offices and libraries. Steve Kathan, CBS News.
The guys behind South Park are tempting fate again. A week after they skewered President Trump in the season 27 premiere, they're doing it again in a trailer for next week's episode.
You can just shut up, baby, because you hate America and you love abortion.
We want to honor the president's courage. Stop.
Spot includes a shot of the president again with Satan. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. John Tucker, Paul Sweeney, live here with you. It is Fed Day. We'll have that live coverage for you at 1:30 p.m. This afternoon, Wall Street time. Coming up, Tyler Kendall, Bloomberg Television Washington correspondent, on tariffs update. I think it has something to do with India today. That's in the news. Steve Mann, Bloomberg Intelligence Global Autos and Industrials Analyst, have talked to us about Tesla. They signed a big battery supply deal with LG Energy. Is that going to be a little bit of a spark there for the EV business over there at Tesla? Dennis Lockhart, former Atlanta Fed president, he's going to join us to discuss the Fed meeting today. And then Jen Bartashis, Bloomberg Intelligence, she's a retail analyst, talked to us about Kraft Heinz raising prices more than expected to beat estimates. That sounds like
my ketchup is going to cost more?
I think it is.
What?
Now, I actually Googled catsup versus ketchup. Catsup is kind of like an old time. That's what my mother used to say, catsup. But now, since Heinz introduced its ketchup like 100 years ago, ketchup has become more common than catsup. So
I'm going to go with catsup just to
okay,
people.
Very good. So we got a lot coming up in the next couple hours. Let's kick it off with Charlie Pellet with the Bloomberg Business.
I thank you very much, and we'll go with anticipation, sticking with the ketchup theme. If you know that reference, you're old. We've got Kraft Heinz right now up by 0.3%. Dow Industrials, little changed on the day right now. S&P 500 index up 6. That is a gain right now of just about 0.1%. NASDAQ up 49, a gain there of 0.2%. Our Mag 7 index ahead of earnings from Apple, Amazon,
Amazon, Microsoft, and Meta today. Microsoft and Meta today. We've got the Bloomberg Mag 7 index up 0.2%. Again, the S&P little changed up 0.1%. The Dow swinging between gains and losses, and the 10-year 4.36%. The 2-year 3.90%. Spot gold down $22 the ounce, 33.04. That is a drop of 0.7%. West Texas Intermediate crude up 0.6%, 69.62 for a barrel of WTI. Bitcoin, meanwhile, closing in on $118,000 again, just below that level, up by about 0.3%. This Bloomberg Business Flash brought to you by IBKR. Will U.S. initial jobless claims exceed 220,000 for the week ending August 2nd, 2025? At IBKR Forecast Trader, the yes was recently at 54%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is August 7th. Humana raising its profit guidance for the year, bucking a trend in the U.S. health insurance industry after most other companies cut their forecasts in recent months. Humana up now by 5.6%. After earnings, we got Starbucks down now by 2.7%. After earnings, Visa up by 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Powell, thank you so much. We appreciate that. As Charlie was mentioning, a little bit of green on the screen here. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside John Tucker, and we're joined today by Bloomberg's Carmen Reinecke. Carmen, what are you looking at in the markets?
Yeah, so one of the first stocks I'm looking at this morning is Wingstop, ticker WING.
Chicken wings?
Chicken wings, yeah. And this, I mean, you wouldn't think it would be such a big move. The stock is up 23%. It's the best intraday jump since 2022, so best in 3 years for this stock. It reported earnings, adjusted earnings per share and revenue, beat Wall Street estimates. It also had a forecast for domestic sales growth for the full year that's up 1% more than expected. So analysts were really cheering that outlook as setting the company up for an attractive path forward. They also called out something, so the company is rapidly opening stores. The CEO mentioned that. And they're hoping...
Do they have them around here?
I don't know. Google mapping it right now. So
okay, keep going, Carmen.
So the stores should also benefit from improving operational efficiencies, including the smart kitchen that they've been rolling out. It's expected to be system-wide by the end of the year, and it's helps them make chicken wings faster.
What's like AI meets chicken wings?
It cuts down ticking time. It makes their kitchens more efficient.
Whatever.
Wasn't there a chicken shortage at some point? What happened to that whole thing?
They were sick.
There was the avian flu, so it was eggs.
All right, here we go. Wingstop, New York, 8th Avenue and 55th Street, John, after the show.
Okay.
We'll go check it out. All right, what else you got for us?
Charlie's free.
Yes.
So I'm also looking at shares of Starbucks. So this is ticker SBUX. This actually had a huge sort of fall off this morning. So it was up as much as 6.4% and then reversed. It's now down about 3%. So it also reported earnings last night. Sales and profit fell more than anticipated. And it seems like this is potentially sparking worry that the company's turnaround is going slower than expected. I think investors have really been trying to digest, the new CEO, Brian Niccol. He's been there since September. There's a lot of optimism around him, sort of versus,
This
what
is the
they're
guy
seeing.
who's like working remotely as CEO?
Yes, because he came from Chipotle, and so he's not in Seattle. So anyway, he's made a lot of changes. It seems like it hasn't 100% quite come through into the financials yet. So analysts and investors are really watching that.
Well, they are writing on your cups again. At least in mine,
good.
which I think is kind of a throwback to the early days, as opposed to just the sticker. That I get maybe my name, a little smiley face. So they're trying to get back to the kind of the.
That's all the reason to go there.
Little nice message.
Yeah. Well, I mean, here's my Starbucks thing. The drive-through is like 20 cars deep. I walk in the store, there's like 3 people in there. I get my coffee in like 30 seconds. People have just totally gone to the drive-through route. So I don't know. All right, what else do we have? One more.
All right, so the other one I'm looking at is Palo Alto Networks and CyberArk. So those are tickers PANW and CYBR. So Palo Alto Networks shares are down about 8% right now. The company agreed to buy CyberArk Software Limited in a cash and stock deal. It values the company at about $25 billion. The transaction is expected to close in the second half of Palo Alto's fiscal year 2026. It gives the company sort of a big suite of new identity security tools, and especially ones that can be used with artificial intelligence. So obviously that's a buzzword there. And I wanted to point out CyberArk shares are down a little bit today. They're down about 2%. But yesterday, after we sort of heard the first rumblings of this deal, the stock closed at a record high and was up like 13%.
And the most important aspect of this transaction is who's advising. We got JP Morgan advising the buyer. We got Frank Quattrone and Catalyst Partners advising the seller, as he always does. Frank Quattrone always get paid when there's money moving in Silicon Valley. Carmen Reinke, thank you so much. We appreciate that. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So there you go. John, tariffs are front and center again today. It looks like India is in the sights of President Trump here. We're talking about 25% plus tariffs potentially on India. Let's get the latest. Tyler Kendall joins us, Bloomberg Television Washington correspondent. Tyler, it seems like India is kind of the flavor of the day here. What do we know?
Yeah, hey, Paul. Well, President Trump announced this tariff rate, 25%, in a post on Truth Social earlier, and he said that while India is our friend, their tariff barriers have ultimately been too high, and that's why he's going to go in with this rate. He also importantly added that there would be additional penalties for India for buying Russian military equipment as well as Russian energy. The administration has been threatening to impose a so-called secondary tariff on nations that do business with Russia, particularly when it comes to Russian energy imports. We're still waiting on future details on exactly what that rate would be or when it would be implemented. President Trump did say, though, that that 25% rate is set to go into effect on August 1st. And we have to keep in mind, India was really prioritized in these talks. You'll recall Prime Minister Modi was one of the first foreign leaders to visit the White House, and India actually made some concessions pretty early on. They agreed to drop their tariffs on an array of goods. They pledged to boost U.S. imports when it comes to LNG and industrial products. But ultimately, it appears that the talks sort of broke down towards the end, with administration officials saying that they ultimately needed more time in order to get a deal done. And at this point, it seems like President Trump is just setting this rate moving forward.
Can I assume the president was not listening to Bloomberg Radio yesterday when we said that more iPhones are being produced in India than China for the first time?
Well, there's a lot of different factors here, perhaps, that the administration is looking at. One is, of course, they want to divert manufacturing into the U.S. They want to reshore production, even if that does mean that it's not going necessarily towards China, and we're seeing companies divert towards India. The administration is really focused on getting domestic manufacturing done. And ultimately, President Trump is really talking about the goods deficit when it comes to this. The USTR last year, I pulled the data for a $45 billion goods deficit with India, and that appears to have been too much for President Trump in these negotiations. And also, this rate for India, 25%, that is definitely higher than what we had been tracking and where the trend had been going. Take the Philippines and Indonesia, for example, which clinched 19% tariff rate. So 25% is considered to definitely be on the high end here. Also, when you just had some big recent announcements like the EU and Japan coming in at that 15% rate.
So it's interesting, Tyler, Josh Wingrove of Bloomberg News is out with an interesting item today, basically saying these trade deals that President Trump is announcing, there's really few details here, and it's kind of hard for the market to understand what's really going on. It's hard for our partners to figure out what really they signed up for here. What do we hear out of the administration as to, I don't know, like actual documents, actual details? What are they saying?
Right, exactly. We are still waiting on the finalized text of many of these deals, which we know takes time. The administration has repeatedly put out fact sheets that outline what the U.S.'s view is, but what's really critical is that we see those joint statements between the two trading partners outlining exactly what was agreed to and the mutual understanding is when it comes to the trade provisions. And you're exactly right. These are frameworks, and while the administration is touting that they were able to get those top-line rates, those top-line top-line numbers out on an expedited timeline. We should note they did get those done pretty quickly. It really is those details, like those sector-specific tariffs, how that's going to happen. Also, a lot of big questions here when it comes to the capital investments that are included in these announcements. Take Japan, for example. The administration had said that this was a $550 billion investment pledge, but then Japanese officials came out and clarified that only about 1 to 2% was going to be new investment, and the rest would be under some sort of loan structure. So that appeared to be a pretty big discrepancy. Same thing goes for the investment fund that was announced along with the European Union's deal. Take that, for example. As you both know, that's really not about the government investing. It's actually going to be private companies, which the EU can't have as binding.
Tyler, thank you for your reporting. We're trying to make sense out of all this news flow coming out of Washington as it relates to trade policy. We appreciate your reporting. Tyler Kendall, Bloomberg Television, Washington correspondent, getting the latest on tariffs. And again, it looks like India is in the crosshairs. So we're going to talk about it. Coming up, this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg Fed Day, and we have got stocks pushing higher. This Bloomberg Business Flash brought to you by Oracle. Attention growing businesses, Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitments, see if your company qualifies at oracle.com/Bloomberg. Right now, we have got the S&P 500 index advancing 12.6383, up now by 0.2%. The Dow up 69, up by 0.2%. NASDAQ up 67 for the NASDAQ Composite Index. That is a gain right now of just about 0.3%. Our Mag 7 Index up 0.3%. Two of the Mag 7 report today. We will be hearing from Microsoft and Meta Platforms, Facebook after the close of trading. 10-year at 4.36%, with the 2-year 3.90%. Spot gold is currently lower by 0.6%, 33.05 the ounce, and West Texas Intermediate crude 69.50 a barrel on WTI, up by about 0.4%. J.P. Morgan Chase and Coinbase have signed an agreement to directly link customers' bank accounts to their cryptocurrency wallets, as banks and financial tech companies increasingly clash over who has access to consumer data and at what cost. J.P. Morgan Chase up 0.6%, Coinbase up by 2.5%. Again, Bitcoin now at 117,990. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. John Tucker and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Head over there and search Bloomberg Live Radio, and that's where you'll find us here. Tesla in the news yet again, but this is for just a more mundane kind of business piece of news. Tesla's agreed to go into a battery supply pact with a company called LG Energy. $4.3 billion worth of batteries there. I want to see what that means for Tesla, what it means for just kind of this continuing transition to electric vehicles. We need batteries. We need charging stations, all that kind of stuff. Steve Mann joins us, Global Autos and Industrials Research Analyst for Bloomberg Intelligence. Steve, talk to us about this deal between Tesla and LG Energy. What is Tesla signing up for here?
Well, Tesla does have a pretty sizable energy storage battery business. So basically, these batteries are usually used at data centers, used at various utility power generation sites to kind of even out power production between the peaks and valleys of usage. So it's a sizable business, and more importantly, it is mundane, but it's a very profitable business. So it's 30% gross margin compared to cars that they make today. They're about low teens, so at least double the gross margin. So very profitable. And this, if the LG deal sounds really promising for that business going forward.
All right, so this has nothing to do with putting LG's batteries in Tesla's electric vehicles.
No.
Okay.
It's
I can't get excited about cars, I got to admit, but what I can get excited about is saving money. And if I have batteries that store electricity when electricity rates are lower, say in the overnight hours, yes, that excites me. How big of a business potentially is this going forward?
Yeah, you can actually consumers can actually buy those batteries and install them in their house, in their garage, and maybe link that up to a bunch of solar panels on the roof. Consumers in some cases can effectively not even have to pay. It can actually make money selling power back to the utilities.
All right, Steve, the number one issue continues to be just demand out there for Tesla products and deliveries and things like that. Anything new that you can tell us here about kind of what you're hearing out there?
Yeah, on the car front, earnings going to be pretty volatile, I think, in the next few quarters. I think, as many know, the 7,500 EV tax credit is going away at the end of September. So we should see a surge of demand, not just for Tesla, but the whole EV market here in the U.S. Between now and the end of September. And Tesla is going full out in meeting that demand. I think they've actually built a little bit of inventory even before this quarter to meet that demand. But then we can see demand fall off, in the fourth quarter and into the first half of 2026. Now the question is, can Tesla, roll out their cheaper vehicle and hopefully create some demand for that vehicle to offset the fall off in the overall fall off in demand from the elimination of the tax credit.
Is Elon back focusing on his companies?
Yes, it seems like it. I mean, he hasn't been really tweeting a lot on the politics, and I think various channels within the social media have indicated that he is focused, and I think he himself has said on social media that he is full on in managing Tesla and as well as his other businesses.
All right, Steve, thanks so much for that quick update. Appreciate it. Steve Bann, Global Autos and Industrials Research Analyst, Bloomberg Intelligence, based down there in our Princeton, New Jersey campus. It is Fed Day. The Fed decides will be Bloomberg Radio and Television's coverage starting at 1:30 p.m. Wall Street time. Tom Keene, John Farrow, Lisa Bronwitz bringing all that to you. We'll get the statement at 2 p.m. and then the press conference at 2:30. We will bring all of that. Michael McKee, Bloomberg's economics editor, he's down in D.C. He'll have full coverage there. Dennis Lockhart joins us, former Atlanta Fed president, joining us from Zoom. I'm guessing some Peachtree type street is kind of where he's located, because every street in Atlanta is Peachtree Street. I don't know what's going on down there. Dennis, I mean, will this Fed maybe give us a hint about how they're thinking about interest rates, maybe for the September meeting? I mean, what should we be looking for here, Dennis?
Well, I think an interesting reality is that the interval between this meeting and the September meeting is the longest on the calendar, and therefore there's a lot of data to come in. We get 2 of each of the inflation reports, or if you include PPI, 3 inflation reports and a couple of jobs reports as well. So with so much information to come, I sort of doubt that there'll be much signaling at this meeting. I think they prefer to wait and see how the data roll out in the coming almost 8 weeks now.
Yeah, speaking of data, 3% GDP does not sound like the environment into which you would want to cut.
Yeah, I agree. I think it's a solid report. Now, you got to get under the hood a little bit. A big part of this report is the reversal of the net exports negative number in the first quarter. So it shows up in the second quarter as more of a normalized picture from the point of view of imports and exports. But that said, I think it remains a well-performing economy. We're at close to full employment, and inflation has sort of stabilized above target, but nonetheless is not at extraordinary levels. It's a good economy, and does it need stimulus at this point? Cutting rates is stimulus.
Dennis, it's very tough to go up against President Trump when he wants to really exert pressure. I don't care if you're a country in trade negotiations, if you're a congressman or senator thinking about passing some legislation. It's tough to go up against the president and his social media platforms. How is it for Fed Chairman Jay Powell? Because, boy, is he certainly in the sights of President Trump as it relates to lowering rates. How do you think that might play out?
Yeah, it's a big question, and I certainly I can't put myself in the head of Jay Powell, but my sense is that he is resolute to serve out his term, and he will essentially stand firm on Fed independence. I think you could argue that maybe the institution is being harmed by all this pressure from the White House, but I still think when he weighs it, he will say the best thing for the Fed is for me, the chair, to serve out my term. And I think he will just stonewall and keep his focus, as he's been doing, keep his focus simply on what's best for the economy and what's the best policy for the economic circumstances.
Given that backdrop, is dissent a big deal?
I don't think so in this particular case. It's been well signaled. Both of the governors who could dissent, Waller and Bowman, have in effect signaled that in advance. I think the rest of the committee will support the decision today, which of course is very, very likely to be no cut today. So I think in this particular case, you shouldn't make too much of two dissents from two governors.
So where do you think policy should be, Dennis? Because again, it seems like economic growth seems pretty solid. Inflation, we haven't really seen it creep into the economy yet from tariffs, and we may not get it at all. How do you think the Fed is kind of viewing their dual mandate these days?
I think they're relatively satisfied. Certainly the employment numbers appear to be close to full employment, and that side of the mandate, if you can argue, is being achieved. It could be at risk if the economy begins to really deteriorate. From an inflation point of view, I think there's a small amount of dissatisfaction that very little progress has been made from an inflation rate that you could argue is between 2.5% and 3% down to the 2% target. So I think they would say there's more work to be done there. And then, of course, the backdrop of all this is what's going to be the tariff effect ultimately on prices, on the inflation rate, and on inflation expectations. I don't think that story has played out enough for the committee to be comfortable, and I think a wait-and-see posture continues to make sense, including possibly in September.
You used a very important phrase earlier, under the hood, that pertains not only to the economic reports, but I also suppose to the earnings, which on the surface looks good, but then you have to look at the commentary. In the aggregate, what's your sense?
Earnings of companies, is that what you're talking about?
Well, I mean, both, whatever, and unfortunately, I've got like 40 seconds.
Well, it's all part of a story of a resilient economy and a resilient reaction to all the developments of the last few months. It's really quite surprising. I remember when we were actually anticipating the shoe to drop on tariff effect in June. We got past June, nothing's happened. So very little has happened. So, I think, it's a good picture.
Yeah, so far, so, I mean, we'll see. And we'll see what the Fed says today. Again, full Fed coverage, Bloomberg Radio and Television simulcast today at 1:30 p.m. Wall Street time. Tom Keene, Lisa Bromwich, John Farrell will bring it all to you, and Michael McKee. He is down in D.C. He will be at the Fed. A little more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. Fed Day, and we have got stocks moving higher right now with the S&P 500 index just about the best level of the session, up 14 right now, 63.85. That is a gain of 0.2%. Traders gearing up for the Fed decision, 2 o'clock Wall Street time, driving bonds lower. Stocks holding near records as data shows the U.S. economy is holding up. Dollar up for a 5th straight day. The Dow right now up 73, up 0.2%. S&P also up 0.2%, while NASDAQ, the composite index, up 79, up 0.4%. NASDAQ 100 index up 0.3, and our Mag 7 index up by 0.3%. Two of the Mag 7, Microsoft and Meta, do report after the close of trading today. Microsoft right now up by 0.3%. We've got Meta Platforms also up by about 0.3%. The 10-year 4.36%, with the 2-year 3.90%. Gold down $22 the ounce, holding just above $3,300, down 0.6%, while West Texas Intermediate crude up 0.4%, 69.53 a barrel. Our special Fed coverage kicks off at 1:30 p.m. Wall Street time. The decision drops at 2 o'clock, as you well know. Jay Powell's news conference coming up 2:30 p.m. Wall Street time. As for what to expect, Dennis Lockhart is the former president of the Atlanta Fed. He was a guest moments ago right here on Bloomberg Intelligence.
I think it remains a well-performing economy. We're at close to full employment, and inflation has sort of stabilized above target, but nonetheless is not at extraordinary levels. It's a good economy, and does it need stimulus at this point? Cutting rates is stimulus.
Former Atlanta Fed President Dennis Lockhart, now CEO of Navigation Capital. Palo Alto Networks buying CyberArk software in a cash and stock deal, valuing the Israeli cybersecurity company at about $25 billion. Cyber down 0.9%. Palo Alto Networks down now by 6.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate that. John Tucker, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. John, you know, with all this inflation over the last several years, I found myself at the supermarket buying more store-branded products.
The white label stuff, right?
But yeah. I'll tell you what I haven't, is ketchup. I'm sticking with Heinz no matter what. I mean, that is ketchup to me. Ketchup, however you play it.
How does Jen say it?
I don't know. Jen Bartashis, she does this stuff for a living. She covers all the staples companies and packaged foods companies. She also covers all the supermarkets, too. So if you want to talk inflation on the stuff we buy at the store, Jen Bartashis is the person to talk to. She joins us from Princeton here. So, Jen, Kraft Heinz, they put out some numbers that show they still have some pricing power out there in the marketplace, don't they?
They do, Paul. And it was by all things considered, it was a pretty decent quarter for Kraft Heinz. But they're still in progress of trying to really turn around and accelerate parts of their business. And although ketchup is a brand where a lot of people have a lot of loyalty, there are a lot of other parts of their portfolio where they're still really trying to invest to regain consumer uptake of their products.
What's like a growth area for this business, like AI-powered mustard or...
Yeah, as funny as it sounds, one of the really interesting things about AI with regards to food companies is that it's really allowing an unlocking and an acceleration of innovation. And so, although it's a little bit tongue-in-cheek, for Kraft Heinz, one of the big areas of focus for them is the flavors, and that's the sauces, because right now consumers like things, they like different taste experiences, and sauce is a very easy and economical way to do that. So they've been really pushing the accelerator in that area.
All right, you go to any restaurant, diner, USA, it's kind of at your booth would be ketchup, mustard, maybe that's basically it. Now, what's there? What's a staple? As much as ketchup is hot sauces.
Oh,
the
really?
Kids,
Yeah, okay.
The kids are doing hot sauces. I don't get it. I mean, they put it on everything, and they got it at their desks at work. What is this? Jen, talk to us about this hot sauce thing. Where did that come from?
Well, you know, there's a real generational shift in terms of flavor profiles that consumers like. And what we see is that in younger generations, Spicy, the balancing of sweet and spicy, or salty and sweet, those kind of those kind of dual type taste flavors are things that younger generation really are into. And they're backing that up with the way they're buying, whether it's how they're consuming it in restaurants or what they're buying when they are purchasing and things to make at home. And that's why you see other companies like McCormick really doubling down on spice and flavor. And the hot sauces are doing really well for them as well.
And in terms of moderating rate of inflation, well, I haven't seen it at the Food Town. I'm paying more for everything, including, seems, Heinz products. Am I right?
You are right with regards to certain categories. I will say retailers are pretty good about trying to bring down prices where they can as quickly as they can, because they really are trying to get consumers to value them in terms of being a loyal, to be loyal to their retail operations. But inflation has been persistent, and commodity costs are down from previous highs, but they're still elevated relative to historic levels. That means that these companies, have absorbed a lot and don't have a lot of room to absorb more. So there is still some selective price increases that are going through. Tomatoes are a unique category because we're looking at prices going up for tomatoes through the end of the year because of some trade agreement changes that have happened.
Oh, well, if you're in New Jersey, you got to grow your own.
We got to Jersey tomatoes, sure. Hey, Jen, I mean, you are the expert. When someone asks me, like, hey, who bears the brunt of these tariffs? Is it the importer? Is it the packaged goods company? Is it the supermarket? You cover pretty much all of that, Jen. How do you explain it to people? Like, where those cost increases get born?
So I think there's a little bit of a distribution across the whole supply chain. And so everybody's taking a little bite of it. But that also includes consumers at the end of that chain. The problem with that, and so, if a retailer is negotiating, they're negotiating with their packaged food counterparts, they're absorbing a little bit of cost, but ultimately the consumer has to pay a little bit more as well, because there's been so much inflation over the last couple of years that there's just no more bandwidth to absorb it and to protect and shield consumers from it. So it is inevitable that price increases and inflation is going to hit that end consumer. We just haven't really seen the full brunt of the tariff impact yet because of all of the delays and the implementation and things like that. We're really expecting to see that tick up in the second half.
For a company like Kraft Heinz, is there some sort of dividing line, or are they just kind of experimenting in terms of like eating the costs, the impact on the margins, and raising prices for consumers? How does that work?
They're really looking at it in a very targeted way. So it's more like category by category, or even sometimes product by product. Areas where you want to make sure that you have at least part of your product portfolio that preserves value for consumers. So that means not changing the pack size, that means not changing the price, but being selective and maybe increasing the price somewhere else in your portfolio to sort of offset that. So it's a big balancing act. One of the really great things that's come out in the last couple of years is that through AI and through big data, these companies have gotten much more sophisticated in how to maintain that balance. And so that's actually really helped in why we've seen some of the margin expansion that we've seen, at least the gross margin line, for some of these companies in the last couple of years.
Jen, 30 seconds left here. Are they going to split this company up? Weren't we talking to you about this a week or two ago?
Yeah, they're exploring strategic options. I think one of the big obstacles is that what was rumored out there in the press was that they were going to spin the bulk of their grocery business into some other entity. The problem is they've tried to sell a bunch of these brands already and have been unsuccessful in doing so. So the question is, can they do this in a way that bundles it, creates value for shareholders, and still gives them the returns that they think they deserve for the brands that they're looking to sell?
All right. I looked at the comp function, COMP, for Kraft Heinz last 5 years. Compounded annual return for this stock. Wait for it. 1% per year. That's it. Wow. But on the flip side, they do pay a dividend yield of 5.5%. So you're getting all in about 6.5%. That's basically it for that part of the world. I don't know. And you pay a PE of 10 times earnings. That's kind of the story for a lot of that stuff in the consumer staple space. Jen Bartashis, one of the best out there on Wall Street. We've got her. She's a senior retail analyst for Bloomberg Intelligence. She's based down there in Princeton, talking about some Kraft Heinz. So we'll get the latest on those earnings. Coming up, Joel Levington, Bloomberg Intelligence Global Director of Credit Research. HOG, the bonds. Harley-Davidson.
Listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, John Tucker, Paul Sweeney, live here in our Bloomberg Interactive Broker studio, streaming live on YouTube. So let's talk Harley-Davidson. Now, John, you know, I bought a ride recently.
You did not buy a Harley. Let's just make that clear.
I bought a Vespa Piaggio scooter, 50 cc's of raw power.
Oh, 50 cc's.
So when you're driving down the road and the guy on a Harley Davidson comes the other way, I wave. They don't wave back. I don't get the cool sign like you're a biker. But
you're not the same.
Anyway, Joe Levington, he follows all the credit stuff for a lot of these industrial and transportation companies. He's a director of credit research for Bloomberg Intelligence. Harley-Davidson stock is up 20% here. What happened?
Paul, you're on the Vespa. I would think you'd be coming. Are you coming out of your Bentley while you do that? Or?
Yeah, I'm Vespa on the Jersey Shore. You can find me any day.
That I believe. Yeah, the key for a Harley isn't really their earnings, which were really not great. But the potential, or not the potential, but a stake sale of their captive finance company, which came in at a much higher price than people were expecting. That's going to be used, or the proceeds are $1.25 billion, with the proceeds used for a mix of share purchases, paying down debt, and also for capital investment.
Okay, so when I go in to buy a Harley-Davidson motorcycle at the dealership, I finance it through this part of Harley.
That's exactly
That's
right.
what they sold,
yes.
Or that's part of what they're selling. Who's buying it and why?
Sure. KKR and PIMCO are the buyers, each taking a 4.9% stake. And really, they're buying it because that business has been a very profitable business for many, many years. It actually should be more than 50% of Harley's overall profits. They actually make more money from the financing side than they do from manufacturing vehicles right now, which goes to the the trouble that they're having on the manufacturing side.
Or let's talk about the manufacturing side. What's the motorcycle market like these days?
The motorcycle business isn't bad. I think the challenge with Harley is that it's kind of one of those melting ice cubes that sometimes you see in the media world that you would know well of. If you go back 10 years ago, the manufacturing side, its sales are down 13% over 10 years. But the real issue is that the margins have gone from 20%, so they're making 20 cents on the dollar, 10 years ago. Now they make about 5 cents.
Wow.
And so it's really the profitability and the erosion and not really playing to their strengths.
Is that because they can't raise prices or their costs have gone up?
Well, I think it's really, they've kind of lost their way a little bit. They were talking today about their $6,000 motorcycle that they're excited about. And I know, like, it's the premium brand. It's that iconic image of a Harley. It's that V8 engine playing to the electrician or the plumber, the mechanic that has an $80,000 to $100,000 income and owns a Mustang. Like, that's who they should be playing to in that 40 to 60-year-old age range. Like, that's their customer. But they've tried to move out into different segments of the marketplace and have really gotten hurt and eroded their image.
But I can't think of a more American-made product anywhere than Harley-Davidson. So are they immune from tariffs? Does that give them an advantage versus some of these Japanese brands?
They're not immune from them, but they do have 25% of their business in Europe and another 25% in Asia.
Oh, okay.
But really, like, the U.S. is where they're big and where they dominate. They just haven't done a great job of marketing to that person and putting engineering into that customer.
Should I be more excited about Harley-Davidson stock, hog, or Harley-Davidson bonds?
Well, I just look at the bonds, and I'm not that excited about the bonds. But what I will say for them is that they're going to remain investment grade after the sale, and they trade very wide to their ratings. And so, like, that is always an interesting combination that people look at.
What does that yield, or what?
Well, they have a variety of issues.
Well, yeah.
But I would say that in general, they trade about 20 to 30 basis points wide of where their ratings are. So what a credit rater thinks. And usually bonds trade to what the raters think.
How about, you also cover the auto sector. How's the credit of the auto industry out there? Because this whole tariff situation, the uncertainty associated with transition to EVs, like, I just say to myself, every time I look at some of the stocks, I can't find a scenario to own any of the stocks. How about the bonds?
Yeah, well, it's interesting because the bonds are a different world, right? All of the issues that you see in autos apply to pretty much everybody except Ferrari, right? Whether it's tariffs or the EV transition being slower or maybe not actually happening in the U.S., all of these challenges still exist. But the difference between an equity investor and a bond investor is that your typical bond is 3 years of maturity, right? Because it's largely tied to the captive finance company, right? The financing of the loans and leases behind an auto. And so it's a much shorter term way of thinking. Can I get my money back in 3 years supported by a vehicle which will have a residual value to it? It's a little different than saying, like, hey, 10, 15 years out, what's my discounted cash flow? So it's a very investable side from the credit side, maybe not as much on the equity side.
Will they tell us more about the future? Can it serve as kind of a canary in the coal mine for a company looking at that end of it?
At the captive side?
Yeah.
Yeah, well, it's very short-term sighted, right? So you have to, for all of the treasurers and CFOs that are out there and CEOs, they're thinking long-term and where can I take my company? How can I grow it into something bigger and more meaningful? A bondholder just wants to get paid back.
That's right. See, this is what I learned. Different outlook. Equity is soft. Debt is hard. You can always tell me to go, go.
Is that why we call it the smart money?
It is. It's smart money. They actually, and they're tend to be pessimists in general. Whereas the equity people were always glass half full. This is what could go right. For these guys, the whole world is what could go wrong. So anyway, Joel Levington, one of the best, Global Director of Research, Bloomberg Intelligence, covering all that autos, industrials, transportation, all that kind of stuff from the credit perspective. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, John Tucker, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. We are right smack in the middle of earnings, so we're going to have a lot of earnings coming up in the next hour. Michael Halen, Bloomberg Intelligence, Senior Restaurant and Food Service Analyst. We'll talk to him about Starbucks. They had some numbers out. I might even ask him about Wingstop, because now I'm all into the Wingstop, and we've got a bunch of Wingstops in Manhattan.
I had never heard of it.
I know. I just did the map thing. They're all around Manhattan, so I'm going to check that out. So that'll be good. Brian Whalen, CIO and Generalist PM at TCW. He's a fixed income dude. He's usually, we get him from his office in LA, but I think he's in New York. I think he's going to be in studio. So he comes here when there's a heat wave. Nice move there. Craig Trudell, Bloomberg Global Autos editor. We're talking autos here. Mercedes, Porsche, they cut their forecast as U.S. tariffs really hammer on their profit margins. So we'll get the latest there. And then it is Fed Day. So the highlight of the day for me, Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. She will be in our studio. You want to listen to this because she is wired in to the Fed. She used to be at the Dallas Fed, so she has some good insight there. So a lot coming up this hour. Let's kick it off. Charlie Pellet.
Hi, thank you very much. Just looking at Wingstop shares that fall right now, surging by 25.2%. Starbucks, another stock we'll be talking about, trading lower now by 1.5%. The Dow, the S&P, NASDAQ solidly in the green. Fed Wednesday here, decision 2 o'clock Wall Street time. Our coverage kicks off 1:30 here on Bloomberg. S&P up 10 right now. That is a gain of 0.2%. We've got the Dow up 13 now, little changed, up under 0.1%, while the NASDAQ Composite Index up 78. That is a gain of just about 0.4%. 10-year 4.36%, the 2-year 3.89%, the 30-year ahead of the Fed meeting 4.90%. Gold down $23 the ounce, just above 3,300, even now 3,302, down 0.7%. West Texas Intermediate crude up 0.8%, 69.78 a barrel, and Bitcoin up 1% at 118,615 on Bitcoin. 2 of the Mag 7 names, Microsoft and Meta Platforms, report today after the close of trading. Shweta Kujaria is Senior Research Analyst at Wolfe Research. She told us for Meta, her focus is going to be on CapEx.
We actually do expect Meta to even potentially raise their CapEx guide one more time to even above $72 billion for this year. And more importantly, investors will be looking for how they talk about elevated CapEx spend over the next few years.
Shweta Kujaria of Wolfe Research, Meta up 0.2%, Microsoft up by 0.1%, and of course Apple and Amazon both report tomorrow. Deal news, Palo Alto Networks buying CyberArk software in a cash and stock deal, valuing the Israeli cybersecurity company at about $25 billion. Palo Alto Networks down 5.5%, Cyber trading higher by 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hi, Charlie Pellet. Thank you so much. We appreciate it. John Tucker, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. As Charlie was just mentioning, kind of got a mixed day out there in the marketplace. Lots of eco data, lots of earnings news. We got, again, the big tech names, as Charlie was mentioning after the close, so we'll pay close attention to that. Carol Massar, Tim Stanovic on Bloomberg Business Week. They'll have all that breaking news for you at the close. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside John Tucker. We're joined by Bloomberg's Isabel Lee. Isabel, what do you got?
We're starting with Mara Holdings, ticker is MARA. So the stock is rising more than 3%, and that's after the Bitcoin miner reported second quarter adjusted EBITDA that beat estimates, and that's amid really the big gain in crypto. It's now around Bitcoin rather. It's now around $118,000. You have Barclays saying that the company's improved energized hash rate is encouraging and its growing Bitcoin holdings is also impressive. Piper Sandler notes that the company posted record quarterly revenue, and its large Bitcoin holdings is the reason for this because the stock obviously closely tracks the price of Bitcoin. Cantor Fitzgerald also says that the second quarter results was strong, and they see the third quarter results to be improving as Bitcoin rises higher.
It's a holding company that owns primarily Bitcoin?
It's a Bitcoin miner, so
It's a miner, okay,
it still closely tracks Bitcoin. And
Okay.
hash rate, to the uninitiated, is basically just a measure of computational power in the blockchain network.
You got that, John?
You got that, John?
Yeah, I guess. Something tells me this is closely aligned with like the cost of energy and power.
Yes, very good. Yes, and over at JP Morgan, they increased their price target to $22. So lots of good news for Mara Holdings.
Can't wait to see that research with how they value this company. All right, what else you got for us?
Peloton,
Yes.
ticker is PTON.
I understand this story.
Yes. Remember the pandemic days? Yeah, the stock is surging now almost 14% after UBS upgraded the stock to buy. They cite upside to full year 2026 EBITDA expectation, and they're saying it's supported by top line growth and further cost cuts. So they've raised their price target to $11 from $7.50. That's an 80% increase from the last close. And Peloton has 9 buys, 11 holds, and 1 sell rating. They report on August 7.
My significant other, she's got the bike, the treadmill. Now, we are in a relatively small townhouse on the Jersey Shore. These things are huge, and they're everywhere. But she's on them every single day. These people are fanatical. So my question to the company is, you got to generate more revenue out of these fanatical subscribers.
What's the growth area for this, though?
It used to be bikes, sell more bikes, and raise prices. And they still kind of raise prices, but they're not selling more bikes.
But you have to have subscriptions to the thing where the guy yells at you?
Yes. You pay
But
extra.
you're right, they are loyalists. It's like if you love Peloton, you just tend to stick with it because you have a special instructor that you like. Yes,
All right,
definitely.
one more for us.
Humana, ticker is HUM. The stock is up around 5%, and that's after the health insurer boosted its adjusted profit and revenue forecast for the full year. So the new outlook is topping the average analyst estimate. So the management said that medical costs were in line with expectations, which hasn't been the case with rivals recently, and that it really benefited from the growth in its Medicare Advantage and pharmacy business. So the company also raised full year adjusted earnings guidance. And it's really actually a contrast from all of the health insurers that we've been hearing so far who've really noticed problems in Medicare Advantages. And all that. So really a bright star here.
All right, very good. Isabel Lee, cross-asset reporter, Bloomberg News, joining us there. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Let's get back to the restaurant business. I know the restaurant business. I mean, I'm not sure about this whole
because you go to
thing,
restaurants.
but I'm in the restaurant almost every single day here, so I know what's going on out there. Michael Halen, he really knows what's going on with the restaurant business. He covers all the restaurants and the food services companies for Bloomberg Intelligence. Starbucks, big turnaround story. Mike, is it working?
You know, there was some positive points that Brian Nickel hit on last night. You know, the fact that their value perception scores are the best they've been in 2 years, and hourly turnover is down to 49%, which is actually phenomenal in the restaurant industry. Service times are improving, customer satisfaction's up, customer complaints are down. So with a small beat on the U.S. same-store sales, you know, and some of these positives he's pointing to, it's given bulls, you know, some confidence that a turnaround in its biggest market is near.
What counts as innovation when you're basically selling coffee?
Well, yeah, restaurants tend to get some shade by calling, you know, new menu items innovation. I'd say one of the more innovative products they're going to have is protein cold foam. Cold foam sales were up 23% in the quarter, so they're going to launch new protein cold foam, and that's part of a broader initiative to sell healthier items.
Protein what?
Cold foam.
Cold foam.
Hey, do they have matcha? Isn't that what the kids are drinking?
Is it AI generated?
Is it AI?
So they do have matcha. I know they're going to try to implement some, debut some healthier food items as well, because typically their offerings are pretty unhealthy generally. You know, they made an effort to remove dyes and high fructose corn syrup and stuff like that, and so they're going to continue to move towards, you know, healthier options.
Hey, Mike, let me ask one question here on tariffs. How do your companies? How are they exposed and how are they dealing with it? What are you hearing from your companies?
You know, we're not hearing much because most of them don't have much exposure. Okay. You know, Starbucks is one we're watching most closely because of coffee. right, and the impacts that tariffs can have on coffee prices. But Starbucks and all the other coffee chains that we follow are sourcing from many different countries. But the restaurant business, most of the companies, all of the companies, are primarily sourcing their product in the countries that they're operating in, right? And so most companies, 90% plus of the items that they're sourcing are coming domestically.
All right, let's go wings, baby. Wingstop. Stock's up 24%. John Tucker and I have never been to Wingstop. We're going to the one on West 55th Street after the show here. What's going on at Wingstop?
Yeah, so Wingstop had a phenomenal year last year, and the stock is, had a bumpy time over the last, we'll call it 8, 9, 10 months, because investors knew that there was going to be a top and bottom line slowing this year. What happened today, the top line slowing was a lot less than expected. Net unit growth was better than expected. I mean, these stores are generating 70% cash-on-cash returns for their franchisees. People are lining up to open new stores. And the same-store sales decline was a lot less than expected, just about 1%, lapping a plus 24 from last year. So less bad. Less bad equals, a lot of optimism around Wingstop, especially around the smart kitchen rollout. They cited, smart kitchen rollout.
There we go, that AI theme again.
There we go. Yeah, and so those kitchens are improving the service time significantly, making the jobs easier for the employees, and it's actually driving better traffic and sales 4 months after implementation.
All right, the West 55th Street, Manhattan store. Better get ready. John Tucker and I are coming over. Michael Hanlon, thanks so much for joining us. Michael Hanlon covers all the restaurants for Bloomberg Intelligence. Our next guest, I always thought was a pretty smart dude. I mean, he went to Yale. He was at DLJ, and if you don't know what Donaldson, Lufkin, and Jen Red is,
but he comes to New York City during a heat wave, so we're calling that into question.
All the way from L.A. Brian Whalen joins us. He's the Chief Investment Officer and Generalist Portfolio Manager at TCW, based in L.A., but here in our Bloomberg Interactive Broker studio. Brian, what do you expect to hear from your Federal Reserve today, this afternoon?
Ooh, by the way, first of all, I came to the heat, but I avoided the tsunami.
Oh,
so not as dumb as you think, right?
Yeah,
there we go.
Good move.
I think it's going to be interesting. More likely than not, they're not going to move. That's expectations. I think the Fed did a pretty good job of messaging that the last few weeks. Although there's a couple dissenters, Bowman and Waller. They've come out pretty aggressively and said they think it is time to cut. However, most likely get nothing. I think it'll be interesting to hear about the messaging, though. I think, we got some information, some data in the last couple of days that I think confirms what Bowman and Waller have been saying, which is that, the economy is slowing down, the labor market is stalled. Yes, there are some areas of the economy where you're seeing an increase in prices, but it's not driving or pushing inflation up broadly across the economy, nor inflation expectations.
But I put this question to Dennis Lockhart earlier. 3% GDP, I don't know that that's the environment in which you want to cut.
Here's what I would say. That the first and the second quarter were so distorted by trade, by gold. So I'd say this. The first quarter wasn't nearly as bad as that headline number would lead you to believe, and the second quarter wasn't nearly as good. I think what we like to look at, and a lot of people in the market, I think, like to look at is like final sales to domestic purchasers, and that's running kind of a low 1%. So I think, our best guess on the economy right now, it's running in a low 1%, but it's also trending down from first quarter to second quarter. So when you talk about Bowman and Waller and getting worried, and I'd point this out, I think they're remembering a year ago, like last June, the Fed came out to the world and they'd said, we're going to cut rates by 25 basis points by the end of the year. And then they got just a couple months of data, spooked them, and then they ended up cutting 100 basis points by the end of the year. And I think at this point, Waller and Bowman thinking the same thing, and that we're at this point now where a lot of the vol and the decline in confidence in the first part of the year due to tariffs and a lot of other things, it seems to be trickling into the hard data, and they don't want to get caught behind, particularly because at this point in time, we really haven't seen anything that would confirm what a lot of the people have been spooked by inflation concerns, were the reason they're holding off on cutting.
Credit. I mean, I look at my IN Go function. If I were in the high yield, U.S. high yield, I'm making north of 5%. I can't remember the last time.
Yeah, it's the debate. Do you want to look at yields or do you want to look at spread?
Okay.
I think like if you're a retail investor and you're thinking long term.
There's that spread term again, John. Joel
bond nerds. We like to bust that out. we take the show off with the spread. So I'll say it this way. if you're buying on yield and you get a good diversified portfolio, and maybe you've got a good bond manager to do it for you, you're probably going to be okay in the long term. But if like asset managers, we're mark to market every day, every week, every month, every year. We are evaluated on how we're doing, and if spreads widen, it doesn't matter if you bought it at good yields. If spreads widen, you're going to underperform for a period of time. So right now, investment grade credit, high yield credit, like you mentioned, Paul, is extremely tight. Basically, you look back in history, it's pretty hard to find a period of time where you've gotten paid less in terms of extra yield versus treasuries to be invested in this space.
Okay, pretend that I'm your golden retriever and talk to me about convexity and how I should be concerned about that
redo.
In the bond. Well, it's important because we're seeing negative convexity, right?
Yeah. Well, first, great question. The way I would describe it to my golden retriever is that basically negative convexity, it always works against you. And when rates rise, you don't want to be long duration, but when you have a negatively convex instrument, it feeds you, the dog, more duration as rates go higher. So you get hurt even more than you thought when you started at kind of the baseline interest rates. And then if rates go lower, so if we go from to a 3% interest rate environment, what do you want? You want duration. It means your prices are going to go up. But at that same moment, your negatively convex instrument loses duration. And so you get hit on both ends. And the only reason you buy a negatively convex asset is because it's giving you a nice yield at this point in time. And that's actually exactly the story that's going on in the agency mortgage market.
You always have to consider what inflation is going to be so many years out or whatever. So.
Always. If you're in a range-bound environment, you want negative convexity because you're going to get paid for it. If you think rates are going to go up substantially or down substantially, you want positive convexity.
Oh, can I ask? I'm hogging this conversation.
You're all in, John. I know.
No, but
I'm an equity guy.
How's Los Angeles doing?
Yes.
Thanks for asking. We're hanging in there. I actually I'm a 18-year resident of the Palisades.
Okay.
So we've had a tough go the last 6 months. It's been hard, but people are moving back. My kids got back in the house a few weeks ago. We were one of the lucky ones. And so I would say what I say to my friends is we went through a tragedy. It's hard. The community's rallied around us, but the best thing is everybody's alive. To work hard and rebuild, and that's what we're going to do.
And that's what I mean. It's a tough part of something's always going on in California with the, with fires or floods and all this kind of stuff. But you just go back, right? I mean, you guys everybody's just going to go back, aren't they?
Yeah. Well, first of all, I'm an upstate New York kid. That's where I'm from. I worked in New York for 7 years, so. They can't take that out of my blood. But Los Angeles, Southern California is beautiful. Obviously, I think your son's down there, right, in that area, right? So it's hard to beat. And after 20 plus years in Los Angeles, it's home.
Yep, absolutely. All right, Brian, great stuff. Really appreciate coming into our studio. Brian Whalen, Chief Investment Officer and General Portfolio Manager at TCW. S&P 500 is up 4 points. How about that? This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We've got the Dow lower, the S&P, NASDAQ both higher, and this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. London Heathrow Airport facing flight disruptions right now. A technical glitch has cut flights out of the airport. You'll recall this comes months after that power outage that shut down operations for hours, indeed almost a day. But right now, developing story, London Heathrow facing flight disruptions. Stay with Bloomberg and we'll keep you updated on what's happening. Countdown to the Fed, 2 o'clock Wall Street time. We've got the Dow lower now by 49 points, drop there of 0.1%. S&P up 4, up 0.1%. NASDAQ up 55, gain there of 0.3. Ahead of the 2 p.m. decision, 10-year 4.36%, with a 2-year 3.89%. Gold now down 1.1%, 32.91 the ounce, and West Texas Intermediate crude right now up 0.7%, 69.66 a barrel. So again, we've got Jay Powell's news conference coming up 2:30 p.m. Wall Street time. Brian Whalen is generalist portfolio manager at TCW's fixed income group. He was a guest moments ago right here on Bloomberg Intelligence.
More likely than not, they're not going to move. That's expectations. I think the Fed did a pretty good job of messaging that the last few weeks. Although there's a couple dissenters, Bowman and Waller, they've come out pretty aggressively and said they think it is time to cut.
And our Fed coverage will continue in just a moment right here on Bloomberg Intelligence. Again, the 10-year 4.36%. Briefly, the shoe retailer Stephen Madden says tariffs are making it too hard to gauge how its business will perform, so it's not providing an outlook for the rest of the year. Steve Madden shares down now by roughly 6.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is the Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. John Tucker and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I'll tell you one area where the tariffs are definitely being felt, and that's in the European automakers. Mercedes-Benz and Porsche, they're scaling back their profit expectations for the year due to the toll of President Trump's trade war and tariffs. Let's bring in Craig Trudell, Global Autos Editor for Bloomberg News. He's over there in our Queen Victoria Street studio in London. Craig, what's going on with the European automakers? What are we hearing from Mercedes-Benz and Porsche?
Yeah, Mercedes and Porsche numbers both this morning are pretty bleak. I think with Porsche, we saw sort of some relief in the stock, but it's one that's been really battered honestly since it went public. But what we're hearing from these companies is in Mercedes' case, they are somewhat spared having a big SUV factory down in Alabama, and yet this is a company that just a couple of years ago was doing record margins and is now really the return on sales for them is just totally out of step with what you would expect from a luxury car maker, and I think that's consistent with Porsche as well, where They, on the other hand, are really in a world of hurt with the state of trade with the U.S. because they don't have any production in America, and it's really a difficult proposition for them to start production. They don't have anything in their lineup that shares an architecture with what the Volkswagen Group produces in Tennessee, for example. And so, everything that is coming into the U.S. market is going to be subject to the tariffs. Even if 15% is better than 27.5%, it's still a lot more than what they were accustomed to paying.
Crushed on margins or sales or both? Or how does that work?
Yeah, I think with Porsche we may see some price increases, and I think this is for me the sort of $64,000 question with all the manufacturers is we've seen a real sort of reluctance to raise prices to account for tariffs. And I should I hasten to note that Stellantis this week goes to show that even if you have a lot of production in the U.S., if you're importing a lot of parts from outside the U.S., even that is going to cost you more. But I think the $64,000 question for this industry is, sort of who blinks first in terms of jacking up prices to try and offset some of these tariffs. You've seen, for the most part, these companies eating this, for now, because I think everyone's reluctant to sort of give up the volume that you would have to give up if and when you ask the consumer for more.
I mean, I would have thought, like, if you were a Porsche customer, that, if you have the means, then, you're going to pay more. You don't mind. Well, maybe you do mind, but you certainly have the wherewithal to pay more.
I don't know. I'll ask Matt Miller that. Hey, real quick, Craig, what are the companies saying about China and their auto manufacturers? Because it seems to me, outside of the U.S., China EVs are going to take over the world. What are they talking to you about China these days?
Yeah, I mean, I think that's another sort of factor that's very consistent across Mercedes and Porsche is that, both of these companies came to really rely on the rise of the Chinese market to be a sort of earnings driver, both from a volume perspective and profitability. And that has swung, very decidedly in the other direction. As you say, EVs have been on the rise in that market. There's been more regulation and stricter regulation around emissions, as we've seen in other parts of the world. And, the fact that domestic manufacturers have become so competitive, including, in the sort of, higher echelon segments, BYD now makes six-figure sports cars or big SUVs that are sort of, G-Wagon-like. And Mercedes and Porsche are having a really hard time in the China market.
Yeah, tough. All right, interesting, Craig. Thanks for a couple of minutes of your time there. Craig Trudell, he's a global autos editor for Bloomberg News, joining us from London. It is Fed Day, so our first request for guests always goes out to Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Why? Because, well, she used to work at the Fed. She knows what's going on there, and she worked at the Fed down in Dallas. But she's always got data that I never even think of looking at, and I probably should. And today does not disappoint. Danielle, welcome here to our studio. What data are you looking at today as it relates to rents?
Well, it hit the terminal just a few hours ago, the Cleveland Fed new tenant rent index. It's right on the terminal. It's a quarterly figure, doesn't come out very often, obviously. But at the December the 18th FOMC meeting, Chair Powell noted that particular metric, and he suggested that market-based core PCE, if you took the imputation, the sole imputation, that's not a market-based inflation number, if you remove the sole imputation of owner's equivalent rent and then substitute in market rents, which were created by this Cleveland Fed new tenant rent index, that you actually get the true gauge of shelter inflation.
I've got it, and it's falling like a rock. So if the Fed today, how do you think they would look at a piece of data like that? And again, folks, the data from the Cleveland Fed shows that rents are actually declining rapidly, so suggesting that that's not a driver.
Yeah, that's a negative 9.8% you're looking at for the 1 quarter.
Not in New York City, though. But.
Not in New York, no. But again, this is a nationwide gauge, but what's changed is, since December, is now on a year-over-year basis, we're at negative 0.3. That is not just the rent index. That is market-based core PCE in its entirety, with the new tenant rent index substituted in for owner's equivalent rent, which again, we wouldn't know to have done it had Powell not suggested it at the podium. That's the whole reason that we started tracking this particular metric. How would you like to be a Cleveland Fed staffer having to show everybody around that great big oval table at the Eccles building that we're in deflation?
Interesting.
So if you take a number like 3% GDP, you're going to tell me, look under the hood, dummy.
I'm not going to use the word dummy. That's just flat out rude. I was raised better.
From Texas.
I am from Texas. No, but I will tell you that in the fourth quarter, I'm reading here, let's see, non-residential fixed investment. Okay, so this is like not construction, this is just businesses. That was negative 3% in the fourth quarter GDP report. And then we had the tariff terror and all this stock building and front running. So that number popped up to 10.3% in the first quarter GDP report. And this morning when it came out, it went kaboom, 1.9%. From 10.3 to 1.9. And on top of that, we did see a pickup in consumption, but it went from 0.5 to 1.4%, which was shy of the consensus estimate of 1.5%. 1.5%. So it came in at 1.4%. What we're seeing right now is a seesaw yo-yo exercise in GDP math between inventory and import-export math that's throwing the numbers all about. It's not great news that imports crashed. That is not good news. That's a sign of what we're talking about, personal consumption expenditures, missing expectations, coming in at 1.4% growth. It is not business investment or consumption that's driving GDP.
So for you, the Fed, if you had Fed Chairman Jay Powell right here, you would say cut today, right?
Well, I would, yes. And I'm not the PhD, but 786 others inside the institution might be making that suggestion to him, just as many did last July. And last July, he said, no, I'm worried about inflation. I still feel like the labor market is solid. So we're going to hold. And then what did he have to do? He had to come in with a cavalry in September with a 50 basis point rate cut that followed it. So it feels a lot like the summer of 2024 right now.
What would get us to the point where it's neither stimulative nor, weighs on the economy? The neutral, I don't know what the neutral rate is,
well,
but we'd have to go well beyond that, is what you're saying.
Apparently we do, if the economy has actually hit deflation.
Yeah.
And that's highly problematic. We've seen jobs are hard to get in the consumer confidence data. We've seen that rise for 7 months in a row, lowest since March of 2021. You don't see that number rise consecutively. Job insecurity rise consecutively for 7 consecutive quarters outside of any U.S. recession. It just doesn't happen. It'll bounce around, but you don't get 7 months in a row of rising joblessness, rising job insecurity.
Danielle, you live in Dallas. You worked at the Dallas Fed.
I do. I live in a bubble. I live in an economic bubble.
Talk to us about that Dallas-Fort Worth Metroplex. Is there anything to stop what I think is reasonable and healthy growth of that Metroplex?
Well, right now it's housing.
Okay.
So we had, we've been getting some really interesting stories out about smaller home investors still buying all cash. And of course, they're levered. Just how they're levered, we don't know. But we have been getting more and more stories about the biggest investors starting to liquidate the portfolios that they purchased. For heaven's sake, Tarrant County, Fort Worth, that was in 2021, 54% of all home purchases were by investors. Dallas County, it was 51% of all home purchases.
Is that like
again
the Black
in 2021?
Rocks of the world?
Yes.
Okay.
Yes.
I mean,
that
but
is.
now when I think
and
about,
now they're reversing it, so it is
Okay.
residential investment that is really feeling it in the DFW area.
Okay. I mean, how many companies come in here, John, and they're like, oh, we're moving this to Dallas.
Oh, no.
Unbelievable.
And that's with corporate relocations. Continuing. The
amazing.
exodus out of California and Illinois continues.
Yep. It's awesome. Great story. Danielle, thank you so much for coming in. I know you're busy today on Fed Day. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, giving us some thoughts here on this Fed Day here. Again, the coverage for Bloomberg, 1:30 p.m. Wall Street time. Tom Keene, Lisa Abramowitz, John Farrell, simulcast, Bloomberg Radio and Television. We'll take you through the 2 p.m. statement, the 2:30 conference. Michael McKee, he's down in Washington, D.C. to pepper that chair. This is Bloomberg Morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, down 32 points right now, 44,600 on the Dow, representing a drop of just under 0.1%. 2 o'clock Wall Street time, the Fed decision. The S&P 500 index, little change right now, up under 0.1%. We've got NASDAQ up 55. For NASDAQ, the composite index, a gain there of 0.3%. 10-year, 4.36%, with the 2-year, 3.89%. Gold is down $35 the ounce for gold, a drop right now of just about down by 1%. We've got West Texas Intermediate crude higher, WTI up 1%, $69.92 a barrel. Coming up 2 o'clock Wall Street time, the Fed decision, Jay Powell's news conference at 2:30 p.m. Our special coverage kicks off at 1:30 p.m. Wall Street time. As for what to expect today, Russell Brownback is head of global macro positioning at BlackRock. He was the guest this morning on Bloomberg Surveillance.
We actually, on our team, think the Fed will deliver what's priced by markets, which is a couple of cuts this year and probably a couple more next year. So I think futures markets have kind of a 3 3/8 target by the middle of next year. We think that's fair.
Russell Brownback of BlackRock. You can hear more of the conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Harley-Davidson surging after the motorcycle maker announced plans to monetize part of its finance unit through selling a nearly 10% stake and more than $5 billion of retail loans. HOG on the ticker for Harley-Davidson. HOG right now up by 16.7%. And briefly, flights in and out of London are disrupted at this hour after a technical glitch at a key air traffic control center forced authorities to limit the number of movements into the UK capital. Recapping, S&P up under 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie. Thank you so much, Charlie Pellet there. We have John Tucker. We have Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. It is Fed Day. We'll have complete coverage for you.
Well, we also have earnings.
We also have earnings. You're exactly right, John. We got Microsoft, Meta coming after the close. We had a nice little M&A trade, I thought. Palo Alto Networks buying CyberArk for 25 large. So a lot going on in the world of technology. Mandeep Singh, he covers it all. He runs the team for Bloomberg Intelligence, senior tech analyst here running all of our tech research. Mandeep, Microsoft, Meta, after the close, what do you think the street needs to see?
I mean, in the case of Microsoft, clearly they will be compared to Google's 32% growth, and the consensus number is higher for Azure at 35%. My sense is they will probably beat that number, given what we have heard in terms of token consumption. And token consumption is like, how many queries are you doing on ChatGPT and Anthropic? In fact, Anthropic introduced a cap yesterday on the usage of their platform because people were using it way too much than they were provisioned for in the $200 subscription. Yes. And when that happens, you know the underlying cloud provider has run out of capacity. So for Anthropic, the underlying cloud providers are Amazon and Google Cloud. We saw that Google Cloud number. In the case of OpenAI, it's all Microsoft. And that's where I think there is upside to that Azure number, the 35% growth number.
Mark Zuckerberg has all these high-paid geniuses sitting around him. At some point, does he turn to them and say, hey, get me into this cloud computing services business?
I think
Is that a stupid question?
Well, I mean,
He'll make it sound smart.
It's too late in the game for Meta to become a hyperscale cloud provider. They should have done that 2-3 years back, and that would have turned out to be a great decision. Right now, he's betting on really transforming the social media assets that Meta has, whether it's Instagram, WhatsApp, and really powering that with the latest large language model enhancements by the superintelligence team. And look, they are behind. When it comes to AI models, clearly Meta is trailing the likes of OpenAI, Anthropic, and Google. But what they have is the commitment from their founder, Mark Zuckerberg, in terms of investing in CapEx, data centers, and then making these acqui-hires really big, which could increase their OpEx guide. But the street still believes Meta has the assets to monetize AI, and they will build it and catch up to the other large language models.
I'm just shutting up and buying Microsoft. I mean,
yeah.
How does that thing not work? I mean, it's up another 20-some-odd% this year, 21% this year. But you think about it, how does that not work?
Yeah, no, you're right. Between the two, I mean, in the case of Meta, you really have to trust Mark Zuckerberg to execute and show it in 2026 and beyond. In the case of Microsoft, the numbers are there. They're already executing, and the numbers will be revised upwards for the second half. And so that justifies the big CapEx. So in Meta's case, you have to hope that they get it right eventually and they catch up with all these big investments. But I think Microsoft is clearly executing very well.
How much do you have to spend to make money on AI? What's the number to watch for?
I mean, look, Azure is a great number to compare, AI's monetization with other cloud providers, because Microsoft actually gives you that AI contribution, which is 17% of 35% growth is coming from AI. The non-AI portion is 18% growth. If you think about Microsoft Azure as an $80 billion run rate business, the 17% growth is coming from AI, which is pretty substantial. I mean, we're talking about a $13 billion run rate. And at this rate, if they keep growing 35 to 40%, I mean, they could double that Azure business over the next 2 years. So imagine that $80 billion business becoming $150 billion in the next 2 years at this growth rate. And that's why it's so phenomenal, because it's recurring revenue.
A couple of days ago, we had on the show Dan Salmon. He's head of internet research at New Street Research, really good analyst. I've known him for a while. He came out with a report that tried to take a look at the return on invested capital that some of these large language models, the Amazons of the world, kind of what they can think about, or what investors can think about in terms of return on all this investment. How do you guys think about that?
Well, I mean, the return is how that translates into AI revenue. So I mentioned about the $13 billion run rate.
Yep.
If that continues to grow at the pace, 100% plus growth in that AI contribution, then that return is there. If Microsoft is investing $80 to $90 billion in CapEx, and their cloud business goes to $150 billion over the next 2 years, I mean, that's where you can show the return. In the case of Meta, it's much harder because you have to reflect that in ad pricing and top line growth. There is no separate cloud business. So that's where the challenge is harder for someone like Meta. But clearly, they are still investing in reality labs that no one is talking about right now. I mean, look, that large language model can feed into a intelligent smart glass offering, the Ray-Ban glasses, and that could grow their share in consumer devices. I'm not betting on that. I still think Meta should focus on what they do best, which is ads and the social media. They should get out of the hardware business. But at least for now, Mark Zuckerberg still believes in that as well.
Before this morning, I'd never heard of CyberArk. What's going on here with Palo Alto?
Well, Palo Alto and all the pure play cybersecurity names have this thread of hyperscalers like Google, which is buying Wiz, a cybersecurity company, bundling cybersecurity with their cloud. So Microsoft is already a big player in cybersecurity. They give you a lot of security with their cloud. Amazon does the same. They have their own identity security. So the challenge for these pure play players like Palo Alto is, how do you compete with the hyperscalers? The way Palo Alto is going about it is with this big acquisition in this field of identity security, because everyone right now is focused on AI agents. And in this case, they want to secure the AI agents that every enterprise is looking to deploy. So that's what they're betting on.
Mandeep Singh, Senior Tech Analyst, Bloomberg Intelligence. Thank you very much. We appreciate that. We were just talking, John, about Mercedes-Benz and Porsche and how their stocks are challenged. Red headline came across here that Renault, the French automaker, they picked a company veteran, Mr. Provost, to be the new CEO. And I just punched up the ticker. Stock performance year to date, down 29%. Ooh. I mean, all these European automakers, it is so many headwinds from tariffs, from China not being the best end market they thought it was going to be, to China as a competitor in the EV business, it is tough out there for these automakers, particularly some of these European ones that are facing the headwinds from tariffs. This is Bloomberg.
Listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, I am a big fan of Hershey, so this story is going to be good. We got John Tucker, you got Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Hershey trims guidance on tariffs and higher cocoa costs. You know what, John? We have an analyst who covers Hershey's. I mean, that's a job, believe it or not. Diana Rosado-Pena, consumer staples analyst for Bloomberg Intelligence. Diana, it looked like our good friends at Hershey, they're feeling the effects of tariffs. They're feeling the effects of higher cocoa costs. What's it mean for them?
Yeah, adjusted EPS is set to decline 36 to 38%, which is higher than the anticipated, or like what they guided before, which was like mid-30s, which, you know, is significant.
But they're talking about tariff costs of $170 to $180 million. So they know what tariffs are going to cost them, and I guess just in their cost system.
Yeah, it's mostly, I would say, cocoa and the headwind of that. It's been significant, and they have been trying to hedge that, but they haven't been that successful. You know, cocoa remains very high. They mentioned that Trump seems to be a little bit more willing to kind of get rid of tariffs on cocoa, or at least lower them significantly. So they're hoping for that, at least for 2026.
And cocoa, the prices have been elevated for other market conditions, whether it be drought or whatever, not just the tariffs. So it's kind of a double whammy.
Exactly.
And I'm guessing you cannot grow cocoa like in New Jersey.
Yeah, no, you cannot, or even Puerto Rico for that matter. But yeah, it's difficult. The supply chain has been strained for the last few years. They're working on having innovation and other things in terms of like how they procure cocoa, and as well as innovation in terms of how they mix cocoa with other ingredients to lower the price per unit. But
I mean, I'm looking at your coverage here. You cover some of the great American companies, Hershey, Conagra Brands, General Mills. I mean, some of these Campbell's Soup. What are all these companies telling you about how they plan to deal with a higher tariff regime in terms of how much will they take in their margin versus how much they'll maybe try to pass along to consumers?
Well, they're trying to the wait and see approach for the past few months. They're hoping stabilizes a little bit and they get to know exactly the type of tariff that they're heading against. We're hearing from Campbell's in terms of steel being a significant headwind for them. Others have a similar thing, but it's mostly they're trying to do with cost savings and as well as a little bit of price increases. Obviously, Hershey wants to increase prices by 16%.
Really?
Yes. So they're planning on doing that, which is probably going to test elasticity even further.
Okay, so they're willing to take a hit on margins, or they're going to raise prices, a combination of both?
I think a combination of both. It really depends on like the byproduct and how elastic that demand is. I think, you know,
Hershey's just, I think of it as just, I'm a big Hershey fan myself. I kind of think the brand there is as strong as anything out there. It's almost like the Coca-Cola of candy. What do they find in terms of brand loyalty and price elasticity for their product?
So they have been, you know, like you're saying, their brand equity is significant, but still when you have consumers going against price increases all over the board, you start to kind of make decisions and go probably private label. But they're hoping that that turns around. At least volume was very strong this quarter.
Okay. What other pressures are you seeing in the industry aside from tariffs? And when do those that's not just one-off. This is like going forward for how many quarters?
Yes, I would say, you know, private label and that thread is significant. It's multi-year. Retailers have been very smart about private label and their offerings, and that has eroded some of the, you know, brand equity that these companies have. So that's definitely something to look out for.
New products. John, what were you thinking? Doesn't Hershey have a new product that you were dying to understand?
Something, a combination of Reese's Pieces and Oreos.
What? Yeah, they call it the Reese's Oreo Cup.
Who's making
Reese's
this now?
Oreo Cup.
Hershey.
And what is this thing?
You're bearing the lead here, you know.
Yes, exactly. Nobody cares about earnings. What is the Reese's Oreo Cup? I mean, they're calling that out as a new product that maybe could be, I don't know, revenue driver?
Yes, that's what the kind of innovation that they're hoping to drive some of the traffic into their brands, and people not minding the price increases. So, you know, they have been trying a lot of things.
This is just so good. I don't care what it costs. I gotta have it.
Well, they a few years back they had like potato chips on Reese's peanut butter cups. So,
all right, here's how CNN Business reported it. Oreo and Reese's fans have been, quote, begging for a mashup for a decade. Now it's here. See, they're onto something here. So this is a Reese's Pieces Oreo, and you put the Reese's Pieces stuff in between the Oreo wafers, and there you go.
Yeah, I am still kind of angry over the Oreo shrinkage. They say they didn't, but the white stuff.
You're convinced? Okay.
I'm convinced.
All right, we're on top of this stuff for you. Again, Hershey, here are real numbers. The company now expects full-year adjusted earnings per share to decline by 36 to 38%, and full-year tariff costs to be $170 to $180 million. So that's operating headwinds, that's margin headwinds, and we're breaking it down for you. Deanna Rossetto-Pena, she's the expert. She covers all the consumer staples companies for Bloomberg Intelligence, and she's on top of all that stuff for us. All right, Deanna, thank you very much. We got looking at the market here. I don't know. I'm just not seeing a whole lot going on here, so we'll pay attention. It is Fed Day. For our listeners in the U.S., hey, reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Stay with us. Your top stories and global business headlines are coming up right now at 1:30 p.m. Wall Street time. The Fed decides. Simulcast, Bloomberg Radio and Television. Tom Keene, Lisa Bronwich, John Farrell. They will bring you all the analysis. Michael McKee, he's down in D.C. at the Fed. This is Bloomberg.
This is CBS News on the Hour, sponsored by ZipRecruiter.
I'm Steve Kathan. President Trump takes trade action against India, and he insists his August 1st tariff deadline for some other countries won't be extended. CBS's Nancy Cordes at the White House.
Just the fact that he is reiterating that the deadline is the deadline is notable because the deadline has slipped several times. But the president is saying no, it is going to happen on Friday. He's going to announce new tariff rates for dozens of countries around the world. And he gave us something of a sneak peek this morning when he said that he's going to be slapping a 25% tariff on goods coming from India.
He's also imposing an additional tax for India's dealings with Russia. Federal safety officials have opened a hearing saying they've determined that a military helicopter involved in the deadly January crash with a passenger jet over Washington was flying above its height limit. NTSB Chair Jennifer Homendy.
Please know that we are working diligently to make sure we know what occurred, how it occurred, and to prevent it from ever happening again.
67 people died in the crash. No major damage reported in Hawaii and the West Coast after a powerful Pacific earthquake kicked up tsunami waves. CBS's Jonathan Vigliotti.
When you talk about the panic that came from the sirens, bumper-to-bumper traffic for hours, this morning there is now relief after evacuation orders have been lifted.
President Trump touches off more controversy, saying Jeffrey Epstein stole some of his employees. Here's CBS's Scott McFarland.
Among those who Trump says was poached or stolen from Mar-a-Lago was one of Epstein's most outspoken victims, Virginia Giuffre.
I think she worked at the spa. I think so. I think that was one of the people. Yeah. He stole her.
According to her family, Giuffre died by suicide earlier this year.
The government says the economy grew at an annual rate of 3% in the spring quarter, a slight improvement over a slight drop in the winter. Now to Birmingham, England. For fans of the late music icon Ozzy Osbourne turned out for his funeral procession. Mark Savage of our partners at the BBC is taking it all in.
Thousands of people were lining the streets from the early hours of this morning, all chanting his name and living up to his reputation in a way. I saw people drinking from Viking horns and scrawling his name across their chest in black marker.
Osbourne once said he wanted his funeral to be a celebration of his life and not a mope fest. The Dow is down 6 points. This is CBS News. A movie sequel did better than simply par for the course.
30 years ago, I decided to give golf a try.
Happy Gilmore 2, the follow-up to the 1996 hit movie starring Adam Sandler, had the biggest opening weekend in the U.S. of all time for a film on Netflix, with more than 46 million views in 3 days. Sandler paid tribute to an old friend in the film.
Wow, that is some stone-age shiznit.
One scene features a clerk watching the sitcom Jessie on TV with actor Cameron Boyce, who died when he was 20 after suffering a seizure 6 years ago. Deborah Rodriguez, CBS News.
5 years after the retailer JCPenney filed for bankruptcy, a Boston private equity firm is paying $947 million for the 119 stores still open. Money will go to creditors. The fate of the stores, not clear. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Fed Day in Washington. Welcome to the Wednesday edition of Balance of Power as policymakers prepare an announcement on interest rates that will likely disappoint the president. We've got our eyes glued to Truth Social. We're about 2 hours away now from the announcement with a fresh reading on GDP that shows growth moderating in the first half of the year. It did come in hotter than expected on the quarter, and we'll talk about that with Bloomberg's Molly Smith with us in Washington. As more companies blame tariffs for weak quarterly results, we're going to spend some time with Bloomberg Markets editor Michael Regan to see how investors feel about all of this. And with Republicans in Texas set to roll out a redrawn congressional map as soon as today, we're going to get into it with our political panel. Bloomberg Politics contributor Jeannie Shanzano is with us alongside Republican strategist Maura Gillespie from Blue Stack Strategies. We start, as always, by setting the baseline on Wall Street. Remember these numbers 2 hours from now when the Fed announces interest rates. Charlie Pellet has his eyes on the markets for us. As always, let's update Wall Street first with Charlie at World Headquarters in New York. Where are we, Charlie?
Thank you very much. Right now, we got a whole lot of little change. Just under 2 hours to go ahead of the Fed decision, 2 o'clock Wall Street time. Our special coverage kicks off 1:30 p.m. Wall Street time. Jay Powell's news conference. You'll catch it live on Bloomberg Television and Radio at 2:30 Wall Street time. And yes, up to the minute analysis and insights as you come to expect over the years. S&P right now up 10. That is a gain of 0.2%. Dow Industrials flat on the day. We've got NASDAQ up 78, higher by 0.4%. The 10-year ahead of the Fed decision, 4.36%, with the 2-year 3.90%. Gold is down 1%, 32.93 the ounce. West Texas Intermediate crude up 1.4%, 70.21 a barrel on WTI, and Bitcoin now up by 0.2% at 117,771 on Bitcoin. Under 2 hours to go until the FOMC decision. As for the rate environment heading into today's meeting, Jim Bullard is a former president of the St. Louis Fed. He was interviewed this morning on surveillance.
I think the policy rate's a little bit high for the current environment, and so I do think that the committee could set up a September rate cut at this meeting. I think the risk for the chair is probably that that gets priced in even more than it already is.
Former St. Louis Fed President Jim Bullard interviewed this morning on surveillance. JP Morgan Chase and Coinbase have signed an agreement to directly link customers' bank accounts to their cryptocurrency wallets as banks and fintech companies increasingly clash over who has access to consumer data and at what cost. Shares of JP Morgan Chase up 0.8% right now. Recapping, S&P 500 index, little changed, up by about 0.1%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet on a Fed day. What else do you want? It's like Christmas morning around here. Live from New York, we'll get back to Charlie a little bit later on this hour as we periodically update the markets as we talk politics every day here. There's usually much in common when it comes to Washington and Wall Street these days, and this is the most literal example of that, with the Fed announcing rates at 2 o'clock. Now, as always, we'll have special coverage. The Fed decides starting at 1:30 p.m. Eastern Time. That'll be right here on Bloomberg Radio, satellite radio, channel 121. You can watch us always on Bloomberg Originals or on YouTube. Check it out now by searching Bloomberg Business News Live. It's not just Fed Day, it's GDP Day. We're looking ahead to jobs on Friday, and we've also got tariffs to deal with here. Following the president's trip to Scotland, he got back last night. He was just on a tear on Truth Social. I can't count all, I don't even know what half of them are, but nothing critical that you need to know about, at least not since the Truth post about India. This is the closest thing we have to news walking us up to the August 1st deadline on reciprocal tariffs. Yes, 25% tariff on India's exports to the U.S. starting Friday, and the president is making clear that Friday is the deadline. It's not going to move. He says it's going to be a great day for America. There you go if you're watching us on YouTube. The August 1st deadline. Boy, look at all the caps, Cece. I almost can't read it. It stands strong and will not be extended, he says. A big day for America. Multiple exclamation points there. He might not feel that way when the Federal Reserve announces its take on interest rates. As we discussed, he's, of course, been pushing Jay Powell to cut, and I don't think we have one economist who expects that to happen. Molly can set me straight. She was up early today to edit the data, and to have Molly Smith in Washington on a Fed day is a big deal around here. Bloomberg News economics editor in the swamp. Welcome to the Heat Dome. I hope you're having fun this week.
Oh, the best week. Are you kidding?
Well, we know how to party here in
the
Washington.
action.
Just don't tell anyone I said that in New York. So, a couple ways to look at the data. Let's start with GDP. Stronger than expected on the quarter, but the smart people like you are looking at the first half of the year, and it shows moderation. How should we be thinking about these numbers?
Yeah, that's exactly right. So we have to remember that the first half of the year, the GDP contracted actually. And remember that this was all because there was such a huge surge in imports leading up to companies trying to rush to get so many goods into the U.S. before tariffs were expected to hit. That really dropped off in the second quarter, so that artificially boosted the headline GDP number. But smart people here, we look past those things.
Yes.
So we look at some other measures that show underlying momentum and growth in the economy. So consumer spending, first and foremost, that has definitely dropped off quite a bit from the pace of last year, as well as when we look at business spending and some other metrics that combine all these together, it definitely points to demand is slowing in the economy. And that's more where you start to hear from some people on the Fed who are in favor of cutting interest rates, and this actually really supports that argument.
Wow, interesting. With that said, what did we learn about prices today? I heard Kevin Hassett from the White House earlier talking about how inflation they expect will remain contained despite the tariffs, but that wages are about to go on a tear, and I don't know how you can have both.
Well, yeah, it's a little tricky because they do tend to go hand in hand in a lot of ways. But we're going to get some more details on that in tomorrow. Also, another big report this week. So that one is going to round out the June figures on PCE, inflation, as well as consumer spending there. So it's more or less a continuation of the same story in that, like, at least we're starting to maybe expect that the tariff-driven inflation is going to come through in June, because the first several months of the year certainly didn't show that yet. But there's every reason to think that it is coming. We've heard from so many companies say that they are planning to raise prices, or they already have done so.
Yes.
It's just a matter of how much of that is getting passed on to consumers.
So let's talk about that for a second, because even just in the last 24 to 48 hours, Procter & Gamble were raising prices, I believe it was on a quarter of their products. Whirlpool down hard yesterday because of tariffs that were supposed to help the company. It's just not arrived yet. Stanley Black & Decker, another one, feeling the weight of tariffs. When you see anecdotal evidence like that, how long does it take to get into the hard data? Because the White House keeps telling us that it's simply not showing up.
So it has happened in some respects. There are some categories that we saw in the Consumer Price Index earlier this month that showed that some commonly imported goods like toys, like appliances, that's definitely starting to show prices coming up. It's really a tough decision for companies, though, who are dealing with so much shifting in trade policy. They're wondering, like, okay, we had an April 2nd deadline. Now there was a deadline in July that has come and gone. Now August 1st, how many times are you going to adjust your prices? And they're looking for some sense of stability so that if you're going to raise prices, you're hopefully only doing it once or as few times as possible to not put your customers off. So in the meantime, we've sensed that a lot of companies are probably absorbing a lot of these costs instead of passing them on to consumers. But there's only so long you can do that before your profit margins start to take a hit.
Well, that's right. And this is a problem for shareholders here. Like, investors are going to start carrying at some point, it seems to me. I'm going to ask you about the Fed in just a minute here, Molly, because we are, less than 2 hours away from an announcement. But how should we be looking at the job report on Friday? This next payrolls report could be important.
Yeah, this is really what we're expecting is to be, a lot of continuation of the moderating in the job market, that the headline payrolls number is continuing to slow down over the months that, we've gotten recently. I think this latest estimate is calling for just about 100,000 advance in payrolls. So that would be, a pretty notable slowdown from the previous month's pace. And we're going to perhaps see a pickup in unemployment as well. So all of this also explains then why consumer spending is slowing down. Yes. And the weaker the job market is, how else do you expect consumers to keep spending and for the economy at large to keep expanding?
So 100,000 is the number we keep in mind for Friday.
As of now, I think it's maybe 102 plus or minus in that area. But we'll get some more estimates into tomorrow too.
Let's talk about the Fed. Elizabeth Warren came to talk to us last evening on Balance of Power. She has something in common with Donald Trump, as we've discussed, and that's an interest rate cut. But when Trump becomes the reason why we're not getting an interest rate cut, that gets a little bit more complicated. Listen to the senator from Massachusetts on Bloomberg TV and radio.
There is exactly one person who is responsible for keeping those interest rates high, and that's Donald Trump. Jerome Powell said last month that he would have urged the Fed to lower interest rates last February, but for the chaos that Donald Trump has been causing over tariffs. If Donald Trump really wants to see interest rates come down, then stop creating so much chaos around tariffs.
The fact of the matter is nobody expects a rate cut today, right? Donald Trump is asking for 300 basis points. By the way, did you see Ghana cut by 300 basis points today? Yeah. Now he's got something to point to.
Yeah, I mean, Ghana also has interest rates that are like around 30%. So it's a little different. Ours is more around like 4%. So keep that in mind. But I mean, she does have a point in a way that like really the indecision among Fed policymakers right now is the consensus is that yes, tariffs are going to have some kind of an upward impact on inflation. The question is though, is this just going to be a one-time fleeting increase or is it going to prove more persistent? And that's something that we just don't know yet. So either way, yes, the tariffs are going to exert some kind of upward pressure on inflation. All the companies that you just mentioned and more would certainly attest to that. We just don't know yet looking further out. And this is exactly the challenge with policy since it does act with such long and variable lags. What is an interest rate cut? Well, not today, but in the coming months, what does that mean for like inflation next year and looking further beyond that?
What's the Economist, the street consensus on cuts for September? Is that something that's baked in at this point or are we data dependent right through fall?
Rising, certainly. I wouldn't say baked in, but it certainly becomes more of a possibility. And I think that's going to be a really key thing for what we're going to be looking for from Powell this afternoon. I don't know that there's going to be much in the statement that would indicate much of a willingness to open the door to cuts in September or beyond that. But what's going to be really key to see how he speaks in the press conference, if there is a bit more expressing of an openness to that.
This is going to be a little more fun than usual to watch, right?
Oh, it's always a fun time, but yeah. I mean, my heart's pumping already.
That's because you're on Balance of Power. I can't help you with that, Molly. It's great to see you in Washington.
Great to
if you see Molly Smith on the street in Washington, say hi. She'll be back to New York soon enough. Bloomberg News economics editor with us here to get things started on a Fed day. Molly, it's great to have you as always. I'm Joe Matthew in Washington. We're going to turn our attention to trade news and some of the concerns that Wall Street is having about these earnings reports. We're going to have another big pile after the closing bell today. So stay here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We are just about an hour and 39 minutes away from the latest FOMC decision. Our coverage kicks off on Bloomberg Television and Radio at 1:30 p.m. Wall Street time. Fed decision, of course, drops at 2 o'clock. You know the routine. Jay Powell's news conference live on Bloomberg Radio, 2:30 p.m. Right here on Bloomberg Radio. Stocks now higher. We had the Dow lower last update, but right now showing a gain of 43 points. But perhaps the key takeaway, little change right now ahead of the FOMC decision, up 0.1% on the Dow. S&P right now up 15. That is a gain of 0.2%. NASDAQ up 0.5. Our Mag 7 index pushing higher by 0.3%. Two of those members will be hearing from Microsoft and Meta Platforms after the close of trading. Busy day for those of us covering financial news. We got the 10-year 4.36%, the 2-year 3.89%. Gold down $30 the ounce, drop there of 0.9%, $32.95 the ounce, and West Texas Intermediate crude up 1.4%, $70.18 for a barrel of WTI. Bitcoin just below $118,000 right now, up by 0.4%. We're keeping an eye on Harley Davidson shares right now. HOG on the ticker is rallying. Harley Davidson up now by roughly 18%. It is surging after the motorcycle maker announced plans to monetize part of its finance unit through selling a nearly 10% stake and more than $5 billion of retail loans. KKR and PIMCO will each buy 4.9% common equity interest in Harley Davidson Financial Services. Again, Harley Davidson up by 18.3%. Back we go to Washington. Balance of power continues right now. He's got a lot going on. Once again, here's your host, Joe Matthew.
All right, Charlie, thank you so much. Charlie's got a lot going on, too. The whole building in 731 is going to shake when this Fed announcement happens. And, of course, we're going to be looking to Charlie for market checks after we get news, not only on rates, but the statement, of course, the news conference. All of this will be part of our special coverage that starts roughly an hour from now, 1:30 p.m. Eastern time. The Fed decides. You know where to be on Fed Day, and it's on Bloomberg. That is not a question. Check what you're drinking with your lunch. This has got to be the more interesting story of the day. Producer James just put this in front of me. It takes America's producer to find news like this. High Noon is recalling its vodka seltzers mislabeled as Celsius. The FDA, right? So you think you're buying an energy drink, you're going to get the Celsius, and there's alcohol inside. High Noon announcing the recall of its vodka seltzer beach pack. You went for the beach pack, didn't you? That's the 12-pack. Due to inclusion, I'm reading off the news release now, of Celsius Astro Vibe energy drink cans that were inadvertently filled with vodka seltzer. Is my kid drinking that stuff at home right now? Consumption of the liquid, it says, in these cans will result in unintentional alcohol ingestion. Oh, Kaylee, we're going to have to talk about that, too. I think they were drinking Celsiuses in the Lines house. All right, let's get to what we're talking about here, and that's earnings reporting season. Look, maybe more people are going to buy it because right? Everyone's going to buy this stuff to try to get the can with the vodka in it, flying off the shelves. Maybe it'll be a collector's item. We've been hearing earnings reports from companies that are making us wonder here about the impact of tariffs and maybe the fact that they're actually finally taking hold. Really interesting series of stories here from some major consumer-facing brands, the likes of Procter & Gamble, now saying that it's cutting its outlook for the year and is increasing prices on a good number of goods, about a quarter of its products in the U.S., to help offset the cost of new tariffs, which, by the way, are going to be likely going up again on Friday. That's the date for reciprocal tariffs, at least with regard to companies that haven't cut so-called deals yet. This is really interesting. Bill George, former chair, CEO of Medtronic. He's now executive education fellow at the Harvard Business School. Bill George, you're going to see companies like Walmart, Amazon, and Best Buy forced to pass price increases to consumers. Main Street, this is important, has yet to see the fallout from increased tariffs. George says they're going to go higher. Add Stanley Black & Decker. Add the meltdown in Whirlpool yesterday. What UPS was also saying. It starts to paint a pretty scary picture about where we might be heading in the second half of the year. You remember Molly Smith just told us that when you look at GDP growth for the first half of the year, not just this quarterly number that was impressive today, stronger than expected, but we're seeing a real slowdown in the economy when you take a longer view. Now match that against the stock market that keeps hitting all-time highs. The S&P 500 is right below 6,400 right now, up another 14 points today. And we've got a big pile of earnings news coming. So we thought this would be a really good moment to take stock with Michael Regan, Bloomberg's managing editor for the U.S. here, and his eyes on not just the markets, but the way they're looking at these issues that we're talking about now in Washington. President Trump just today announcing a new tariff on India. This is, again, ahead of the August 1st deadline that he says will not move 25% on India's exports heading into the U.S. Michael Regan is with us from World Headquarters in New York, and I'm wondering if you're starting to feel like we're in nosebleed territory here, Mike, or if the earnings reports that we're going to get in the days ahead will actually justify these levels.
Yeah, Joe, I mean, I think the big tech earnings obviously are the main show for the week. Meta Platforms, the operator Facebook and Instagram after the bell, and Microsoft after the bell. Because, you know, obviously the tariffs are starting to bite, as you point out. You know, Whirlpool is a great example. They actually were in trouble because so many Asian competitors imported or exported to the U.S. a lot of competing appliances. So even though Whirlpool is, you know, has a lot of domestic manufacturing, they still got hit because of that sort of trying to front run the tariffs. But really, you know, the market, these mega cap tech stocks are just so heavily weighted in the major indexes, your NASDAQ 100s and S&P 500s, that that's the real story for the week as far as earnings go. And the real thing that a lot of people are zeroing in is actually something you don't usually look at for these companies, and that's capital expenditures, because they really are just writing giant checks for AI chips and data centers and trying to ramp up their AI offerings, either to meet demand from customers or to really improve their own businesses. So if you look at a company like Meta, I believe they're expected to double their CapEx spending to about $16.4 billion. Microsoft expected to increase it by about 30% to $18 billion. Now, it's interesting because oftentimes, you know, before the AI boom, a big ramp up in CapEx would not be exactly something that investors would be happy to hear about. This scenario is a little bit more nuanced. We saw Alphabet a week or so ago announce that they expect to spend $85 billion on CapEx this year. And the initial sort of knee-jerk reaction in the market was a drop in the stock after hours. But then the executives got on the call and explained, like, no, we're responding to demand here from clients, and that's why we're spending so much. So it's, you know, a lot of nuance as far as how these companies explain this giant expenditures on CapEx. If they can sort of illustrate that they are able to reduce costs or improve sales, fatten out those margins a little bit because of what they spend or expect to spend, then they're going to get rewarded. If it looks like they're just kind of gambling and taking a bet that AI will help them, then you know, the market's going to be a little bit skeptical about that. But you're absolutely right that with these valuations, especially among those big Magnificent Seven tech stocks, as they call them, and the market at large, that we really are at a point where any bad news could be taken sort of in a worse fashion than it might have otherwise, just because of this ferocious rally we've seen since the lows in April.
Well, that was a great readout, Michael, and that massive capital expenditure you're talking about is the reason why we have yet another all-time high for NVIDIA today, because that's where so much of that money is going. Look at this thing above $178 now. It's up another 2% today. Absolutely remarkable as we wait to hear from these companies. Those we're hearing from tonight, we'll put Apple aside with all the talk of where it's going to assemble the iPhone and so forth that the president likes to talk about. Michael Regan, if you're Microsoft or Meta, are you tariff-proof? I mean, if you're selling software and selling ads, isn't that about as good as it gets right now?
Yeah, I don't know if you're 100% tariff proof, Joe, but you're pretty well inoculated compared to, say, your importers of your retailers, especially. We'll hear from most of them towards the end of the reporting season. The banks as well, who we heard from at the beginning of the season, relatively tariff proof, and not only that, all the commotion in the markets, the volatility and the heavy volumes were really a boon to your Goldmans and your Morgan Stanleys and your JP Morgans, any big bank with a trading desk. So that sort of front-loaded a lot of growth into the earnings season and a lot of better than expected reports. Now we really do get into the nitty-gritty of, the big tech, obviously, as we said, but also these industrials, the retailers, the more consumer-facing names coming later in the season that are more exposed to the tariffs. I'll give you one example. PayPal came out and said, you wouldn't think this company is very exposed to tariffs, but they said the tariff effect has really just affected overall consumer spending. So lower volumes, not good for a company like PayPal. So really kind of sending an interesting macro signal from a stock like that. We also heard from Harley Davidson. That stock's up big, as Charlie mentioned, on its plans to take some investments in its financing arm. But if you look under the hood of their earnings, they also pointed out to a 125 basis point or 1.25 percentage point hit to their margins. So the anecdotes are starting to pile up. And remember, there's going to be a delayed reaction to these tariffs, I think, as Molly alluded to earlier. The quarter we're talking about now was that March to June quarter. So, it didn't encompass really a lot of the tariffs that we're looking at going forward. So it's a story, Joe, that's going to remain with us for the rest of the earnings seasons this year and beyond, for sure.
Yeah. We've only got about a minute left here, Michael. Walk me up to Friday. We get through the Fed today. We've got GDP, important data tomorrow. But Friday, we have a jobs report and we have the August 1st deadline. So presumably Donald Trump's going to have an event where he holds up a big board or he goes on Truth Social and puts up a whole bunch of new reciprocal tariffs. If that jobs report doesn't impress, the tariffs freak out investors. Maybe we have some shaky earnings in the next 2 days. What happens to the market?
Yeah, I mean, I go back to your point again, these, record after record and these really very richly valued valuations from the index side. Really, the market is priced to perfection, as I've heard several investors say. Now, I'm not sure the August 1 tariff announcements will have the potential to be too big of a shock because we already know what to expect with Europe, Japan, and China back and forth. But we have a pretty good sense of what the major trading partners are going to be. So on the payrolls report, I almost think an upside surprise will be more problematic for the market because of that. A lot of hope that the Fed will lower interest rates this year.
Fascinating to spend time always with Michael Regan, Bloomberg managing editor for the U.S. Watch the Celsius when you open the can, Michael. You don't know what's inside that thing today. I'm going to go grab one myself and see what happens. We'll assemble our panel coming up. Jeannie is with us, Jeannie Shanzano, alongside Maura Gillespie from BlueStack. We're going to talk about what's happening today in Texas, maybe the most important underreported story today. They're redrawing the congressional map, and we'll have our panel with it next, only on Blue.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. 1 hour, 20 minutes to go until the FOMC decision. The Dow, the S&P, NASDAQ, all moving higher. Traders gearing up for the Fed decision drove bonds lower. Stocks hovering near records right now. As data shows, the U.S. economy is holding up. The S&P up 13, 63.84. That is a gain of 0.2%. The Dow up 35, up by under 0.1%. Little changed on the Dow. NASDAQ up 85, up by 0.4%. Our Mag 7 index picking up 0.3%. Two of the Mag 7 index members, Microsoft and Meta, will be reporting today after the close of trading, and then tomorrow the focus will be on Apple and Amazon. 10-year 4.36%, with the 2-year ahead of the Fed decision of 3.89%. Gold is down $31 the ounce, below 3,300 now, down 1%. Spot gold 32.95. West Texas Intermediate crude up 1.4%. 70.21 a barrel, back above 70 on WTI, and Bitcoin up 0.2% at 117,768 on Bitcoin. So we've got just over an hour to go until the Fed meeting. What to expect at 2 p.m. Wall Street time. Stuart Kaiser is head of U.S. equity trading at Citigroup Global Markets. Stuart Kaiser, Citigroup, interviewed on Bloomberg Surveillance. We'll get to his remarks just a little bit later on. But the S&P now higher by 12, up 0.2%. The Dow up 27, up 0.1. NASDAQ up 82, a gain there of 0.4%. Deal news, Palo Alto Networks buying CyberArk software in a cash and stock deal, valuing the Israeli cybersecurity company at about $25 billion. Again, recapping, stocks higher ahead of the Fed decision, up 0.2%. Balance of power continues right now. Back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie Pellet doing some on-the-ground reporting here in Washington, D.C. with the big story. You're about high noon. This is like the third most read story on the terminal today. High noon announcing a recall of vodka seltzer drinks. It says were mislabeled as Celsius energy drinks. We know this because the FDA posted something on its website. We've got a full-on recall here. The company says consumption of the liquid in these cans will result in unintentional alcohol ingestion. This is something made for Charlie and the Chocolate Factory as people head out to convenience stores around the country looking for a drink with the golden ticket. And, you know, the crack team here at Bloomberg in Washington is all over this. Brendan went running for us here. Just going to play a little Celsius roulette. We got a couple of them. Tropical Vibe. I think this one's going to be okay. We'll test a few more of these cans as we make our way through the program. Why is Hakeem Jeffries in Texas today, you ask? It has to do with the redistricting that we've been talking about for days. We actually might see the map today. Republicans in Texas want to redraw the congressional map. Donald Trump says he wants 5 new seats in Texas, and it started a big conversation because it's off the clock. It's obviously in an effort to keep the Republican majority in the House, and some Democratic-led states like California say, well, they might get in the game too if this actually happens. Something we talked about with James Tallarico. Did you hear our interview with Tallarico? He's the Texas state rep, a Democrat who's also a pastor who's gone viral recently and might end up running for Senate in the state. He's taken a stand on Texas redistricting. Here's what he said.
The president has asked our governor, Greg Abbott, to find him 5 more congressional seats. He wants to redraw the political maps in the middle of the decade to try to protect his majority in the next election, regardless of how we all vote. And I think this is politics at its worst. You know, politicians picking their voters instead of voters picking their politicians. And so I'm doing everything I possibly can to stop this gerrymander from going through, to stop this power grab.
Politics at its worst, or using the system to maintain a Republican majority in the House by playing by the rules? Let's bring it to our panel for their take on this. I know Jeannie has had a chance to weigh in, and with the new information we have, I'd be awfully curious to hear from the Democrat on our panel. Jeannie Shanzano is a Bloomberg Politics contributor and senior democracy fellow with the Center for the Study of the Presidency and Congress, joined today by Maura Gillespie, Republican strategist, founder of BlueStack Strategies and a veteran of John Boehner's Speaker's office, knows a thing or two about maintaining Republican majorities in the House. Great to see both of you ladies. Thank you so much for joining us. Jeannie, it looks like this is actually happening in Texas, and a lot of people have very simple questions about this because Congress is supposed to actually be a mathematical equation here, right? You have the number of seats based on your population. So how can Texas actually pull this off, or should this not be happening right now?
First of all, Joe, on behalf of Maura and myself, I cry foul on you opening these great drinks and we're listening to them and we get nothing, right, Maura? So please send them over. Thank you, Brendan.
I haven't. I'm going to just keep doing this as we make our way through the.
Joe.
No, this one's clean as well. Go ahead, Jeannie.
You know, this is, I think, just a fascinating story because it speaks to volumes as to how focused Donald Trump is on the midterm. For anybody who thought he was going to go out as a lame duck, you know, doesn't have to run again, doesn't care. This is anything but evidence of that. You know, the last time this was done with Tom DeLay, it wasn't driven by the White House, this sort of midterm redistricting in a state. But this is unusual because the call is coming from the White House. The Justice Department messaging Texas legislature and saying, hey, you guys may be in violation of the Voting Rights Act. You have to redistrict. So that's one fascinating element of this. I think it speaks to how difficult it would be for Trump if the Democrats take the House and or the Senate, but the House in particular, and how much he is investing in making sure that doesn't happen. And this is Texas's, you know, attempt, and I think we'll see others attempt to try to stave that off. And if they're successful, this would be, I think, a sort of laying the groundwork for what we're going to see going forward for these midterm redistrictings.
Hakeem Jeffrey says this is a moment that requires a forceful on-the-ground response, and that is why I am traveling to Texas to convene with members of the Texas House and Senate delegations, as well as our Democratic members representing Texas. He's going to be holding a news conference there, and then he goes to California later in the week. What's your thought on this, Maura? And can Texas pull this off? Donald Trump says this would be enough to keep a very thin majority in the House.
You know, I think it's interesting. We see this happen every now and again as far as state legislatures that decide to, you know, redistrict to put their party at an advantage. My former boss, Adam Kinzinger, he got districted out. You know, they paired up two Republicans together. It's not uncommon. It's something that we've seen happen before. But this particular situation, because, as you mentioned, the president's involvement, and as Jeannie pointed out, the heavy hand that he's playing in this, in order to protect the House majority, razor thin as it may be, to me signals that they're worried about their ability to message effectively of what they've done to the people, you know, to the American people, and you know, keep the votes they need, keep the seats they need to keep. And so, to me, as a Republican strategist, that's a red flag for me, that they're already getting ahead of this as far as we need to, you know, grab the seats, not necessarily earn the vote. And it harkens me back to thinking about January 6th and during the committee when President Trump asked Brad Raffensperger from Georgia just to find him, 12,000 votes, just find him these 5 seats. And so I think that that's going to sit a bit of a sour taste in the mouth of the American people as they remember that as well, because it does feel as though they're worried about their ability to effectively say, you should want to reelect us because here's what we've done to make your life better. And instead of doing that and going out on the road and having a robust August campaign schedule and really hitting the ground running here now and also throughout the next year as you lead into 2026, they're kind of skirting it by trying to take over these seats. Now, again, also Gavin Newsom's trying to do the same thing, right? He said he's going to come back, fight fire with fire, and do the same thing in California. Yeah. Where does that leave people, right? Where does that leave us?
Well, look, Democrats have 2 paths here, it seems. Jeannie, you can take the Hakeem Jeffries path. Maybe there are 3 paths. You could do Gavin Newsom, fight fire with fire, actually change the state constitution, redraw California, or you can take a legal route. That's what Senator Alex Padilla is doing. The Democrat from California you last heard about rolling on the ground with security guards at a Kristi Noem event is pushing for an investigation, Jeannie, into Hatch Act violations. Politico says this, Hatch Act, because of the White House involvement that we've discussed, suggesting that appointees in the White House and DOJ broke the law by prevailing on Texas along with other states, to redraw congressional maps. Which route should Democrats take?
I think they're going to pursue all of the above. I'm never a fan of trying to resolve political questions in the courts, but we have done that since time immemorial, as Tocqueville told us, and we will continue to do that. And he has a good point about the Hatch Act. I mean, the DOJ, the Trump administration, the White House is actively involved in this effort, and so it may be a violation. I think the sounder move for me would be the political avenue. I know that California, as you mentioned, Newsom, they're trying to think about redrawing. Kathy Hochul in my home state of New York trying to think about redrawing, although it is a violation of the state constitution. I think for me, one of the things is what Maura talked about, the messaging component here, is that Democrats have to couple this with a message, which is that when Donald Trump can't win on his policies, which polls show in many cases, putting the economy aside, are not particularly popular at this moment, including immigration, they try to find these votes. And so I think Democrats are going to use an all of the above strategy in trying to combat this. I also think there is a conversation that should be had, but probably won't, that we need to figure out about redistricting and gerrymandering in this country. It has not been something that has been addressed at the federal level, and very well should be, because what it does is it has really thrown a monkey wrench into our politics for a long time now.
Well, look, this is a conversation, you're right, that we need to have, and a lot of people believe, we've talked about this before, that it's one of the root causes of the extreme partisanship in this country and the gridlock on Capitol Hill. And Maura, I'm sure that you have thought about this a lot too. If you look at the way some districts have been redrawn even since you were in the House with John Boehner, you can't even recognize these Frankenstein districts. They don't make sense anymore in some cases.
It really doesn't. I got a quick look at the proposed Texas map that I saw, out on Twitter, and District 24 and 20 and 12 are overlapping each other, where a chunk of 24 is in the middle of 12. I mean, that is just. And I know, when Kinzinger was a congressman, we had from the very top of the state of Illinois to the very bottom, we touched, it was really hard to get anywhere from one point of your district to the bottom point of your district, in one day. You couldn't do it driving wise. And so it's tough. And it's based on the fact that they're trying to skirt these districts to get their most advantageous numbers for what they think will be a win. But I think that what it shows me, as far as Texas and California goes, Texas has turned, more purple. California has turned more purple. And to counteract that, this is what you're seeing. Where you have a Republican governor in Texas, so they're trying to take out those 5 extra seats to push Democrats together, and then potentially the same thing happening in California. But as I said before, it's like, where does that leave us as a country? Where does that leave us as the citizens who get shoved into these little districts that are so wonky that you're not even sure your next door neighbor could be in a different district for all you know? And so it's very confusing. Yes, it's very confusing. And it doesn't, I'll say another Boehnerism here, it doesn't pass the smell test. It just feels icky.
Well, yeah, look, and it happens all over the place to both parties. Jeannie, remember when Barney Frank got redistricted? He couldn't win his own district in Massachusetts. Along comes Joe Kennedy, and he's got to balance a district from Brookline to Fall River, constituents who have nothing in common with themselves, which really upends the candidacies and the campaigns in these districts, doesn't it?
It absolutely does. And I'm glad you mentioned that, because it is on both sides of the aisle. It is usually every 10 years. And now we're seeing more and more at these midterm points during this 10-year period. And it has really, really made it very difficult for us to have competitive elections in some of these districts. The number of competitive elections in these districts has gone down dramatically. And so what that means is we have people running for Congress who are running to the far left and the far right to win these very funky districts, as Maura called them, and they absolutely are. Yeah. And that does a disservice to all of us. And so it's one of these structural challenges we've long faced that has a huge impact on our day-to-day lives and politics, and should be addressed by either Congress, arguably, or the courts, but has not. And now we see what's going to happen, and I think likely will happen in Texas and potentially elsewhere as we move to the midterm.
What a great conversation. See what we can get done around here when we're not trained on the Oval Office for 3 hours a day. Jeannie Shanzano and Maura Gillespie will be back in our second hour here on Balance of Power. In fact, just moments from now as we count down to the Fed. Special coverage only about a half hour away as we prepare for the announcement on interest rates. Straight ahead on Blue.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
Counting down to the Fed, just an hour away. Welcome to the Wednesday edition as policymakers prepare an announcement today on interest rates here in Washington that will likely not please the President of the United States. A fresh reading on GDP to take with us into this meeting. I'm Joe Matthew alongside Kaylee Lines in Washington. Thanks for joining us. We're about a half hour away, Kaylee, from our special coverage. And an hour from now, we'll finally get word on interest rates. This could be quite the test for Jay Powell following the last week or two that he's had with the president.
Yeah, knowing that the vast majority of market participants expect the Fed will be holding rates steady, not to say that that's expected to be a unanimous decision. We actually could see dissents today from the likes of Christopher Waller or Michelle Bowman, but of course, it's likely that the vast majority majority of the members of the FOMC are going to decide not to do what the president is encouraging them to do, which is cut rates. And he, Donald Trump, is using today's GDP data as the latest evidence that a rate cut is necessary. He says 3%, way better than expected, too late. His favorite nickname for Jerome Powell, must lower the rate now.
This after Ghana cut by 300 basis points, the very move that Donald Trump has been asking for in a rather different type of economy, because you can make the argument that a stronger than expected GDP is a reason not to cut interest rates today. The questions that Jay Powell will face from the likes of Michael McKee ought to be pretty entertaining when it gets time for the news conference. Maybe entertaining for us and not so much for him.
Yeah, I wouldn't want to be in Jerome Powell's shoes today, but I do look forward to watching, knowing he also is likely going to have to face questions around how tariffs are actually impacting the economy. Because yes, that 3% print, stronger than expected, but a lot of that has to do with the effects of trade and the lack of the influx in imports we saw in the first quarter. It does have a bearing on overall growth, and that's the kind of data the Fed is watching.
Look no further than Procter & Gamble. We're starting to hear about this now in some of the earnings reports that are helping to drive stocks for better and worse, depending on the case. So I'm sure we'll all be listening when this happens at 2 o'clock.
Indeed, we will. But before then, it's 1:01 p.m. right now on Wall Street. So let's get a check on how stocks and everything else is trading ahead of the Fed decision and turn to Charlie Pellet in New York. Hey, Charlie.
Hi, thank you very much, Kaylee. Indeed, 59 minutes to go. We are on Fed Watch big time. Complete coverage coming up 1:30 p.m. Wall Street time. Yes, it drops at 2 o'clock. And Fed Chair Jay Powell's news conference, 2:30 p.m. We got it covered on Bloomberg Television and Radio. Right now, stocks higher, holding on to gains. S&P up 14, 63.85. That is an advance right now of just about 0.2%. Dow Industrials up 26 on the Dow, a gain of under 0.1%. Nasdaq higher by 0.5%. The Mag 7 index pushing higher by 0.3%. Two members, Microsoft, Meta, will be reporting today after the close of trading. Right now, the 10-year ahead of the Fed decision, 4.35%, with the 2-year 3.88%. Gold is down $28 the ounce. Spot gold down 0.9%, $32.98 on the precious metal, while West Texas Intermediate crude up 1.4%, $70.20 now for a barrel of WTI. Deal news: Palo Alto Networks buying CyberArk software in a cash and stock deal, valuing the Israeli cybersecurity company at about $25 billion. CyberArk shares, they're up 0.9%. Palo Alto Networks down now by 5%. Balance of Power continues right now. Lots going on in Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, lots going on in Washington, indeed, but lots going on in the U.S. economy this week as well. As Joe and I were just discussing, we obviously got GDP data this morning ahead of the Fed's interest rate decision less than 1 hour from now. More data comes tomorrow with PCE figures. Then it's Jobs Day on Friday, which also happens to be August 1st, the deadline for tariffs on a number of the U.S.'s trading partners to take effect, expected to be higher even in some instances than what we saw on Liberation Day, as the president is now floating perhaps a 15% baseline. And some countries, of course, getting fresh numbers from the president today. India faced with a 25% tariff now, according to President Trump, who posted that rate on Truth Social, also saying that a penalty for the above, which is India purchasing Russian military and Russian energy, in his lengthy Truth Social post, will also be applied starting August 1st. So actually, the total tariff we're talking about here, Joe, could be well above 25%.
That's right. The president writing that India has the most strenuous and obnoxious non-monetary trade barriers of any country, knowing that the White House was really hoping to cut a trade deal with India, and that was one of the first countries mentioned that they were reaching for here. Realizing as well, and the president says that August 1st deadline is fixed. That's Friday, and it's not going to move. We want to bring you to the White House on this Fed Day with all of this news in the air to get an update from Bloomberg's Tyler Kendall, who's on the north lawn of the White House. The president is back from his trip to Scotland, Tyler, and I'll let everybody know it's 93 degrees right now in Washington, and we understand that the heat index today will reach 109, where poor Tyler is standing. I mention this because the pressure cooker that Jay Powell is going to be in a little more than an hour from now, it seems somehow fitting to meet together today under the heat dome, no?
Right, exactly, Joe. I think that's a pretty good metaphor and way to put it, because President Trump already today has ramped up the pressure on Jerome Powell, though we should say when we saw his post earlier today, the FOMC was already in their meeting, so that means that none of those committee members ultimately saw his criticism. But he had been pointing to that GDP number that you and Kaylee were discussing at the top of the show, which did show that U.S. economic activity rebounded in the second quarter. President Trump hailed it as coming in above estimates at 3%. The estimates were around 2.6%, really underpinned by perhaps recent tariff-related swings. There's a lot of different factors that we could get into when it comes to the data, and you look under the hood, including that business investment actually ended up weakening. But ultimately, President Trump tried to use this as a way to force his point here when it comes to lowering interest rates, and it continues on this trend of expanding on the White House's list of arguments against Jerome Powell, which has really gone from pointing to the data, talking about the stewardship of the economy, and to Jerome Powell's management of the central bank. We saw it on full display last week when President Trump put on a hard hat and went down to the Federal Reserve to view those renovations and criticize cost overruns. Though there did appear to be some sigh of relief almost, Joe and Kaylee, last week, because President Trump said that ultimately those cost overruns did not amount to a fireable offense, amid speculation that the administration might be trying to build a legal case here to remove Jerome Powell. That doesn't appear to be on the table at the moment, as they say that they'll let him serve out his term till May of 2026. But it really does point us to what we're going to see when it comes to the debate that the FOMC members are having, and when we could expect that rate cut potentially later this fall.
Well, of course, a lot of that debate centers around the unknown impact of tariffs and the unknown rate of tariffs that is going to be applied depending on what sector or what country we're talking about, Tyler. But we learned at least what India will be facing come Friday, 25% with the threat of more. What do we need to know?
Right, exactly. And in his post on Truth Social, President Trump said that India has long been a friend of the United States, but ultimately their tariff and non-tariff barriers have been too high for too long. So any hopes from the country to get a more preferential rate appear to really have been dashed. This White House often talks about the goods deficit between the two countries. The USTR's office says that last year that ran around the tune of $45 billion. And really importantly, so that's the 25% rate around that goods imbalance. But perhaps we could also see an additional penalty. President Trump threatening here over India's imports of Russian energy supplies. The White House has long been threatening that they could impose a so-called secondary tariff on those countries that import Russian energy in a bid to try to get Vladimir Putin to the negotiating table too when it comes to the conflict in Ukraine. But this really comes against this stark backdrop, and Joe alluded to it at the top of the show. India was long prioritized in these talks. The Indian Prime Minister Modi was one of the first foreign leaders to visit the White House back in February after President Trump's inauguration. The country has been seen as a strategic partner to counter China, for example, and there were initial concessions put on the table pretty early on. India dropped tariffs on an array of goods like luxury items and motorcycles. They also moved to make pledges to boost U.S. LNG, for example. But Joe and Kaylee, in recent weeks, it seems that India really seemed to toughen its negotiating strategy, particularly around U.S. agricultural products, and that might be a really big sticking point that we continue to hear about moving forward. Because at this point, India didn't get that preferential rate when you look at these other countries like Indonesia and the Philippines coming in at 19% compared to India's 25%.
All right, Bloomberg Washington correspondent Tyler Kendall live at the White House for us, braving the heat and also reminding us of the hard hat moment in the Eccles building last week. Thank you so much. The images, of course, of President Trump and the Fed chairman next to each other in hard hats probably going to go down in economic and political history books, considering, of course, the words President Trump was sharing with the Fed chair at that time included direct criticism of his rate policy, something that, of course, is nothing new. It's been going on for months now. President Trump is no fan of this particular Fed chairman, or at least his policy on interest rates.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Pal because he's always too late. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job. Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth. and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed. He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned. I believe that he's going to do the right thing. I believe that the chairman is going to do the right thing. I mean, it may be a little too late, as the expression goes, but I believe he's going to do the right thing.
Of course, the right thing President Trump thinks is the right thing is to cut rates today, which is not expected. So I think we all get the gist here. Let's play it now to our political panel. Jeannie Shanzano, Bloomberg Politics contributor, is with us. She's a senior democracy fellow at the Center for the Study of the Presidency and Congress, alongside Maura Gillespie, Republican strategist and founder of Blue Stack Strategies. So, Maura, obviously the president has not been quiet about how he feels about Chairman Powell and the Federal Reserve's policy overall. Does that mean we can expect something explosive and just as critical when the Fed ultimately likely does not do anything to change interest rates less than 1 hour from now?
Yes, should Jerome Powell not do what Trump wants him to do, I'm sure the president will be on Truth Social and probably walk out to the nearest camera and share his unvarnished thoughts with all of us about how he feels about him. But I think I think the frustration is very clear, not only just with Jerome Powell, but with how the economy is being viewed. You're seeing Republicans obviously tout the fact that the numbers today were better than expected. But I do think that it's a similar problem to what Joe Biden and Kamala Harris had during the 24 race, was that they could tell us that the numbers were improving, but the American people did not feel it. And currently, most Americans feel as though they're financially behind. So you can't necessarily just gaslight them into saying, well, it's better than expected and things are going, So it's really important that they recognize that. And so for Trump, when he can't control something, it's better for him to have someone to point to blame, to say, well, if we had been able to lower our interest rates, the economy would be booming and you would be feeling it immediately. So it almost is a benefit to him to have this person to point to blame for people being, unhappy with the current financial situation that they're maybe facing. We're seeing that with not only grocery prices, but also housing. Individual home buyers, they can't buy a home. So bigger corporations and companies and investors are being able to scoop up what limited housing there is. That's a problem, and that in the long run, short-term also a problem, but in the long run creates even more financial strain for the American people.
Really interesting take, Maura. I'm wondering your thoughts on this, Jeannie. Do Trumponomics and Bidenomics have something in common where people don't feel so great? It's not reflected in the hard data, but people seem to know better at the kitchen table.
I think so. We did see the Wall Street Journal poll recently where the one thing that is keeping Donald Trump at least up in the polls for his overall approval rating is the economy. So his poll numbers there have not plummeted. They've plummeted on immigration, on the big, beautiful bill, on Epstein, but not yet on the economy. But if we just go back to the interest rates today, there is no question we all want interest rates to come down. Nobody, to Maura's point, wants to be paying this much on interest rates for a mortgage or a car or on credit cards. The problem is not Jerome Powell. It is Donald Trump's chaotic economic policy. And I think what we're seeing here is that Donald Trump is torn. He wants lower interest rates, and yet he has for decades been committed to this tariff fight. And even today, just hours before the Fed is meeting on interest rates, he is saying we're getting 25% on one of our closest allies, India, plus penalties for buying energy from Russia. So the only one Donald Trump has to blame for interest rates is himself. But of course, he doesn't have Joe Biden to kick around anymore. And so he has turned his fire on Jerome Powell, and it's going to stay there regardless of what Powell did today. I guarantee if they lowered him today, which they likely won't, he would still come out and eviscerate Powell for not lowering them enough.
Well, Jeannie, to your point on the president's policies perhaps leading to the interest rate policies that he is not in favor of, it's actually echoing what we heard from the ranking member of the Senate Banking Committee, Democratic Senator Elizabeth Warren on Massachusetts, on balance of power last night. This is what she told us.
There is exactly one person who is responsible for keeping those interest rates high, and that's Donald Trump. Jerome Powell said last month that he would have urged the Fed to lower interest rates last February, but for the chaos that Donald Trump has been causing over tariffs. If Donald Trump really wants to see interest rates come down, then stop creating so much chaos around tariffs.
So as we consider the uncertainty that there is around tariffs, Maura, could that actually, though, come to, in large part, an end this week? He says August 1st is it. That's final. This is the deadline. The tariffs are going into effect as expected. Is this the moment we actually get clarity, or do you think that there could be another kicking of the can?
I think that with how many countries have not come to the table and negotiated, it's going to be a big moment for Donald Trump. He knows this whole taco thing is grating on him. He doesn't like the idea that he is wishy-washy when it comes to something that, as you pointed out, he has cared about so deeply for so long. Tariffs, tariffs, tariffs. But I do think that for those who are in his cabinet and recognize that this could be really damaging to, again, we've talked for a long time about these short-term pains for the long-term gains. The amount of pain that will cause for everyday Americans who, the tax, the tariff, is going to be on the American consumer. So I do think there's going to be some negotiating that happens on August 1st, but it may be one of those things where, I mean, even with the EU saying that they're going to invest, the 600, it just, where is that really going in, and can they even do that? There may be some of those kind of other things to tout, and maybe the tariff isn't as robust as he's making it out to be. Maybe it's not the 15%. Maybe there's some sort of other conversation that gets shared about investments and things of that nature to balance out the fact that he's not going to enforce the 15%. That's, a theory that could potentially happen on Friday, but really the only person that knows how he's going to react to any of the news on Friday is Donald Trump.
Jeannie, I know you're dialed into Truth Social to see what the president is going to say after this. Typically, Jay Powell would be speaking to Wall Street. The market would be the audience, right, as he takes questions from reporters. But he knows Donald Trump is going to be watching him today. Does he need to speak to the president and deliver a stronger message following this announcement?
I think Jerome Powell, I give him credit. Under this enormous pressure and storm, he has held on. He has not been pushed out of his position. And so I do think he needs to speak to the market, to the president, certainly to the American public, based on the data, and tell them the truth. This is why we are not lowering interest rates, and this is what you can maybe expect going forward. The reality is that come Friday, if the president continues and we see tariffs go up on 160 countries around the world, 200 countries around the world, however many we haven't had deals from yet, that is going to put enormous pressure on businesses as we enter the school season, the holiday shopping season, who are working through their inventories. Prices will go up.
Jeannie Shanzano and Maura Gillespie, many thanks to you both. Great panel and a great conversation as we count down to the Fed. We'll have much more straight ahead here on Bloomberg, including special coverage of the Federal Reserve decision and announcement that starts just about 10 minutes from now. So stay here on the fastest show in politics, only on Bloomberg TV.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks hovering near records ahead of the Fed decision coming up 2 o'clock Wall Street time, 2:30. We have got Jay Powell's news conference, and our coverage begins 9 minutes from now right here on Bloomberg Television and Radio. S&P up 12, 63.83, 60.83 where we stand. We have got the S&P up by 0.2%. The Dow just about flat ahead of the Fed decision, up 10 right now, little change there. NASDAQ up 91 for the NASDAQ Composite Index, a gain of 0.4%. Our Mag 7 Index pushing higher by 0.2%. Earnings after the bell for Microsoft and Meta, both of those names higher by about 0.1%. Apple and Amazon do report tomorrow. The 10-year 4.36%, with the 2-year currently yielding 3.89%. Gold is down $26 the ounce, $32.99, down 0.8%. And West Texas Intermediate crude up 1.6%, $70.35 for a barrel of WTI. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Checking on markets with just over half hour to go until the Fed's rate decision. In the aftermath, of course, of today's stronger than expected GDP data, 3% growth, Joe, something that White House and administration officials are touting across the board. The Commerce Secretary Howard Lutnick says that Trump's economy has officially arrived. And of course, Trump himself says that kind of economy is one that could use some lower interest rates.
So 6 months is what it takes? We've been asking that when it becomes Trump data, right?
I guess second quarter, they say.
Second half of the year or something like that. Yeah, this is interesting. Kaylee, as we prepare for special coverage here on Bloomberg that will not only include the announcement on rates, the statement from the Federal Reserve, but the news conference where Donald Trump's name is going to come up a lot. And I suspect that the word tariff is going to come up a lot as well. And we wanted to spend some time with Bharat Ramamurthy, Senior Advisor for Economic Strategy at the American Economic Liberties Project, Deputy Director of the National Economic Council during the Biden administration, when we spent so much time talking about Fed independence. It's a different world we're in now, Bharat, and there are some who think that Jay Powell, just by simply holding a news conference, is a profile in courage today. How deliberate does he need to be when the issue of independence arrives at some point in this conversation?
I suspect that Chair Powell will do what he has done consistently, both during the Biden administration and the Trump administration, which is reiterate his absolute commitment to Fed independence. I don't think he's buckled an inch under President Biden, and he hasn't buckled an inch under President Trump. And I think he's been pretty data-driven when it comes to leading the Open Market Committee, and I suspect that he will reiterate that today when asked about it, which, as you said, I suspect he will be.
Well, as you point to the data-driven nature of the Federal Reserve, where, Bharat, exactly do you think this morning's data would drive them? Because, yes, 3% on the headline seems like remarkable growth, but when you look beneath the surface, what do you see?
Yeah, I think 3% is pretty misleading for a couple of reasons, right? We've gotten a huge whipsaw effect since the beginning of this year because of Trump's tariffs, where you saw a huge surge in imports in the first quarter of the year and then a huge decline in imports in the second quarter of this year, which contributed to these big changes in annualized GDP quarter by quarter. To me, what you should do is look at the 2 quarters together. And when you combine them, what you see is annualized growth of about 1.2%. And that's very low. But going into the year, people were projecting about 2% growth for the year. And so I think it's fair to say that the cost of the Trump agenda when it comes to growth has been about 1 percentage point on an annualized basis, which is very significant. Also below the headline, you see a decline in business investment, which again reflects what I think we've been seeing in the survey data of a lot of pullback in investment as businesses try to navigate and wait and see what's happening on the tariff front. Consumer spending was okay, but not very robust. There's a lot of troubling data under the hood of the GDP report, and I think that when you layer in the fact that we're likely to have a bigger impact from tariffs actually hitting prices in the second half of the year, I can see why the Fed is adopting a wait-and-see attitude.
Well, if we're seeing a slowdown here over the first half of the year, there are concerns about clearly where we're heading in the second half when the impact of tariffs finally begins to show up in the hard data here. Bharat, there's an expectation that the Fed won't cut today, but might be more likely to cut in September. Wouldn't that be the opposite?
Look, I'd be surprised if they tip their hand today. I think that they're going to want to see 2 additional months of data coming into the September meeting before deciding what to do. I just think that there's an enormous amount of uncertainty. Like, the way I see it is that you have a labor market that's been hanging in there. It's still low 4% unemployment. You're seeing some stagnation in terms of additional hiring, but you're also not seeing a lot of layoffs. So you basically have a stable labor market in decent position. Meanwhile, you have inflation, core inflation, tracking to be about 3% for the year, which is quite a bit above the Fed's target. So given the state of the labor market and the projections on inflation and data about year-ahead inflation projections from folks being quite high, I can understand why the Fed's not itching to cut. And I think they're going to want to see 2 additional months of data, especially on the impact of tariffs on prices, before deciding what to do in September.
Well, of course, the Fed is not just kind of one monolithic viewpoint either, Bharat. We are expecting that we could see some dissents today from the likes of Christopher Waller, who has suggested he's worried about what could happen to the labor market if they wait much longer. How seriously would you take dissent today, knowing that there may be a bit of jockeying to be the next Fed chairman at play as well?
Yeah, look, I think without denigrating anybody, I think that that's a factor here. There are people who are looking to position themselves as a good choice for Trump when he makes his selection to take over for Chair Powell. Look, that said, I think Governor Waller has been quite accurate and quite prescient in his projections about where the economy is going over the last couple of years. And so I don't want to diminish his viewpoint in particular. But look, I think people are trying to position themselves for Trump's choice, and obviously the president wants interest rates to come down, though ironically he's been going around talking about how the economy is absolutely booming, and as people watching the show know, that's not really a good argument for cutting rates. So he kind of wants to have it both ways.
Jay Powell will be walking into this news conference just hours after Procter & Gamble said it would be raising prices on about a quarter of its products in the U.S., Bharat. Mid-single-digit increases across categories, according to a spokesperson. What do policymakers think of a headline like that?
Well, it's concerning. You're hitting consumers where it hurts, the types of everyday goods that they're going to pick up at the grocery store, at the convenience store. We lived through it during the Biden administration. People don't like to see those types of everyday prices go up. And the way that the president has conducted tariff policy basically guarantees that those types of staples, from the things at the grocery store to the things you're going to buy at Walmart and Target, are going to go up in price. You know, how much is the question, not whether it's going to go up or not. And when you have that prospect of price increases coming in the second half of the year, which could feed through into a more sustained increase in inflation, you can understand why the Fed is adopting a wait-and-see posture. As your previous guest said, if Donald Trump had come into office and done nothing, and just sat back, not announced any of these tariffs, and just waited, the Fed likely would have cut rates multiple times by now. That was the trajectory that they're on. But all of the uncertainty that he has introduced into the economy has not only squelched business investment, it has also made it basically impossible for the Federal Reserve to cut, which has, in effect, continued to lock down the housing market because nobody wants to trade out of a 2.5% mortgage for a 7% mortgage, which means nobody's selling.
Bharat, we have less than a minute left here, but if you could ask one question of the chairman at the news conference today, what would it be?
I want to ask him, what are the 2 or 3 data points that you're most focused on over the next couple of months as you make your decision for September? You know, in the past, under the Biden administration, Chair Powell said he was very interested in inflation expectations, like you would get through the Michigan Consumer Survey and so on. That was a little bit surprising for me because there's some concerns about the validity of that data, but it was an important factor in his determination. What are the things that he's going to be looking at over the next 2 months to determine, in particular, how are tariffs feeding through to prices? Are there a couple line items that he's looking at, a couple sets of goods where he thinks the tariff effects are going to show up? To me, that's the real question, because I don't think that they're going to tip their hand as to sort of guaranteeing or strongly suggesting that they're teeing up a rate cut in September.
All right, Bharat, we appreciate you joining us here on Balance of Power. Bharat Ramamurthy, Senior Advisor for Economic Strategy at the American Economic Liberties Project and Deputy Director, of course, of the National Economic Council during the Biden administration. We'll be back for more Balance of Power at 5 p.m. Eastern Time. We'll have the aftermath, the reaction from the president to the Fed's rate decision today, and they'll break it all down for you on a special edition of Bloomberg Surveillance, The Fed Decides, which starts right after this.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live from New York City this afternoon. Good afternoon. Good afternoon. That Fed decision 27 minutes away. After that, 30 minutes later, a news conference with Chairman Powell. And one word on the minds of everyone on Wall Street: dissent, dissent, dissent.
There is the expectation for two potentially Fed governors to dissent for the first time since 1993. Of course, we're talking about Michelle Bowman as well as Chris Waller. And that would really put potentially a real question of what this does to political interference as well as the path ahead for the Federal Reserve.
It started with a single voice of Greenspan, and you know Lawrence Meyer writing about it years ago. And John, I think it's refreshing. I wish it was more like the Bank of England. I mean, you've seen fist fights at the Bank of England.
I agree with you, TK. I think it's healthy. It's a good thing if there are credible arguments to make the call. However, if you're ambitious and you would like to become the next Fed chair, is now the right time to throw your name into the hat.
This is the reason why the messaging is going to be so important, especially as we get upside surprises from a lot of economic data earlier today, the GDP data. I understand that it's a little bit complicated, so I think that we will get into that, but it raises the question, what will be the justification that now is the moment to pull the trigger, and how many more rate cuts could there be going forward?
In the last 12 hours, John, it's less of a snooze fest. You've got dollar moving, you got weaker euro, and the GDP data, Jason Furman, we'll get to it, was brilliant on this weak economy.
And equities for much of the last 2 months, up and to the right. The rally continues. Equities positive by 0.2% on the S&P 500. Stocks higher by more than 6% since this Federal Reserve last met.
Yeah, and bonds not doing that much. Coming up shortly, we're going to be talking about all of this with JP Morgan's Bob Michael, who is around the table with us. Kathy Jones of Charles Schwab and Subhadra Rajappa of SocGen. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Was there any dissent? We will discuss. Then we'll get immediate reaction from Jim Bianco of Bianco Research, Diane Swank of KPMG, and Bank of America's Aditya Bahav. And then after we get Chair Powell's news conference, we'll be talking with former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg to understand the implication of this very important Fed meeting.
Lisa, thank you. Let's get it started. Bob Michael of JP Morgan Asset Management with us around the table. Bob, good afternoon.
Happy to be here.
It's good to see you, sir. Dissent. How much dissent are you expecting, and how instructive might it be?
We expect certainly one dissent and possibly two. If we see two, I think it indicates that Chair Powell has lost a little bit of control on the FOMC. I think it's seismic. The last time there were two dissents was 250 odd meetings ago. That's 0.4% of the time. If you're going to dissent, you better be really sure you're going to be right, that you have the data and the rest of the committee is wrong. How many of us have been in investment policy meetings or corporate strategy meetings where you hash it out? And if you disagree where the consensus is going, we always say, convince everyone else to change your mind. If you can't do that, maybe actually your argument isn't as well-founded. Whatever happens, what we agree as a team, that's what we go out and say. We can always talk about this are the risks to our forecasts and expectations, but you don't go out with multiple forecasts. That's what I see with two dissents.
At the same point, they're not an investment committee, and they don't have to go out to pitch somebody an idea with the same kind of conviction that maybe a fund manager does. At a certain point, have you ever seen this wide of a spread of potential outcomes and a wide interpretation of economic data? Isn't there some sort of justification for a level of uncertainty and dissent, especially on the FOMC?
No, we've seen the great financial crisis, of course, was seismic in and of itself. We just went through COVID. We talk about the potential economic outlook is uncertain. That uncertainty has cleared up to some extent since the last meeting. We have the details of the One Big Beautiful Bill Act, and we have a lot of trade agreements in place, and we know where they're headed. So a lot of the uncertainty is past. Now, what are we going to do from a policy perspective? I think that's a different argument. And probably the best thing to do is nothing until you see the impact of either the One Big Beautiful Bill Act down the road or tariffs.
Bob, let me frame this for you. I'm sure you got a briefing from Michael Feroli in the 10 o'clock hour. Jason Furman up at Harvard says annualize the first 2 quarters. And if you do so, he's got a run rate real GDP of 1.2%. That's a Donald Trump cut interest rates economy. Did the winds tilt this morning towards the governor and towards a rate cut now?
So you brought up Mike Feroli. He's got on average 0.75% for the second half of the year. The problem is the details of the forecast. You've got core personal consumption expenditures steadily rising to an annualized rate of over 4%. And by the same token, you've got unemployment rates rising into the mid-4s.
Yeah.
That's a difficult equation for the
John,
Fed to
this
solve.
is the heart of the matter. I've never seen the equation this messy, ever.
They've got a lot of reasons to wait. 2 more payrolls reports, 2 more CPI reports. You get to September 17th. Is that enough information to make the call in a few months' time?
Absolutely not. All that's going to tell us is what we're seeing today. We haven't seen the full impact of the tariffs for a full quarter. We're talking about in a couple days, the tariffs will take hold. So you're going to see a month or two of the impact. We need to see what happens in the fourth quarter. We need more data. We think they're likely going to be on hold in September as well.
So if you have to wait until December, what is the risk out there that inflationary pressures are building? Because that would be the argument to remain on hold, that actually inflation is more of a threat than any kind of potential weakness to the labor market. So where is that coming from on a sustained level, given that a lot of consumers have really pushed back against higher prices?
Well, the June inflation data showed that we are starting to see some of the pass-through in goods inflation. We're going to see a heck of a lot more over the next couple of months. We also have an employment market where unemployment is in the low 4s. By a lot of definitions, that's full employment. That's the data today. That's not telling you that there's a lot of weakness. Yeah, we project that perhaps the labor market will continue to weaken from here because businesses are frozen until they see the full impact of tariffs on their business. But that's down the road. That's not now.
So if they were to cut, or they were to have a dovish tilt, do you expect a material sell-off in the long end of the yield curve?
I think it depends in the press conference how dovish Powell is. Certainly, the last time we saw dots, we saw 2 cuts for this year. I think he'll still reiterate that they're biased to ease, but I don't think he's going to pin himself into a corner by 1 or 2 cuts. I think he's going to reiterate they're patient, they're data dependent.
10-year yield higher 3 basis points, 435 this afternoon. What's the most compelling reason to buy that right now?
The most compelling reason is at some point they're going to bring rates down. That this is still a Fed looking for an opportunity to bring rates down. Does it happen today? Probably not. Does it happen in September? Maybe. Will it happen in December? Probably by then they'll have enough data. What's been interesting to us is how resilient the 10-year has been. We're pretty much right on top of the Fed funds rate. Every time I'm on one of your shows, we seem to be right around 440 on the 10-year. We never really go anywhere. Yeah, we go a little bit higher, a little bit lower, but we seem to wind up in the vicinity of the Fed funds rate. There's an awful lot of money looking to come into this bond market.
Take equities, bonds, currencies, commodities at JP Morgan. DXY, printing a 99 today. It's gone from -2 standard deviations to +2. For showbiz, that's a 4 standard deviation move. Resilient dollar. Muni bonds pounding the table, price down, yield up, buy muni bonds right now. What's the mix of the market here, and what does it signal to the Fed?
I think what the Fed is seeing is that there's good demand for bonds on average. There are still flows coming from overseas into the U.S. Treasury market, coming into the U.S. bond market. Now, are those flows fully taking the dollar? They started to hedge some of that out. Maybe there was a little bit of a reversal in the last couple of weeks, but they're more balanced on the currency side. When we look at the municipal market, there's been a lot of issuance before pretty much the August break. But we see a lot of money on the sidelines looking to come into the municipal market and buy it up. still, every meeting I have with our client base is about where do we get into the bond market, how do we get in, when do we get in.
Have you got a favourite show? I'm insecure. We just want some love.
I love this show.
Thank you, Bob. Appreciate that. The president might be watching. This is what he's got to say this afternoon.
I'm going to tear up.
The chairman of the Federal Reserve probably won't lower interest rates today. Don't think many of you were expecting that to happen. That decision is about 20 minutes away.
Why do the biggest names in business choose Bloomberg Television?
That's a great question. It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
I call him Too Late Powell because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He keeps the rate way up. I think it's Trump derangement syndrome. I think if Jerome Powell stepped down, it would be a great thing. He's spending $2.5 billion rebuilding the Fed. I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. He's a knucklehead. It's a tough construction job. It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out. Well, I'd love them to lower interest rates. Other than that, what can I tell you?
The President of the United States taking on the Chairman of the Federal Reserve, Chair Powell. The President speaking just moments ago saying that the Chairman probably won't lower interest rates today. Welcome to the countdown to the Fed decision on Bloomberg TV and on Bloomberg Radio. Your price action this afternoon is shaping up as follows. Equities look like this, up by 0.3% on the S&P, looking for another all-time high on the Nasdaq, up by 0.4%. Outperformance on small caps. In the bond market, 2-year, 10-year, 30-year bond yields look like this, higher this afternoon by 3 basis points. Bramo, the 10-year, 435.41.
Yeah, but it's notable to say that July 18th, the last time the Fed met, rates were 4.42% on the 10-year. So they've actually come in since the last Fed meeting on the 30-year yield, also coming into 4.9%. So not exactly this freak out the way that there was about duration, about the deficit, and about some of the other potential.
And the 10-year real yield is range bound still. We haven't broken out either way. To me, that's a big deal.
The decision at 2 p.m. Eastern Time. 30 minutes later, a news conference with Chairman Powell. Joining us now to discuss, Kathy Jones of Charles Schwab, alongside Bob Michael of JP Morgan Asset Management. Kathy, welcome to the program. Let's talk about the setup. In the statement last time around, the Federal Reserve said the labor market was solid. Governor Waller comes into this meeting, and he's making the case this labor market is on the edge. Who wins?
Well, I think in terms of the decision, the committee wins in terms of not changing policy based on the labor market yet. But I do think that when we look at the data, we're seeing evidence of a languishing labor market. I guess that might be the word to use, where there's no hiring, there's no firing, we're just kind of hanging in there. It's not a bad labor market because the overall unemployment rate is low, but it's also not showing any sort of dynamic activity, which it should show if we're in a growing economy. You combine that with the slowdown in consumer spending that we've seen in the last GDP report, and there are signs of softening. But I think the committee will look at the overall picture and just say, not yet. We're not there yet because inflation is still elevated. It's still closer to 3% than 2%, and we haven't fully felt the impact of the tariffs, and there's just not yet enough evidence for the Fed to cut.
Pretty much every morning of Fed Week, I whip out my previous copy of the statement and I look at the language and I say, what's going to change? And I was struck by the fact that last time around they said uncertainty about the economic outlook has diminished but remains elevated. Couldn't they say the same thing now? Is there anything that gives you the sense that it's less elevated now and that actually they have some economic certainty?
I wouldn't say so. This has felt like the calm between the storms. We had all the volatility earlier in the year on the tariff proposals, and things have sort of settled down. But we still have the IEEPA ruling coming up, which people don't seem to be talking about. But we have all these sort of frameworks for tariffs. But what if the ruling goes against it? What will happen to all these deals that have been set and the way the market has adjusted to the prospects of them? And then, you have the slowdown in global growth. So tariffs not only affect the U.S., but they affect the growth abroad. And I think we're seeing that with the dollar up and the euro down. Prospects for growth in Europe are hit on the tariff. So there's a lot of stuff coming that could indeed slow the economy and cause the Fed to move to cut rates in September. It's still our call, a September rate cut. I wouldn't say my confidence is sky high, but it's still our call that we get a cut in September.
Bob, this Fed Day is into tech earnings. Microsoft and Facebook. I'm not going to call it Meta, Lisa. I'm sorry. It's just
Carry
Facebook.
on this good fight.
We had wonderful earnings from Google. Is the Fed different than every other central bank because they got a bolt-on of American technology excellence? Is it just simply we've got this odd, what, John, AI is it called?
Is that what you're doing on Bloomberg Radio? Is that how advanced things are over there?
Yeah, I mean, it is.
What's going on?
I'm looking at technology, and is that the
Facebook figuring out AI?
So Tom, I think you're right. I think we forget we've been living with 10% baseline tariffs for close to 4 months now. Yeah. There are tariffs in place. The ability of corporate America to adapt to what's going on and continue to operate. We just heard Kathy talk about there's no hiring or firing. Corporate America just hit the pause button and continues to do the things that they do well and figure out where they're going to do the sourcing from and where they're going and how they're going to pass through pricing.
John, question to you. I mean, the Bank of England does not have this problem. They don't have a tech juggernaut to deal with.
Well, Europe doesn't have that problem either, or rather Europe would like to have that problem because Europe doesn't have those big names.
Yeah.
And Europe would love to have those big names. I think that's what we're talking about here.
Yeah.
I think. And that's been an issue for a while.
Which is the reason why the resilience in the U.S. economic data raises a question, when will they know enough that inflationary pressures aren't significant enough for them to start easing more materially?
Let's bring in Subhadra Japa of SocGen to try and make sense of all of this. Subhadra, welcome to the program. Let's talk about this Federal Reserve decision about 10 minutes away. The chairman of the Federal Reserve under a ton of pressure to reduce interest rates, the pressure coming from the President of the United States. Does this chairman have the luxury of waiting?
Actually, I think he does, especially given the fact that we did get a very strong GDP print for the second quarter. Today's ADP print also shows that private sector job creation is not probably as bad as it seemed in the last ADP print. So I think that they do have the luxury to wait. The question is for how long? I mean, the market's pricing in still 2 cuts for this year. I think September is still very much in play because we have 2 more jobs reports as well as 2 more inflation prints to digest before the September meeting. And if you start seeing cracks in the job market, I mean, as Kathy pointed out, I mean, the job market is basically in stasis. And the only way I think it's potentially likely to go is deteriorate. Under those circumstances, I think the Fed is going to be in a position where they're going to need to act quickly. And the question really is that, are they going to act preemptively, or are they going to wait to get more data before they act?
When will they know that they actually have enough data to act, Subhadra? And this is something that John's been saying for quite a while. What I find compelling is this is coming at a time where there is increasing market expectation that the Fed is going to cut in September. And now we've got President Trump speaking at an event saying, I hear that the Fed will cut in September.
Actually, that would be my question to Chair Powell if I had to ask him a question, because, to me, it feels like, they're waiting for a feed-through from tariffs into inflation. It's not clear how long that's going to take. They're waiting potentially for a further deterioration in the job market. Again, it's not clear to me that that's imminent. So the question is, what sort of data points need to line up for them to be comfortable cutting rates? My personal take is that I think if inflation stays, say, between 2.5% to 3%, and the job market starts to deteriorate, I think then they're going to act quite quickly to ease policy.
Kathy Jones, will we see that on Friday? I mean, carry it right forward to the jobs day on Friday. I don't see the unemployment rate cracking yet, although a lot of people are modeling out 6 months, 12 months out. You'll finally see that.
Yeah, I don't think this Friday's number will probably be that weak, although predicting the non-farm payroll number is, a fool's errand these days. But nonetheless, there are no signs that it's ready to fall off a cliff. But if the trend is towards deterioration and weakness under the surface, which is what we are seeing in some of the data, then I think that the Fed, I think Subhadra's right, that as we get closer to the September meeting, if we have a couple of months deterioration in the pace of growth in jobs and no big move up in wages, then I think that sets the stage for the Fed to say, okay, we don't need this so-called restrictive policy anymore. We can move somewhere closer to neutral. I don't know where neutral is or what they consider neutral, but they have described current policy as restrictive.
The guesses for Friday are amazing. If you haven't seen the guesses for Friday, here's a sneak peek. The high is 170, the low is 0. 0. Stephen Stanley, Santander. That's how wide the range of estimates is going into the payrolls report.
Even wider is how to interpret those estimates, because on one hand, Stephen Stanley was here and still saying that he doesn't think they're going to cut this today, and he thinks there's a possibility they don't cut in September because of all of the distortive effects. How do you get conviction around policy when you have ramifications from bringing trade forward and then pushing it out that completely distorts data that a lot of people rely on?
So this is the issue, Subhadra. Bob was talking about this earlier. Is 2 CPI reports between now and the September meeting enough? Is 2 payrolls report between now and a September meeting enough to draw any conclusions whatsoever?
I think it is because of the fact that you have an aggregation of data for the year, which has been suggesting that there's a steady economy, resilient economy, but a gradual deterioration. You also have a haves and have-nots economy where the top half is doing better and the bottom half is not. The question really becomes, when do they start paying attention to the signals that they're getting on that's going to stimulate the bottom half of the economy, cut interest rates, perhaps try to stimulate the mortgage market a little bit, alleviate some of the stresses on credit card as well as student loan delinquencies. So I think lower interest rates will help all of the interest rate sensitive sectors of the economy. The question is, when do they actually act and how quickly do they need to react to a slowdown in that sector of the economy?
Well, Bob, to that point, there's this argument that a lot of people in the lower income sphere tend to borrow short. It's not necessarily the mortgage market that's borrowing long, but they borrow credit card loans, they borrow auto loans, they borrow other types of short-term instruments. Wouldn't there be a pretty big boost for these individuals if you did cut rates by 25 or 50 basis points that wouldn't necessarily be that inflationary, but that could really equalize some of what we're seeing in the income sphere?
Absolutely. We spend a lot of time looking at the securitizations of short borrowings, and what surprised us this week is how well they're performing. And when we talk to the originators of those loans, they're telling us that the borrowers are confident, that they are already starting to price in the benefits of the One Big Beautiful Bill Act. We looked everywhere to find stress in the consumer, and it's not there. I'm also going to give you another very good reason why there don't need to be two dissents today, and the Fed doesn't need to do anything. They get a do-over. They get Jackson Hole a month from now. So they'll have another month of data. They can look at things, and if they want to reposition themselves, they can go back to Waller and Bowman and say, wait until then. I promise I'll go on stage and say we're biased to cutting rates.
Subhadra, the most important single line I saw today was from the Mag 7 company, Hershey's Chocolate, at the Abramowitz house. Trust me, it's a Mag 7 company. Their tariff estimate was shocking. Is the thing that we're going to see for the Fed coming up is company after company after company beginning to account for tariffs?
That is a big concern. You're starting to see a creep up, especially in inflation expectations. You look at, the 10-year break-evens are starting to climb. 5-year forward, 5-year inflation break-evens are starting to climb. So you are seeing the feed-through from tariffs into the economy ever so slowly, even though tariff rates have been a little bit volatile. The concern for me is that if we start heading towards, say, 15% or 20% universal tariff rate, that might actually start becoming quite impactful. And especially if inflation expectations get a bit unhinged, then I think that's something that is going to also be difficult in an environment like that for the Fed to cut rates.
Subhadra, we've got to let you go. I know that. Appreciate your time. Subhadra Rajappa there of SocGen, Kathy Jones of Charles Schwab, with the decision only 2 minutes away. And just for the record, chocolate snobs around this table, right? Yes.
Are you looking at me?
Yes, absolutely.
Okay, fine. Tom said that my household is the single, behemoth holding up Hershey's. And I will just point out, Hershey's milk chocolate typically contains about 11% cocoa, and typically I like a little bit higher.
You're more of a 60% kind of person, 70?
65, 70.
Yeah.
I enjoy that. I enjoy the actual taste of chocolate.
TK was projecting, I think.
What do you think so?
Much more of a Hershey's kind of guy.
You like 11%?
I'm a Hershey's kind of guy.
Hershey's
I learned that from Mike Nicklock a few years ago.
Hershey Hugs?
He was a hockey player for the Hershey Bears.
Got any more brands out there? You got the list of them?
John,
ready to go?
We're really close to that decision. 1 minute away.
The tariffs
Let's go.
from Hershey's were jaw.
You're trying to keep us in line.
No, the tariffs. Bob, help me here. This is a real deal. These tariffs coming in here is a revenue gain for the country. They're beginning to add up.
They are. They're going to be trillions of dollars. All you have to do is look at the CBO scoring methodology, and it almost perfectly offsets the incremental spend of the One Big Beautiful Bill Act.
Bob Michael is going to be sticking with us. The decision is about 30 seconds away. So here's the setup. Most people, no, almost everyone, expects no change in monetary policy in about 30 seconds' time. However, there are some people who are expecting some dissent. One governor may be, if you get two governors, it will be the first dissent against the chairman, going all the way back to 1993. The decision, moments away. Equities are positive by 0.25% on the S&P 500. On the NASDAQ 100, up by 0.4. On the Russell, up by 0.9. That decision seconds away. 30 minutes later, Chairman Powell. For now, let's cross over to Mike McKee.
No rate moves, 2 dissents as anticipated, and no future guidance. The benchmark rate remains in a range of 4.25% to 4.5%, even though policymakers say that economic growth moderated in the first half of the year as, quote, swings in net exports continue to affect the data. Uncertainty about the economic outlook remains elevated, their statement says. They dropped the suggestion in the last statement that it had diminished. But there are no hints about future moves. September is not mentioned in the statement. There's no change in their line about carefully assessing data, the outlook, and the balance of risks in considering the extent and timing of additional adjustments to the target range. At the moment, labor market conditions remain solid and inflation remains somewhat elevated. Those were the characterizations used in the last statement. As anticipated, Governors Chris Waller and Mickey Bowman dissented the first time, as John mentioned. that 2 governors voted against a committee decision since 1993. They preferred a 0.25 percentage point cut. Governor Adriana Kugler did not attend the meetings or vote on policy. The Fed says she is attending to a personal matter. Guys?
Mike McKee, appreciate it. Fantastic breakdown, as always. As expected by many of you, policy unchanged. 2 dissents, 2 governors, as Mike repeated, the first time since 1993. In the first paragraph of the statement, the committee says the labour market remains solid. This is the issue that Governor Waller has with the labour market and that kind of communication and language. When he made the case to cut interest rates in the last few weeks, he thinks this is a labour market on the edge. Ultimately, at this meeting, he failed to convince the rest of the committee to go with him.
Although he did get another Fed governor, and I am curious to see what their justification is, especially after the ADP report, the better-than-expected GDP print, a whole host of other economic data points that have come out, as well as earnings that have continued to surprise to the upside more frequently than not. This is going to be very much an emphasis on why from their perspective.
I don't agree with the 3% statistic today. I think we're at 1.2% domestic final sales. I love what Jason Furman did with a 6-month moving average, and you mentioned Bob Michael. Feroli's at a 0.75 forward. I think the numbers are soggy. They were Trump-affilic numbers.
Let's look at the market. Equity is still positive, but fading, up by 0.2% on the S&P 500. In the bond market, yields just a little bit higher. Look across the curve on a 10-year up by 2, on a 30-year up by 3. The price action could get mixed up in about 28 minutes' time when we get this news conference with Chairman Powell. With us around the table, Bob Michael of JP Morgan Asset Management. And Bob, I want to come to you first, because ahead of this decision, you weren't just banning away those 2 dissents that could come on this committee. You said they were important. Why are these 2 dissents important this afternoon?
It's got my attention for sure. If I go back to December 1993, you had Wayne Angel and Larry Lindsay dissented. They thought policy was too accommodative. You know what? They were right. In January, the Fed came in and started a year-long doubling of the Fed funds rate. When I look at Waller and Bowman dissenting, they're seeing something that's meaningful enough for them to be the first Fed with 2 dissenters in over 30 years. You have to pay attention to that.
It's going to be really compelling to see how Fed Chair Jay Powell messages this afternoon in about 30 minutes' time when he gets to that podium. Yeah. What are you expecting him to say to explain why they were unable to convince the rest of the committee and whether he has lost control over the majority of the thought?
Well, I think he likes to be a consensus builder, so I expect at the press conference he'll try to close the gap and say there wasn't much disagreement in actuality, that if you look at the last summary of economic projections, we had 2 rate cuts in there going into year end. The timing of that was always uncertain. We had a couple governors who felt maybe we should be pulling it a little bit forward. The rest of the committee thought we needed to see a little bit more data, but we're all on board with a rate cut or 2 before year end.
This just in from Neil Data of Renmac. Waller and Bowman dissenting tells you the FOMC will eventually move in the direction of the dissenters. Let's extend the conversation. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the program. Just first of all, your reaction to the statement and the dissent of the FOMC.
The statement and the dissents, I think, were as expected. There's really not a whole lot to be surprised about it. Maybe that Mickey Bowman did it, but I'm not shocked that she did at this point. Waller, I think, is going to have an interesting case to be made when the blackout is lifted on Friday as to why this is not an audition to succeed Jay Powell and as opposed to being an economic case to really cut rates.
You said that you're less surprised about Mickey Bowman and that actually that's less of a preeminent concern for you, and yet she was the dissenter last September when the FOMC did cut rates, and she said she didn't think that they should. Does this seem a bit like an about-face when it comes to her approach to monetary policy?
It might be. It might be in terms of the way that she's been looking at the economy lately, and it's been a bit, in at least my read, somewhat inconsistent, but not a whole lot. And so, yeah, it does kind of have that feel that it's an about face.
Jim, you're a trophy taken. You were one of the first ones there saying inflation, sustained inflation, we're not getting a disinflationary vector. I want you to revisit that right now, given 2 dissents, given the understanding of a slowing economy. Are we still going to see persistent inflation?
I think we are. I've been using the case that whenever you have a recession or a financial crisis, and we had both in 2020, that the economy fundamentally changes. And if you want examples of that, deglobalization and remote work are probably top of the list. This is not the 2019 economy. I know Chairman Powell likes to say that we see broad signs that the economy is normalizing or returning to pre-pandemic levels. That's another cycle. We're in a different cycle right now. And this is a cycle of elevated inflation. I think that the inflation rate is going to run around 3%, maybe as high as 4%. But I like to caution that I did not say 8-10 or Zimbabwe inflation. And with that type of level of inflation, and that's largely what we've seen, we've averaged over 4% in the last 5 years on the inflation rate, that the appropriate level for the funds rate is about where it is now. And the Fed should not be talking about cutting rates when you've got all-time highs in the stock market, in housing, in crypto, all the way down the line. I don't know what problem they're trying to solve that they think that they need to give us easier money.
Add on to that, Bob Michael, as you can. Synthesize all of J.P. Morgan about the nation's productivity, our technology overlay, and the persistency of inflation Mr. Bianco talks about.
Yeah, I think Jim's on to something, and if I were on the Fed, I'd be worried that corporate America is bottoming in here. They're learning how to absorb tariff policy, so they're pausing on a lot of things. But once we get through this year and head into next year, they'll start spending again, and we'll be left with a labor market that has unemployment, call it in the mid-4s, but we don't have the immigration coming in. So now you've got a labor market with unemployment in the mid-4s, corporate America starting to pick up a little steam again and starting to hire, and you're back to tightness in the labor market. So I understand where Jim is coming from. It's something that I worry a lot about. We'll see what happens over the next couple of quarters.
Based on the conversation you guys are having, though, the Federal Reserve's got a problem. Because the way the Fed has communicated under Chairman Powell over the past few months is that the only reason they're not reducing interest rates is because of the tariffs. He's not talking about any of the things that you're talking about.
Yeah, and it's good cover for now to say tariff policy is one of these transitory inflation impulses. That's probably true unless it becomes embedded in wages, unless we get into the first half of next year and we find out the labor pool is actually tighter than we thought, and without the immigration inflow, suddenly existing workers demand higher wages. That's a wage price spiral I would worry about. That's putting a lot of horses and carts in front of each other right now. I get it. But it's also a good reason for the Fed not to rush to cut rates right
So,
now.
Jim, you were taking us there. I just want to squeeze in a final question with you, sir. Just how messy this September meeting might be. It might be easy to get through this one. But when you get to September, how much of a mess will it be in a few months' time?
I think it could be a big mess. I think that the data is not going to be consistent for the Fed, what they're going to be looking at. There's an argument to be made that there's a residual seasonality in CPI data that's going to show up in the second half of the year and push it higher. That will give them pause to want to cut rates. I think that the president, again, within the last hour, has pretty much laid on the law that he expects them to cut rates in September, or he might wind up having to take action himself, whether or not that's appointing another chairman to replace Powell or to actually consider firing him. So this is going to be like the last, quiet meeting. I think when we get to September, it's going to be a much different ballgame.
Hey, Jim, thank you, sir. Jim Bianco there of Bianco Research. Thank you very much. Reacting to the Fed decision just moments ago. Policy unchanged as widely expected. 2 dissents from 2 Fed governors for the first time since 1993. As Jim just said, this meeting could be the easy one. The next one gets a whole lot harder.
All of a sudden, you're expecting to see that inflationary impact from the tariffs that will trickle through in a more meaningful way. A lot of analysts saying you just have to wait until the third quarter and fourth quarter to start seeing that, because Hershey's is getting more expensive as they expect tariffs to roll through. This really is the question. If you're not seeing significant weakness in the labor market, how do they justify it?
The news conference, 20 minutes away. Diane Swanker, KPMG, joins us now for more. Diane, welcome to the program. How is Chairman Powell going to navigate this one?
Well, I think one of the key issues that we haven't talked about yet is the implied PCE index, which the Fed targets, which was in this data today. And that suggests what was in the data today suggests before revisions, we could see an 0.5% core and overall PCE index, the highest core PCE index at 2.9% since March of 2024. That is not a number the Federal Reserve wants to see, and that's ahead of the full effects of tariffs kicking in, which takes 6 to 18 months. And so we're going to start to see more of that tariff-related inflation. The inflation, by the way, today, the acceleration was in both goods and services. That is also worrisome for the Federal Reserve because it suggests that perhaps there may be some contagion from tariff inflation from goods tariff inflation into service sector inflation. And that is exactly what those who are most hawkish on the Fed are worried about. And that's the data we're going to get tomorrow morning. But it's in this data release that we got today.
Diane, I'm watching the long end of the yield curve, and I'm wondering how much the bond market is going to start to worry about a pickup in inflation on the back end of some sort of rate-cutting cycle. You're not really seeing it in any kind of massive way. It is early days. We haven't gotten the press conference. How closely are you watching that indicator for a repeat of what we saw last year, if there is this dovish tilt in the expectation of several rate cuts for the remainder of 2025?
Well, first of all, I think Chairman Powell is going to be very cautious on all meetings are live. We'll take the data as it comes in. We're wait and seeing, but he's not trying to do forward guidance here. That doesn't mean he won't say the meeting still could be live in September, because it could be live in September. He may not have enough information to telegraph that at the Jackson Hole Symposium, but the bottom line is he will be saying that all meetings are live. That doesn't mean the Fed will be cutting in September, and we actually don't think they'll be able to cut in September unless you see a very much larger deterioration in overall labor market conditions. We agree with the economy has slowed. Domestic demand has slowed. The economy is slowing as inflation's picking up. That is that stagflationary kind of environment that the overwhelming majority of the Fed has been expecting, and what they're waiting to see is which effects are larger ultimately. Waller still feels the margin of error is very narrow for the labor market. I can have sympathy and empathy for that point because, listen, hiring and the pace of hiring, the pace of quits, they're below 2019 levels. They're consistent with much higher unemployment rates. But as Bob mentioned, we have curbs on immigration that are going to kick in and create pockets of labor market shortages at the same time as we get into 2026. That's a very hard situation for the Federal Reserve, and the threat of a more persistent and pernicious bout of inflation, and why we don't have the Fed cutting until the end of the year.
Diane, just on these dissents, how convinced are you that these are credible economic arguments and not just auditions for the chairman's job?
I actually think Waller is a very credible economist. And certainly there's a lot of politics at play here, but I think he's really sincerely worried about the strength of the economy. You can hear it in the cadence of his voice. I've spoken with governors of the Federal Reserve. I think he's very, very concerned about where the labor market is, and he has some credibility within the Federal Reserve Board of Governors because he looked at the overshoot on job openings and said we can get a soft landing out of this, and now we're on the flip side of that where he's saying, listen, the labor market stuff is saying that it could be much weaker, and demand has weakened. The question is whether or not, I don't think it's a one-time bump, and I don't agree with him on that, but we won't know until we get there. And that's where the uncertainty within the Fed is, and I think it's interesting that uncertainty came back into the statement as well.
You'll have to forgive me for following up, but the obvious response to what you just said, Diane, all of those nice things about Waller, nothing about Governor Bowman. Why not?
Governor Bowman is more on the vice chair of supervision. She's not as much an economist. She doesn't carry the same weight on her economic analysis as Chris Waller does. It's just plain and simple. Not going to get into the game of politics on this one because I think, frankly, that's not a useful place for the Fed to be, nor anyone commenting on the Fed at this point in time.
I had to ask. A diplomatic response, no doubt. Diane, stay close. I want to bring Mike McKee back into the conversation. Mike, you've had a second look at the statement as you go into this news conference in 15 minutes' time. Mike, I imagine you're starting to think about questions to ask the chairman. What kind of questions do you want answered this afternoon?
Well, I think one of the most important questions, John, is going to be whether anybody else on the committee, even if they did not vote or did not vote to dissent, agreed with the Waller and Bowman position. Is there more of a move in the Fed towards a cut than we had seen? We also want to know more about what they're thinking in terms of the bigger danger. Is it unemployment at this point? Is it the labor market? Or is it inflation? They were very sort of anodyne, not changing much their analysis of either one this time. The big picture that we're missing right now is the labor market, because it's still, as they say, solid, but that's backward-looking data. We don't get the latest until Friday. The inflation numbers, as Diane mentioned, we can also already pretty much calculate, and we know it's going up. The GDP numbers today, one question is, the business spending numbers were dismal, but was that because companies are sitting on their hands waiting for tariff decisions, or is that because they've decided now that they're going to pull back because the economy is slowing down? A lot of unanswered questions. I'm not sure how many Jay Powell can give us answers to, but those are the kind of things we might see in the press conference.
Mike McKee, thank you, sir. We'll let you run. Mike McKee there with the breakdown of the Fed decision. The objective of Chairman Powell has to be to make this boring. This should be boring. And as someone said to us earlier on this morning, if the most entertaining thing about this is 2 dissents, then this is a boring meeting at the Federal Reserve.
There is not going to be anything boring about this press conference, because Fed Chair Jay Powell has to message why this committee that has been noted for its consensus suddenly is breaking apart, and why people believe that there is a shadow Fed, effectively, a shadow Fed chair in the likes of Chris Waller. Interesting, the Mickey Bowman comments. I'm not going to go there, but there is this question of whether Chris Waller is being taken more credibly and whether people are going to hear what he has to say more directly.
I think Diane handled that perfectly.
She was beautiful.
Absolutely perfectly. Neil Dutter's much more fiery. He writes this: using tariffs to absolve yourself of doing anything is downright pathetic. So Diane, naturally, I've got to ask you whether you think it's downright pathetic, and whether you do think they're using tariffs to absolve themselves from doing nothing.
I think tariffs are an unknown. The rollout has been uneven. There's more of them coming on Friday. We know the effective tariff rate is lower than it actually should be right now, and that's because firms are using bonded warehouses and free trade zones to not have to pay the upfront costs of tariffs. But over time, we're starting to hit a tipping point, and that's what you're seeing in the Fed's Beige Book. That's what you're seeing in their surveys. They're seeing that the effects are starting to come in, and coming off the heels of the pandemic-induced inflation, which, frankly, we have yet to fully bring down. That is important as well, because that proximity, as Jim pointed out earlier in the show, this is a different environment than it was in 2019. And that proximity to that inflation that is still with us from the pandemic, that's important.
Diane, give us the dynamic of our nominal GDP, our animal spirit. You mentioned stagflation, but if I got real GDP coming down, I don't know what inflation's going to do. Do you just assume a more dampened nominal GDP? Is that the heart of the matter, like the crater in fixed investment that Mike McKee talked about this morning?
So, yeah, what we have is the overall economy basically moving sideways in the second half of the year, not much more than that. That's slower than the first half, but not a lot slower than the first half. This is a major slowdown in the overall economy as it deals with the disruptions due to tariffs, among other things. It's been destabilizing. There's an uncertainty factor. If we get more certainty, we should get more investment as interest rates finally do come down in 2026, and you do get some of the stimulus from the One Big Beautiful Bill Act coming into the economy. Those things we know are out there, but it really is the second half of this year has a lot more headwinds than the first half did, and the first half was not insignificant given all of the hot air we've seen on tariffs.
Diane, appreciate your time, as always. Diane Swank there, KPMG, on a breakdown of the U.S. economy and what to look for from the Federal Reserve Chair, who speaks in about 10 minutes' time. If you are just joining us, welcome to the program. So 20 minutes ago, the Federal Reserve and Chairman Powell leaving interest rates unchanged. 2 votes to cut interest rates came from 2 Fed governors. As we've said repeatedly, the first time going all the way back to the early 1990s. Some acceptance in the statement that growth has moderated, though they still believe the labour market remains solid. On that labour market, some data still to come. This is the runway going into the Federal Reserve's next meeting. That meeting on September 17th. Payrolls, August 1, September 5th. CPI, August 12th, September 11th. In between, Jackson Hole, August 22nd. And Bob, you've said repeatedly that maybe Jackson Hole is the opportunity to have a little bit of a reset. Do you think that's still the case?
I think so. I'm still surprised that there were 2 dissents. Not totally surprised, but I would have thought with Jackson Hole a month away, you could have gotten Bowman back in the tent with everyone else and just gone with 1 dissent. That would have been okay. I think this is a very important historic Fed meeting.
Well, let's get to the nature of that dissent. Governor Waller articulated this pretty clearly in his last speech. It was quite literally called making the case to cut interest rates. And in that speech, he talked about not just the labour market, saying it's on edge, but also on inflation, that a large share of tariff increases won't be passed through to the consumer, plus any increase would fade over the next year or so. What is it about that argument this afternoon that's just unconvincing to the rest of the committee?
Well, I think Diane actually phrased it pretty well. We're all expecting some level of stagflation in the second half of the year, but we don't know the magnitude or shape of it. We don't know if it's going to be more stag than inflation or more inflation than stag. And until you see that, why go ahead and start changing monetary policy now? You've got corporate America kind of where you want them. They've paused. They look healthy. When we look at second quarter bank earnings, they actually release credit reserves into the system. There's a lot of money sloshing around the system. You look at M2, it's over $22 trillion. The reason for the Fed to start guessing 3 to 4 steps ahead to bring rates down today just doesn't make sense to me.
Aditya Bave of Bank of America agrees with you. He joins us now. Aditya, welcome to the program. You've got no cuts for 2025, no cuts at all, and you're not alone. So just articulate the reason why and whether this afternoon's communication ultimately just reinforces your view.
Good afternoon. Thank you for having me on. So I think at the core of our view is what's going on with inflation, and there's this endless debate about the effect of tariffs, but let's not forget where underlying inflation is. This does not get talked about enough. In the last 18 quarters since 2021, how many times have we been below 2% Q-over-Q annualized on the core PCE? Never. In the last 18 quarters, how many times have we been below 2.5? Just 3 times, and most of that was used cars. So underlying inflation for us is stuck at 2.5%. So even if Waller's right that the tariffs really aren't that big a deal, you still have an inflation problem, and I think the Fed is not still appreciating that enough.
Although you look at, for say, housing, which is a huge component into CPI, Aditya, and prices are actually coming down in a growing number of jurisdictions around the United States. What's to say that there isn't this one-time price pop in particularly consumer goods that will fade, and you also will have disinflationary forces coming down the pike that have really been anchoring a lot of the inflation rates we've been getting?
So per our math, if housing inflation goes back to 3% year over year, which would actually be below where it was before the pandemic, that would take about 20 basis points off of the core PCE, which is why I'm saying that we're trending at 2.5 rather than 2.7%, which is where the rate was as of May. So I still think 2.5, 2.4% is roughly where you're trending, and that's a big overshoot. It's not a small overshoot. That's part of the story, and then the other part of the story is just the resilience of the labor market. Of course, if the unemployment rate goes to 4.5% or higher, they will cut rates. I think that's pretty clear. But we're just not seeing that evidence of increasing slack in the labor market.
Given that, Aditya, does it concern you that there were 2 dissents by governors for the first time going back to 1993 amid a pretty heated political environment for the Fed?
The reality is that this is a very divided committee, and I'm sure Chair Powell understands that, but that cuts both ways. Let's say he were to capitulate to the dovish dissents and cut in September without seeing signs of weakness in the labor market, there would very likely be dissents in the other direction. There were 7 FOMC members who did not want to cut rates at all this year in June, right? And I would say that the balance of data since then has been hawkish.
Bob, what's the 10-year going to do through the rest of the year? You take the summation of what we've blathered on about for the last hour. What's the 10-year yield going to do for the rest of the year?
When in doubt, 440. I think we're in a trading range.
Is that stability good for the economy? It must be.
It's really good because it's pretty much flat to the Fed funds rate where you are today. Right. So there's some relief in housing because of that. And I know the housing market has slowed down a lot, but imagine if you had a normally shaped yield curve once the Fed paused cutting rates, and you were up over 5% on the 10-year where mortgage rates would
We
be.
have parts of America where it is an absolute boom economy. I mean, I was looking north of New York City this week in Bronxville. It's insane up there. Absolutely insane. So I don't, I get it. It's slow in Kansas City. I'm not sure it's slow around New York City. If you sum to the September meeting or Bank of America saying there'll be no rate cuts, what will be that tension then in the December meeting? It'll be historic.
I think what we're going to see is the effective tariff rate settle closer to 20% than 10 to 15%.
So back to 1933 or even further back?
And a few months ago, we were in that 10 to 15% effective tariff rate. Now we're in the 18 to 20%. That is going to hit corporate America. It is going to hit pricing to the consumer. There will be some pullback on spending, and corporate America will respond to that doing what they always do, reduce their flexible cost, which is labor. So I think all of that is yet to come, and that's what the Fed will be responding to over year-end.
Aditya Bhavev, Bank of America, still with us. Aditya, just before you go, just squeeze in a question on the labour market. We get payrolls on Friday. I went through the range of estimates from 170 at the high end to 0 at the low end. Aditya, what are you and the team looking for, and why?
We're at 60,000 on the headline, but we're at 85,000 on private, and I think that is much more important. What happens with the headline will be a function of how much payback we get for state and local education from the POP in June, right? So set that aside, 85,000 on private. It's still a little bit below consensus, but it's an acceleration relative to June, and most importantly, the unemployment rate. Where will that land? We have that at 4.2%. That's what tells you what the balance is between supply and demand in the labor market. 4.2 or lower, I think, is just fine from the Fed's perspective. If you go to 4.3 or higher, they would get more concerned.
Aditya, we'll let you run. We'll let you get back to it. Appreciate your time, sir. Aditya Bhavev there of Bank of America. Fed decision behind us, news conference still in front of us. That news conference starts in about 2 minutes' time. I think we've all got a lot of questions for Chairman Powell.
Yeah, what would it take for them to have enough confidence to cut rates at a time when you have a lot of economists, including 2 Fed governors, calling for that to happen right now? What is the concern about some sort of tariff-related inflation making it that much more difficult in September, even if, in the longer term, this is a one-time price shock?
Aren't we all expecting that? Firmer goods prices through the next several months?
The key will be, what is the consumer tolerance to that? If you see weakening and sort of the stag and the inflation that Bob was talking about, if you see more of the stag, in addition to the inflation, that will make them feel more confident in cutting rates.
So, Bob, of those 2 reports, jobs versus CPI, if I could say to you, I'll give you them right now, you can have the 2 CPI reports or the 2 payrolls reports. What's more important?
I'd take the 2 CPI reports because that's what we're going to see first. We're going to see the impact of tariffs on pricing. Later, you'll see whether consumers accept that and then how businesses respond to that, either consistent demand or fall off in demand. But it's going to be pricing first.
Can I ask you, do you put equal emphasis on both services prices and goods prices, or do you overweight one versus the other?
No, you have to look at both, and you have to see if there's some offset. I think the goods prices are what everyone's focused on now.
In about 60 seconds' time, the chairman walks through that door, he'll stand in front of that podium, and he'll make some comments for the next 60 minutes and face a ton of questions about why they didn't cut interest rates today, how he's handling the dissent. Then Mike McKee puts his hand up, and Bob slipped him an email. What do you want Mike McKee to ask this afternoon?
I think you have to nail him on inflation. If they're so sure that the impact from tariffs on inflation will be transitory, and he said that in the past, why not go ahead and start bringing rates down, 25 basis points or so? Go with the 2 dissenters. 30-odd years ago, the 2 dissenters proved to be right.
Bob Michael of JP Morgan Asset Management. Bob, thank you, sir. Appreciate
Happy to be
it.
here.
Solid question for the chairman in a few minutes' time.
Yeah, and if CPI is the most important, you aren't going to see the consumer tolerance to it for quite a while. Well, that kind of sets up a chicken and an egg, and you don't get either of them in time.
Bob Michael should be in the press conference. The wow statistic today is JP Morgan with a modeled 18% tariff rate. That changes this entire dialogue.
There is a question as to whether we've seen the test just yet. Peter Chiv Academy is making the argument that we haven't had about the tariff test. All of that pre-tariff inventory that we've been working our way through, the fact that it's been escalating slowly, and maybe by the time we get to September, that test is a whole lot bigger. Here's the Federal Reserve Chairman Jay Powell stepping in front of the podium for today's meeting.
Remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve. Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So, at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again.
There have been several deals that have been struck, and now we seem to have an idea what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't. That you're right. That's what it says, and that may well. I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market? So
let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. we're going to be, at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean I wouldn't insist upon that. But I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria. Hi, Victoria Guido with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president.